The U.S. military Central Command forces conduct self-defense strikes on Iran's Qasem Island and defeated multiple Iranian missiles and drones as regional allies Kuwait and Bahrain report attacks. U.S. Secretary of State Marco Rubio says U.S. will not lift sanctions on Iran in exchange for reopening of Strait of Hormuz. Stocks on Wall Street closed Tuesday's trading session modestly higher as risk appetite driven by AI fervor was counterbalanced by tensions arising from US-Iran talks to reopen Strait of Hormuz and end months of long war. Markets in the Asia-Pacific region trade mixed on account of news flow coming in from West Asia. Japan's Nikkei index hits a record high, while GIFT Nifty is indicating a gap downside for the Indian market. Brent crude prices rise towards $98 per barrel, gaining for a third straight session as uncertainty surrounding the US-Iran peace talks kept the geopolitical risk premium in oil markets. While gold prices ease as stronger than expected US labor market data reinforced expectations that the Fed may keep interest rates elevated for an extended period. The Reserve Bank of India's three-day monetary policy meeting begins today. CNBC TV 18 Citizen Monetary Policy Committee votes unanimously for a status quo amidst geopolitical tension and adverse monsoon forecast. The rate decision will be announced on 5th of June, that is Friday. Hello, good morning. You've tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala. Thank you so much, as always, for tuning in to CNBC TV 18. Now, in terms of the markets, yesterday we saw a very good day in terms of recovery for the Nifty, right? In the second half of the trading session, what a strong recovery that came in for the Nifty 50. What we saw in the US markets, that US markets also managed to close with some modest gains. But today, the Nifty implied open is indicating again a gap down start for the Indian markets. Now, whether we recover again today will be key to watch out for. But in terms of the uncertainty for the US-Iran war, that's continuing. So Asian markets also, when we're looking at it, a bit of a mixed opening is what we're seeing coming in. Taiwan index is holding on to very strong gains of 1.8%. Hang Seng, on the other hand, is down almost 1%. We have Nikkei, that's doing well again. 2% uptake. It's almost near those high levels for the Nikkei, that's the Japanese index. Record high levels over there. ASX 200 is holding on to gains. Shanghai is holding on to gains of 2/10 to 3/10% as well. So slightly bit mixed opening. But as of now, today, again, Indian markets, as of now, Nifty implied open seems like we're going to see a red start for us. But we'll watch out for whether that sees a recovery. Now, let's go on to that update that's coming from West Asia, right, which is keeping the markets on their toes. The United States military's Central Command said that its forces conducted a self-defense strike on Iran's Qasem Island and defeated multiple Iranian missiles and drones as civilian vessels and regional allies Kuwait and Bahrain came under attack. Meanwhile, U.S. Secretary of State Marco Rubio said that Washington will not lift sanctions on Iran in return for reopening the Strait of Hormuz, noting that any economic relief depends on Tehran surrendering its enriched uranium stockpiles. Listen in.
Iran is being sanctioned because they've highly enriched uranium. Iran is being sanctioned because of their nuclear activities. If they agree to give up those things, there will be sanctions relief associated with their commitment and compliance with those agreements.
You will not give sanctions relief just in exchange for reopening the strait.
No, that's not been discussed. That's not been offered.
Moving on, International Energy Agency's head, Fatih Birol, has warned that the oil market could enter a red zone if the Strait of Hormuz does not open unconditionally by June. In an exclusive conversation with Shireen Band, he said that the oil market will continue to be rocky and volatile even after the war ends. When asked if the IEA was considering releasing another tranche of emergency release, the IEA said, not there yet. Listen to what more he had to say.
I think it is rather naive to expect that the Qatar LNG terminals will go back very quickly where they were just before the war. So if it is, to sum up, if the Hormuz Strait is open, if there is a peace, it is an agreement, it will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process, volatile markets for some time to come. This 400 million barrels is big, but it is only 20% of the reserves we have. 80% is still in the pocket. And we will see, we will assess the market conditions, and if we think it is necessary, we will be ready to act immediately. Now, I don't think that we are at this stage yet, but we are monitoring the markets momentarily and very closely. If we believe it is the time, we will definitely go for it. But at the moment, we are not there. If we are not able to see fully an unconditional open of Strait of Hormuz by end of June, July and August, the travel season around the world in many countries are starting, the flights and the cars and the buses. We may be entering the red zone for the global economy, especially those in Asia.
Okay, let's move on and now talk more in terms of commodities, right? What's happening because of all of the West Asia uncertainty, the war there. Let's go across to Manisha Gupta, who's here to take us through all of that every morning. Manisha, good morning.
Morning, Vinny. Thank you for that. As IEA's Fatih Birol was saying that if it continues until the end of June, we could be looking at much higher crude oil prices and bigger concerns perhaps emerging. The IEA also in a different conversation has said that it would take at least 6 to 8 months in a best case scenario to reopen Strait of Hormuz if an agreement was reached today. So either way that you look at, there are concerns coming in for the crude prices is the reason we are looking at Brent now gaining back up to $98 a barrel. There is uncertainty surrounding U.S.-Iran peace talks. The U.S. in the meanwhile is seeking written commitments from Iran on specific nuclear-related concessions, and a lack of breakthrough heightens the concerns that the global crude inventories may need to be drawn down further. So all of that is clearly supporting the crude oil prices. We also have seen a decline, though, come in for the metals as a space. So gold and silver both have declined. The U.S. labor market data has been better than what the street was anticipating. And now it is going to be about the U.S. non-farm payroll data that would get released on Friday. And finally, it is the metal sector which continues to do well yet again. Copper is holding around 2 weeks highs. Aluminum is trading at around 4-year highs. The U.S. signing a proclamation adjusting certain metal tariffs to better address the national security concerns means that more metal will now be going to the U.S., and that is leading to a supply concern in the rest of the world.
Okay, thank you so much for that, Manisha. But on that note, we're going to slip into a very short break. After the break, we'll get you how these overnight cues are going to be impacting our Indian market. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now we have a team of research joining us to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. And first up, let's go across to Hormaz, who's joining us to tell us the important market cues that we're keeping an eye out on. Good morning, Hormaz. And obviously, yesterday we saw a very good recovery in the second half of the trading session. What's the expectation today?
Good morning, Vinny. And the expectation is always on the positive side. And a lot of the motivational speakers will tell you that nothing is impossible. But I'll tell you something that's not possible. That's to predict what the market is going to do today. Maybe Sudarshan is more capable of doing that. But of course, even after yesterday's recovery, the GIFT Nifty is almost back to square one in today's session. It's a 120-point gap down that you see. And there is a reason behind that as well. The oil prices, which had declined to almost what, $94, $93 a barrel until yesterday evening, are back to 97, 97 and a half in today's session as well. So there are fairly valid reasons why the GIFT Nifty is indicating what it is, despite Asia doing fairly well for itself. Now, the other pocket of caution that you need to watch out for today is the Nifty IT. Now, after the surge that it saw in yesterday's session, the Nifty IT's RSI is very close to overbought levels. It's at 66 and a half. The overbought territory is 70. But more so for the fact that the Wipro ADRs and the Infosys ADRs were down anywhere between 3 to 8% overnight. Now, take a look at these two charts. The Nifty Bank was one reason why the index did what it did when it recovered from the lows yesterday. The IT index continued to provide that support all through the day, despite the volatility that you saw on the Nifty Bank. But of course, the index to watch is going to be the Nifty IT. The Wipro ADR was down 8% overnight. The Infosys ADR was down around 2.5%. Now, on the levels front, of course, the bulls will be happy for the fact that they managed to defend the May series low. Yes, so that becomes the first important level. Then Tuesday's low, which is 23,222. That is the next important level on the downside. On the upside, of course, 24,500. We did cross that intraday, failed to defend that, of course. That remains to be the key monitorable as well. The other important things to watch out for, of course, is that despite the market being where it is, there is very, very strong responses seen to everything else that is on offer. Be it the OFSs, be it the block deals, be it the QIPs, all of them are getting very strong responses. That is one thing to watch. The 3-day RBI policy meeting begins today. The outcome comes out on Friday. The US trade talks continue as well. And the markets, of course, they may not react much till oil reaches $100 a barrel, but it's getting there. So that is something that the market will take note of. But today, the GIFT Nifty is indicating a gap down yet again. Lower levels come into play as well. But the bulls will be hopeful that what happened yesterday makes a repeat today. More importantly, it sustains.
Thank you so much for that, Hormuz. But let's move on to Sonal, who's here to tell us which are the important stocks to watch out for this morning. Good morning, Sonal.
Good morning, Winnie. Well, a couple of stocks which are in focus. Adani Ports, where cargo volumes in the month of May were up 15%. However, the logistics rail volumes were down 19% on a YY basis. For Concord Biotech, the company has received US FDA approval for Mofetil for oral suspension USP. This is a pediatric drug that they've gotten an approval for. Canara Bank has approved fundraising of 8,500 crore rupees for FY27. They will be raising 4,500 crore rupees via AT1 bonds, 4,000 crores via Tier 2 bonds in FY27. Vedanta, we did get a response to CNBC TV 18 yesterday on ED raids on their premises. The company has informed the exchanges that yes, this has happened in some of the offices. They have informed that they're fully cooperating with the authorities and providing all information sought as well. For Happiest Minds, after numbers, they've also put out their investor presentation. They're guiding for 12.5% constant currency growth, the aspiration for 15% growth. They are also backing it by 27% in pipeline, which is led by strong AI-led demand. They have a strong order book as well. For Equis Limited, their subsidiary has received Government of Karnataka's approval with respect to an incentive for setting up a manufacturing facility under the incentive scheme by the government. So these are a couple of names which will be in focus. Of course, has also mentioned NHPC, so that stock will be on our radar.
Thank you so much for that, Sonal. But let's move on to the final update. We have Sudarshan here to take us through the updates in the world of FNO. Good morning, Sudarshan.
Good morning, Vinny. So one problem that has been for the market for the last almost few months is the continued FI selling. And you know, FI's short position now, it's at the highest level that we have seen in last 5 months. That is of it's the first or second week of January of 2026. So until unless FI start reducing short positions, instead of, even if they don't add much on the longer side, they have to reduce the short positions to see market moving higher from current levels. We can see a short covering here and there, but for sustained buying or sustained move towards the upside, FIs have to reduce the short positions. Another thing that happened yesterday is put call ratio is now back of the level of 1. Yesterday it was 1.05 versus earlier or previous day's level of 0.69. Look at the flows. In the index futures, they were the sellers. In the stock futures, so it tells you that they were buyers in selective stocks. That's the reason. In the stock futures, the buying figure was more than 5,000 crore. They have reduced long positions by more than 2,200 contracts. They've added short positions by more than 4,600 contracts. Now, longs exposure has reduced to 9% and short side the exposure has increased to 91%. On the options data front, 23,300 and 23,000 on the put side were the most active ones and have seen maximum increase in the open interest. And on the call side, 23,500 and 24,000 were the most active ones. So it tells you the range from 23,000 to 24,000. But first support for Nifty would be 23,250 and next support comes around 23,000. Resistance will be 23,500. Two stocks are in the band. Those are Amber Enterprises and Keynes. Some of the stocks that have seen fresh longs or fresh shorts. Varun Beverages has seen fresh longs. Tube Investments has been seeing fresh longs, and TCS amongst all the IT stocks has seen short covering.
Okay, thank you so much for that, Sudarshan. That's the FNO update that we'll watch out for in the Indian markets. But talking about the US markets now, S&P 500 ticked up to record close after reaching a new all-time high as traders monitored the latest in terms of the US-Iran developments as well as moves in the major tech names. Dow Jones was up over 200 points while the Nasdaq was a relative underperformer, closing with minor gains in the trading session. So Nasdaq was only up 0.03%. But yet Ben Snyder, who is the chief U.S. equity strategist at Goldman Sachs, who says that there are a lot of uncertainties, but the market has dealt with it all. Listen in.
It's an incredibly dynamic market environment, lots of uncertainty. But one way the market has dealt with uncertainty, not just this year, but over the last few years of the AI boom, is to really focus on near-term visible earnings. And that means if earnings strength continues, and our view is it will, the market should continue to move higher.
What are your S&P numbers for this year and next?
We have 24% earnings growth this year and 13% next year. We have about half of that earnings growth being driven by the AI infrastructure beneficiaries. And actually, if you look on a bottom-up basis, you can argue that the largest semiconductor companies, just 2 or 3 of them, are accounting for over a third of that.
Okay, on that note, we're going to slip into a very short break. We'll get you more news and updates on the other side. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now, India is seeking competitive advantage over Asian peers amid trade negotiations with the United States. Government sources tell CNBC TV 18 that the negotiations will focus on getting relief on new tariff under Section 301, which are expected to be announced by the end of July. Let's go across to my colleague Abhimanyu Sharma, who's here to give us more details on this one. Abhimanyu.
Preferential market access for Indian products into the American market and relief from Section 301 probes are likely to remain the focus of the Indian negotiating team in talks with their American counterparts who are currently in India for negotiations with the Indian trade delegation. It remains to be seen how early both the sides are going to conclude negotiations for an interim trade deal. Last week, US Ambassador to India had indicated that only 1% of talks were left for an interim trade deal between both the sides. Commerce and Industry Minister Piyush Goyal too had indicated that both the sides were already on the verge of finalizing an interim trade deal, and only a few commas and full stops were being taken care of as far as the current talks are concerned. Now, earlier this year, the Indian trade delegation had visited the United States in April, where they spoke to their American counterparts, which was preceded by the joint statement released by both the sides on 7th of February 2026. Now, the joint statement had indicated that India and the US had agreed on a framework for an interim agreement on reciprocal and mutually beneficial trade. The framework had also reaffirmed a commitment to broader India-US bilateral trade agreement negotiations. Now, in the current spate of talks, several issues like market access, investment promotion, economic security alignment, tariff measures, and customs and trade facilitation are likely to be discussed. All eyes, of course, would be on how early both the sides are going to finalize the interim trade agreement.
Absolutely, Abhimanyu. Thank you so much for that. Now, U.S. Trade Representative Jameson Greer spoke exclusively to CNBC on the Section 301 probes. As Abhimanyu was pointing out, the section of the U.S. trade law allows government to probe and penalize what it considers unfair trade practice by other nations. Greer also told CNBC that they will release the findings of the probe soon, which will form the basis of imposed tariff on other nations. Listen in.
We have investigations ongoing in my office, Office of the U.S. Trade Representative, and we're investigating specific unfair trading practices by different countries. And we're covering a lot of countries, over 70 countries. And so you will see over the next few weeks, we'll be releasing reports on our findings. And if we find unfair trading practices, structural excess capacity, forced labor, things like this, we'll put out proposals on how we think we should fix it. And that may be proposed tariffs or other things, and everyone will comment. They'll have an opportunity to say their piece.
Now, while we are on the issue of trade with the United States, Venezuela's acting President Delcy Rodriguez will visit India today. A meeting with Prime Minister Modi is on the cards as well. Last month, U.S. Secretary of State Marco Rubio had hinted at a potential energy deal between India and Venezuela. Listen in.
Well, we want to sell them as much energy as they'll buy. And obviously, you've seen, I think we're at historic levels of U.S. production and U.S. export. We want to be able to do more. We were already in talks with them to do more. We want it to be a bigger part of their portfolio. We also think there's opportunities with Venezuelan oil. In fact, it's my understanding that the interim president of Venezuela will be traveling to India next week as well. So there's opportunities. There's a lot to work on with India. They're a great ally, a great partner. We do a lot of good work with them.
And in his Senate hearing yesterday, the U.S. Secretary of State said that they want to end the Russian oil sanction waivers soon, and the time limited extension will be subject to the changes. Listen in.
Well, China doesn't, I mean, China refines oil. They import a lot, but they refine oil. Well, that ultimately is a decision that's made by Treasury, but I will tell you, it depends on the circumstances at the time. We would like to end it as soon as we possibly can because the underlying policy of this country has been to sanction their oil. These are time-limited waivers for the purpose of opening up more global supply.
Now, on to another important national story. The chairman and secretary of CBSE have been transferred amid controversy over Class 12 evaluation. The government has also formed a one-member committee to probe the tender process for the new on-screen marking system. More than 4 lakh Class 12 students have sought a re-evaluation of the CBSE and the CBSE is facing a crisis of credibility. In a blog post, a student claimed that the tender process was biased to alleged favor Hyderabad-based company EduTech that came in here in terms of the latest update. Now, after reviewing the tender documents, the students claim that the rules barring blacklisted companies and many other rules were diluted. Both CBSE and EduTech have denied wrongdoing as well. Okay, with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on Bazaar Morning Call. Well, it's a season of conferences and we are coming to you from one of the best in the business, the Morgan Stanley Investor Forum 2026. And, as you can see, I'm in an outdoor location, but my colleagues Nigel and Dreama are very much in the studios right now. Guys, good morning.
Hi, good morning. It's a perfect time actually to get in all the smart people about money, the smart investors, about what's happening. The FIs continue to pull out from the Indian markets. Yet again, yesterday, a large sell figure of 8,000 crore. Look at the way crude prices have moved. Yesterday, when we closed the Indian markets, Brent crude was at $93.5, $94. Now we're at 97, and the war continues to simmer on. And every now and then, like yesterday, you get a little bit of an explosion.
Well, that's right. And, the Mumbai monsoon has started. Rains here, overnight. It's a trickle. I don't know whether it's going to trick us this year, but a trickle, cooling down the weather a little bit, looking quite beautiful this morning as well. I'm not sure about the markets, but at least Mumbai looks far better this morning. Prashant, take over.
It looks better, Nigel, I can tell you that. I mean, I drove all the way on. I took the sea-link and it's looking beautiful. Yeah. I hope the rains stick around and they're not it's not one and done, right? And much needed, absolutely hot, sweltering last 1 month or so. So that's one of the many wishes we have. The other, of course, wish is that, things turn around in terms of sentiment, because I think we are at an extreme at this point in time. And that is essentially what we will try and do in just a bit from now. Rhythm Desai is going to be with us and we'll ask him what will it take for sentiment to turn around? And that's going to be the key focus area. But as always, just to run you through some of the top-down stuff which we are watching out for this morning. So oil's jumped up a little bit. We're at about $96 odd a barrel. There's reportedly military activity once again. Not large scale, but military activity nevertheless. This is all reportage and sort of commentary which we know from the Iranian side and the US side as well. US struck Iran's Qasem Island and Iran retaliated by launching drones, missiles targeting US bases in Kuwait and Bahrain. The US Central Command says, well, all these attacks have been invalidated, they've been taken down, and nothing has really been damaged in that sense. And that's the thing, and that's the number one thing to watch, because we don't know how this will develop. There are all kinds of reports on social media, etc., which say that the airspace is in the Middle East is now shut down, and all kinds of things really going around. So a bit of a flutter of activity this morning, and oil, of course, reacting and reflecting some of it. So just to sort of, take you back a little bit, US equities, last night they clawed back losses, new all-time highs, but flattish, right? S&P was up about 0.1. In terms of single stock action, humongous, huge. Every day we count out more than a few names which are up 10%, 20, 30. So Marvel Technologies jumped 32% last night. And this is after, Jensen Huang of NVIDIA said it could become the next $1 trillion company. Well, that's some backing if it needed it. Alphabet was down about 4%, and so much chatter, commentary around why Alphabet, which throws up so much cash flow, is raising $80 billion and through equity, right, to pay for its AI investments. So Alphabet was down about 4% or so. I'll just mention Indian software as well. So last night, you look at Globant, you look at EPAM, you look at Accenture, Cognizant, Gartner, Wipro. Wipro ADR was down 8%, Infosys was down about 3% as well. So there is a bit of a we saw a nice, neat 12% rebound off the lows on the Nifty IT index. We've seen a bit of a pullback last night in that sense. Here, I mean, we got a breakdown. It looked like perhaps it was a bit of a breakdown. We've been highlighting this channel. The Nifty is broken below that channel. But what's interesting is, it's kind of sort of held on to the strong double bottom, which is at about 23,270 or so. The critical gap zone remains unfilled, which is, to my mind, a clear sign of strength in that sense. Targets for the Nifty, 23,800 first, 24,070, and then I guess, whenever we see this broader macro-ish turnaround, 24,280, 24,300 roughly are the numbers on the upside. And of course, on the downside, the support is a firm close below 23,270. I guess, invalidates all of this. I mean, we're basically looking at 23,300, 24,300, 1,000-point range, and we've spent time in 400, 500-point blocks over the last many months or so, and I think we are kind of sort of in a way bound to repeat it. We'll see. It's an interesting session, especially because there is some activity. It's neither war nor peace. It's kind of a stalemate. But this morning there is some action, there is some activity, and oil prices have kind of reflected it. Let me toss it across to Nigel for a quick bit on the F&O positioning, and then, of course, we'll take it forward with the conversation from the Morgan Stanley Investor Forum. Nigel, over to you.
Well, the GIFT Nifty is suggesting that we could pull back a little bit. But, I've learned a lot from CNBC TV 18 prior to being employed as well. Over the last few years watching our anchors. And I recall one thing that Anuj always says. The Nifty closes in the green on the first day of the rains in Mumbai. So it's got its stars cut out. We're down close to under 100 points. We have a bit of a trickle here in Mumbai. Let's see whether or not, that sticks with regard to the Nifty closing in the green. But yesterday was a beautiful trading session. We saw a bit of a bounce from the day's low. It could have an element of weekly expiry as well that played out. But the FIs, they continue their selling ways. Close to around $1 billion is what they sold. But the DIs, well, they are battling in there. They put in the money and they offset most of the FI selling. In terms of what are they doing in the index futures? Well, they did what they're doing in the previous trading session. They added shorts. Maybe the quantum was not as large, but close to around 5,000 contracts is what they added, and they unwound some longs as well, which takes the short positioning in percentage terms to around 91%. Now, that's the highest we've seen all the way since the middle of January. So a big surge is what you're seeing. In percentage terms, from around 83% just last week, we have moved to around 91%. And you pull up a chart. The last few trading sessions, the short positions from the FIs have moved from 1.5 lakh contracts to around 2.3 lakh contracts. That's in addition of close to around 75,000 contracts in a matter of 5 trading sessions. So you'll wonder what happened. The FIs, they sold in cash. The DIs, they offset that. And they added shorts as well on index futures. There was a big short covering bounce that played out on individual stocks because there were some shorts that were added in the system. And yesterday it appeared the FIs covered a lot of shorts, particularly on stock futures. Which brings us to the levels that we're tracking. In today's trading session, you'll want the Nifty to actually make a higher high and defend the low. So that's the band you're looking at. That should be the broad range for the day. And a breach of this will give you further direction. After this, you'll be looking at around the 50 as well as the 20 DMA. But the bulls will at least want to defend yesterday's low, going by the entire cues that we're getting. The question is, the 23,250 to around 23,350 in the last 1 month or so, every time we have gone there, it's invited a good bounce, either a 5 to around 600-point bounce. Now, this time around as well, we have gone to that level. Will it get that sort of a response? For the time being, we've done just around 200, 230 points or thereabouts. So will we go the whole hog is the question. Recent data suggests that maybe, in fact, we go up from there as well. But cues, a little bit skittish this morning. Finally, the Indian rupee has been showing signs of stability. Yesterday, it slipped a little bit. You don't want it to slip too much. We know that this is more a sentiment barometer as well. The rupee showing some kind of stability, some kind of strength may not be such bad news. So we'll keep an eye out on that front. But the GIFT Nifty suggesting a downtick. First rains in Mumbai, normally 10 good times. Let's see whether or not the Nifty ends in the green yet again.
All right, for now, we're firmly wedged in that trading range with the kind of up move recovery that we had intraday yesterday. But let's go across now to Prashant, who's going to be in conversation with Rhythm Desai, Chief Equity Strategist India at Morgan Stanley. Prashant, it's over to you.
Well, coming to you from the Morgan Stanley Investor Forum 2026, and as always, we're sitting down with the man who's got the pulse and who sort of helps puts this conference together for so many years now. Rhythm Desai is with me. Rhythm, great to have you with us here. Thank you very much for joining us.
Thank you for hosting me, Prashant.
And it's a day when we've got some showers, some rains in Mumbai, so hopefully, it rains good news as well. But just start with the starting point, Rhythm. It's not very demanding. It's not as if this is a raging bull market. I'm just starting with sentiment is quite negative. There's a fair bit of self-loathing, I feel now, which is kind of, we don't have AI, we don't have this, we don't have that, and all kinds of things, right? So it's almost very tough to justify a kind of bullish view. So that is where sentiment is at. So just talk us through the conference and what you aim to get to your investors from the conference, the message, straight up.
So see, the interest level in India is very low. That's the bottom line. And the reason is that on a relative basis, India is not looking good on growth. It's looking very good on valuations, but it's looking very inferior on growth. So if you compare with other large markets, And this is, AI is an excuse. The real deal is on growth. And this has not been the situation only for the last 2 or 3 months. It's been the situation since September of 2024, when India's growth peaked, valuations peaked, and since then the market has derated on a relative basis, and growth has been decelerating. Now, growth did pick up in the December quarter. It's actually picked up a fair bit in the March quarter. Companies are quite positive and are guiding despite the global uncertainty, despite the conflict in the Middle East. But the growth elsewhere is very strong. So the earnings growth in Korea, Taiwan, Japan, the US, even parts of Europe are way above India's growth. And this is not like a 2-3% point thing. So if India is doing 12, 13, 14% earnings growth, these markets are experiencing 30, 40, 50, and Korea is, in the hundreds.
Yep.
So that's where the thing stands. This thing with respect to foreign investors only flips when the growth flips or the growth expectations flip. It's not when the growth flips, because that will be too late, but when the expectations flip. So something has to give, say in the memory cycle, for Korea's growth to go down. Something has to give in the compute cycle for Taiwan's growth to decelerate, and so on. So that's not something that's visible. In fact, the capex in the world has been very resilient, and it has not reacted to the uncertainty coming from the conflict, which is why markets elsewhere outside India are all putting up new highs, and just not a soft new high, really strong highs. I mean, Korea is up 60% from its March end low.
No, it's up 60% this year. It was up 75%. No, it's up 100% YTD, and it was up 75% last year. And of course, Taiwan has done what it has. Rhythm, the question is, so are you saying that for FII, especially FII flows to flip, how you put it, right? This memory trade in North Asia, or this entire AI capex frenzy has got to end, because those are beneficiaries. That's where that money is going. So that needs to slow down a little bit for investors, foreign investors, to pay attention to India?
It's about expectations. The expectations have to pivot. The expectations that this is going to generate more and more growth has to change. And India's growth expectations have to accelerate. So both have
to happen.
Both are one. The relative growth picture has to change with respect to forward expectations.
Is there any signs of the former happening?
No,
because
not at all. If you look at Morgan Stanley estimates, we are only upping our capex forecast for AI. And a lot of this has to do with the AI supply chain. So there's no visible sign that this is about to slow down. That's not in the horizon.
If anything, I've seen numbers which say that it's going to accelerate all the way into 2028, maybe even beyond. And you're kind of sort of agreeing with that, right? That's your expectation, estimates as well.
28 is far away, but it's there for 27 at least. So if you're looking at from a near-term perspective, next 12 to 18 months, this capex cycle is pretty intact, and it is not seemingly going away.
It's not going away. No. So where does that leave us?
So India's growth is accelerating, and at some point in time, the valuations relative to growth opportunities do become attractive. And of course, see, there is a technical aspect to this. Retail investors in India are just not stopping the bid. So in March, you would have ordinarily expected retail investors to be a little bit hesitant because the markets were volatile, there was bad news, there was a drawdown, but they put record inflows, and they followed up with another strong April, and I think the May month also has been probably very strong, going back by the amount of buying that domestic funds have done. So if that bid is on, then there has to be a seller. Now there can potentially be two sellers. There can be corporate issuances and there can be foreigners. So the other way that foreigners can become buyers is that corporate issuances resume. It's counterintuitive, but that will be good for
more supply, basically.
Exactly. That will be good for the overall bid on the market. It will be good for the BOP. It will be good. So it's counterintuitive. But issuances can make a difference here.
That foreigners can come back and participate in those issuances.
Because then they get space to come into the market. Otherwise, retail has just kind of taken them out.
That bid has been absolutely strong.
And I don't expect the retail bid to go away, because that's a secular shift that's underway in India.
And you pointed it out, you made that argument.
We've been talking about for 11 years now And now finally that skepticism is fading, but people are waiting that one day retail will panic, but retail has matured in this, and they are upping their equity allocation, rightfully so in my view. In the long run, this is going to pay off quite well to them.
You started by saying that sentiment, there is very low foreign interest in India at this point in time. I mean, you've done this conference, what, 20 plus years, Rhythm?
28 years.
28 years. And if we were to sort of plot a interest level, foreign investor level through those 28 conferences, where are we now? Are we pretty much at the lows?
No,
Yeah.
we have been through these.
Okay.
Like 2011-12, I remember, was very bad.
Yeah.
But, frankly, I should have been ready with this data. I am not. We should see the data.
Yeah.
But, when we were doing this conference in the early 2000s,
yeah.
like in 2003, we used to write a conference book. Now we don't do it.
Right.
So I used to write the preface.
Right.
India's market cap in 2003 was $100 billion.
Wow.
Because I remember writing this, that 50% of India's market cap is going to be represented at our summit. $50 billion.
Was here.
Yeah, so we've come really long way, $100 billion. So it's difficult to make comparisons on the basis of numbers.
Yeah.
Because the market is now up 45x.
Yeah.
It's a much it's sized up.
Yeah.
It's a player in the global.
Absolutely. I started in 2003 as well, so it's a year which I remember. But Rhythm, so just to complete the foreigner point, right? This constant selling that we're seeing. I was speaking to somebody, and I was kind of surprised to hear it. That typically. And this was in response to what I asked. Is that typically we get asked whether foreigners are calling up and asking what should we buy. But the gentleman, again a foreign firm, said, I'm getting questions of what can we sell to increase allocation to these other markets that you were talking about as well. Is that something you pick up as well? Because that foreign selling is showing up on the screen every day.
Foreigners are also selling Korea. Okay.
Right.
So let's not.
No, it's almost, but there it's more technical. The selling is.
But this is also technical.
Yeah.
Large part of the outflows are passive. It's because the weight is falling because India is underperforming, and every single day India underperforms, the weight falls, and passives have to adjust their index in their position to match the index weight.
So the flow bit, it's not active discretionary kind of reallocation, that kind of thing, or that has already happened.
There is that also, but there's a fair bit of passive in this. So it has got a circularity to it. The opposite of this was happening in 2024, which is why India's valuations got stretched. And now it's going the other way, and that's why it's getting depressed. And these, the passive thing has gained share globally in total assets under management and is a dominant price mover. And is not actually going to react to valuations, is not going to react to relative growth opportunity.
Yeah.
It's in the active bit, but the active bit has lost share. So that is, I think, part of the problem. Just going back to the FPI question, of course, relative growth needs to get fixed. Or we can have corporate issuances. But I think we can also do adjustments on the policy front.
I was coming to that.
So, for example, I think make it easier for foreigners to participate. And that is, I think, something that should be done over the next few months, because it takes a lot of time for people to get registered. If I want to trade a US stock, I just have to go to one of the brokers' website, register myself, and I'm up for trading in 5 minutes. That ease of trading that market.
I remember at the CNBC TV 18 forum, the SEBI chairman was there, and I think you and others made that point to him, that the time to registration, the time when you come in, put the application in, and when you're able to participate, that was very, very long, and we got that feedback as well. But that is still an issue? That is still a niggle?
So, for example, in the budget, we increased the limit for non-residents, which includes non-Indians, to buy up to 24%. But they still have to go through a process which makes it rather hard for them to actually participate easily. It's not like a decision I make today, I want to buy Indian stocks and I'm up and ready for trading this morning. I can't take a decision at 8 o'clock in the morning to trade at 9:15 if I'm sitting outside India without an approval. And that, I think, can change and it can become a lot easier. I know there are concerns around round tripping, etc. But I think there is room for us to make it easier. On the debt side, there's room for us to reconsider withholding tax because debt investors don't do it.
Discussed, so
And
perhaps.
yeah, and debt investors surprisingly have stood. They've not exited. They've actually been buying, and this is despite the losses they are suffering on the currency.
What about taxation, equities taxation?
So taxation, I don't think is a burning issue in my view. The issue about taxation is the whole administrative process to file returns and to pay the tax. It's not about the tax itself. And you know, it reminds me of what my father told me in the 80s when I was first filing my tax returns for the first time. I was still a teenager filing my tax returns, and I was complaining to him, you know, Dad, "Abhi mane to tax bharwanu avyo. Okay, I have to now pay tax." So he said, "Beta, you made money, na? So that is why you're paying tax. So never be unhappy about paying tax." The fact is that, you know, a lot of foreigners who probably are not making money now and selling, and so they're not paying the tax, right? So I think tax is not such a burning issue. The administrative process around that could be. Yeah, but I think easier access is probably the better thing. If you want to choose amongst policies, and I think that's the easier thing to fix. Also, capital gains tax, it can be a tricky thing. You can't do it retrospectively now.
Correct.
Because if you do it, suppose hypothetically you reduce long-term capital gains tax to zero, it's going to be a selling avalanche. Because now I can take all my gains without paying tax. Who knows
On
where
the stock of investments that you have.
Exactly. Who knows where the tax will be in 3-4 years? So it can't be done retrospectively. It can only be done prospectively, if at all.
Yeah.
Okay, interesting chat there, and we'll keep coming back to you with more from Morgan Stanley. For now, we need to slip into a break. Before that, let me quickly tell you the interactions that are lined up on the show. So first up, 8:35, ICICI Securities Probal Sen will put the spotlight on oil imports and more. 9 a.m. Jay Kali of Elara Capital will talk about the auto sector. 9:20, Vikas Khemani of Carnelian Asset Management will be our market master for the day. Following that, 9:30, we will chat with Amish Shah of BofA Global Research as they wrap up their conference. 9:50, the management of CMR Green Technology joins in as their IPO opens for subscription today. And towards the end of the show, Lata will speak to Amol Gupte of Citi ahead of their investor conference on the mood of the foreign investors. All right, get into a quick break. On the other side, we'll talk about the top stocks to watch for the day. Stay tuned. Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Vinny is now joining in with the list of stocks that you need to know for the day. Hi, Vinny. Good morning.
Hi, good morning. So first up, let's talk about NHPC, right? Yesterday we saw a fall coming in. It was the first day in terms for the OFS that had opened up. For the non-retail investors, they saw a very strong response coming in there, 3.47 times subscribed by the non-retail investors. The government has now decided to obviously exercise that green shoe option that they have as well. And the retail investors and employees will get to bid today. That's 3rd of June. Now, so we'll expect some bit of a green here, given that we've seen a fall coming in yesterday in terms of the stock and the strong response that you've seen. Now, we have John Cockerill that is also going to be in focus after the company has received an order of around 1,250 crores to 1,300 crores. This is from JSW Vijayanagar Metallics for a CRNO project. So watch out for this one. Concord Biotech, that also isn't going to be in focus after the company has received a US FDA approval for a drug that is used in treating organ rejection during transplant. The estimated market size of this is around $30 million. So that will be something positive that comes in for Concord Biotech. Bliss GVS Pharma, that's also something that will see some bit of a green on the screen. And the company's Palghar unit has received an inspection closure report from the World Health Organization. This is confirmed, and the positive responses they've gotten is in terms of good manufacturing practice that has been confirmed for this plant as well. Lastly, Adani Ports is something that we'll see green on the screen as well. The May traffic data has come in, which has grown by 16%, led by containers as well as liquid cargoes. The cargo volumes overall were up by 15%, while on the flip side, you have the logistic railway volumes, which were down by 19%. Now, Nomura sees EBITDA CAGR growth of 19% over FY26 to FY28. Jefferies has also maintained the buy call and raised the target price as well. So we'll watch out for all these stocks in the trading session today.
Got it. Okay, all right. Thanks a lot, Vinny, for taking us through that need list. Well, let's hop across to Manisha Gupta. She joins us to tell us what else going on in the commodity markets overnight. Manisha, good morning. Plenty going on, I guess so.
It is, Nigel, yes. Pardon me. The crude oil prices is what I'll begin with, because we've seen strong gains come in for this one. Now almost $97, $98 a barrel is back. Then there are reports of Iran firing missiles at Kuwait and Bahrain. The diplomatic talks between Iran and the U.S. are showing little progress. And then when you look at the U.S. crude inventories, well, they have declined for a 6th weekly decline. Also, the actual physical molecules of jet fuel and diesel are trapped behind the blockade. And there are more and more voices now suggesting that if the Strait of Hormuz continues to be shut by June and July as well, and with the summer demand season coming back, you could be looking at a massive shock in sense of crude oil prices on the higher side. That is what the street is preparing for. We also have seen gains continue for the metal prices. So whether it's copper trading at a 2-week highs or aluminum holding its 4-year highs has been extending gains. What is extending losses, though, has been the gold and silver prices, both of them trading in the negative and down by nearly 2% already for the month of June.
Thank you very much for that, Manisha. We will get into a break. On the other side, we'll connect with ICICI Securities Probal Sen to put the spotlight on oil imports and more.
Welcome back. You're tuned in to Bazaar Morning Call. Well, the International Energy Agency head Fatih Birol has warned that the oil market could enter a red zone if the Strait of Hormuz does not open up unconditionally by June. An exclusive conversation with Shireen Ban, Birol said that oil markets will continue to be rocky and volatile even after the war ends. When asked if the IAE was considering releasing another tranche of emergency release, he said that not yet. Let's listen in.
I think it is rather naive to expect that the Qatar LNG terminals will go back very quickly where they were just before the war. So if it is, to sum up, if the Hormuz Strait is open, if there is a peace, it is an agreement, it will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process, volatile markets for some time to come. This 400 million barrels is big, but it is only 20% of the reserves we have. 80% is still in the pocket. And we will see, we will assess the market conditions, and if we think it is necessary, we will be ready to act immediately. Now, I don't think that we are at this stage yet, but we are monitoring the markets momentarily and very closely. If we believe it is the time, we will definitely go for it. But at the moment, we are not there. If we are not able to see fully an unconditional open of Strait of Hormuz by end of June, July and August, the travel season around the world in many countries are starting. The flights and the cars and the buses, we may be entering the red zone for the global economy, especially those in Asia.
Well, that is Fateh Birol for us. For today, crude prices have risen to about $97 per barrel, and that is a bit of a problem. Probal Sen, oil and gas analyst at ICICI Securities, is now joining in. Probal, thank you very much for joining in. Every time we speak, we were hopeful that perhaps the conflict's going to come to an end, but it hasn't. So just yesterday, there was news about how India has started importing from Venezuela, and it now contributes about 10% of India's total crude imports. How significant is that? What is the price at which we are importing from Venezuela? And what would India's fuel basket now cost?
Okay, so first of all, in terms of how significant is it, obviously it's a fairly large number. If we look at the situation when the sanctions by the US were actually imposed on Venezuela, even before that, similar numbers, if slightly lower numbers, were actually being imported from this country by Indian players. Specifically, I think Reliance definitely, because of the complexity and its ability to process these crudes, was the largest buyer. And I think that situation has returned right now. So it does act as a useful buffer for meeting the shortfalls that we are facing in terms of overall crude availability. In addition to that, US imports from Brazil, imports from Africa, those all have actually ramped up. But on the basis of reports that we see in Q1, we are still running short of around 10 to 12% of what our pre-war import levels used to be. Again, that's something that we'll have to verify from the companies, but that is what we see in terms of news reports. In terms of pricing, our understanding is that the Brent plus $15 to $20 premium that was prevailing in the peak period in March and parts of April, when the shortfall was particularly acute and prices were very, very strong, that has come off a bit to Brent plus less than $10 premium, but it does remain more expensive than it was compared to earlier benchmarks. So the Indian basket of crude is not really what is the price at which physical crudes are being delivered at this point of time. It is Brent plus a premium of anywhere between $7 to $10 from what we understand as of now. Individual crude pricing, it's going to be very difficult to understand or calculate at this time, but that seems to be the blended cost of delivered crude.
But when we get from Russia and now even Venezuela, is it at a cheaper price, or is it just acting as an alternate source of supply to secure the supply?
I don't think there is any cheap crude available in the market right now. I think it's unlikely that anybody is offering any discount on crude that is available to be purchased. It's more about just backstopping the shortages that continue from the Gulf region, from the Strait of Hormuz. Before the conflict, about 2.4 to 2.5 million barrels a day of supply was actually coming through from that region to India, with overall imports being about 5.2 to 5.3 million barrels of oil per day. So, obviously that's a big shortfall. We don't know how much is the net amount that is still flowing through the alternate east-west pipeline along with the Fujairah route from the UAE. And therefore, whatever shortfall is there, every source is being leveraged and tapped to meet this. But no discounts are available as far as we can understand.
All right. And Prabal, just to give us the brief number, how much comes in from Russia as well as Venezuela out of the total basket?
From what we understand, 30 to 35% of our requirement, around 4.5 to 4.6 million barrels a day, is what is being imported by the country, of which close to 35%, I think, is coming in from Russia. Venezuela, as we just discussed, about 4.4 million barrels a day is now flowing from there. So that's close to 10%, 9 to 10% of what our requirement is. And then the rest, even US is a major supplier now. There are some crudes coming through from Brazil as well as African crudes. And as I said, some volumes are still flowing through from the Middle East, although it's a fraction of what it was pre-conflict.
All right. Prabal, then how do you approach these stocks? What do you think with regard to the OMCs? I think 7.5 rupees price hike has been pushed through. They're still making losses. But, the hope is that this war is called off and we see some kind of cooling off in terms of crude. So in your matrix, what are you factoring in first in terms of crude oil prices? And how would you approach the producers as well as the OMCs? I mean, what's your preference right now?
So we would, I think the IEA commentary just at the beginning of this session was fairly spot on, that this is not a binary situation where if the ceasefire is announced, the strait starts flowing normally from the next day. The fact of the matter is that there's a structural change in the way that the energy dynamics and energy supply chains will work, at least for the next 6 to 12 months. And therefore, we continue to believe that even if there is a ceasefire that is reached in short order, crude will remain elevated at around $85 to $90 kind of a range, which is what we are working with. And therefore, our estimates still suggest that, there could be significant losses in the first half of the year, particularly if you see the LPG losses, which have actually risen very, very sharply. They were less than 100 rupees a cylinder. The commentary given by the OMCs themselves suggested that in May, they have reached upwards of around 600 rupees a cylinder. So if you if you factor the LPG losses alongside still, the retail losses, even though the extent has reduced quite a bit, our sense is that H1 will see OMC earnings remain under pressure. And therefore, upstream will probably continue to do better. Now that the crude prices are in a slightly narrower range, ironically enough, the threat of any or even the risk of any windfall taxes seems to have reduced in the sense that, we don't see any commentary, and even the ONGC and oil were very clear in saying that there's been no communication to that effect. So what you're looking at is probably 2 quarters of extremely strong earnings from upstream and 2 quarters of very soft earnings, if not losses, from OMCs in the current environment.
Okay, so just some follow-up questions. So on oil marketing companies, you said the LPG losses are about 600 and per cylinder. And for auto fuel, what is the loss that we're working with right now after the price hike that's taken place? And therefore, as things currently stand, assuming it continues status quo, what would be the losses in Q1 for OMCs?
I don't have the exact numbers of Q1 in front of me. We have not released our preview, so it'll be difficult to share exact numbers. But retail margins at this point of time are still, low single-digit losses are still there for petrol, and similar levels would be there for diesel. The reason why it's difficult to pin an exact number is that there is a negotiated pricing that is now being used, from what we understand. There were news reports earlier that there was an RTP capping that was there at a certain level, although that capping number is not publicly available, our understanding is that refineries are not really transferring it at the exact international prices to the OMC marketing, whether it's from the internal refining or from the external refiners who are selling to the OMCs. So everybody's margin number will be different, but if you apply a certain, a cap of anywhere between, let's say, $15 to $20 product spreads on what the international prices are, you would still come to a small loss on the retail front, even in Q1.
Prabal, any word on the refiners? MRPL, CPCL. CPCL, I mean, just take a look at that stock. The markets are in a bit of a tizzy, but that one's making fresh highs. I think it's 1,150. They've been repaying their debt. There was an argument that replacement cost, in fact, is far higher than what it trades at in terms of an EV. Any view on these names? Because global refining capacity has got hit.
Yeah, I think I wouldn't be able to comment on CPCL since we don't cover it. But in terms of refining margins, you're absolutely right that the fact is that, significant amount of refining capacity continues to be impaired, both in the Gulf as well as in other regions because of the fact that the economics was not working, crude availability was an issue. So depending on which estimates you look at, anywhere between 2 to 3 million barrels a day of refining capacity continues to be constrained. And that is reflecting in the fact that product spreads continue to be fairly strong across products, specifically petrol and diesel, which are, as well as ATF, which are the mainstay of product yields for Indian refiners. If you look at the product yield or distillate yield that is there for most Indian refiners, these three products alone will be close to 65%. And these are the three products that have been doing that have been showing the most strength as far as product spreads is concerned. So definitely, I think if refiners are allowed to earn the unconstrained refining margins, I think earnings would look fairly strong for them.
Okay, very short since we're out of time, Prabal, but one high conviction idea from you.
I would probably look at ONGC in the current environment. I think that valuations are still fairly attractive. Production growth should start to pick up over FY27 and 28 based on all that they're doing with respect to KG, Daman Offshore, as well as the technical service arrangement at Western Offshore. And earnings, as I said, will get a boost from the way that crude has been behaving. And, even if they get around $80, even that implies a 20-25% uptick for the stock from here.
Okay, thank you very much for that, Prabal. Always great chatting with you. We will get into a quick break. On the other side, we'll connect with Deven Choksi. Stay tuned for that fundamental stock talk.
Welcome back. Well, GIFT Nifty is suggesting a pullback of close to around 200 points approximately, and Asian markets actually a little bit mixed. Some of them were closed, so they've reopened. For the time, actually, GIFT Nifty is, beg your pardon, it's suggesting 120 to 130 point downtick. Remember, yesterday we saw a bit of a relief rally, but if we're going to see 130-point downtick, then most of what we put on yesterday is going to get sold in two. So we'll have to see how that goes. But keep in mind, in the past, this 23,250 has been actually a bit of a lucky level for the bulls, and risk reward has favored the bulls. So they'll be hoping for more of the same. We'll wait by for the opening. For the time being, Harmaz joins us. He's going to tell us some of the big movers yesterday. Some of them were backed by delivery. Harmaz, morning.
Morning, Nigel. And NHPC, of course, is a news-based move in yesterday's session at the OFS that was launched. The stock ended 7% lower, the biggest single-day fall and volumes since June of 2024. But unlike Coal India, which also received a very strong response to the non-retail portion, NHPC did not recover from the lows of the day. It, in fact, ended at the day's low. And the volumes on Tuesday also the same, the highest since June of 24. 21 crore shares were traded yesterday. The 20-day average is 1.5 crore, and 44% of those shares were marked for delivery. So over 9 crore shares were marked for delivery. The 20-day average is only 70 lakh shares, and the stock is down around about 25% from its 52-week high levels. And now the three IT names that I'll be mentioning, it shows you the extent of the selling pressure that these names have seen. Infosys saw its biggest single-day gain since May of 25. It was the most traded stock on the Nifty 500 yesterday. Volumes were 3x its 20-day average, barring that MSCI session on Friday. 60% of those shares traded yesterday were marked for delivery, 2 crore shares that is, and that too is 3.5 times its 20-day average. And despite this move, the stock is still down 22% for the year. TCS saw its biggest single-day gain since July of 24. It was the fourth most traded stock on the Nifty 500 yesterday. It was only the fourth instance in the last 3 months where over 1 crore shares were traded on the stock, and 52% of those were marked for delivery. The delivery volumes too were 3x its 20-day average, and this stock too is down around 26% for the year. And Newgen Software being the last one, it was the biggest single-day gain on record for that stock, was up almost 20%. The stock over 3.5 crore shares were traded yesterday on Newgen Software. The 20-day average is only 8.5 lakh shares, and only 8% of those shares were marked for delivery. So around 27 lakh shares. The 20-day average is only 2.5 lakh shares. Now the stock is down 36% so far this year, and from its peak or around its 52-week high, which is around about 1350, the stock is down well over 60%.
Got it. Okay. All right. Thanks a lot, Harmaz, for that. Well, let's welcome Devin Choksi, MD DR Choksi Finser, who joins us on the show. Hi, Devin. Good morning. Good to see you, Devin. What about tech, Devin? 28,500. Recall the index was around those mark or a little lower than that. And suddenly the tech index has moved to 31,000. And stocks have popped up 10-15%. But keep in mind, they're more than 15-20% away from their 52-week highs. What's your view on tech? I ask you this because some of those ADRs, well, they ended lower overnight. You've had some of those services-based companies, the SaaS companies, that also saw profit taking. Would you buy into this dip? Do you think the correction got overdone, or do you think it's run its course and now you'll stay away?
Yes, Nigel, good morning. Certainly, I think we have been vocal about it, that the tech companies, they remain absolutely convincing from the business perspective as well. Most of the Indian IT companies, they being the service providers and adapting to the AI way of delivery is actually, I think, shifting away from the time and effort basis of the revenue model to outcome-based revenue model. That's what I think we have been understanding on these companies, and that's where we felt that the downside in the stock prices is practically limited. The movement right now, as we are seeing, maybe I think due to 2 or 3 reasons. One, of course, I think the downside is limited. So obviously the fund investors find it more meaningful to accumulate more amount of IT stocks in the portfolio, especially given the kind of inflow of money that they are having. On the other side, I think what we are observing, majority of the large investors, they basically feel at this point of time to, I think, buy into some of the mid-tier IT companies. And that's where probably, I think we see the opportunity in some of the likes of Tata Technology or KPIT or Tata Elxsi kind of companies, where I think their OEM customers have actually placed significantly large orders, and they have fairly good visibility on execution side as well. So yes, I think we see the large cap IT companies, the contra buying happening because of the downside is limited. And at the same time, I think mid-tier IT companies where the larger growth is lying, because of the higher execution part, I think that they are doing it. So certainly our views validated as far as IT is concerned, and we remain firm about this view. We believe that I think there is 15 to 20% upside in this counter, some of these counters going forward as well.
Okay, all right. And what about any of these product companies you like? Yesterday, I think stocks like Newgen were up more than 15%. Orient Pro as well was up close to around 8%. Will you be looking at these companies? HP, we know what it did overnight, was up close to around 20%. If any view on these stocks are half from the top.
So our weaker focus has been on likes of KPITs, TTS, and Tata Technology kind of companies, where I think they are firmly integrated into their OEMs program and providing the solutions, which are basically the productized solution, as you may want to call it, as for their end customers. We like these companies also because of the fact that there is a fairly good visibility of next 2 to 3 years in their execution program. So that's why we believe that I think these are a little better off compared to pure product companies.
Okay, all right. Let's take a look at the bottom of your screen, Lenskart. There's a large trade that's got cleared out, close to 5 crore shares getting cleared out. So keep an eye out later today when you look at the FI, DI flows as well. Could be a little bit skewed because of that. Devan, any view on this one? Lenskart. Everyone was looking at it through a closer lens, but the stock has done a thing of its own. After seeing, I think, a gap down 10% downtick, I think, on the day of listing, from the 350, 370 mark, it's at 520. The numbers, to be fair, have actually improved. You could argue on the valuations, but numbers for the past quarter look pretty good.
Yeah, I think they're supposedly better, and definitely I think we would expect it to remain better going forward as well. Because the pure focus is shifting onto the profits. I think that is an important part of the entire transition which we are seeing in this company. How much I think it is in price, I think a guesswork, because frankly, to me, I think this market capitalization is definitely suggesting that I think they require significantly large amount of profit to build to justify this market cap. Not too sure whether I think one could immediately buy for deep value investing. Maybe momentum investing, definitely for sure. I think you can argue for going in for this company.
Got it. All right, Devan, wanted your view on NMDC because that stock has moved beautifully in the last few days. And, I understand that effective today, they've gone ahead and effective another price hike. On lumps, it's up by close to 200 rupees. And on fines, it's 150 rupees higher, which is great news from NMDC's perspective, and for the users, they'll have to pay a little bit more. The revised prices on lumps are around 5,700 rupees and on fines 4,850 rupees odd. That's a rough information I've got based on the sources. We'll wait for an official release on the exchanges, but ballpark, this should be the rough increase that we should see. And remember, when we quote these rates, they are for the Bailadila mine, which is the Chhattisgarh mine, and that's close to around $1,000 or thereabouts. And it's a little bit of a surprise because it's ahead of monsoon, right? I mean, monsoon is upon us, and hopefully we'll see monsoons pick up from an economy perspective. But ahead of that, you normally don't see, these sort of price hikes, but that's coming. And also international iron ore prices have weakened a little bit. So a bit of a surprise package coming in for NMDC. And as is, the stock has been quite strong. Devan, in your view, NMDC at around 95 rupees. The last few days, the numbers are a little bit softer because of the pellet business delivered a bit of a loss. Then the production number for the past month wasn't good. But now we have positive news flow. I don't know whether the reaction will be positive because to negative news flow, the reaction was positive. Your take.
So this quarter, April to June quarter of the financial year 26-27 looks, I think, pretty set for this company to report volume-led higher numbers, largely because of the fact, even if you see the last results, the amount of production that they have increased has been quite significant. Fully understood that I think in this quarter, the dispatches are on a higher side, and that's what the confirmation we are getting. So despite of some amount of weakness in the international prices, I think you are still seeing a higher amount of demand continuing for the iron ore. And that's where probably I think you're likely to see a large number of profit reported in this quarter. According to me, I think the market has moved up by 10 rupees in this stock, I think in the last 2-3 days, is largely because of the fact that the April to June quarter is expected to be the bumper quarter as far as the profits are concerned.
Devan, where do you stand on this solar theme? There are a lot of naysayers because they say that there's oversupply, returns are not very high or a little risky. But this is a theme which has done well. And I was just reading a JM Financial, and they're saying because there's ALMM list 2, which comes out in June. After that, in June 28, ALMM 3, list 3 comes out, basically forcing backward integration and helping some of the big companies. So the pecking order that JM Financial has given is MV over Premier, Premier over Vari, that over Vikram Solar. So you've got 4 companies in this place. Do you have a view on the solar theme, and which one would you back?
So on a business side, Rima, I think we remain fully convinced that I think the business is going to grow well. Now, whether any of these companies deserve immediate upside, I'm not too sure, because I think most of this is already priced into the stock. Unless likes of Vayu are basically fully getting backward integrated, that's where we see, I think, higher amount of opportunity and a scope. The stock has been moving in the range for a while, and in my viewpoint, I think stock price correction is a good opportunity to consider it again, because they're completely backward integrating on an end-to-end basis, starting from polysilicon onwards to supplying of the panel and implementation as well, along with, I think, the other areas of activity like energy storage and green hydrogen. So all in all, together, it is becoming an integrated play, and that's why we like this company better compared to others.
Okay, all right. Deven, I wanted to ask you about one more stock, IFL Finance. You know, the stock has been a rank underperformer, and there's been a large seller on the counter, which has been the technical factor that's been weighing down. Now, I understand that, you know, if you look at the exchange releases, gradually that's getting absorbed. And yesterday, the stock saw a bit of a recovery. After such a stark underperformance, would you be interested at around that 480 rupees odd?
Honestly, Nigel, not seen enough, I think, in this company. So we'll refrain from putting any view at this point of time.
Okay, no worries. Got that. Devin, request you to stay with us. For the time being, we'll slip into a short break. We'll be back pre-open rates. We'll also be joined by Jay Kale of Elara Capital, who will be focusing on the auto space. We'll also be joined by our technical experts. Sudarshan and Somil are waiting for us.
Welcome back. This is Open Exchange coming to you live from the CNBC TV 18 Motilal Oswal studio. This morning, the GIFT Nifty is suggesting a gap down opening, a cut of about 130 odd points. But remember, yesterday we had a very smart recovery. The Nifty at open was down about 200 points and ultimately ended with a gain of over 100 odd points. But crude prices are negative. Asia, we should pull up the Asian markets, and they're chugging along just fine. So that AI momentum continues to pull most of the other Asian markets higher in trade. Hang Seng has given up a bit, but that was the outlier yesterday. But if you look at Taiwan, you look at Korea, the gains are very much intact over there. But let's talk about levels levels. Sudarshan Sukhani, Somal Mehta now join in for some technical trading ideas. Sudarshan, would you give a lot of importance to that intraday pullback that we had yesterday? Was it on account of the weekly expiry? And what's the trade now? Yesterday you said it was sort of in a no-trade zone. What is your view today?
Good morning. My view is the same. See, the markets will make an attempt to find some kind of a low, start building a base. We don't have to wait for a long period for that base building process, but we must get some signs before we can start becoming bullish and go long. This is not a market where we can go short. Any news event can see a 300 to 500 point rally on the upside and kill short sellers. The only trade that will be available is once this decline ends, then we are willing buyers. But it's too early to say that decline has ended. One level that we should be watching out for is the 23,250, 23,300 zone, that 50-point band. If that band holds either today or tomorrow, then something interesting on the long side will emerge. Today, we just want to watch that level.
Got that. Somal, you want to come in on the Nifty? Yesterday, we managed to hold on to important support levels of 23,220. Where from here on, if there is a gap down, what's the advice on the Nifty?
Yeah, at this point of time, good morning. Good morning to everyone. See, Nifty has been making lower tops, lower bottom on the weekly charts. Every time in the last 4 to 5 weeks, every time it has made lower tops and lower bottom. Now, this time, Nifty has taken resistance around 24,100, and it has again started moving below the moving averages, short-term moving averages, which is 20 and 40 daily moving average. And it is breaking the previous swing low as well. So from here, the trend is still down. I'll be expecting more downside till 23,100. Probably if it does not sustain around 23,100, then probably 22,700. I would like to go short on weaker stocks, which are trading below 200 daily moving average, trading below 2040 daily moving average, and already in the downtrend. So I'm looking for weaker stocks to go short. But yes, of course, there are pockets where we are seeing good, move up, which is IT, pharma. These sectors are looking definitely good. So I don't suggest a short there, but yes, there are, pockets where you can go short.
Got it. Okay. All right. Hi, gentlemen. Morning. Good to see you all in. Sudarshan, let me come across to you. What are the top stocks you're looking at?
Well, it's a mix, and CAMS is a buy with a stop under 760. Keynes is a buying opportunity with a stop under 3115, 3115. Ashok Leyland is a sell with a stop above 155, and Voltas is a sell with a stop above 1265. It's a mix, and that reflects the market also.
Got it. Okay. Somal, what about you?
I'll be going short on a few stocks. One is REC Limited. REC Limited already in the downtrend, taking resistance at crucial resistance levels, trading below short-term averages, that is 20 and 40, trading below 200 daily moving average. My stop loss would be 332, and my target would be 305. The second stock is SBI Life. Already in the downtrend, taking resistance at the averages, has broken a triangular pattern on the downside. So my target would be around 1700 and my stop loss would be 1855.
Thank you very much for that. Those are some technical trading ideas. Today also the 3-day RBI MPC meets starts from today, 3rd to 5th. The decision will be only known on 5th. That's Friday at 10 o'clock. Perhaps no tinkering on the rate side, but the outlook on inflation growth will be very crucial in light of the fact that the West Asia crisis continues to simmer on. But let's talk about autos. Jay Kale, Executive Vice President Research, Elara Capital, is now joining here with us in the studio. Jay, it's so good to have you here with us in the studio.
Yeah, good morning and great to be here. Thanks for having me here.
All right, so let's begin top down. The Q4 earnings season, the key takeaways, and that with the fact that we got the May supply, May auto sales numbers. What's the read on the auto sector from here on?
Yeah, so I think if you see the numbers in Q4 have been pretty good. Most of the companies reported in line to marginally above estimate numbers. The commentary was also pretty buoyant from a demand trajectory side. If you see passenger vehicle players, most of them kind of guided 10% plus growth. Two-wheelers was single-digit growth guidance. CVs was a little cautious. But one needs to see what happens from now, because all of these numbers and commentary was before the fuel price hike. Till then, the buoyancy was there in terms of demand. But of course, now one needs to see the way forward once this fuel price increases happened. Current numbers seem to be good, but there will be some slowdown imminent going forward.
Okay, all right. Let's take it piece by piece. Then, Jayan, good to have you in the studio. The passenger vehicle segment. You had a couple of stocks that have done very, very well. But now, what's on your pecking list? And for the industry, what kind of growth are you factoring in for FY27? Some of the street believe that maybe these OEMs are being a little bit too ambitious. Right. You're in that camp, or you believe that they'll walk the talk?
So I think if you see, everyone's given growth guidance. Most of them have given growth guidance for themselves. So obviously, most OEMs expect market share gains for themselves. Our current industry growth assumption is 6 to 7% for FY27. If you see, till now, they've clocked double-digit growth. May has been pretty good. Also got to do with some bit of pre-buy because there are some price increases coming in June. Point is that with this inflationary pressures that we've seen in the last few days, you will see some bit of a slowdown. But the question is, a key question in minds of investors is this a slowdown or is this a start of a down cycle? In our view, this is more of a slowdown, not necessarily a start of a down cycle, because there are other positive metrics also that have happened in the last 8 months, which should hold in good stead in terms of resilience of demand, which we are already seeing currently.
Okay. You've written a recent report which talks about the two cycles and the parallels after F518 and H1 of F519. Take us through what's happening and what we can draw from the lessons of the past and how it's going to play out.
Yeah, so like I said, the key question is that with all these fuel price increases that we've seen, could this be a slowdown or could this be a start of a down cycle? Now, we draw parallels to what happened in the FY20 down cycle, and this is even before BS6 increase and pre-COVID. Actually, autos started declining in FY20 in terms of retails even before COVID hit, right? And that was got to do with one, NBFC crisis, the fuel price increases that had happened, the insurance increase that we had seen. All of that meant that during 2H FY19 and FY20, the total cost of ownership for PV and two-wheelers actually increased by 4 to 6%. Okay. Right now, if we draw parallels to that currently, here also we've seen that we came across a very good growth in 2H FY26, and then of course these inflationary pressures are starting to hit. But if we see to this time around, the total cost of ownership, even after these increases, is still 1 to 4% below pre-GST levels. So we still have that cushion, and hence probably the down cycle may not be triggered in this cycle versus what we saw in FY19-20 time frame.
So you'll be reasonably more optimistic on both the two-wheelers as well as the passenger vehicles, what you're saying. Tell us, what about CVs?
Yeah, so
some on the street, they were talking about this, fresh trend emerging a few months ago on CVs, and to be fair, that has, pretty much played out. I mean, I think there has been a bit of recovery out there. But would you be a little bit cautious on CVs?
Yeah. The CVs is one of the most cyclical industry, right? If you see till April to November, things weren't really that buoyant, and then December to March, we suddenly see a huge spurt in volumes, and that triggered that probably this cycle will last longer. But here we have to see that the tonnage has already crossed pre-FY19 levels. So we're already sitting at peak tonnage, and from here, if diesel prices the way they are going up, fleet operator profitability becomes a question. And the key driver of demand in the last few months was replacement demand. Yes. With fleet operator profitability coming under some question, they will be a little cautious in replacing their demand, and they'll probably chug along with their old fleet as well. So to that extent, we are a little more cautious on CVs. PVs and two-wheelers are much more resilient. Historical cycles have shown that PV and two-wheelers cycles are not sharp. CVs are pretty sharp. Risk reward from here, in our view, is better for PV and two-wheelers over CVs.
What you put out a couple of scenarios, right?
Yeah. So what we're saying is that if at all, in a worst-case scenario, the down cycle like FY20 happens this time around, what are the kind of downsides we can see for the different segments? For stock price downside from here for PV and two-wheeler names, in a worst-case scenario, could be 10 to 20%. But for CVs, even after the recent correction, could be 30 to 40%. Whereas the base and bull case upsides for PV and two-wheeler names are close to 20 to 80%, whereas for CVs is just about 10 to 50%. So risk reward, if I have to look at from here, much more favorable for PV and two-wheelers than CVs.
Do you think EV is at an inflection point, and can supply keep up with the kind of demand we're seeing in the market, or will that be a bottleneck for strong growth?
No, absolutely. I think EVs, if you see post Feb March, have seen very strong demand on ground, and we are seeing capacity constraints being seen. However, I'd like to point out that 1 year back, EV penetration was kind of undershooting the earlier expectation, which now is actually kind of probably FY30 estimates of EV penetration of 20% for two-wheelers and 15% for passenger vehicles now looks more realistic given the recent scenario. I think for the next few months, it will be a capacity ramp-up mode for PV and two-wheeler names on the EV side. And I think EV penetration is surely expected to increase further from here. The buoyancy on ground, the customer sentiment is definitely more positive on EVs now than 3 months back.
We can't let you go without giving us your top picks. Since you like PVs as well as the two-wheelers, what's top of the list out there?
So within our top picks, we have Eicher Motors, TVS, Maruti, and Mahindra. We prefer in this expected slowdown kind of a scenario, companies which are expected to gain market share, like Eicher and TVS, are expected to fare better, and valuations will be much more supportive for them.
And one auto ancillary stock that you would bet on?
I think I'll give a name. I have 4 top picks over there. Gabriel, Minda Corp, Uno Minda, and Sona BLW. These 4 would be the top 4 auto anchors over there.
Jay, great to have you here with us. Look forward to the next conversation, and keep coming down here to, with us to chat face to face.
Surely, it was a pleasure. Thanks for having me here.
Okay, it's about 9:10. The pre-opening rates have settled in, and it's a downtick of about 67 points. Sensex lower by 140 points. So mildly lower after the big up move that we had yesterday. Sudarshan is back with us for his 9:10 call. Sudarshan?
It's CAMS, buy CAMS with a stop under 760.
Okay, now let's go across to our Sudarshan for some brokerage calls of the day. Sudarshan?
So first one is on pipe companies. JP Morgan maintains overweight call on Astral with a target price of 1,800 rupees per share. Same overweight call on Supreme Industries, and here target price is 4,050 rupees per share. It says the top 5 companies combined saw 8% YOY volume growth in FY26 with substantial market share gains by both Astral and Supreme Industries. And these 2 companies have delivered volume growth of 16%, 14% respectively versus flat for rest 3 companies combined. So it expects share gains for these 2 companies to continue in FY27, and these 2 companies can continue to report double-digit volume growth even if industry sees muted growth in FY27. Next one is T-Tagar. Jefferies maintains buy call and target prices increased to 990 rupees per share. It has written the note after Q4 earnings in which EBITDA was 7% above estimates, which was driven by better than expected execution and margin, and also management has guided for substantial execution ramp up even in FY27. Company is going to be a key beneficiary of rising passenger metro coach demand led by government initiatives, and considering all these factors, Jefferies now estimates 44% FY26 30 EPS CAGR. Last one is car trade. Kotak Institutional Equities has upgraded the stock to buy, and target has been increased to 2,300 rupees per share. Stock has come off sharply Y2D on concerns of disruptions from AI models, but as per Kotak Institutional Equities, its deep dealer database and value-added offerings may limit the impact because of AI, but upgrade is on account of sharply higher valuations for OLX, and OLX has said that it targets steady GMV growth, improving monetization and margin, and Kotak has raised FY27-29 EPS estimates in the range of 1 to 5% on higher profitability estimates, especially for OLX.
Got it. Okay, all right. Thanks, Sudarshan, for that. Hopping across to Vinny. She's here with a note on Mankind Pharma. Vinny, you've got a bullish and bearish argument, I believe. Go ahead.
Absolutely. Hi, good morning. So first up, and for the bullish commentary that we have, that's coming from Jefferies. They're maintaining the buy rating, target price of around 3,000 rupees per share. Now, what are they positive on? Double-digit India growth. That should work out for the company going forward. That will drive the growth. And what in that will drive the growth? Acute therapies. That will do well. Strong volumes are expected, and which is already visible in FY26. Now, that is what they expect to continue as well. They're also expecting high teens export revenue growth coming in for the Bharat Serum vaccine side, which they've taken an acquisition as well. So that's why they're expecting stronger growth, and that would drive deeper market penetration and newer markets. That is also something that will add to the growth story. Over the medium to long term, what Jefferies highlights that they believe that the management will continue to invest in R&D, and that could help deliver strong growth. Now, on the bearish side, who's on the bear side? We have Bernstein, that is maintaining their underperform rating. Target price is 2,057 rupees per share. They believe that the go-to-market strategy engine as well as acute therapy conversion, slight bit of a weakening is something that they're expecting here for the company. R&D intensity, that is something that will remain, but versus other peers, it's still 1/3 of that. So versus other peers, they're still much lower in terms of the R&D spends that they've spoken about. And they believe that the move into super specialty, that's a bit of an abrupt move that has come in, and seems like that's a disconnect from the core therapies and core execution. That is something that they are worried about, and that is why they're maintaining their underperform rating on this one.
Thank you very much for that. Just awaiting the market opening. Asia before that, the Japanese markets have surged 2.5%. The Taiwanese markets are 1.9%. And Kospi as well will come up for you on your screen. Kospi is not trading today, but you can see some softness coming through in Hang Seng, even as the Chinese markets are up close to about 0.6%. Just awaiting the early rates. Friday was a difficult session for our markets. Monday, we continued with the downtick. Yesterday, we opened lower but managed to close higher as the Nifty weekly expiry led to some buying. The second half of the trading session was strong, and the Nifty inched closer to 23,500. The bell has rung. The opening tick on the Nifty is 23,420, a cut of about 50 points on the Nifty. The Sensex is lower by 250 points. In percentage terms, we're looking at a downtick of about 0.25%. So not too bad, but a little bit of a give back from yesterday's up move. What's on the way down are the IT names. They've been strong for the last 3 trading sessions. So today there is a pullback in that rebound trade. The Nifty IT index lower by 2.5%, with TCS selling off 3, Infosys down 2, Wipro, HCL Tech also lower by 1.2%. Tech Mahindra has a downtick of 1%, and we should pull up LTI Mindtree, LTM, because the company held its analyst day yesterday, and the company reiterated their aspiration to double revenues in 5 years and expand EBIT margins by 200 basis points. Again, this is the 5-year outlook shared by the company as a part of their Lakshya plans. And their key takeaway is that AI will shrink part of their revenues, but it will open up new opportunities, and therefore net enterprise tech spend, according to them, will expand by $1 trillion, and that's the opportunity they're going after. So IT is right at the bottom. Then you've got cuts coming through in Eternal, ITC, some NBFCs like Bajaj Finance, Shriram Finance, a weak. Asian Paints is under pressure, so that's down over 1%. Now, we've seen an increase in crude prices, and along with that, Interglobe Aviation will also come up. On the way up, a few gainers. I can count 5 on the Nifty, led by Adani Ports, a Bharti Airtel, and an Apollo Hospital. But no Nifty stock, at least as of now in the opening tick, has a gain of more than 1%. Now the sell-off is accelerating. What started off as a 50-point downtick has now accelerated to 160 points lower on the Nifty, and the Nifty is now closer to 23,300. The key level to watch will be yesterday's intraday low, 23,220, which has acted as a support in the past as well.
Tricky times, Rima. You take a look at the tech index. Well, that's pullback itself. Yesterday it was the biggest gainer. Today it's the biggest loser. And you have tech stocks that are selling across the board. You know, if you look at the broader market, stocks like Forge, LTI, I think you have Persistent Systems, all of them down 3 to 4% in trade today. So big downtick is what we're seeing. Emphasis as well as down closer around 3% or thereabouts. From the frontline names, though, there are a few gainers because you have around 900 stocks that are still gaining. MTAR Tech, just take a look at that stock. It pulled back a little bit. It's resumed its winning way. So big uptick is what you're seeing on MTAR Tech. Volume's fairly decent as well. Borosil, I think there's some protection that's coming in there. So that's why Borosil as well is up close to around 4%. Good move is what you're seeing on Borosil. Concord Biotech, a favorable news flow coming in there. So that stock as well has moved up. Smart up move is what you're seeing out there. And Newgen Software, you know, that was a stock that moved up yesterday 15% on large volumes. It's a stock that's nearly halved, I think, from the top. But today as well, volume's quite high on that stock, so it's moving up. Sterlite continues its winning ways. That stock is up close to around 5%. Remember, yesterday, there was some supply that came. That's got lapped in 2. Another stock that I'm looking at very closely is Tejas Networks. Now, just take a look at that stock. That one, in fact, is up close to around 4% as we speak. This is a stock that had corrected from more than 1,100 rupees all the way to close to 300 rupees. And today it's moving with very, very good momentum. So keep an eye out on that one. NMDC, we told you about the price increase. It's rallied a goodish bit in the last few trading sessions. Today it's putting on some more weight because of the surprise price hike that we've seen. The Nifty has revisited the 23,300 odd mark. The past 1 month has indicated that at around 23,250 to around 23,300, you've seen a bit of a bounce. The bulls will latch on to that data point and hope that we see a bit of a bounce even in today's trading session. For the time being, it's a very, very nervous start. But maybe, in fact, the bulls will fancy their chances. For the time being, the Indian rupee as well has opened up with some weakness. Falling through yesterday's weakness that we saw, the rupee yesterday ended at around 95.3, I think so. Let's pull up the Indian rupee. I think that showed some weakness to kickstart trade as well. Now down close to around 200 points. So clearly, it's a very, very weak start to the trading session, Rima.
Well, indeed. So those are some of the big movers. Just to go back to that point about LTM, that's LTI Mindtree, and we had some brokerage notes also coming through on them. So Jefferies has an underperformed rating, UBS has a neutral rating on LTM. So basically, you know, as I said, they had their analyst day yesterday, and what they gave, and this is important, they said the enterprise tech spend today is $1.3 trillion. Now, because of AI, the legacy business, we will see a compression of 20 to 25% of the current spend. So 20 to 25% of current 1.3 trillion, which is about 0.3 trillion. So we are looking at a net tech spend of $1 trillion.
Right.
But because of AI, two new opportunities are opening up. One is companies are looking to modernize their tech debt. So that is an opportunity. And secondly, even business AI services is opening up. So these two together, according to LTM, can add 1.3 trillion in terms of an opportunity. So therefore, what they're saying is you add the existing 1 trillion, which is net of the business compression because of AI, the two new opportunities of 1.3 trillion, we're looking at an enterprise spend of 2.3 trillion. So current 1.3 trillion, which is pre-compression, goes up to 2.3 trillion. And that is the opportunity for the Indian IT companies. Now, the question is whether they can execute on it. So brokerages is still not convinced. So UBS says that we will wait to see tangible signs of revenue acceleration before they turn constructive because they have a neutral call on LTM. And what LTM also spoke about is that they see 200 basis points of margin expansion over the next 5 years because some of these services are coming in at higher margins. But again, I think the proof will be in the pudding in terms of execution. But that is, one of the few companies talking about how this entire enterprise tech spend will change for IT services companies in terms of opportunity, in terms of compression. It was laid out by LTM. And just to reiterate, their 5-year goal is to double the revenues and expand margins by 200 basis points. But we've got Vikas Khemani, founder of Carnelian Asset Management, joining in. Because it's been very, very tough. All domestic institutional investors, retail, they've been so patient. They've been consistently putting money into the market month after month. But it's tested everyone's patience with the kind of moves that we've had in the market. What is your own assessment from here on? Do you think this is going to be another tough year where you should not expect anything in terms of returns? Because even if you go up from here, at best, perhaps you will have a flat year.
Morning. I think in the last 1.5 years, we have had one or after, setback at a, macro global level, started with, of course, in India, Operation Sindoor, then tariff, then, West Asia war. Beginning of this year, if you remember our conversation, we were very positive because corporate earnings were picking up, Indian economy was holding on. The West Asia war has created a concern, especially on the oil price and, of course, our pressure on the currency. So that has put some pressure. But again, I think these kind of events do happen in the markets, and which kind of derails the story from a short-term perspective. But we all know from the experience, whether it was Ukraine war of 22 or COVID year, that these kind of periods are the only period which are the best vintages to be built. And investing is never about a quick return. That's called trading. So according to us, and I understand that when you don't make money for 1.5 years, it feels bad. But at the same time, investing in long term gives you these kind of periods only give you the best outcomes. So we've been kind of our view is that once the West Asia war settles down, or especially the energy prices comes down, I think India's story should be back on track. I mean, still it is in some sense from other than this factor, pretty much the rest of the macro factors are working out, and thankfully. Domestic flows have held on to the markets, and this kind of situation, also markets have held well. Imagine, when things turn back, how the market would behave. So according to me, and we've been fully invested. Our idea is to kind of identify good companies which you think can come out well on the other side. And we've seen this in the past. So that's our approach, throughout this period of crisis.
All right. Hi, Vikas. Good to see you. And Vikas, what kind of measures are you looking at? We're looking at the center, and we have now, I think, a 9-month period where there is no elections as well. So some good reform measures can be taken. Anything that you're looking at in particular?
Yeah, there's a possibility of some kind of, reworking on the capital gains situation. That's at least from the recent comment of FM. If that could be worked out, that would be good. According to me, keeping a point, equity market is in the interest of ability, having good equity capital is available for the economy, and tax collection anyway from capital gains is not a lot. So it's a good trade-off, in my opinion. Government can make up, but if it happens, it'll be great. If it doesn't happen, I think we have to keep working at what it is. So, and generally speaking, I think other than that, I would expect the government to continue to focus on investment boosting. How do we do import substitution? Because government is working at it, and there's no quick answer to that. One of the biggest problem is semiconductor imports, and that has put a big strain on our FX. Gold has put very big strain on our FX. So any measures around that would be welcome, but there are no short-term answers. I'm completely aware about it. So I'm sure there will be some work happening there. But in general, I think continuing to execute more of same. How do you boost industry? How do you boost investments? Execution focus. Those are the important things.
There is a Adani Investor Day which is taking place today and tomorrow across Mumbai. So all the key Adani Group stocks will be presenting today. So whether it's Adani Enterprises, Adani Ports, Adani Green, and you can see buying in some of the names. So for instance, Adani Ports is up 1.3%. So maybe there is some excitement. The street is going to wait and watch to see what comes out of that. Because are you invested in foreign markets? Is that something you're looking at, or what percentage of your portfolio today would be in markets outside of India?
I think I do believe that India is one of the best sort of wealth creation story, not now in the shorter term, but even in over 5, 10, 15, 20-year period, we have seen from that experience. So, we think that, diversification should be done, global diversification should be done only with a purpose. So we don't think there's any significant merit from an objective to be achieved perspective. So everybody has. So we currently don't have any exposure to any global markets.
Okay, all right, Vikas. But what do you make of this entire AI theme that's playing out globally? We have missed out. It seems we have become a bit of a punching bag, right? Because in the last 12 months to 18 months, crude goes up. AI trade plays out, something or the other. The rupee weakens. But at times, this gives you a perfect and a good entry opportunity for longer-term investors. Comment on this AI trade, and we have a couple of large global IPOs that will play out. So there'll be some rush of money maybe out there. Will it signal a top?
So I think, it's a good point you're raising, that this whole, very often people say that, we have to be only copy of other markets and other. I'm not saying AI is not significant. AI is a very big disrupting sort of technology or change, which all of us will have to adapt and work at it. It will change the way we work, and there are different layers. Every country has strength in. India would have probably more strength in implementation because that's our legacy, that's our sort of strength and ability. So I do believe that first part, of course, value has been created by US markets and some of the companies are going public. What worries me in that space is that I think it sounds like pretty much like .com, where lots of situation was there where the .com was supposed to disrupt the world and massive investment was happening, M&A was happening at crazy valuations, and we all saw what worked out. So to me, currently, a lot of questions started happening about the returns on the investments of you make in AI. If let's say about $1 trillion of investment is supposed to happen in AI, how the ROI is going to come from on that investment? Who will pay for that ROI? Will it be extra productivity? Will it be job losses? What will be bought? I think those questions are already beginning to happen. So I think we'll have to only see. Only time can say that whether it is a bubble or it is here to stay. There's no question on that. The thing is that whether investment point of view, whether it will make money from here or not, is the only time will answer. Our view currently has been that it sounds like more like a sort of euphoria bubble from an investment point of view, and hence we've tried to stay away more, where we think that we understand the risk reward of investing. That is where we would be putting our money on.
Got that. You want to tell us how your portfolio is constructed right now, Vikas?
I think it's again, we've been very, very heavily invested into pharma, CDMO, healthcare space, which we've been very, very positive about. It has worked out very well for us. In financial services, which are again, in companies which are growing at 20-25%, we have a good run in most of the places we've been invested in financial services. So manufacturing, we've been a long believer, and last year it was a rough patch, but I think this year it's come back. Once the tariff issue sorted out. So I think, for us, things don't change very often. For us, we believe in all these things which I talked about from a medium-term to long-term perspective. We don't kind of do narrative-based investing. We do based where we see cash flow moving, profit growth moving, ROE coming through. And more importantly, we can understand the risk reward. Very often, there may be a good investment opportunity, or if you don't understand the risk reward, you should not be betting on it. So we avoided. So our portfolio has remained by and large around the theme which we've been continuing for a couple of years.
Vikas, mentioned a few themes, but if you could tell us that one theme that is in for a multi-year bull run, that one theme that you're really bullish on, say the 5-year horizon, could you name that?
I think the whole manufacturing space we've spoken many times over, and we think that India is at a very early stage of manufacturing replacing import substitution, export oriented stories, and that will continue over one decade, according to me. Our manufacturing GDP is around 15-16%. That's where a lot of government focus is happening. That's where a lot of opportunities are, both from import substitution, export oriented, and that spans across various sectors, whether it is auto components, whether it's chemicals, specialty chemicals, CDMO, capital goods, and within those names, you have to identify good risk reward stories. But there are a plethora of them, and plenty of them where we think that over fullness of time they will become 5x, 10x, 15x from where they are today.
This entire solar theme seems to be also doing pretty well. So, an MV is up 1.5%. Vikram Solar is higher by, again, another 2%. Do you have a view on the solar theme in the manufacturing pack?
I mean, to the solar, meaning the renewable space. So I think, again, we currently don't own anything. And we believe that the first leg of that has played out. The competitive intensity seems to be intensifying in the sector. So hence we've kind of, the valuations have come down. Most of the stocks have got derated in the last, 1 year or so. So I think we've so far stayed away from that, and we keep watching. Currently, we don't know it.
Okay, all right, Vikas. Thanks a lot for joining in. Wishing you a good day ahead. Always good to hear your optimistic voice. Particularly at times like these where people are getting a little bit jittery, but the flows, as you said, domestically have been stronger, telling you that the Indian investor is maturing a little bit. Hopefully big returns over the next 5 to around 10 years for medium as well as long-term investors. But let's move on. As India looks to attract more foreign capital into the country, the CNBC TV18 IBLA collectives asked the question, can GIFT City be the gateway to make this happen in a big way? My colleague Prashant Nair spoke with the top leaders from markets and the aviation sector to understand where we are and what needs to be done. Let's hear out some comments.
Omnibus investment. Undoubtedly, there is risk of round tripping. But omnibus, where a private bank or a wealth manager or an insurance repper makes investment on behalf of hundreds of their clients, is a globally accepted practice. If round tripping is not an issue in those jurisdictions, we will have to provide similar facility to global investors and global capital. Today, there are many foreign citizens who would like to invest in India. They have some connection with India, or they are interested in participating in India growth story. But they'll have to take a PAN account, PAN number, PAN card in India for investment. That's not going to work. So why not give omnibus facility to private wealth bank insurance pool so that they can collect money from their customers and invest via Gift City into India.
If you created a leasing company in Gift City and you want to remove the asset from an Indian airline to, let's say, a foreign airline in a third country, then the most efficient way to do that is if you have a double taxation treaty with the third country, which India has a few of them, perhaps not to the extent that Ireland has. And so, yes, over time, we will need to increase the amount of double taxation treaties we have to be able to create a stronger set of sort of taxation infrastructure for Akasa. I mean, the good news is we're an airline, not a leasing company.
Correct. No, I mean,
so as such,
on the other side, yes.
Yeah. So as such, we will continue to lease from third-party leasing companies that could be sitting anywhere in the world, and that doesn't change. I think the question that you asked has an effect on someone wanting to create a leasing entity in India.
Lessor sitting in Gift City.
A lessor sitting in Gift City. And that's something that, you know, for that to be fully effective, we'll need to have a broader set of double taxation treaties.
I think India must do a campaign called Inevitable India to attract long-term capital and to attract high-quality talent back. How do we make it easier for onboarding, easier for the convenience of like investing initially? Omnibus is one, maybe the digital KYC instead of having those physical, instead of wet signatures, we make it very easy. And just to expand on the point of what Nilesh Bhai mentioned, that when you look at Clearstream, Allfund, those aggregators or the platforms, or you look at, let's say, Standard Chartered Bank as a custodian, globally they would be marketing different kinds of products in different jurisdictions, be it a UCITS fund, be it a fund in DFM, be it a fund in whatever in Singapore, or maybe a fund listed somewhere. A Gift City product doesn't get added there today because you have to do a completely separate onboarding exercise. If you make it easy, we market very strongly as a country, and all of us will put our might behind this to put like India as a great destination. This time, I think instead of doing some of those kind of like bonds and all, we should really try getting money from the NRIs in the equity market.
Today, if you talk about Gift City, it has arrived, it's got a status of Singham. So Chava has actually morphed itself into Singham. So that's point number one. But that is when you look at it from an absolute perspective, from an India perspective. Because today, the Bollywood grosser, clearly the reigning Bollywood grosser, considering Dhurandhar and the sequel, obviously, both of them put together, that's the grosser. There, I think we yet have to arrive. So we might be a Bahubali there, but the Dhurandhar status is yet to be arrived. So that is the first up thought. So I think for me, the campaign for GIFT would be, do we know the acronym of GIFT? What is the full form? For me, it is Go India, Full Throttle. I think that should be our tagline, because I think the more and more you kind of talk about Go India, Full Throttle, and it's a great catch line for a concept like GIFT, because it's truly a gift.
Interesting one out there. Well, let's get back to the markets. The Nifty is struggling. We're down closer around 200 points. We're at a very, very crucial juncture. The 23,250 mark, that's where we are at. We actually breached it on an intraday basis. Yesterday's low was around 23,229. You don't want that to break on the downside. That could open up further downside from here on. And the first 15 minutes of trade have clearly gone to the bears. So it'll be difficult for the bulls to fight back. But it's back in the slot. So let's see how that goes. Broader markets, a couple of stocks doing well. One such stock is NMDC, because we learned from sources that they've gone ahead and they've hiked prices. On lumps, it's been by close to 200 rupees. And on fines, it's by around 150 rupees or thereabouts. And the revised prices that come up for you is 5,700 rupees on lumps and fines at around 4,850. Remember, this is source-based information. We're waiting for a clarification on the exchanges. I've reached out to the management as well. Not got a response till now, but I think these figures should be pretty much in line. It's effective from today. It's a surprise price hike, right? We're awaiting the monsoon. So ahead of the monsoon, you see a price hike on a company that's already increased prices from January, February, March, April, as well as May. So this 150, 200 rupees is a bit of a booster shock. And we, we haven't seen any kind of price increase actually globally. To be fair, actually international iron ore prices have come down a little bit. So that's why the street is lapping this up. Remember, the stock is reacting to this news positively. And the last few days as well, the numbers weren't very, very good. the production number was good, but the sales number wasn't very good for May. And now this price increase, Street latched onto it. Stock now at the high point of the day, up close to around 1.5%. I'll tell you what, we'll slip into a short break. On the other side, we have Amish Shah of BofA Global Research, who will be waiting for us. He'll be joining from the sidelines of the BofA India conference. Stay tuned. Welcome back. Well, global cues in a bit of a tizzy, and that's why you have Brent crude prices that have spiked up. The geopolitical piece again has come back on the table, and that's what soured mood a little bit. And the Nifty is clearly reacting. Brent crude prices, I think, holding at around $97 a barrel. The rupee is a little bit weakish, and that's why, in fact, we are lower with a cut of close to around 200 points. But let's get in Amish Shah, Head of India Research at BofA Global Research, who joins us on the show. Hi, Amish. How's the conference going? What's the mood like out there? As good, as bad as you expected? Is there fair amount of interest for India?
Hey, Nigel. Good morning. Interest, yes. Versus last year, the corporate attendees are up about 10-12%. Number of clients are up about 29%. So we are not complaining in terms of interest on India. Messaging is mixed. So there are. When you look at the long term, there are a lot of policymakers talking about how do we get out of this crisis, how do we bring the growth up, and we will discuss the details. Corporate India, on the other hand, is sounding a little more modest. They are cautioning that first half of FY27 is going to be impacted on the back of West Asia conflict, higher commodities, and a possibility of El Nino as well as rate hikes.
Okay. Amisha, hi, morning. So in terms of policy expectations, what do you think could be on the anvil now till the end of this year, FY27? Because you spoke about policy imperatives in our past conversations about energy security, maybe even shipbuilding. That was a theme you referred to last time around. So in terms of realistic expectations on the policy front?
So, Reema, energy security was debated and discussed quite at length. Variety of policymakers all acknowledge that it is a top priority. There is a lot of discussions going on, and they want to address all forms of energy security, including biofuels, including coal gasification, more electrification, more oil and gas exploration. So everything's on the cards. Meaning, obviously, they are trying to come up with what would make it viable, where is there a need for subsidies, how do we make it exciting for private sector capex and SOE companies or PSU companies to get in a big way. So I think it will take some time for the policy drafts to be out, but definitely it's up on the agenda for policymakers right now. The other thing that we learned was there's a debate going on, as you would agree, that will the central government cut capex in order to meet its fiscal deficit targets, or will they continue with capex in order to promote growth? The policymakers are arguing for the latter. They want to continue with capex as is. There is no curtailment that they are expecting. And on the other hand, a lot of auto companies are talking about that post the West Asia conflict, they've already seen a large demand for EVs, and some of them are starting to see supply constraints. So they're now talking about ramping up their production capacities on the electric vehicle side. Final thing I would say is also on power distribution sector. There is a debate within policymakers on whether we should fix the problems of that sector through legislation changes or should we do it the other way. But clearly power distribution reforms are also on the cards.
Okay, all right. Amish, what about, in terms of earnings for this year? Do you think that, they have seen some kind of trimming back in terms of earnings expectations, and ultimately a market is driven by earnings, right? Growth, earnings, both those two have been missing, and FY27 is supposed to be a better year. Are those hopes fading away if there's going to be capex cuts, if we're going to have elevated crude oil prices, and the economy is going to slow down a little bit, not even considering that the RBI hikes rates till the end of this calendar year?
So there, Nigel, as you know, we have a somber message. We are already working with 8.5% earnings growth, which is much weaker than the 15% that we have from the consensus. We do think that every result season will act as earnings cuts from the street. And going back to my earlier point, the corporate India at our conference is also cautioning investors that at least the first half of the fiscal 27 is going to be impacted on earnings. The other pattern that I have picked up is that earnings are going to be more of a challenge for B2C companies as opposed to B2B companies, because B2C companies are finding it very hard in the current environment to pass on the cost pressures through price hikes. B2B companies, on the other hand, are still talking about price hikes, even if it comes at the cost of weaker volumes over time.
Amish, did you manage to convince the foreign investors about India to put in money in India? Or it's a hard sell?
So, Rima, look, we are definitely arguing the themes in India and the long-term stories, etc. And they're all convinced. It's not as if people have given up on India, going back to my point about 29% higher participation at our conference. But to be realistic, I think most foreign investors are trying to do their homework in order to be ready of what they want to buy, at what price they want to buy. But unlikely that foreign flows are going to turn meaningfully positive anytime soon.
So, Amish, if I have to ask you your learnings, based on the conversations that you had with corporates, policymakers, even from an investor point of view, what challenges the current thesis that you have about any sector, if you could like that? Maybe you've gone it back and said, well, this is where we got it wrong and we need to re-look at it. Or any conversations which have reinforced their view, or you now come away saying that, guys, this is the top theme we need to bet on. It's a structural up move for the next 4 or 5 years. So on both places.
So, Rima, on the reinforcing our view, there are plenty of things. We were bullish on, let's say, the non-ferrous metals. That commentary is quite strong. We were bullish on financials. All the financial companies are talking about that NIMs may be a bit of pressure, but everybody's arguing for improving loan growth, etc. We were quite optimistic about the energy security piece that we spoke about, and that was dependent on policy action. There is indeed a policy action. We were hoping for a good window available to do reforms, because there are no elections until February of next year. Government is talking about doing reforms. So all of that is basically reinforcing our view. And on the bigger picture, we were arguing that FY27 earnings will get cut. We are already the lowest on the street at 8.5, and it seems that the street will eventually converge with us. So I think all of this aligns with our view. In terms of surprises, I would say I was negatively surprised in the telecom space, because most of us are expecting a tariff hike. That seems to be very tough in the current environment. So that's a negative. On the positive side, we were of the view that capex curtailments from the central government is very likely, because otherwise fiscal deficit targets and debt to GDP will start to look a concern. But the government policymakers are very clear that they are not going to cut capex. They are in fact arguing that, can we cut leakages? Can we improve the efficiency of subsidy distribution? And on the back of that efficiency savings, can we continue with the balance of fiscal deficit and capex?
So now no telecom hike till when, Amish? You said you were negatively surprised. Street was hopeful that maybe in the second half of the year we would see one. So now you think this has been pushed forward by another 1 year, 1.5 years, even longer?
Yeah, so, it definitely doesn't seem like a calendar 26 event, Rima. So it's now wait and watch because inflation is already on the rise. It seems that the telecom players are not very confident of taking a hike in the current environment. But in case if the West Asia conflict were to resolve, inflation were to roll back, perhaps that is a time to do it. But it doesn't look like this calendar year event. Obviously, telecom companies are arguing about that it will still lead to ARPU continuing to grow on the back of premiumization, and which is all very good. But the tariff hike seems to be pushed out to next calendar.
You touched on a few sectors, but you didn't tell us what people are thinking about the AI/tech theme and how is that playing out. SaaS companies globally, they saw a bit of a bounce back of late, and that had a positive rub-off here in India as well. But what's the feedback?
So, Nigel, all the foreign investors are still, having a consensus view that AI capex will continue to accelerate. This is still not time to take the foot off the pedal in Korea, Taiwan, if that's your question. But if you think it from the flip side of IT companies are actually also having a positive story to say here. So they are arguing that enterprise AI investments or capex has already started, and it's started faster than what they would have expected. And as a result of the AI spends by enterprises, they are in fact arguing that the deflationary pressures of revenue growth that we had seen in IT, it is already a bottom. So we are for the large cap companies in IT, as we know, revenue growth is already down to 2 to 3% constant currency terms. They are arguing that 2 to 3 is now a bottom. On the back of AI investments, that growth will now start to creep up, but there is no further deflationary pressure.
And going back to that point about that there's a lot of debate on whether the central government will be cutting back on capex, and the key takeaway seems to be that no, they're not. So the capex spend remains intact. From an investment point of view, what does that lead you to?
So, we were positive on certain pockets of capex. We were more excited about the industrial companies that fit into the energy security theme, because that's where we thought capex will accelerate. We were also positive on shipbuilding and defense. So shipbuilding, defense, energy security, and data centers. So that is a pack of capex companies that we were optimistic in general. It seems that it could be more broad-based if the government capex spends continue.
All right, Amish, it's been so great chatting with you. Thank you very much for joining in.
Pleasure.
Have a wonderful last day at the conference. Very insightful conversation coming through, but let's move on because we've got another management waiting by, the one of CMR, Green Technology, and we've got an IPO KYC lined up with them.
Well, that's right. Let's get straight to the management then. It's a 631 crore rupee IPO that opens for subscription. The price band should come up for you on the screen. Let's find out what's the strategy ahead. We're joined by Mr. Mohan Agarwal, the chairman and MD of CMR Green Technologies, who joins us on the show. Hi, Mr. Agarwal. Good morning. Good to see you in. And all the best with this IPO. In terms of valuations, I think the bankers have done a good job in terms of pricing. So good on you on that. Let's see how demand goes, because if I compare your valuations with the rest of the companies that are already listed, it seems fairly attractive. That said, we need to understand business. So let's go straight up. What's your current capacity utilization levels? Most of your money comes in from the aluminium recycling vertical. So tell us, what is your utilization levels? And I see you have much higher capacity in comparison to your peers. So what is the targeted capacity that you're looking at?
Thank you very much, and good morning to you. Before I come to your question, this is the first time we are coming to the market. So I would just want to give you a perspective of overall what is our business. I started working in 1986. In last 40 years, recycling and primarily aluminium is the only thing that we have done. It has always been my dream that we build an organization which will last more than 100 years. For that, the foundation has to be extremely, extremely strong. So what we have worked on the foundation is that we, one, built on the governance. We have an independent board for more than 10 years, even though we are now coming to the market. Then we very strongly focus on innovation and technology. We are amongst the top adopters of technology from across the world. People are a very, very important aspect. So we work as a people-first organization. And lastly, growth is extremely, extremely important. So we focus on growth all the time. So having said that, like we have grown, we've been growing at nearly 23% since our inception. 20 years back. We put up 7 plants in the last 6 years. So having said that, coming to your question, we are 4 times bigger than our nearest competition in India. We are also amongst the largest in the world. We have a total capacity of about 605,000 tons. 2 of our large plants are in the ramp-up stage at this moment of time. So we recorded a 70% capacity utilization, which is ramping up further.
Okay, 70% utilization level, right? That's what you're saying right now.
Yes, sir.
And in a business like yours, can you go to 80-85%, or is there a or 90%, or is there ballpark for the industry it stabilizes? I mean, the peak level is 80-85%.
In certain businesses, like we have been up to now targeting the auto business.
Okay.
Where have a 45% market share and where our capacity utilization kind of peaks out at about 70-75%.
Okay.
Now we have added a plant for billets and sheet ingots. There we can go for about 95% capacity utilization, and we have also added one more plant where we recycle beverage can and supply liquid metal to Hindalco Industries.
Right.
So that is again, we can go to about 95% plus market share. One very strategic thing that I would want to point out here is that this venture of ours where we are bringing the recycled metal to a primary producer is something which is very futuristic or is very strategic for us, because in the decarbonization effort of the primary producers, everyone will have to have a recycled metal in their portfolio. So we getting a first start with that gives us very good growth opportunities in the future.
Got it. Okay. All right. And your market share currently is around 10 to around 12%. You're satisfied here? Or in the coming years, do you see you would like to have a higher market share?
Look, of the auto space, recycled aluminium, we have a 45%.
Mention that. Yes.
Of the overall recycling space, we have a 17% market share. We obviously would want it to go up. I mean, 10 to 12 is wrong. It's 17% as of FY25, 17.
Oh, you're saying you're at 17%. All right, because we got various presentations and various research reports that came out, but we'll correct that. 17% is what you're saying, and you want to hold on to that market share, right?
Yeah, grow it actually.
Or grow it towards 20-25%, say in the next 3-4 years?
I would target that.
Okay, got it. Global Scrap Processors, that's the entity that holds stake, and I think 80% of this OFS is going to be, because of them. The core promoter entity is diluting very, very little. What will their share be post this dilution? Are they totally out?
No, they will still continue with 1%. They have 13. They came in about 13 years back. They've been a very consistent, a very patient investor with us. And they still want to continue with 1%. Even after 13 years, they don't want to exit completely.
13 years ago, what kind of valuation did they come in at?
They came in at a very low valuation. I think they are getting pretty multiple, tens of multiple. They are getting a very, very good value.
Okay. Let's focus on a couple of other aspects. Your debt, the last recorded number is close to 900 crores, I think. So could you help us out with what is the net debt in your books and where do you see this number headed?
The net, we have always maintained a debt equity ratio of close to 0.5.
Okay.
Because of the increase in prices and also the capex that we have done recently. Large So it has gone to about 0.76. I expect the debt should come back to about 0.5 in future.
0.5.
That's where we have always been, because as the new capacities are ramping up, our debt equity ratio will also come down.
Got it. Tell us about your revenue mix. Currently, aluminium is close to around 80% of your mix. Would you like to maintain it around these levels? And if I look at it, automotive as well is one of the dominant factors, right? It has a large share and it's moved up over the last few years. So what should the mix be on both these two parameters? Aluminium as a contribution of total sales and auto as a contribution of total sales?
Out of aluminium, the auto comes within aluminium.
Yes.
So out of the 78% aluminium portion that we did in FY25, auto constituted 90%. Now this auto's constitution will go down as we will do more sheet ingots and beverage can recycling and billets. On the other hand, we do the balance 22% was furnace ready scraps of brass, copper, zinc, stainless, magnesium. So we are a non-ferrous metal recycling company with focus on aluminium.
Okay, what I was trying to understand is auto segment is better margin business or margins are the same? Because I was observing over the last few years from 3.5% of margins, you moved to around 5%. Does this mix change the trajectory of the margins? And do you believe that margins can continue to improve from here on, say by that 50 to 100 basis points per year?
Look, one auto is a good business. The other business that we have added are also good businesses, both from margin perspective and consistency of the business. So all the businesses that we have added are good. We are continuously innovating. We are continuously taking steps to up the technology, to better the quality and to reduce cost. So with all those things, we believe that our margins should improve as we go forward.
Okay, you believe that margin. So, currently you're ballpark around 5.5% odd. Say in the next few years, it should move, say, closer to around 7% or thereabouts. That would be the aspiration?
I would not, as an aspiration, you can say yes, but we more concentrate on ROCE. And then it's a reasonably good ROCE that the recycling sector provides.
You want to tell us what is your targeted ROC? I think your legal team is, cautioning you. Make sure you don't give any forward numbers. We are talking about aspirations. Tell the legal team, you're in line. What is the targeted ROC you're looking at?
Again, they say don't give me a number, but it will be in line with what you are getting for the other recycling companies or slightly better than them. That is what would be our target.
Okay.
So that's what...
Okay, one risk is that your sourcing of your raw material. I understand most of it, I think around more than 45% of your imported scrap is sourced from the United States. You could correct me on that number. And do you believe it's a risk or do you believe you're well guarded?
Sourcing from United States is a major sourcing. That's because United States produces the most scrap and sells the most scrap, exports the most scrap in the world. And we have our own 100% subsidiary there, which buys. As far as our risk is concerned, we are present across the whole world. We buy from more than 73 countries, thousands of scrap yards across the world. So we are very well distributed across the world to be able to source. So I don't see it as a risk. And US sourcing about 47% is also within, it's not a risk.
Okay, you don't believe it's a risk. Final question, sir. What is your capex plan? Because this OFS money is going to, to that large entity that invested and made multi-fold profit over the last 13 years, and some part goes to the promoter entity as well. So what is your capex plans? I wanted to ask you, because I'm looking at your operating cash flows in FY25 at least, it was negative. Could have been due to some one-offs. But how do you fund this capex plans? If you could help us out.
we have been funding our capex through internal accruals. Going forward, also we generate enough cash that we will be able to fund our capex plan, and that is why we have not taken primary in the company.
So operating cash flows turned positive, right?
Yeah, absolutely. And that negative is because of capex and larger working capital requirements because of increase in prices. So that
put a number, sir, to that capex plan per annum. How much is it? I think you've been doing 100 to 250 crores per year on capex.
Look, I will. In the last 2 years, we did 500 crores of capex.
Oh yeah, so 250 crores per annum is something that you will be looking at.
I cannot give you a future number at this moment of time, but yes, we would want to. We are a very growth-focused company.
Yeah.
So it all depends on what is the opportunity that we get.
Okay.
जैसे अच्छी, as we get a good opportunity, we will definitely. Capex is not a limiting factor for us.
Got it. Okay, Mr. Agarwal, it's been a pleasure talking to you. Wishing you all the best. As you said at the start of the interaction, you're a bit of a doctor in your industry, a recycling doctor, one would term it as. And wishing you and all the team all the very best. On listing day, we'll push you a little bit for your numbers. I'm sure your legal team will permit you at that point of time.
Before.
All the best for the issue.
Thank you very much.
Quick check then on the Sensex options data. So let's get a couple of strikes up for you. The Nifty as well as the Sensex, both of them are lower. As we have been covering for the last hour or so, both of them are down. Now the Sensex is down close to 750 points. And the options data is quite interesting because it's telling you that there is some caution out there. Take a look at the 73,900 call. That's fairly active in today's trading session. And the premium, yesterday it ended at around 1,016. Now that premium has come down to around 400 rupees odd. That's obvious, right? Because the direction has gone not, for the buyers. It's gone inverse. So that's why you're seeing some erosion in terms of the premium. There's clearly writing we're seeing at those levels. And since, the world has gone into a bit of a tizzy and we don't know what the geopolitical issues that could crop up in the next 24 hours or so, and we have the weekly expiry that plays out tomorrow, that it appears there's some deep out of the money put buying. The 72,500 put, just pull up the premium of them, that's moved up from close to around 9 rupees to around 23 rupees. So there is some put buying. In case things go wrong, then those put buyers will make money. There's something even deeper because 72,000 put as well has opened up. I'm highlighting this because both of them are fairly active. The premium out there as well has moved up, and that's quite out of the money as of now. But that's telling you that there is some protection buying that we're seeing on the downside, and there's aggressive call writing. And since the 73,900 call is seeing a fair bit of addition and fair bit of writing, you put in there the 1,100 rupees of premium, the 75,000 mark becomes an extremely important resistance mark. And then you have the 20 as well as the 50 DMA. And over the last few weeks, we haven't been able to cross that mark decisively. I recall a couple of weekly expiries ago as well. We went to that mark and we did a bit of a U-turn. So that's the crucial resistance mark on the upside. And looking at the options data, the bulls will believe at least they've got the 72,500 odd mark covered. For the time being, Sensex down 750 points. Take a short break, come back. Manisha Gupta is waiting for us on the other side. She'll tell us what's going on in the commodity markets. Stay tuned.
Welcome back. Let's talk commodities now. Manisha Gupta joins in as always. Manisha, top of mind is crude, and we knew about Karg Island. There's a new island I learned over there, Kesham Island. So tell us more what's happening.
Oh, well, yes, never a dull day when it comes to crude oil. And we are looking at very, very volatile prices continuing into this one. So overnight was a strong gain. We are holding around that $97, $98 a barrel mark. There are reports of Iran firing missiles at Kuwait and Bahrain. And there are similar statements coming in from US as well on how they are shielding it. Also, diplomatic talks between US and Iran seem to have kind of broken with the kind of statements that we are hearing from various state media agencies, especially in Iran there. Also, when you look at the U.S. crude inventories, well, we have seen a decline for a 6th straight week onto that one, and this time around by 6.8 million barrels. It has been a constant draw that we've been looking at in the U.S. crude inventories, also supporting prices there. Also, when you look at the actual physical molecules of jet fuel and diesel are trapped behind the blockade. So the markets believe that the crude oil may come faster, but when it comes to refined products like jet fuel and diesel, that could take even longer to start coming back to normalization as and when Strait of Hormuz opens. So when you look at the U.S. global reserves therein, the U.S. is holding at around 357.1 million barrels. This is the lowest since Jan 2024. So multi-year lows in sense of U.S. reserves there. Also, when you look at the IEA members, and remember, IEA has released 400 million barrels. 50% of that has reached market, but 50% of that hasn't yet. And IEA members also are holding reserves much lower at 1.55 billion barrels versus 1.8 billion that they were holding in the month of Feb 2026. And China, of course, has the largest national strategic reserves, holding 1.4 billion as a single country there. When you look at various statements that have been coming in from major producers and market traders, they believe that the crude prices would go much higher from here on. This is from Toril Basoni of IEA. She's the head of global oil there. She says that it could take 6 to 8 months in a best case scenario if the reopen of Strait of Hormuz was to happen today, and then 50% of 400 million barrels has been released via IEA there. So according to IEA, it would perhaps take nearly 6 to 8 months before we can see any kind of a normalization coming in for the crude there. There also is a very strong statements coming in from Vitol, MD of Bahrain, who's Tom Baker. He says that the market is underpricing the risk from Iran war right now, and the West Asia conflict has taken nearly 14 million barrels per day off the market. Much of that, of course, comes in from Middle East. He also says that the crude prices may come back, but refined products, of course, are going to take a longer time there. And that is Daniel Haynes for you, ANZ. He says that any efforts to reopen the Strait of Hormuz is facing challenges because Iran has mined large portions of the vital waterways there. ADNOC and various other large producer countries, in any case, have been telling us that the markets are calm, but they will likely be shattering by August 2026, because once the global peak summer demand hits and domestic reserves deplete, the market is facing a violent upward correction. And that is the view coming in from various global banks as well, which believe that by the time it's June end and July end, you could be looking at crude oil prices anywhere between $95 to $120 a barrel on the higher side. Why is crude not trading at those levels right now? That is because it is the Chinese demand has kind of declined. Average China demand in 2025 was 11.5 million barrels per day. China also continued to buy 1 million barrels per day in sense of stockpiling in 2025. So it is sitting on a very large, comfortable stock therein. If you look at Jan to Feb, China was looking at 11.47 million barrels per day of a demand, which is 16% higher on an year-on-year basis. And then came March, and we saw the Chinese imports decline by 3% because the crude oil prices had surged. And then in the month of April, the Chinese imports fell even sharper by nearly 20%, which is a 4-year lows in markets therein. So it has been a very sharp decline that we're looking at in sense of Chinese demand. China has been buying when the crude prices were at 60s and 70s. As the prices went to 90 and 100 and beyond, China clearly is out of the market there. The other thing really is about the Chinese volumes. While they have declined 23% for the month of April, that has freed up the global supply, and that is where markets are taking cues from. Russia, West Africa, Atlantic Basin have supplied to Asian consumers, so we've seen that premium go down a bit. And then China's new EVs are nearly 50.8% of the automotive market, so electrification really seems to be surging in China, lowering the demand for crude there. Is the reason you're not looking at $100 a barrel right now. But then apart from that, it also is about the backwardation that the markets are in. So spot is higher and the future markets are trading on the lower side, and that is what the paper crude oil is looking at. Apart from that, it is a broader financial financial markets, which are working with a demand destruction going forward, also weighing onto the prices. But if this continues for the month of June or even July for that matter, we are definitely preparing ourselves for higher crude prices.
Thank you very much for that. Let's cut across to SBI Chairman C.S. Setty's keynote address at the Citi India Conference.
This 7-year journey that where we started sometime in 1988, I joined in the bank, December 1988, quite some time ago. And the journey of these 37 years also, a tremendous journey for the banking industry in the country. A few anecdotes which I would like to share. In 1988, when we joined SBI, Indian banking was dominated completely by the public sector banks, virtually no private sector banks in the country. And the government of India, through the RBI, wanted to implement computerization. They didn't call it computerization, they called it mechanization. They wanted to bring machines in the banking industry. And every employee, union, association pushed back that we don't want machines. And very typical Indian jugaad, what the government has done is that they have given a computer increment. Anybody who uses computer will get an increment. So all of us, of course, got the increment. And the story of computerization of India and banking in particular and payments in general is an amazing story, right? Where you have started in 1988 and where we are today. Similarly, sometime later, 4 or 5 years later, I was a branch manager in one of the small branch. I remember having, in India, the districts are headed by collectors. They are the district administrator. In one of the days, one collector walked into my office and said that I want 20,000 rupees, clean overdraft. He didn't have, I need to pay a fee to my son's education and my account is elsewhere. So I need some money here. I told him, sir, there is no clean overdraft facility. I can't give any clean loan. Unless you have a deposit with me, you won't get a loan. And then 5 years later, just before this liberalization began in India, we were taking 400% cash collateral to open a letter of credit to import anything into India. So this is where we all started maybe 30, 35 years ago. Today, everyone chasing a retail customer to give a loan, everyone chasing a business to give a seamless SME loan, everyone is changing every particular segment, whether it is a microfinance, whether it is SME, whether it is a corporate banking. And the banking has definitely played an important role the way the country has progressed over the last 3 to 4 decades of my journey in SBI. I thought I'll set the context from there and let us see what exactly the Viksit Bharat and the banking role is going to play. So first of all, again, a very good morning to all of you. And as I said, it's a privilege and pleasure to be here today at the Citi India Conference. I didn't expect to be such a massive gathering, but I think I must compliment the Citi to organize such a wonderful event. And as Amol mentioned, I think it's a time when the whole global economy is navigating geopolitical uncertainties, shifting supply chains, technological disruption, and changing patterns of capital flows. I thought I've seen everything, but every year brings new dimensions of challenges. But India stands out as a source of stability, resilience, and opportunity. Don't look at Sensex. Look at India as a long-term story. I think that is what I'm going to talk about now, that Vision India 2047. You're all familiar with what we talk about 2047, essentially the 100 years of independent India, and where India aspires to become Viksit Bharat, the developed country, and provide at least improved per capita income to $10,000 and be called a developed country. So India's story is no longer merely about catching up. As I said, the context, it is actually emerging as one of the defining growth stories of the 21st century. Increasingly, it is helping shape the global future. Over the last 2 decades, living standards have more than tripled, with the GDP per capita increasing to 2,700. It's still low, but it increased from $800 in 2006. Hundreds of millions of people have been lifted out of poverty. I think it's very, very significant. When I was a child in the school, we used to get, in a government school, a wheat from US under the scheme called PL 480. We all used to wait for that wheat because that used to give the midday meal to many of the students, millions of students those days. Today, I'm very proud to say that India is surplus in the food grain production. And India has established itself as the fastest growing major economies in the world. But the most remarkable aspect of India's rise is not simply the pace of growth, it is the ability to deliver transformation at an unprecedented scale. And throughout this journey, the banking sector has been far more than a provider of financial services. It has been a critical partner in nation building. The most distinctive feature of India's developmental journey has been the creation of a world-leading digital public infrastructure. I think you're all familiar with the DPI, JAM Trinity. I think they've been spoken quite a lot. But the digital prowess, what India has developed, particularly in the payment space, is amazing. And you must have read extensively that today, UPI handles 200 billion transactions every year. And very proud to say that SBI handles 30% of that volume. If you see the volume of transactions and the capacity what the system has developed, SBI alone handles almost 250 million transactions every day on UPI.
Well, interesting conversation there. But for now, we need to slip into a very short break because on the other side is another interesting and important conversation. Lata will speak to Amol Gupte of Citi on the sidelines of their investor conference on the mood of foreign investors.
Welcome to this very special edition of It's the Economy, because this is coming to you from the Citi Investor Conference. And my guest is Amol Gupte, the CEO of Asia South, someone who has put this conference together, actually. Amol, thank you very much. I know I've dragged you from a very busy morning. Okay, just tell us, what is the mood? Because when we look at the markets, I mean, India is, you can't hide the despondence. But how is the mood among investors, guests? Is it also despondent?
So look, reality is that the mood is mixed. It is bound to be mixed because of what we've seen so far. And there's so many factors at play here. You've got the Middle East crisis, you've got the AI revolution, you've got balance of payments, currency, you've got many factors in play, you've got valuations in play, and all of that is impacting our portfolio investors in India. But I think you have to also step away and think about how they're behaving when there are fresh IPOs. And we still see FPIs investing in fresh IPOs when they're high quality.
India.
In India. In India. I'm talking India. And I think it's important when you have a situation like this to zoom out and not look down, but look far. And when we see far, we see the foundational macro of India really strong. The fiscal discipline that India has shown post-COVID is exceptional. Banks today are in fantastic financial health. You've seen corporate results. Corporate results are great. So with that backdrop, consumer is strong as well, right? So I think the long-term potential for India remains intact. That story remains intact. And we've been investing in India for over 100 years. So we see the long-term value for India.
That's the point, Amol. Your predecessors, every time we speak to, your team ahead of the conference, they always say that India is one of the jewel in the crown, the most happening emerging market for Citi. How is it now? Now that North Asia seems to have stolen the thunder.
No, I don't think North Asia has stolen the thunder. I mean, this conference is huge for us. We don't do a conference of this scale. We have 1,600 people coming into this conference. We have 1,300 clients, 300 investors. And we don't do this conference everywhere in the world. There's just 2 countries, Lata, we do this conference in at this scale. That's India and China. That says it all. That says it all. India is amongst the top 5 big markets for us in the world.
Okay. That's good to hear.
I'll give you some interesting data points on how big India is for Citi. If you compare Citi today, and I'm talking about March 25 versus March 23, when we had the consumer business, which we divested.
Yes.
In 2 years, without the consumer business, our advances are up 25%, our revenues are up 30%, and our net income is up 35% on the combined business in 2 years. That's what focus gets you.
Okay. Fair enough. That's good to hear if there is business. But to come back to investor interest, are you at all hearing that with the rupee now, I mean, an economist told us it is 3 standard deviations below its long-term average, if you go by the real effective exchange rate. With the rupee having cheapened and stock markets, in correction territory, over 12% from its recent 2024 highs, is anyone telling you that we are close to the bottom?
If I knew we were close to the bottom, I wouldn't be doing this, Lata, right? I would be a betting man. But look, there are cycles, and we are going through a cycle. And are we at the bottom, near the bottom? We're somewhere there, right? We do expect that the second half will be quite interesting for us and for India. We do think that, as the Middle East crisis settles, oil prices are not going to resume and revert back to normal very fast. It's going to take some time. But all of those cycles will reverse, and at some point, valuations will be attractive. India has signed some really large FTAs with the UK, with the EU, with the US, hopefully shortly. Now, all of that is going to drive increased trade. It's going to drive increased FDI. That's going to bring dollars into the country. And that's going to drive jobs. It's going to drive consumption. And that's a sort of cyclical story, which will in turn drive interest for investors into equity markets in India.
Actually, let me come back to the fact that you said FPIs are still showing interest in Indian IPOs. In fact, about 6-7 months back, I saw an interview of yours where you said, at that time things were more cheerful. You said 10 to 12 billion IPOs can happen this year. How do you explain this difference? They are selling, even yesterday it was an 8,000 crore net sell by FPIs. How do you, they want to sell secondary market and they want to buy.
You have to understand there are many factors in play. One is you've invested in the India market for a long time. You have to realize some returns. You've got capital allocation that you have to do across multiple markets. You have to realize that the mother of all markets, the US, is having a phenomenal rise, right? there will be some really large listings and IPOs in the US. So people will create firepower, and that is going to impact emerging markets.
That's true. We are
That's just
becoming a
normal.
funding market. That's true. There are investors who tell us that. Okay, speaking about, the IPOs in the US market, it is not just IPO. What we realized from Google yesterday is they're doing an 80 billion issue capital raise, which means a secondary market, offer for sale issue. Now, if there is so much of capex going on in the mother economy, the largest economy, usually growth spills over. The positivity spills over. Are you seeing that kind of a sense?
It'll absolutely happen. When you raise all of this capital, that capital is then going to be invested. Yes, a large portion will go into the US, but it will go into big markets like India.
Okay. Actually, we hear of a lot of capex even in North Asia. Like I said, Korea, Taiwan, also doing a lot of capex. So can we hope that if parts of Asia does very well, like North Asia, and US does well, there is usually a global multiplier?
It will be, because you see, the consumer story in India is really strong on the back of the whole digital infrastructure that India has built. To fuel that, you're going to get data centers, you're going to get a lot of investment in India, you're going to get a lot of AI investment in India. That will then fuel and drive growth back in India.
And hopefully...
So that's why I keep going back to the long-term view. And, as India becomes more relevant, as capital, advisory, and other things, India gets more connected into the global economy. Citi really sits at those crossroads because of our global network. We have an on-the-ground presence in 90 countries. We have intelligence, deep local intelligence, and then you've got sectoral expertise that brings in the ability to advise, to raise capital, to finance in public markets, private markets, and then you follow that up with the cash management and the foreign exchange. There's no platform that can do that and be more relevant for our clients when there is a time like this.
No, absolutely. That's why, since you sit at the confluence of so many corporate and investment and fund interests, I want to ask you, what happened to the China plus one story? FDI, gross FDI has not done very badly in India. It was only
not at all.
Because people cashed out. How is gross FDI? Are people still asking for China plus one? Where are we? Are we way lower than Vietnam? Are we catching up?
So I think the China plus one story will always remain, right? COVID was the big shock when people realized that you can't put all your eggs in one basket. And I think post that, Southeast Asia has done really well. Because Southeast Asia, you have to remember, has a few things that have sort of wind in their sails. They started on this 2 decades back, 3 decades back. They also have physical proximity to China. They have cultural proximity to China. Their business has proximity to China. A lot of the large conglomerates in Southeast Asia are of Chinese ownerships, right? So they have done really well. In that, I would say Malaysia and Vietnam are standout beneficiaries across the sort of industrial manufacturing spectrum, electronics, semicon. So they've done really well. But I see India catching up, right? India has been catching up in the last few years. The government has done some good reform, whether it's labor markets, it's taxes. There's much more to do, and I'm sure the government is focused on doing that. Plus, you throw on top of that the FTAs that India has signed will bring in new FDI and encourage new FDI and manufacturing to come, which will drive jobs, which will drive consumption, and then...
Okay, one final question.
Drive
the markets as well.
Correct.
That's where our investments are. One final question, in terms of how are Indian corporates behaving in terms of capex? Because you are likely to hear about it for fundraise. And secondly, we hear, I mean, this is just urti khabar, that the Reserve Bank may tell PSUs to go out and raise ECBs and do some hedging, bear their hedging cost. If they were to do that, is there a lot of appetite?
Oh, on your second question, there is definitely appetite. There is definitely appetite. I go back to the fact that the fiscal balance sheet of India is in good shape. And I'd say the same about the PSUs as well. So the capacity for them to raise dollars overseas or ECBs is very, very intact and very sort of there. It's very possible.
Indian capex cycle?
Indian capex, I think we're beginning to see conversations because private capex in India has not been as big as we would have liked to see. But I think with some of the reform measures, our clients and our corporates are now beginning to talk about wanting to do more capex in India.
Okay, that's very good to hear. Amol Gupta, you've lifted our spirits somewhat. Let's hope more conversations like this will lift the markets.
Long term,
yes,
the future is bright.
Absolutely. Well, that's the first conversation we are getting you from the City Conference. Many more are lined up. Orchard, it's time for a break. Chartbusters thereafter.
Mounting geopolitical uncertainties and persistent FII selling triggers a weak open for the Dalal Street. Brent crude extends gains. The Nifty IT has snapped its three-day winning streak. TCS TechM, Infosys, HCL Tech, the top drags on the Nifty IT.
India extends countervailing levy on texture-tempered glass imports from Malaysia. The finance minister imposes duty for a fresh 5-year period, superseding the 2021 notification. Shares of Borosil Renewables spike over 5% in trade.
The NHPC OFS subscribed 3.47 times by non-retail investors, which was there yesterday. Today it has opened up for retail investors. Centre also exercises the green shoe option. The shares of the state-owned power company are higher by 3%.
US FDA greenlights Concord Biotech's immunorepressant drug. The company cites a $30 million opportunity in the United States. The stock is up close to 6%.
Car trade tech rallies in a weak market as Kotak Institutional Equities upgrades the stock to a buy rating and raises the target price to 2,300 rupees a share, citing sharply higher valuations for its OLX business.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and with me is Vinny in green. Vinny, markets in red, as we can see to the top of the screen. We have broken yesterday's low, which is a bit of a worry as well. But I don't know, the bulls, they would fancy their chances. 23,200, 23,250 in the past. You've seen the markets bounce 500-600 points or thereabouts. But global Q is a little bit worrying in today's trading session with the spike in crude oil prices and the uncertainty from Mr. Trump. But at least Vinny is in green.
I am supporting the bulls. I hope that we see a recovery like we saw yesterday as well. Hoping for that. But as of now, like you said, right, 23,200, which is managing to hold on to that. And in terms of sectors, also IT, which was doing well in the last few trading sessions, that seems like seeing a bit of a profit taking. Maybe we could say down 4% in the trading session today. Realty is among the top drags as well. And banks not supporting in terms of an up move in the trading session. Autos is the only one with slight bit of a green. And pharma, that also is seeing some bit of a green. On that note, let's welcome on board Ruchit Jain of Motilal Oswal Financial Services for a check in terms of the market, his technical and trading strategies as well. Ruchit, good morning. Thank you so much for joining us on the show. We're back near the 23,200 level. So in terms of levels, what are the key numbers that you are keeping an eye out on for the Nifty? And what is the important close that we should watch out for there?
Yeah, very good morning, Vinny. Very good morning, Nigel. Well, since last 3 weeks, we have seen the markets have seen a gradual correction where on pullback moves, the index is not able to surpass its 50-day EMA, which usually we see as a good medium-term support or resistance. But on the lower side, now the support is around 23,100, which is a 61.8% retracement of the recent up move that we witnessed in the month of April. So I think we have already seen a correction in last 1 week from that high of 24,000. We are approaching that support zone of 23,100. So from current levels, we think that price-wise downside seems to be limited for the index. Yes, the market breadth needs to improve for any kind of trended move. But these are not the levels where one should be much negative on the market. Maybe around 23,100, 23,000, if those levels comes, then those could be good levels where the risk-reward ratio would become too favorable to take some contra trades over there.
Okay, all right. Got that, Ruchit. What about individual stocks? What's in your radar?
Yeah, so a couple of names, which are looking good or positive. And when we are selecting stocks, we are just looking at which stocks are not correcting when the markets are going down. So those kind of relative outperformance are indicating good strength. So Premier Energies is one stock from the broader markets which is looking good. On the weekly charts, the stock has given a breakout from a bullish flag pattern. So medium-term trend remains quite strong over there. So at current levels, traders can go long on Premier Energies with stop loss below 1,000 rupees for potential up move towards 1,220. And Tata Communication is another name where the structure looks quite bullish. In the month of April itself, we witnessed price up move supported by good volumes. Certain corrections have been seen from the highs, but we are not witnessing volume-based selling when the prices are going down. So this structure where the prices go up with good volumes on correction, volumes are low, these are very good for positional trading. So at current levels, Tata Communication can be bought with stop loss below 1,840 for potential targets around 2,200 in the near term.
Okay. Rishit, we'll keep an eye out on that. Thanks so much for joining us this morning, taking us through your individual trading strategies as well as in terms of the levels that you're keeping an eye out on for the markets. But let's move on. And USCR makes findings and proposes action in Section 301 investigation relating to failures to take action on trade in forced labor goods. Ashmit is joining us now to give us more details on this one. Good morning, Ashmit. What is the latest you're picking up here?
Well, the latest that we're picking up is that the USTR has arrived at findings against India. Not just India, a total of 54 countries, including India. The USTR has concluded its Section 301 investigations. Now, as per the investigation findings, what the conclusion of the USTR is that there are not enough measures deployed by India to prevent the import of products coming from countries which face forced labor situations. And as a result of that, the conclusion of the USTR is that because India has not deployed such measures, it adversely affects US commerce. And to that end, what the US has proposed is that of the 54 countries, it has decided to levy additional duties of 10 to 12.5%. India falls in the second bracket. So this is the proposed additional duty that India may potentially be looking at, 12.5%. But a couple of aspects to bear in mind. Number one, this is only a recommendation at this stage. There has to be public hearings to take place. Those public hearings are scheduled for July 7th, and only then we'll begin to get a better picture on whether or not there's any confirmation on levy of this penalty. That's one. The second important takeaway to bear in mind is that this is one of 2 301 investigations that the US had begun. This is on forced labor. The other one is on structural overcapacity in areas of steel, aluminum, processed food, solar modules. That the result of that second investigation, again, we're awaiting clarity on that. So that could be, again, another aspect that US and Indian trade negotiators will have to watch out for. And speaking of negotiators, that brings us to the third and perhaps the most critical aspect. Brendan Lynch and the USTR negotiating team is in India to finalize the bilateral trade agreement. Will this throw a spanner in the works? Section 301 investigations is something that India has flagged repeatedly, is flagging again as a part of these ongoing negotiations. And of course, we're awaiting clarity on what the response from the Indian government will be towards these proposed additional tariffs.
Okay, all right. Thanks a lot, Ashmit, for joining in and giving us that quick update. By the way, from the broader markets, a few stocks are bucking the trend. MRPL, as you can see to the bottom of your screen, that's moved up. CPCL as well, the stock has nearly doubled. You know, the first time we here at CNBC TV 18 had explained about a possible crunch in the refining capacity, and because of the geopolitical issue, a lot of refining capacity globally as well has gone out of whack. So that's why that stock continues to build on. It's nearly a 1,200 rupee stock now. And Rain Industries, that's the other stock that's done well. In early January, we said that if aluminium cycle is so strong, then CPC, in fact, could do well. And that's something that they produce. CPC as well as coal tar pitch, both those two products, roughly 45% of its entire revenue basket. So that's why Rain Industries as well has spiked up. Take a break, come back. We'll continue our focus on markets and stocks that are moving around.
Welcome back to Chartbusters on CNBC TV 18. Nifty is still at 23,230 levels. Not much of a move, down 1% in the trading session. But let's keep it going with some of those individual names that are moving around. Today we have shares of Car Trade that are gaining, and this came in after a bullish brokerage note that came in from Kotak Institutional Equities. Let's go across to Sudarshan to get the details in terms of what the note is saying. Why are they positive on this one? Sudarshan, good morning.
Good morning, Vinny. So Kotak Institutional Equities has upgraded the stock to buy, and target price here is 2,300 rupees per share. Remember, the stock has been one of the biggest underperformers of 2026, down more than 30%. But now, because of the higher valuation of OLX, Kotak Institutional Equities has upgraded, and also OLX targets steady GMV growth and improving monetization margin are some of the other reasons for this upgrade. And now Kotak Institutional Equities too has upgraded the FY 27 to 29 EPS estimates in the range of of 1 to 5%, and that's because of higher profitability expectations for OLX. So OLX is the main reason why Kotak has upgraded the stock.
Okay, all right, Sudarshan. Thanks a lot for joining in. Why so serious today, Sudarshan? Front foot power. It's a heavy work day for Sudarshan. Thanks for that, Sudarshan. Thanks for giving us an update with regard to why car trade is buzzing in trade. Slip into a break, come back. We'll have some more stocks that are buzzing around. We'll explain them to you. Stay tuned. Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. Well, a few stocks that are buzzing around in today's trading session. We should get some of them up for you on the screen. Tejas Networks, what a big spike up we're seeing on that stock. It's moving on very, very good volumes. Go Fashion seems to be back in fashion. So we're seeing, a good move out there, and volumes as well are spiking up on that counter. We had HFCL. The stock has moved one way. All the spotlight has been on Sterlite Technologies because that's moved well. Well, HFCL as well as close to have doubled. Stock up close to around 3% as we speak. But let's cut across to an interesting conversation on India's corporate landscape from the sidelines of the City India Conference 2026.
Tend to get absorbed in the metros. But tell us how the Nagpurs, Indores, Jaipurs, Ahmedabads are growing. Is Middle India growing faster than metro, and finally rural?
Sure. So I think, especially in the current environment with the uncertainty, there is a little bit of, I would say, wait and watch. But in my opinion, the consumer growth story is as intact, as solid as it ever was. We could have a couple of quarters here and there. And why do I say that? If you take a step back, and when we talk about, because you're talking about results of some of the larger companies, I think it's very, very important to look at the overall ecosystem. We were chatting earlier, and I was saying that 10 years back, there were probably 5 brands of sunscreen lotion in this country. Today, there are 200 of them. Earlier we used to say there are X number of channels. Today, we say there are 4 million influencers. So obviously, there is great work happening on the supply side. On the demand side, I stay very, very convinced about overall the ability of this sector to grow in double digits. Yeah, and that's why it's important not just to take the large players, it's especially in businesses like personal care. I think, but what is important is within this large India growth story, it's not homogeneous. Yeah, it's very, very difficult to sort of pass judgment on such a large. I think I'll start with the best news for any brand. I think the top end of the market is extremely resilient. So take it the 30, 40 million top end customers. I'm sure if there are people from the automobile, real estate, any part of the economy, the resilience, you can see it. We see it. I mean, I sell 2 rupee Nescafe sachets and I sell 2 lakh rupee Nespresso machines. And the Nespresso machines are doing really, really well. So the top end is very resilient, and I see that continuing to grow. I think rural continues to do well. So if you take the last 3 years, more of a secular trend, as per Nielsen, it's always been growing faster than urban. The challenge is more in the urban middle. That's where, with some of the inflation factors we've been talking about, the growth in real earnings has not kept pace. That's where we see a little bit of wait and watch, where consumers could push out discretionary expenditure. So that's how I look at the market.
Okay.
I think for Nestle per se, it's a little different because we are largely used to be more of an urban company, and therefore our growth across these, I would say, would continue to be very healthy.
But you're still putting up a 2,000 crore capex plan, right? So clearly you're seeing a mix of the premium and the rural grow very well.
No, absolutely. I'm saying if you look at the last 2 years, the capex was upwards of 2,000 each year. We'll continue to do it. We're putting up the 10th factory at Orissa. So we are very, very clear that the growth story is there. And we do 98% of our own manufacturing, which is why we need to keep on investing. So yeah, that goes to show that we're putting money where.
Okay.
Okay, that's Lata in conversation at the sidelines of the City conference there with Harsh Mariwala of Marico, Sunita Reddy of Apollo Hospitals, as well as Nestle's Manish Tiwari. Stay tuned for more highlights from the City India conference through the day as well. But okay, let's move on. And as India looks to attract more foreign capital into the country, the CNBC TV18 IBLA Collective asked the question, can GIFT City be the gateway to make this happen in a big way? My colleague Prashad Nair spoke to the top leaders from the markets as well as the aviation industry to understand where we are and what more needs to be done. Listen in.
Omnibus investment. Undoubtedly, there is risk of round tripping. But omnibus, where a private bank or a wealth manager or an insurance repper makes investment on behalf of hundreds of their client, is a globally accepted practice. If round tripping is not an issue in those jurisdictions, we will have to provide similar facility to global investors and global capital. Today, there are many foreign citizens who would like to invest in India. They have some connection with India, or they are interested in participating in India growth story. But they'll have to take a PAN account, PAN number, PAN card in India for investment. That's not going to work. So why not give omnibus facility to private wealth bank insurance pool so that they can collect money from their customers and invest via GIFT City into India?
If you created a leasing company in GIFT City and you want to remove the asset from an Indian airline to, let's say, a foreign airline in a third country, then the most efficient way to do that is if you have a double taxation treaty with the third country, which India has a few of them, perhaps not to the extent that Ireland has. And so, yes, over time, we will need to increase the amount of double taxation treaties we have to be able to create a stronger set of sort of taxation infrastructure for Akasa. I mean, the good news is we're an airline, not a leasing company.
Correct. No,
and
I mean,
so as such,
on the other side, yes.
Yeah. So as such, we will continue to lease from third-party leasing companies that could be sitting anywhere in the world. And that doesn't change. I think the question that you asked has an effect on someone wanting to create a leasing entity in India.
Lessor sitting in GIFT City.
A lessor sitting in GIFT City. And that's something that, you know, for that to be fully effective, we'll need to have a broader set of double taxation treaties.
Well, we'll keep getting you bites from last evening. Interesting comments coming in there from all the industry big names. Well, a small programming note, though, as we wrap up on Chartbusters, uncertainty in the market is rising, given the geopolitical as well as trade headwinds. We here at CNBC TV18 are featuring some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune into CNBC TV18 to catch the top minds from Bank of America's global investment team, including Amish Shah and Vikram Sahu. You can also catch the macro and the market opinion from Morgan Stanley's Chetan Iyer, Rhythm Desa, and Jonathan Garner. Citi's Managing Director Sue Lee, as well as CEO Jane Fraser, will also be part of the blockbuster panels lined up only on CNBC TV18.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormas Patakia. Joining me as always, Ritu Singh from Bangalore. Ritu, good morning. Well, it's not a very good morning for the markets. We said the same thing 24 hours ago, but then there was a very, very sharp recovery after we were done with our bit on Trading Hour. But today, the important bit is the fact that we are back at yesterday's lows. 23,229 was the low that the Nifty made yesterday. Today's intraday low is now at 23,223. And so now we are holding on to those levels by the skin of its teeth, very, very close to breaking below those levels as well. So now it remains to be seen whether buying interest emerges at these levels yet again, as it did in yesterday's trading session. Unlike yesterday, the sell-off has resumed in IT names after that couple of days that we saw some very, very strong buying or some relief rally, if you would like to call it. The IT index today is the principal culprit behind the losses that you are seeing on the index today, Ritu.
Yeah, Hormaz, I mean, see how the story changes from day to day in this very, very volatile environment. IT, we were calling the star of the show yesterday. Now it's hammered. It's down almost 4.5% as we speak and, on a decline. But there's pain in the market overall. IT pack, of course, is dragging the market down, but look at the breadth of the market. There are more than 2 stocks declining for every 1 stock that is advancing on the National Stock Exchange at the moment. And focus on the India Wix. This shows you the kind of volatility and the anxiety in the market. It's risen up sharply by almost 8.5% today. So, that tells you how the mood of the market really is. The Bank Nifty, that's trading with cuts of almost 560 points. The frontline index seeing cuts of 260 points, and the broader markets also down by more than 1%. So there's pain across the board in the markets today is what we're getting to see. There is no, hardly anything that is in the green. But in this market, there are a few gainers, of course, which we'll talk about in just a bit. But Hormaz has walked by on the wall to give us a list of specific stocks that are in focus today. Hormaz.
There is some change that you can see from yesterday's trading session. Now, yesterday we opened lower, we recovered, every intraday recovery got sold into, but today there is no intraday recovery whatsoever. There is this ever so brief bit that you saw past 10 o'clock, but then ever since we've just continued to grind lower, and that's what the situation has been. We are now very close to breaking below the 23,200 mark, and if that happens, then the next level on the downside is only 23,100 or maybe even 23,000. So there is a risk of further downside that is emerging. Of course, it will be interesting to see if there is any buying interest that emerges at these levels as we go into the second half of the trading session once all the margin positions settle out as well. There are, of course, 2 main reasons why the market is doing what it is. Of the first one, of course, being the oil prices, which are back at 97 for Brent. Now, we were talking about the fact that the markets would not react significantly until and unless it remains well below 100. We were at 93, 94 yesterday, but we are at 97, so the market is taking note of that. And that is having an impact on the currency as well. 0.5% now on the currency. 95.73 is where it is, of course, still well below the 96 low, but you're seeing back the selling pressure is resuming on the currency as well. The principal culprit, as I mentioned, is IT. At one point, all through yesterday, the index was lending support to the market. But today, look at TCS. It has given up everything that it gained yesterday and a lot more. 8% lower now on the stock for India's largest IT services company. Tech Mahindra is down 4.5%, 5% as well. At one point, the stock was on the verge of turning positive on a year-to-date basis. That remains distant as of now. LTM, of course, some not so positive brokerage commentary coming in as well after its analyst meet. 7.5% lower here, and Infosys as well. The ADRs were down around 2.5%, 3% overnight, 3.5% knocked off here as well. The picture is pretty similar for mid-cap IT as well. There is no change there. LTTS is 5.5% lower. Persistent Systems and Coforge, which did well yesterday, have given up most of their gains, if not all. 5% lower on both of these stocks as well. But there are some names that are bucking the trend. Yes, there are some newsmakers and news flow driven names. Concord Biotech, after a $30 million drug approval that it received, 6% higher on the stock. NHPC, very strong response to the non-retail OFS. The OFS has opened for retail investors today, so 4% higher on that stock. Cartrade Tech, after an upgrade that came in from Kotak earlier in the day, and MRPL, of course, with the moves that's seen in the crude oil prices. The real estate as a sector is also sulking this morning among the top index losers today. Lodha, Prestige, Oberoi, DLF, all of them seeing losses of anywhere between 2.5% to 4%. And of course, there are stocks that are at 52-week lows. The usual suspect, ICICI Prudential Life, another day of 52-week lows for the stock. Wakefit Innovations, it's a new post-listing low for the stock. The Bajaj Electricals and Mahindra Holidays too trading at 52-week low levels, Ritu.
All right. Thanks very much, Hormaz, for running us through that list. That's a great setup to now go to Devang Mehta, Deputy Managing Director and CIO Equity from Spark Private Wealth Management, joining us now to discuss market fundamentals and his sectoral picks. Thanks very much for joining us here, Devang. Let's start with the IT pack. That seems to have been the story of late. Yesterday, we were talking about, the kind of recovery that the sector is seeing. Today, we're seeing how it's getting hammered. In this volatile environment, would you stay away, or do you see this as a buying opportunity? And, overall, would you say how much more pain to go? I mean, these headlines don't seem to stop. Have we seen the bottom yet?
Ritu, thanks for having me on the show. Always a pleasure to be on CNBC TV 18. I think typically what we have seen in the IT space, and I'll not mince words here, we generally have been avoiding this. The last 3 years, I think we generally don't hold a single IT stock. Yes, 1 or 2 mid-cap IT stocks, but that not too materially in terms. We generally avoided the large-cap IT space. And why? Very typically, I think you've generally seen very single-digit type of volume growth. There are headwinds across. There are always that competitive trades in terms of AI, in terms of other things which have come to hamper the sector very, very badly. My sense tells me that from here on also, after such ridiculously low valuations also, is there going to be growth? The question that Indian market, or the Indian market participants rather, are asking right now is that I'm ready to be a bit of a larger valuation or a high valuation, but that has to be commensurate with that growth. So here, if the growth does not come back in a hurry, I don't think this 15, 16, 18, 20 valuation also probably would sustain. Some of them even at 12, 15. Yes, from here on, if somebody wants a FD plus type of returns, can it give you 8, 10% type of returns CAGR over the next 5 years? It possibly can. But there are a lot of alternatives in the given system where I think the market has gone through price correction, time correction, valuation consolidation. So my sense that a lot of domestic facing plays, be it capex, be it consumption, be it financial market related plays, there are a lot better alternatives at this point than chasing the IT because it's sort of undervalued or sort of valuation correction and price correction have happened.
So which are those pockets then, Devang?
Yeah, so I briefly mentioned, and I've been very vocal about it the last 5-6 years, and I'm trying to not exaggerate on the fact that we have been extremely bullish on power automation companies, HVDC companies, the likes of, not recommending, but just stating likes of Hitachi Energy or GE or Nova. I think we still believe that there is a lot of tailwind for this sector, yeah, right? There is so much of HVDC requirement that India has. Probably the companies today have a market cap of anywhere between 2.5 to 3 lakh crore, but the opportunity is minimum 12 to 15 lakh crore in this type of industry. I think engineering, manufacturing, EMS, still there are a lot of opportunities in the capital goods type of space, semiconductor allied. All these are spaces which one should probably look at. One part of your portfolio has to be on the capex side of the universe. The second is very typically, which again are, I would not say banks are a compelling buy. I would say there are a lot of other NBFCs. There are a lot of companies which are capital market plays. Very interestingly, I know there are wealth management, there are brokerages, there are financial intermediaries, exchanges. On a correction, I think this typically for the next 3-5 years, as India goes through the wave of financialization, India's market gets more oriented towards wealth management or asset management. I think these are franchises which could probably compound anywhere between 18, 20, 22, 25% also from here on. And the third play, which I always mention, is something in the discretionary consumption space, the upper end consumption, which which was once a luxury is now becoming a necessity. So my sense, traveling, hotel, hospitality, all this probably there are headwinds right now because we know that the crude prices have risen. There would be some pressure on autos, but the last 6 months since the GST has been cut, 6-7 months, I think you've generally seen very, very strong figures from the OEMs as well. So I think this is a universe where if somebody has a medium to long-term horizon, I think these are sectors one need to be as part of portfolio constituents.
By the way, we've briefly slipped below the 20 23,200 mark on an intraday basis, and now that opens up another further downside gate now towards 22,800 levels if this goes any worse. 285 points lower now on the index. Devang, I wanted to dwell upon the financialization bit that you mentioned, the capital market theme in general. You know, most of this demat account boom that we saw was after the post-COVID era, where there were substantial returns that you saw across 21, 22, maybe even 23, and all of these names, be it the depositories like the CDSLs or the brokerages and so on and so forth, they gave you stellar returns. But in a market that is not doing very well, that has not gone anywhere since September of 2024, maybe even given you negative returns since then, with the pace of demat accounts also being where it is, does that picture not dissuade potential investor from entering the market, considering the situation that is in, and would that therefore not act as a headwind for the entire theme in general? Because for the theme, the basic foundation would possibly be for the market to continue doing well.
Very well said, and I think that is where I always use this phrase, there can be opportunities in adversities, right? And some of these stocks, yes, would have not gone anywhere in the last couple of years. They had a sharp bounce back over the last couple of months. In fact, while the markets were not doing good, a lot of broader market themes like financialization also came back to the fore. But my only narrative rather here is that over the next 3 years, are there many options for the Indian investors to probably dwell into? Gold, silver did its bit. Real estate is not everybody's cup of tea. I think clearly FDs are not going to suffice. Yes, bank would need a bit of deposit growth. They would do their bit because probably credit growth is also on the rise. But most important plays are where India probably wants to invest. They want to invest into stocks. They want to invest via SIPs, via mutual funds, via asset management companies, via PMSs. I think very clearly there is a roadmap ahead. Where India wants to smartly invest, and right now, yes, probably the demat account speed might slow down a bit because it's a cyclical industry. Typically, you have to go through the cyclical downturns also. But honestly, these are opportunities where if you want to compound your wealth anywhere between 18, 22, 22%, these are pockets. Yes, it might come with a bit of volatility and uncertainty during difficult times, but somebody who has a horizon of 3 to 5 years, I think this typically is going to balloon out as a very, very interesting industry.
Devang, very briefly, since we've run out of time, Friday, we have the MPC decision, the market's pricing in a pause. Quick thoughts on the rate sensitives thereon.
I think, yes, probably the things have changed. I think India was a macro trade 6 months back, if you ask me, 4, 5 months back. Now it's more a micro trade, right? So typically India was on the rate cut spree. India had a lower inflation. India was supposed to be probably having the tailwinds of crude price benefit, which right now it's not going through. So my sense that a pause, market has sort of accepted the pause. Even a 25 bips hike, I don't think market would sort of react very negatively. Because yes, we know that the rate cut cycle is now close somewhere, and probably it might be either rate hikes or at least a pause with a little bit of a hawkish stance or an anti-inflationary stance. But I think the governor has done very well to balance growth and inflation, because at this point, growth is also required across the economic aspects. And I think across even the government would come back, because there are no elections over the next 6, 8, 10 months. I think there is good time for reforms to be done. So I think it's generally the market would accept that the next couple of quarters, the earnings will not be great, and maybe the rate cut cycle is now strong.
Devang, pleasure having you as always. Thank you so much for sparing time and joining us with your views on the markets as they continue to remain choppy. 280 points lower now on the Nifty, fighting to hold that 23,200 mark. Take a short break, put the spotlight on the bond markets on the other side with Manisha Gupta.
Welcome back. As promised, let's shift focus to all the bond market action. Manisha Gupta is joining in. Manisha, with all that crude price volatility and RBI's expected status quo policy this Friday, what are the bond markets telling you?
Well, those are exactly the two things that the bond markets are looking at as well. When you look at the month of June, and it's been just 2 or 3 days, and we've seen the crude oil prices gain up by nearly 3%. That's exactly what is impacting the bond yields as well, which have surged. And we saw the market open at around 7.028% therein. The crude oil prices have risen back again to $98 a barrel. This is because the US-Iran peace talks or agreement talk seems to be stalling, falling apart yet again. There have been instances where you have seen Iran actually over the night put some conflict on Kuwait and Bahrain, and that is where the markets are taking their premium from. Having said that, there are various reports suggesting that the Indian firms and NBFCs are slowing the pace of fundraising via bonds. That is because you have seen borrowing costs spike to nearly 7-year highs. The borrowing cost is high on the anticipation of higher policy rates, and also because of the tighter liquidity conditions that we have seen come in from RBI. If you look at the overall numbers therein, well, Indian companies raised nearly $11.24 billion in the months of April and May. But going forward as well, for the month of June and July, the expectation is that we're going to be looking at a lower number as compared to last year. This actually, by the way, the month of April and May also are the lowest first 2 months of a fiscal year since 2022. There is rise in corporate bond yields, and that has increased the borrowing cost. That is likely to delay the fund buying plans for many of those issuers, are the statements coming in from many of these companies as well. So if you look at the overall bank credit to NBFC, that gained up by 28% in the month of April to nearly 20.56 trillion. That clearly tells you on how the money or the fundraising is shifting within. Having said that, you have one more muni bond coming in. Vadodara Municipal Corporation is expected to raise nearly 2 billion rupees. They are in working process right now, and they're going to do this via bonds maturing between 5 to 7 years. They are going to be using this money for strengthening of water infrastructure projects, is what the document says. Having said that, there are some major bond issuances happening today as well. You have Kirtana Finserv, which is looking to raise 1.5 billion. They are doing this via bonds maturing in September 2028. The other one on the list for today is Credila Finance. They're also looking to raise up to 5.5 billion, and they are doing this via 5-year bond maturities.
Manisha, thank you for those updates there. By the way, there are almost 400 stocks on the Nifty 500 that are trading lower. And, well, the top 5 of them, of course, belong to the IT names: TCS, LTM, eClerx, Persistent Systems. But the one stock there where selling is not stopping is Natco Pharma. And ever since it reported its results last week, the stock has just been on a downward move. The stock fell 13% on last Friday when the numbers were out. And then fell another 8% on Monday, is down another 5% in Tuesday's trading session as well. So 891 on Natco Pharma. By the way, when the numbers were about to come out for Natco Pharma, the stock was on the verge of testing its 52-week high. Now it's on the verge of testing its 52-week low. And that is at its 790 is the 52-week low for Natco Pharma. So keep an eye out on this stock as well. Take a short break, get your quick chart check and some trading ideas on the other side with Pritish Mehta from Yes Securities. Welcome back. The bulls are trying to defend that 23,200 mark on the downside. There is a bit of a recovery, around 30 odd points, if you could call it a recovery, that is from the lows of the day. But well, again, that recovery, whether that gets sold into or not, remains to be seen. Well, Sudarshan is at the FNO desk. He'll give you a better answer for that question, whether that recovery will get sold into, because he's hopped into all the data from the FNO space. Sudarshan.
As you have said that bulls are trying to protect the levels of 23,200 for Nifty, it seems that from FNO data is that's also indicating the same, that at this point, it seems like that they will try to protect 23,200, because if you take a look at the options data on the put side, the major activities that we are witnessing at 23,250 and 23,200. But talking about today's session, so yesterday the biggest segment, like one sector that had seen a sharp recovery, was the IT. They have completely erased all the gains that they had seen yesterday. And today, take a look at the large cap names. TCS down more than 8%, Tech Mahindra down 5%, Infosys similar move, even Wipro. For Wipro, take a look at the cash and the future. In the cash, if you take a look, it's down 2%, but in the futures, it's down more than 6%. And if you take a look at the indicators, put call ratio, now it's back below 1, 0.83 versus earlier level of 1.02. Brent continues to remain over the level of 97. Rupee continues to depreciate. Now it's near to the level of 96 against dollar. Now in the options data, as I told you, on the put side, 23,250 and 23,200 are seeing maximum increase in the open interest with a sharp rise in the premium, while on the call side, 23,300 and 23,500 are seeing maximum increase in the open interest. So for now, the range for Nifty looks like 23,200 to 23,500. That's the reason I've taken support. First support 23,200. Next support comes around 23,000, and resistance would be 23,500 for Nifty Bank. Support would be April's low of around 52,700, and resistance would be 54,300. Some of the stocks that are in focus: Apollo Hospitals is seeing fresh longs in the even weekday of trading session. Wipro is seeing fresh shorts, and Avenue Supermarts is also seeing short covering.
Sudarshan, thanks very much for bringing us that update from the FNO desk. Let's bring in Pritish Mehta from Yes Securities, who joins us now for a technical check of the market. Pritish, quick thoughts on where you see the frontline index heading from here, and also any thoughts on the IT index, any near-term levels you'd be watching out for, and of course your top stock picks for the day.
Yeah, good morning. Honestly, it is not ideal time to look at markets. Rather, I would say it's quite painful for last couple of weeks. Nifty was holding on to support of 23,300. Yesterday also we saw the sharp reversal coming in. But again, it gave that away very easily into this trade. The way the big boys of the benchmark index are performing, when I say big boys, I mean to say the banks and financial, the way they are shaping up, I think the current weakness in index could continue. We have already seen a double bottom sell coming in Nifty. So I think a move towards 2900 is possible in near term. As far as IT is concerned, see the ratio, the long-term ratio chart of IT versus Nifty has provided a bit of turnaround, a bit of reversal. But again, I still doubt the long-term structure. I don't feel that the way it is shaping up, I'm not expecting a big turnaround coming in. In fact, we would see this bouts of rally coming in, but it won't be, rather it would be fleeting in nature. It won't continue for a long period of time.
Well, Pritesh, in that light, what are the stocks that you're recommending this morning?
So, we have two recommendations. The first one is short on Shriram Finance. We have a target of 800. Now, see, it has already seen a series of double bottom sell, and the stock is trading below its 10-column average. It is facing resistance around 45-degree downward super trend line. So I think it's shaping up with the stock already outperforming Nifty Financial on the downside. So I think we could see more pressure. The second one is buy on Motherson Samvardhana. It is trading well above its September. It is trading around the September 2024 peak. Post a bullish anchor column, we have seen bullish data breakout coming in. The structure is interesting. Structure is looking strong. Also, it is outperforming our customized alternate index. So from here on, we can see a rally towards 170 levels.
All right. Thanks very much for taking us through that. Appreciate your time here. Let's take a short break on that note. Up next, we'll get you more on the markets, and we will be joined by Alok Gupte from the sidelines of the City India Conference when we return. Welcome back. For the market, still near the low points of the day, 23,218 is where we're currently at. Just about 8 stocks, in Nifty 50 that are still in the green. The rest of the pack pretty much in the red. The top gainer, Apollo Hospitals, up by just about 2% or so. All of the rest with gains of less than 1% or so. So not looking so good for the market setup right now. But let's bring in focus car trade. Now, shares of car trade gained after a bullish brokerage report came in from Kotak Institutional Equities. Sudarshan is standing by with more details on this one, on what the brokerage has to say on the company. Sudarshan.
Not looking good for market, but car trade is higher in the trade. The stock is currently up more than 4%. It's on the back of positive brokerage note. Today, Kotak Institutional Equities has upgraded the stock to buy, and target price is increased to rupees 2,300 per share. And remember, this stock has been one of the biggest underperformers of 2026, falling more than 30%. And that's mainly because of the concerns of disruptions due to AI models. But as per Kotak Institutional Equities, its deep dealer database and value-added offerings may limit the impact to an extent. But the upgrade is mainly done due to higher valuation assumptions for OLX, and also OLX's steady GMV growth, improving monetization and margin. Now, Kotak has raised FY27-29 EPS estimates in the range of 1 to 5% on higher profitability expectations for OLX. So mainly because of higher valuation estimates for OLX has led to upgrade for car trade.
Very interesting. Sudarshan, thank you for that update. Car trade bucking the trend, 5% higher on the stock, and it's been an absolutely wild ride for car trade technologies. The stock had an issue price of somewhere around about 1,400, 1,500 rupees. From those levels, it fell to almost 340. From 340, it went up to around 3,200, 3,300, which was its peak, and now it has come back down to around about 1,880 as we currently speak. So for car trade technologies, very wild and volatile moves that the stock has seen. On the other side, NHPC's offer for sale received a very strong response from institutional investors yesterday, and John Cockerell has also received orders up to around 1,300 crore rupees from JSW Vijayanagar Metallics. Vinny is here with both of these names. First up for the offer for sale, Vinny, the retail portion has opened today.
Absolutely. Retail portion is open today, and seems like, as of now, 35% of that is also subscribed for. Do not forget the overall issue, the offer for sale size is around 4,200 crore. Half was non-retail and half was for a green shoe option as well. Retail and non-retail was 2,100 and green shoe option additional of 2,100 crores. So yes, now we're seeing good traction even coming in on the retail side. Yesterday, obviously, the non-retail portion was also subscribed 3.47 times, and that's why the green shoe option now that comes into play for today's day. And today, retail investors seem to be excited as well. So that is why we're seeing NHPC. Yesterday was down in trade. Today, we're seeing an up move coming in for the stock after the stock action. Let's move on to the next one that you were talking about. That is John Cockerell. This one is also in focus. They've gotten an order. This is of around 1,250 to 1,300 crores order. This is from JSW Vijayanagar Metallics. This is a CRNO project order that they've received, and that is why this stock also is buzzing in trade. And look at the gains, more than 10% gains that you're seeing on the screens for y'all as well.
Thanks, Vinny, very much for getting us those updates. So NHPC, John Cockerell, car trade, some of the pockets of relief in the current market. But let's get you some more opinion on the markets. We had Morgan Stanley's Rhythm Desai, who said India looks attractive on valuations but weaker on growth. He added that retail participation is unlikely to fade and policy reforms can help get back the FII flows. Take a look at what he had to say.
On a relative basis, India is not looking good on growth. It's looking very good on valuations, but it's looking very inferior on growth. So if you compare with other large markets, and this is, AI is an excuse. The real deal is on growth. And this has not been the situation only for the last 2 or 3 months. It's been the situation since September of 2024, when India's growth peaked, valuations peaked, and since then the market has derated on a relative basis, and growth has been decelerating. Now, growth did pick up in the December quarter, but the growth elsewhere is very strong. Retail investors in India are just not stopping the bid. So in March, you would have ordinarily expected retail investors to be a little bit hesitant because the markets were volatile, there was bad news, there was a drawdown. but they put record inflows, and they followed up with another strong April, and I think the May month also has been probably very strong, going back by the amount of buying that domestic funds have done. And I don't expect the retail bit to go away, because that's a secular shift that's underway in India.
Then you pointed it out.
We've been talking about for 11 years now, and now finally that skepticism is fading. But people are waiting that one day retail will panic. But retail has matured in this, and they are upping their equity allocation, rightfully so in my view. In the long run, this is going to pay off quite well to them.
Foreign selling is showing up on the screen every day.
Foreigners are also selling Korea. Okay.
Right.
So let's not.
No, it's almost, but there it's more technical. The selling is.
But this is also technical.
Yeah.
Large part of the outflows are passive. It's because the weight is falling, because India is underperforming, and every single day India underperforms, the weight falls, and passives have to adjust their index in their position to match the index weight. But I think we can also do adjustments on the policy front.
I was coming to that.
So, for example, I think make it easier for foreigners to participate, and that is, I think, something that should be done over the next few months, because it takes a lot of time for people to get registered. Taxation, I don't think is a burning issue in my view. The issue about taxation is the whole administrative process to file returns and to pay the tax. I think tax is not such a burning issue. The administrative process around that could be. Yeah, but I think easier access is probably the better thing. If you want to choose amongst policies, then I think that's the easier thing to fix. Also, capital gains tax. It can be a tricky thing. You can't do it retrospectively.
Correct.
Because if you do it, suppose hypothetically you reduce long-term capital gains tax to zero, it's going to be a selling avalanche.
Rhythm Desai there with his views on the markets. Just pull up TCS before we take that break. At 2250 is now where the stock is 8% lower now as we speak. The important level to watch on the downside for TCS is now going to be 2210, and that is because if it slips below that level, its market cap will slip below the 8 lakh crore rupee mark. So keep an eye out on TCS. 2210 is that level. Take a short break, get you more on the macros on the other side. Stay tuned.
Welcome back. Let's get you the macro signal of the day. Now, for decades, U.S. government bonds were the world's choice of reserve assets. Central banks parked their money in treasuries because they were considered the safest and, of course, the most liquid asset in the world. But that's starting to change. We have a new report from the ECB which shows that gold accounted for 27% of global reserve assets as of the end of 2025, overtaking U.S. treasuries at 22% and the euro at 15%. Interestingly, this is the first time in decades that gold has occupied such a dominant position in global reserves. Now, part of the story is, of course, about price. Gold prices have surged 30% in 2024, another 60% in 2025, and that, of course, boosts the value of the gold that is already held by central banks. But that's not the entire story. You also have the central banks which have been buying gold at a record pace. Now, for 3 straight years, they bought more than 1,000 tons every year, which is more than double the average we saw before Russia's invasion of Ukraine in 2022. In fact, today, central banks account for more than a fifth of the global gold demand. The reason, of course, gold goes beyond markets. The freezing of Russian reserves after the Ukraine war forced many countries to rethink what really makes a good reserve asset. Government bonds and foreign deposits can be sanctioned or frozen. Gold, on the other hand, cannot. It has no issuer, no counterparty, and if stored within the country's boundaries, remains fully under the country's control. Reserve managers are also increasingly treating gold not just as a financial asset, but also as an insurance of sorts. But it's not just countries that are buying gold. Interestingly, from this ECB report, you see one of the largest buyers of gold last year was not a central bank at all. It was Tether, which is the issuer of the world's biggest stablecoin. Their purchases exceeded those of several sovereign nations, showing how gold is now increasingly being used as a reserve asset beyond traditional banking system. Now, India, of course, is part of the broader trend. The RBI now holds more than 880 tons of gold, with gold accounting for nearly 17% of the total reserves. Nearly 77% of our gold stockpile is also now stored domestically within India, up sharply from just 6 months ago. So the takeaway from all this, the dollar remains the world's dominant currency, but when it comes to reserve assets, gold is making a comeback simply because in what is an increasingly uncertain world, countries and institutions are once again placing a premium on assets that they can hold, control, and trust. And on that note, we're going to slip into a short break. When we return, we'll get you more on the markets.
Welcome back. Let's go across to the sidelines of the City India conference. Nimesh is in conversation with Alok Gupte. Nimesh, over to you.
Thanks, Harma. So I have a very special guest joining me from the City conference. Alok Gupte is the global head of ECM, and he's the one who's driving a lot of money globally as well as in India. Alok, pleasure to have you on the sidelines of the City conference. Thanks for joining us. First and foremost, the big question which is in the mind of most of the investors is the mega IPOs globally which are coming up, the SpaceX, the Anthropic and all. How good is the liquidity globally? And do you think such large IPOs is going to suck a lot of global liquidity?
Nimesh, first of all, thank you for having me here. It's a real pleasure to sit down with you at our amazing conference. Look, I think this is a unique year when it comes to capital raising, certainly. We've seen the entire sort of AI ecosystem come to market in many different ways. It's equity, it's debt as well, lots of mezzanine happening as well. And you've seen that sort of, go across the board. So it is from the hyperscalers to the neoclouds, to the semis guys, to memory companies, to infrastructure around AI. All of it is incredibly busy. We think that the market is really thirsting for these transactions. I think they have been quite well flagged that we will see some mega IPOs happen across 2026 and going into 2027 as well. I think investors have prepared, they have positioned. Yes, it will mean a little bit of rotation, but when you think about the amount of liquidity that is sitting on the sidelines, as well as how people have prepared for these transactions, we think that the outlook is incredibly constructive, and we should see a very strong outcome on these deals.
But you talk to a lot of global investors. What's the feedback from them, the likes of Anthropic and the likes of SpaceX, and the kind of crazy valuation at which they're going to come in? Enough appetite from global investors?
More than enough appetite. And I think the dynamic certainly is that these are in the territory of must-own companies. They will be incredibly large and meaningful companies from a global basis, right from day one. And investors want to position for it. And, we will see over the years how the commercialization and monetization of the entire AI trade or ecosystem develops. But certainly right now, investors are incredibly focused on these large assets.
I can understand the kind of excitement which is there for the likes of SpaceX and Anthropic. But what surprised a lot of people in India as well, and to me as well, that somebody like a Google is sitting on so much of cash, and they have announced raising over $50 billion or something like that, right? How do you read these kind of announcements where companies sitting on so much of cash are further looking to raise money?
Yeah, it's an $80 billion dollar capital raise that they've announced. Look, I think we are in a unique time. This is a unique time in terms of how everybody is preparing for what the next 3, 5, 7 years are going to be. You have an incredibly constructive market at this point in time. It is actually pretty well flagged that when you think about the hyperscalers, they have some pretty extensive spends. I mean, at the beginning of the year, the 5 biggest hyperscalers or 4 biggest hyperscalers were going to spend $400 billion. That number is now $700 billion at this point in time. So clearly, I think a lot of these things were well flagged and well advertised. So we are not surprised. And the strength of the market is immense. The constructiveness of the market is immense. Investors globally want to actually play this cycle and see how the AI, sort of ecosystem develops over the next few years. And so from that standpoint, it's a uniquely strong time to raise capital, even if you're net cash.
But what all this means for India then, Alok? Because, investors are making a lot of money in the US. Suddenly in the last 1 year, a lot of investors have made money in Hong Kong and Taiwan. And India is lagged behind, right? We've seen massive erosions of FI capital in the last 2 years or so. What all this means for India from a top-down perspective?
That's an interesting point, right? Because you're right. When we think about 2026, it's been a relatively weak year for Indian equities. But I think it's important to zoom out and have a perspective through all of this, right? The first thing I'd say is we are still close to a $5 trillion market cap. We have 114 companies that have market caps in excess of $10 billion. That is only third to the US and China in terms of scale. We have every sector here, so this is not a market which is predominated by certain certain specific sectors. It's very broad-based from that standpoint. We are only just entering to see what the Indian AI ecosystem looks like. Where do we contribute? Do we contribute in hardware? Do we contribute in infrastructure? How do we contribute there will become evident over the next few months and years. We have some unique and amazing assets which will likely come to market, in the next 12 months. I obviously can't speak about live transactions, but these will be very globally relevant assets, not just, India relevant assets. And I can assure you every global PM is going to look at them, very, very closely. The final point I'd make is that it's the only large market that has delivered positive returns every year since 2020. So when we think about things in a short term, we should also think about them in a medium term, where India's had a fantastic secular run that has happened over the last 5 years. I'm actually extremely bullish over the next 5-year period as well. I think the attendance at this conference shows that there are more than 120 corporates, more than 1,000 attendees. I think 200 people that have come from overseas. So the focus on India from a long-term perspective is just as strong as it's ever been.
You know, you sounded very, very positive on India, and very rarely I've heard global guys talking so much positive from an India perspective. But you know, the other big important point is, and which has been a big debate of late in India as well, that India has become a very strong exit market for global investors and for promoters. What's your take there? You know, beyond a point, you think the domestic liquidity is going to be enough to, you know, counter the FI outflows? What's the sense there?
I think the answer is yes. And I'll make 2 points there, Nimesh. One is, for any market's long-term strength, domestic liquidity is paramount. I mean, at the end of the day, why is the US the most unique and largest market in the world? Amazing amount of domestic liquidity there. I think the other element that we have, which is unique in India, is also the retail and high net worth market. I mean, the number of 150 million plus demat accounts, the amount that actually the populace plays in the equity market as well. This is actually a long-term strength. There can always be periods of ups and downs, but this is a long-term strength that we have. And when we think about FI outflows, these have happened before. They will happen again. But the cycle will reverse. This is also a reflection of the fact that India is traded at very, very strong multiples. I mean, even today, you know, our market PE is about 18 times. The only large market that trades at a higher level is the US, which is trading at 21 times at the S&P. So that is still a significantly high number. FIIs still own about 16% of the Indian stock market in totality. That is close to $800 billion of investments there. When you think about the outflows this year are about 24 billion. So yes, that's a large number, that's a meaningful number, and it shows that there is a cyclical element happening here where people have pulled out a bit out of India and gone to other markets. But when you think about 24 billion in the context of 800 billion, that's not a very large number.
Sure. But Alok, what can India do right to attract that capital? You know, of late there has been a lot of chatter about you know, reduction in the capital gains tax for the FIs and everybody. Do you think that's going to be a very detrimental in attracting a lot of FI money?
Yeah, look, I think you know, two things in my view dictate you know, participation from global investors in any market. You know, one is what is the policy environment that is out there? Is it supportive to markets? Is it supportive to business? And I think there, you know, we should continue to see what we've seen from the government so far. Hopefully that will continue and we will see more action.
Specifically on the FI taxation, you think if that's been tinkered, that will be enough impetus for FIs to come back into India market?
I do think it will be a factor. Absolutely. It will be an important factor in the larger scheme of things. My bigger take, though, is that when you think about the pipeline here, when you think about the assets that are likely to come out, these are such high-quality names. They are also large transactions. You know, the number of deals or number of IPOs that will happen in India, which are above $1 billion in size and comfortably more than $1 billion in size, is very, very high. You also have the global MNCs looking to IPO. There were a few that happened last year. There will be.
You were part of most of them, so.
We were part of most of them. We were very privileged to be part of that. There will certainly be more through the course of 26 and through next year as well. So I think when you look at the elements of the types of businesses coming, the scale of the India equity story, I don't think it's a market that frankly can be ignored for too long. Now, within that, people do look at what are relative valuations. People do look at, you've had 5 years of a run which is only in one direction, versus many other markets have suffered tremendously through that period. They may appear from the lens of valuations certainly cheaper in the context of today. And that does move money in different directions. That does create an inflow-outflow dynamic. But I think over the medium and long term, I continue to remain extremely positive.
You know, you spoke about a couple of large transactions which will come from India, and those are global relevant as well, the likes of NSE, likes of Geo. Is that going to be a big impetus for a lot of FI money to come back into India, look at India in a positive way?
Oh, it absolutely will be. And I think this is not just a forward-looking statement, Nimesh. I think it is a statement that if you look at the last 2 years, even through periods where FIIs were having outflows out of the market, they have always participated in the IPO product in very, very strong manner. And I think that trend will continue. I do not think they will change that. Besides the fact, I mean, some of these assets that you've named, as I said, are global majors, right? These are massive companies, and these are not just important in the India context. They are actually important from a global context for investors.
Tell us what's you've been observing across Asia in terms of the ECM trends. Because, you know, we sometimes only look at India market and get upset or whatever. But from a Asia perspective, from a global perspective, how's the ECM trend shaping up for the next 1.5 years?
Very strong, Nimesh, across Asia. I think we're up in volumes by close to 65-70%. And I think what's driving that is you're seeing lots of different markets be busy. China is extremely busy after quite an elongated spell where China was not busy. We're seeing a lot of industrial IPOs. We're seeing tech IPOs. We're seeing privatization transactions in China. So all of those coming out as well. We are seeing a lot of strength in Korea and Japan, where people that are associated with the wider tech ecosystem and the AI ecosystem are extremely busy. So memory makers, chip makers, all of those, we've seen massive surges in their stock prices. I think that trend will continue for 26, and I think Asia will have one of the biggest overall years that it's ever had after 2021.
And will India be a big part of it?
I do think so. I think when we think about where we end up at the end of the year, the numbers will not be very different from the 65 billion in total issuance that we saw in 2025. And this is of course across all ECM products, not just the IPO product.
What's the other trend that you're observing in India? A lot of Ps are existing, or the promoters are selling stakes. What's a broad your view on that particular trend of a lot of the promoter taking out money out of the capital markets?
Yeah, so my take on it is actually this is a logical path in the evolution of any business. As a business gets scale, as it becomes larger, it is important for it to become listed. Being listed allows it to get capital market access, not just on the equity side, but also on the debt side of things. And it actually sets the company up with even an M&A currency potentially in the future as you go. So I do think it's a very logical step that promoters are taking and private equity firms are taking as well in terms of listing. And largely speaking, I think it's to the nation's overall enrichment that you have more companies come and participate, be part of the markets, have an opportunity for domestic savings through domestic institutions, or people directly through retail and high net worth be able to participate in these stories.
When you talk to your global clients, is that been a big chatter that India is really missing out on the entire...
That was Nimesh there in conversation with Alok Gupte on the sidelines of the Citi India conference. To take your leave on this edition of Trading Hour, the Nifty has once again slipped below the mark of 23,200. Halftime report joins in from the other side, from Ritu and me. Thank you so much for watching.
Stocks take a beating across the board as resumption of strikes by US-Iran ups the risk of disruption and inflation even as the rupee sulks, as India's external vulnerabilities come to foray, as well as IT and realty are the big losers.
India has underperformed on growth and policy reforms. Policy reforms are needed for acceleration, says Morgan Stanley's Ridham Desai. He sees this along with easing of taxation and registration processes as steps to draw foreign investors.
Oil flares up after US and Iran exchanged fire after an uneasy, calm and an elusive deal that's going on. IEA's Fatih Birol warns that oil prices could enter the red zone if Hormuz is not reopened by the end of June.
Gold has emerged the reserve asset of choice for central banks across the world, overtaking US Treasuries as the #1 asset, reveals an ECB report. Central banks have bought in excess of 1,000 tons of gold in each of the past 3 years. Even the RBI's holding stands at over 880 tons. Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vinny Motiwala. A down day despite the last hour recovery that we saw yesterday. It is on the back of West Asia tensions. The strikes continue, and that is something which the equity markets are not liking. A big fall in the IT index, that was the top gainer yesterday, and we are seeing a similar sharp fall today as well. The Nifty is at the day's low as we speak. Most of the stocks are in the red in the Nifty pack, barring some of these healthcare names. And we've been talking about the big selling that has been coming in from FIIs. Yesterday we saw selling come by again. And that data will come up for you on the screen. After the selling that we saw yesterday, now in 2026 so far, the amount that FIIs have sold has surpassed what we saw in 2025 as the full calendar year as well. So that is a big selling figure that has come by, 3.08 lakh crore rupees so far in 2026, which compares with 3.06 lakh crore rupees that we saw in 2025. So the chart is there for you, the line graph that is. Of course, last year was very strong in terms of DI buying, 7.88 lakh crore rupees. This, of course, was much higher than what we saw in terms of FII selling. So far, DIs actually have bought more than half of what they bought last year. So DIs continue to support the markets. That has been the trend. The DI inflows have been higher, but look at that figure when it comes to FII selling, 3.08 lakh crore rupees, which is higher than what we saw the entire year. So that's the kind of confidence that we are seeing from FIIs this time around. Of course, some of it in the last week was also on the back of MSCI outflows. But after yesterday, we have actually surpassed that figure as well. Quite telling of the data that we are seeing on screen. So last time they actually were net buyers, that is FIIs, were back in 2020. We saw a buy figure there. But since then, it has been quite on the downside. But DIs have continued to see a big surge. And that's what we are seeing in the SIP flows as well.
Absolutely. That's what we're seeing in those flows coming in as well. But an interesting chart there showing us how those FIIs and DII flows have moved so far. But today, as of now, all the sectors are now in the red, right? You have nothing that is holding on to the green. Like Sonal mentioned, IT obviously is the loser, and we have the top drag. That is obviously Nifty IT, which is now down 5.7% after 3 days of gaining streak. We're seeing a fall that's come in for this one as well. Obviously, broader end of the market, let's keep an eye out on that as well and where that's headed, because in the last few trading sessions, we've seen the broader end of the market was underperforming. Today, also the Nifty mid-cap is down 1.6%. Day's lowest point is what the Nifty mid-cap trades as well. And in terms of the markets, Nifty is now comfortably below the 23,200 levels. It's at 23,170. Days low for the Nifty 50 as well. But let's talk about what's on the show for you all. First up, we'll bring you some excerpts from Morgan Stanley's Ridham Desai from the sidelines of India Investment Forum 2026, as well as in our Movers and Shakers segment. We will focus on NMDC, NHPC, John Cockerell, as well as Borosil Renewables. We'll also be speaking with the management of Sharda Cropchem on the impact of El Nino and the road ahead. And we will focus on crypto space with Manisha, who brings you all the latest developments there. First up, let's go across to Hormaz, who's here to take us through which are the top stocks that are moving around in the trading session this afternoon. Afternoon, Hormaz.
Good afternoon, and well, it's back to square one, I guess, for the markets after that second half recovery that we saw in yesterday's trading session, driven by the weekly expiry. But of course, the principal culprits today are IT. The protagonists of the last few days have turned into the antagonists of today's session. Look at TCS and Infosys. TCS is now down 9%, and it is heading very close towards that 2210 level that we highlighted. It might slip below the 8 lakh crore rupee mark. Infosys too now extending its losses down around 4.25% as we speak. There is one factor that I wanted to highlight for Wipro, not just for the fact that there is a selling in the stock, but there is a significant price difference that you are seeing in the cash levels and the FNO rates as well. The cash market right now, the stock is at 202. In the FNO space, the futures are trading well under 180 rupees as of now. So there is this significant price difference that has emerged on Wipro, both in the cash and the futures market, as my colleague Sudarshan highlighted as well. Now, for some of the other losses in stocks today, Physics Wala is another one, 6% lower on the stock. Is the fifth straight day of losses now, is down around 20% during this period. A couple of names that are bucking the trend though. Tejas Networks is one such name. That stock is up around 5.5%. And then in the last 9 sessions, the stock has gained in 7 of them. And during this period, the stock has risen around about 22%. News flow driven up move seen in Concord Biotech. That too is seeing good gains in today's session, 6% higher on the stock. The stock was up 10% in yesterday's trading session as well. And during this 3-day stretch, the stock has gained around about 20%. But the one stock where selling is refusing to stop is Natco Pharma. Now, although the stock is recovering from the lows of the day, it's still down. And well, it's from 52-week highs before the results were announced. The stock is now very close to its 52-week low, which is at 790 rupees. Still some distance, but a significant cool off from the 52-week high levels for Natco Pharma.
Okay, all right, take that point. Thank you so much, Hormuz, for joining us. So those are some interesting names that we are tracking. With that, let's move on. This is time for our Movers and Shakers segment, where we track a whole host of stocks buzzing in trade. Vinny, let me come across to you first up. Borosil Renewables, that stock is buzzing in trade on the higher side in a weak market like this. What's happening here?
So absolutely, we have some more positive news that's come in here for Borosil Renewables. Actually, for all those Indian makers who are into this business of tempered and textured glass making. Now, what has come in as is that the Indian government has extended the countervailing duty on imports for textured tempered glass from Malaysia. This duty is already there on China as well. Now, if this is extended for a period of 5 years, the CVD has been extended for a period of 5 years from these products that have come in from Malaysia as well, or that would be imported from Malaysia. Now, there are 2 rates that they've given. One is a differentiated rate for a couple of companies from Malaysia, which is at 9.7% to Malaysian companies. And the other one is for other companies, the duty is at 10.1%. So these are the 2 rates. So what does this mean now? This will protect local players. You will have that pricing power versus, imported goods as well as in terms of imports, they become expensive. So everyone will have to start going more domestic if the pricing is better. And that means it's a benefit for Borosil Renewable because they are into this business as well. They do make these solar glasses, which are there, these tempered textured glasses. And that is why the stock is buzzing in trade. But let's move on and talk about NMDC as well. And Nigel was talking to us about some price hikes here as well. Nigel, over to you, NMDC. And this is something that has been confirmed as well.
Well, that's right. NMDC has been moving quite well. And early this morning, we here at CNBC TV 18 give you a bit of a heads up that there's possibly a 150 to 200 rupee price hike that's been affected in the Bailadila mines, which is in Chhattisgarh effectively. Now, that's come through, right? Because you have the lump prices that have been fixed at around 5,700 rupees and the fine prices that have been fixed at around 4,850 rupees per ton. In the last few months, we have seen close to 1,000 rupee price hike, and this price hike has come as a bit of a surprise. The reason I say that is because we are awaiting the monsoon, and in the monsoon season, normally you see activity slowing down. So that's why it's come as a bit of a surprise, point number 1. And there's been no big fluctuation with regard to global prices as well. So that's why the street is quite impressed. After such a big price increase, getting into the monsoon season, still they go ahead and increase prices. Explains why this stock is doing a relative outperformance in today's trading session. Back to you guys.
Okay, all right, take that point. So that's NMDC. The stock was higher but has come off from the highs of the day. But some other stocks which are on our radar, there is NHPC, John Cockerill. Tell us more about that, Penny.
Hi, so obviously yesterday NHPC we saw was falling in trade via that OFS that had come in, right? The government had issued an offer for sale, non-retail and retail portion over the 2 days. Now, what happened in the non-retail investor side? That was yesterday. Subscribed 3.47 times. So very strong subscription that came in here. Now, obviously, the government has decided to exercise the green show option as well. So overall, the base size of this OFS was around 4,200 crores. Half was obviously the normal issue, and the other one was green show option of other half of 2,100 crores approximately. Now, today is the retail investor side. We're seeing good traction coming in so far as well from the retail investor subscription. Around 25 to 30 times the last time I checked as well was around half an hour ago, where we saw the subscription coming in 25 to 30%. I beg your pardon. That's the subscription so far for the retail side. Now, John Cockerell, this one, why is this in focus on buzzing away in trade? They have received an order of around 1,250 to 1,300 crores. This is from JSW Vijayanagar Metallics for a CRNO project, and on the back of this project win, an order win, the stock is buzzing away in trade, and now holding on to gains of 14-15% in the trading session as well. So that's about both these stocks, Sonal.
Okay, 13.5% on one of them in a weak market like this. So that stock definitely stands out. The other one which is doing well is Cartrade Tech. Sudarshan is joining us now. There's a note coming in from Kotak as well. Sudarshan, tell us more.
Kotak Institutional Equities has upgraded the stock to buy, and target price is increased to rupees 2,300 per share. And remember, this stock has been one of the biggest underperformers in 2026, down more than 30%, mainly on the back of concerns related to disruptions from AI models. But Kotak believes that its deep dealer database and value-added offerings will limit the impact from AIs, and this upgrade has mainly come because of the higher valuations for OLX, and OLX sees steady GMV growth, improving margin and monetization, and that will support the growth. So Kotak has raised FY27 to 29 EPS estimates in the range of 1 to 5%, and that's mainly on the basis of higher profitability assumptions for OLX. So mainly because of higher valuation for OLX has led to upgrade for Cartrade Technologies.
Okay. Thank you so much for that, Sudarshan. All those stocks that are moving around in the trading session, Borosil, NMGC, NHPC, John Cockerell, as well as Cartrade, all of them buzzing in the trading session. But on that note, we're going to slip into a very short break. Up next, we'll speak with Bubna, the chairman, RV Bubna, the chairman of and managing director at Sharda Cropchem, on the other side to talk about the outlook of the company going forward, as well as the El Nino condition. What does it mean for the company as well? Stay tuned. Welcome back to Halftime Report on CNBC TV 18. As of now, where's the Nifty standing at? Let's take a quick look at that, right? 23,180, still below the 23,200 mark. Trying to come off from that day's lowest point, but let's see what's going to happen in the second half of the trading session. As of now, the Nifty is down 300 points. But let's move on and bring on board the first management for today. We have Mr. R.V. Bubna, who's the chairman as well as managing director at Sharda Cropchem, joining us right now to speak to us about that El Nino condition that's coming in, the numbers of the company that have gone by as well, what is the outlook of the company. We'll discuss all of that with Mr. Bubna. Thank you so much, sir, for joining us on the show this afternoon. Sir, let's start by talking about the recent news flows, obviously in terms of the El Nino condition. That's expected to come in as well. One, are you seeing some concerns around this as well? What is the possible impact that, we could see coming in for the company because of the El Nino conditions?
I hear about the El Nino many times, but this is not affecting the agrochemical business most of the times. So El Nino is not having a very big influence on the agrochemical business globally, particularly for Sharda Cropchem Limited.
Mr. Bubna, you do have more international exposure. India is really a small part for you. India, there have been talks about deficient rainfall that is possible. Europe is facing a lot of heat waves. What is the indication that you're getting? You have guided for a 10 to 15% revenue growth in FY27. What is that based on? Will you see volume growth or will it be based on pricing growth?
Both. Volume as well as price improvement.
How much of a price improvement will you see? A lot of the improvement that you saw this time was also because of Forex. Is that also one of the tailwinds that you factored in your guidance?
I foresee about 10 to 15% increase in the prices, but that doesn't mean the entire benefit will come to the company, because I also expect massive increase in the cost of the purchases.
How much has that gone up by, Mr. Bubna? I know that's happening across the industry. It's not specific to your company. But how much have prices for raw materials gone up by? Where are you importing your raw materials from currently?
Madam, most of our raw materials we are importing from China. And I would not like to use the word import, because none of these goods come and touch the soil of India. The goods are being exported from China directly to the destination countries.
Yes, yes, of course, I know that, because you do have manufacturing facilities in different countries as well. In that case, how much have they increased by because of the West Asia crisis? How much of an impact are you seeing? Are the transportation times increasing, or because you have a multi-facility arrangement available, it is not impacting your pricing so much?
Madam, the West Asia crisis has not impacted our business at all. The only thing is there's a slight increase in the freight cost, which doesn't form a very significant part of the prices, and most of it is being passed on to the customers, and they are not having any issues or complaints against this increase in the prices or because of the freight.
Okay, so you're saying not much impact because of the West Asia crisis. That increase also, if there is in freight costs, that you already passed on to the customer, and you're not seeing any issue in front of the demand terms over there as well. So if I could go more region-wise as well, at least for Q4, the NAFTA region, we've seen a bit of a concern coming in here in terms of the growth there. So could you tell us what's happening here? Are we seeing a recovery again coming back in Q1? What is the current scenario?
We are seeing a recovery coming again in Q1.
Okay, that's for the NAFTA region. You're seeing a recovery coming in. So we'll come back to the growth story, right? Because in Q4, I think you've seen a degrowth. So that you will see a growth again in Q1? Okay. And sir, any specific trends that you're seeing coming in from the LATAM as well as the Europe region as well in terms of volumes? Any specific growth outlook over there?
We are very positive about increase in the volume in the European region, and Latin America is also improving.
So you had planned an FY26 capex of around 450 to 500 crore rupees. The actual capex was at 505 crore rupees. What is the outlook for FY27? What will this capex be on? And considering that, how will you be funding that? You do have cash in your books. Will you continue to use that?
We use the cash that we have in our books. And as far as the total investment is concerned, this is also likely to go up. I would say in the range of 525 to 550 crores.
What will it be on, sir? What kind of, is it maintenance capex? Will you be using these capex for new registrations? What is the pipeline of products that is in place for FY27?
Mainly we use the new registrations, and we have about more than 1,000 products registrations in the pipeline.
Okay, 1,000 products in the pipeline. So on an average every year, how much do new products contribute to the top line? This 10 to 15% growth that you're looking at, will it be for existing products? Will it be pricing led, or a lot of it will come from new products as well for you?
Then put together, including new products as well as the capex and improvement in the business atmosphere.
So, just in terms for your non-agri-chemical side of the business as well, I believe it's spoken about good demand trends that you saw in FY26. What is the outlook here in terms of growth? What is the growth guidance for FY27?
We have matching growth in the non-agricultural business for about 10 to 15%.
Okay. If I'm looking at your balance sheet at a time when everybody is talking about stretched receivables, stretched inventory because of West Asia crisis, you've actually been able to improve your working capital by 20 days to 98 days. Will this trend continue? What has led to this improvement that you're seeing? And if suppose there are heat waves that come by, there is El Nino condition and sowing across the globe is impacted, do you think your balance sheet could get stretched in FY27?
Not much. The main improvement is because of the business atmosphere in European Union, particularly in context of agrochemical business and agriculture.
So are you getting more demand from Europe is what you're saying, and that is something which is improving fundamentals across the board from PNL to balance sheet?
That is one factor. Second factor is our customers are able to pay on time. Sometimes we give them a small cash discount and they pay earlier than the due dates.
Okay.
That is in our working capital.
Okay, so hoping for that as well, sir. Thank you so much, for joining us this afternoon on the show, talking to us about the current scenario in terms for the company, as well as the industry outlook and the outlook for the company going forward in FY27. Thank you so much for joining in. And a spike up that we're seeing coming in from the day's lowest point for the stock as well. Shraddha Cropchem is now down 1.5% in the trading session. Both volumes and prices are expected to improve from here on. They've spoken about around 1,000 products that are coming in terms of the pipeline as well. So that is something that we'll watch out for, as well as the growth guidance that they've spoken about. But that is Shraddha Cropchem, the management for y'all. But on that note, we're going to step into a very short break. After the break, we'll have Sachidanand of Trade Bulls joining us to take us through his trading strategies on the other side. Stay tuned.
Welcome back at the 23,200 mark on the Nifty as we speak. But while the Nifty has seen a wee bit of recovery for now, we do have a lot of stocks in the broader markets which are buzzing on the upside. Lakshmi Organic, it is up 14% at the day's high, continues to do well. Balaji Mines, which was up around 19% yesterday, continues its up move today as well. So that stock is up around 6.5%. We do have Aether Industries, which is up around 3%. So a lot of these chemical stocks are making a comeback, so keep an eye out on this sector. There is something which is changing, and that's why a lot of positive reaction to some of these names. But what's happening at the F&O desk this afternoon? Let's go across to Nigel with all the details. Nigel.
Well, you know, one worry today is that the India VIX that a few sessions ago went ahead and breached the 15-odd mark. Actually, that's an additional trigger for the markets to move up. Now, the problem is from going to around 14.8, that one is perked up to around 16.5. You want the India VIX to cool off. And it has an inverse relation, right? The markets are down, India VIX moves up. So you're expecting it to pop up, but you don't want it to run past the 20 mark. Today, in fact, you know, it's been a bit of a backbreaker for the Nifty because both the constituents, that's the IT index that was holding on to its own for the last few trading sessions and doing an outperformance, that's lost 5% in a single trading session. While you have the Nifty Bank as well, that's, you know, it's down close to 100%. So it's a bit of a backbreaker out there. But when you see the markets fall by this sort of velocity, you see that, in fact, you know, there is some call writing that comes in. And because of that, the PCR has cooled off. Now, the PCR has come down to around 0.78. Remember, a couple of sessions ago, it went to around 0.68, and then it bounced from that. So we're a little bit distance away from there. But the call writers are feeling very confident. Now, just take a look at this. The 23,300 call. The premium is down to around 167. At the start of the trading session, it was 360 rupees. So those call writers, they are feeling very confident. Even the 23,500 call, which we were at just yesterday, out there, the premium has come down to sub 100 rupees from around 225 rupees. Aggressive writing is what we're seeing out there. What's giving you some hope is that 23,200 put. The premium at the start of today was around 55 rupees. Now that's perked up to around 200 rupees. So earlier yesterday, there was some kind of buying that was seeing out there. But now you're seeing signs of writing, which if there is writing out there, the 23,000 mark becomes the next reference point you're looking at. Individual stocks, NHPC, there's a bit of a special situation that's playing out there because of that OFS. The short's getting stumped on the wrong side. That stock moves up, open interest down. MCX, after having a good run, various brokerages are pointing out that maybe it ran ahead of itself and valuations have become a little bit expensive. That one's coming for some fresh shorting. And Apollo Hospitals, and that's been a beautiful moving stock. From the Nifty pack itself, that's holding on to its own, and there are signs of fresh buying. It's very, very important that the markets go ahead and defend these lower levels. 23,160 is the lows of the day. You don't want that to breach. We're flirting with that level, but the bulls will want to fight back, you know, 100, 150 points from here on. So we'll keep a close tab on that. Back to you.
Absolutely, Nigel. We'll keep an eye on those levels over there. Hope the bulls fight back strongly, but thanks so much for that, Nigel. Let's also bring on board Sachidananda Dekar of Trade Bulls, joining us right now to take us through his trading strategies. Sachi, hi, good afternoon. Thank you so much for joining us on the show as always. As of now, we have seen some bit of a recovery, right, from that low. We were at the day's lowest point. Now we have moved up to 23,260. Around that mark is what the Nifty is trading at. What are the levels you're keeping an eye out on for today?
Good afternoon, Vinny. Good afternoon, Sonal. Clearly, if you look at the way Nifty has been performing, it is near to a very significant gap support area, which was left on 8th of April, near to that 23,150 mark. Now, also, if you look at the overall rally that we saw in April, the 61.8% retracement is also placed somewhere close to around 23,110. So I think it's a very significant support zone for the market. We have already seen a very strong reaction at 24,130 levels last week. And when the Nifty turned from that particular level, now even there was a gap resistance which was created on 8th of May. So right now, though we are oscillating within this particular range, somewhere on the 60 minutes charts, there is a sign of hope. There is a 60 minutes positive divergence on its RSI, indicating that there could be limited downside and we may see another run on the higher side. So we are expecting that the market should stabilize somewhere close to around 23,150, 100 zone. And it's an ideal zone wherein some contra bets on the long side can be deployed. We are expecting that the Nifty would again, display a rebound towards 23,440, 430 kind of a zone in a day or so. And hence we are recommending building long position at this juncture. One can keep a stop loss at 23,100 on closing basis and build fresh long positions for a rebound towards 23,440.
Okay, as we speak is again a sharp recovery from the lows that we are seeing. This is something that we saw yesterday as well during halftime report, and that has happened yet again. And of course, it's coming in from Bank Nifty. That index has recovered sharply from the lows of the day. A lot of these heavyweights on the index are leading to this recovery from the lows of the day. ICICI Bank, you have HDFC Bank, there is Axis Bank. All these three stocks have surged from the lows of the day. The charts will suggest how these are contributing to the gains that we are seeing from the lows. ICICI Bank is in the green right now. We also have HUL, Maruti Suzuki, Trent, some of these consumption names which are doing very well. So watch out for the moves on the Nifty as we speak. The mid caps too have surged around 300 points from the lows of the day. The recovery, whether that sustains or not, is the big question. But yes, a definite recovery which is underway. Since you are suggesting to go long on the markets, Sachidanand, what are some of the stocks you would like to play that with? Because Bank Nifty yesterday was the reason for the recovery from the lows. Today as well, that's the case. What are your individual bets?
Good afternoon, Sonal. Sonal, even on Bank Nifty, the support which is coinciding with the 8th of April gap is placed somewhere close to around 52,800. And if you look at the overall construct, even yesterday we saw ICICI Bank, displaying some kind of stability in the price. We saw a kind of a spinning top formation on the daily scale, and I think the confirmation could be set today. Hence, what we have done is we have recommended, building long positions in ICICI Bank for our clients. So this will be our disclosure. Stop loss for the trade can be placed at around 12.22 on closing basis, and we may see a quick recovery towards 12.46 in a day or so. Hence, we are recommending building long positions when it comes to ICICI Bank. The other stock that we have recommended on the buying side is Maruti. Now, if you look at the last 6 weeks, Maruti has displayed a strong resilience near that 13,100, 13,000 support zone. Even today, we have seen signs of short covering here. The trigger point is around 13,200. And hence, we are expecting that there could be a short squeeze which will be in motion. And we may see this particular stock scaling towards 13,450 to 13,700 in a couple of trading sessions. So we are expecting this particular move to unfold soon. Hence, recommending building long positions in Maruti. One can keep a stop loss at 13,080 on closing basis.
Okay, we'll keep an eye out on the levels over there for Maruti Suzuki. But, Sachidanand, we do have a couple of queries that have come in, and this is the first one is interesting. It's coming from Yash Mahindru, who's writing to us from New Delhi. They're looking to invest in those AI-related stocks in India. So if there's anything that one could look at over there, as well as your thoughts on TCS at current levels, does it make sense investing in TCS at current levels? Like after 3 days of gains that we've seen coming in, today we're seeing a fall coming in for TCS as well. So are these the right levels to look at that one?
When we look at the price action, I think the price action has been very evident. We have seen a lower top, low bottom structure. There has not been any major change in the price action for that matter. Yesterday, we saw a very strong velocity move. For the first time, we saw TCS giving a close above its 50-day exponential moving average resistance. But if you look at the overall construct, we need a couple of strong closing above this particular resistance, and then probably we may see some change in the structure. But as of now, it's a classic sell on the rise kind of a movement. And in case if you look at 2,300 levels, I think that particular level has been very significant. If the prices still close below the same, there could be a possibility that there could be further slippages going forward towards 2,1960 kind of a zone. So I think the structure is still weak. There are no major signs of a reversal yet.
Okay, still weak. That's on TCS, the biggest fall that we've seen since 2020. Let's go to the next one. Jyoti Gupta is writing to us from Mumbai. She wants to know if she can invest in Eternal for the short term. What's your take here, Sachidanand? Is it a good trading bet?
Definitely, yes. If you look at the positioning, the stock has been consolidating within the range of around 260 on the higher side, and it has been maintaining that support around 240. Now, recently, if you look at the way its daily RSI has moved, it's a good sign that there could be further strength in the coming days. So we are expecting that eventually this particular range would be breached on the higher side, and hence recommending fresh long positions even with this current price action in motion. One can keep a stop loss at around 240 on closing basis and expect a move towards 275, 280 to unfold in a couple of weeks' time.
Okay, Sachidanand, thank you so much for joining us on the show, taking us through your individual trading strategies as well as answering the viewer-related queries as well. Thanks so much for that. A quick look in terms of the markets, because now 23,300, about that mark is what the Nifty is trading at. So, we are seeing that very sharp up move that's coming from the day's low for the Nifty 50 as well. When you're seeing that when we started the show, it was at around somewhere 23,170, 180 levels. And now at 23,327, that's the market for y'all. Bank Nifty leading the charts in terms of the recovery there. But let's get you some market opinion on that note. We have Morgan Stanley's Rhythm Desai says India looks attractive on valuations but weaker on growth. Adds retail participation is unlikely to fade and policy reforms can help get FIIs flows back as well. Listen in.
On a relative basis, India is not looking good on growth. It's looking very good on valuations, but it's looking very inferior on growth. So if you compare with other large markets, and this is, AI is an excuse. The real deal is on growth. And this has not been the situation only for the last 2 or 3 months. It's been the situation since September of 2024, when India's growth peaked, valuations peaked, and since then the market has derated on a relative basis, and growth has been decelerating. Now, growth did pick up in the December quarter, but the growth elsewhere is very strong. Retail investors in India are just not stopping the bid. So in March, you would have ordinarily expected retail investors to be a little bit hesitant because the markets were volatile, there was bad news, there was a drawdown. But they put record inflows, and they followed up with another strong April, and I think the May month also has been probably very strong, going back by the amount of buying that domestic funds have done. And I don't expect the retail bit to go away, because that's a secular shift that's underway in India.
And you pointed it out.
We've been talking about for 11 years now, and now finally that skepticism is fading. But people are waiting that one day retail will panic, but retail has matured in this, and they are upping their equity allocation, rightfully so in my view. In the long run, this is going to pay off quite well to them.
Okay, on that note, we're going to step into a very short break. Don't go anywhere after the break. Manisha Gupta will be in conversation with Athar Sahab, MD at Zuari Industries. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Nifty has continued that recovery that we're seeing. 23,340 around that is what the Nifty is trading at. More than 100 points recovery we've just seen itself in the last 40 odd minutes since we started the show, right? Look at the Nifty Bank as well. Where is the Nifty Bank? Moving towards the green side for the Nifty Bank. 53,680 around that mark is what the Nifty Bank trades at, and very, very, very sharp recovery is coming from Nifty Bank. That's what leading the way for the Nifty 50 as well. And that's why let's look at the stocks that are supporting this up move right now, right? ICICI Bank, in terms of the contribution for the Nifty 50, also is coming in from that banking side. That Nifty Bank recovery is clearly the one that's supporting this up move. And this green that is coming in for the Nifty Bank also, that we're seeing slight bit of a between the red and the green, is for the Nifty Bank and the Nifty. 170 points recovery there as well. Nifty Bank more than 600 points recovery from the day's lowest point. And all the names are the banking names that we're seeing coming in for the Nifty Bank on the screen for your ICICI Bank, HDFC Bank, Kotak Bank. These are the private banks that are leading the up move. SBI is the one that's a bit muted in the trading session. IndusInd Bank on the other side. But today's recovery so far in this last 40 odd minutes is come from the banking side. Keep an eye out on that. And the broader end of the market also has seen a recovery. So when you look at the Nifty mid cap, small cap, that too has recovered from the day's lowest point. And in that, and specifically the last 40 odd minutes, what's actually moved up? Let's look at some of the names over there. We have Aether Energy, that's up. Inox India, Adani Transmission, that's seen an up move in the broader end of the market. Orient Refractors, that's also a one that's seeing an up move in the trading session from the broader end of the market. So yes, that's how we're seeing in terms of the up move that's come in for the market and the recovery that we're seeing led by the Nifty Bank. But it's time for commodities, right? And let's go across to Manisha, who's here to take us through a conversation with Athar Sahab, MD at Zuari Industries. Manisha, over to you.
Well, thank you so much for that. And Mr. Shad, thank you so much for joining in. I want to talk about ethanol and blending going forward, and that really seems to be the buzzword right now, especially since India has already done E20 ahead of schedule, mandatory from 1st of April as well. And we also have seen those BIS standards for E22, 25, 27, 28 come in, and conversations about E85 are already on. But amidst all of this, the one thing that the street is still awaiting for is favorable policies when it comes to flexi fuels. Would you say that is one thing that India perhaps needs to sort right now?
I think we are at a very interesting moment, Manisha, and we are very happy and excited about the recent developments. You see how beautifully India has tracked this development. We always believed that ethanol blending is going to play an extremely important role in India's energy transition story. And from scratch to the numbers that we have achieved, it's absolutely staggering, unprecedented. And I think the numbers speak for themselves. The payout to farmers, the saving in forex, all these numbers speak for themselves. I don't think there's any country of size and scale such as India, which has achieved 20% blending in such a record time. And as industry was building capacity, and we were all kind of gearing up, but there was a pause at 20%, which is very happy to see that now there's a lot of excitement around increasing that blending percentage and going right up to E100, which is very interesting, very exciting. The industry is already ready, as you say, in a $20 billion installed capacity. So straight away, it could go up to 40% blending. But I think we are at a very interesting time in the current geopolitical environment. The industry is going to play an increasingly important role. We are happy to note that the political leadership of the country has recognized the importance of this industry. And we're all geared up to play our role, honestly.
Mr. Shah, are you saying that with the current investment and capacity that India has, 40% blending is something that we could go to immediately? Is that what you said?
I mean, the math is very simple. With 1,000 crore of tenders, India has achieved 20%. Right. So if 2,000 is the capacity, I think 40% is a straightaway math.
As my first question was, would you say it is about flexi fuels now? Because everything seems to be ready. It's just the framework and policy about flex fuels. You think that is what needs to be pushed ahead? And why is it getting so delayed?
I think, we are very happy to see that it's falling in place.
Okay.
And the speed and the alacrity with which it has happened in the last few weeks is quite amazing. One wishes that it had happened a bit earlier, but nonetheless, I think the speed at which the government has moved has more than made up for whatever delays happened in the past. And we are all looking forward to not only E25, E30, but E85 and E100, which is once again quite exciting for all of us.
How are you as a company also positioning yourself for this new phase that India perhaps is readying itself for?
So we have always been long on biofuels. And we have a sugar complex in Uttar Pradesh, where we set up a distillery a few years ago. We used to produce 100 KLPD, which we expanded to 125. And whatever we produce, we have been selling to AMCs every year. But knowing the potential, we tied up with a large European company and we set up a 180 KLPD grain-based distillery, which is now fully ready. And I think we will play our role. Our stated plans have been to expand this capacity to 1,000 KLPD. But I think as India rolls out the program, we are very happy to take it up to our stated objectives. I think we want to play our role in biofuel story of India.
Mr. Shab, how would you react, or how do you normally, lead in a conversation? Because when we talk about ethanol, it's about farmers and food security and fuel and self-reliance. There's a lot of conversation always around that. What is your stake or hold on that?
I think farmers are very happy. Honestly, I just asked for some data, and I think the amount of funds transferred to farmers is about 1.4 lakh crore since the whole thing began. The estimate for this year itself is that the farmers would receive 40,000 crore from distilleries. So this is a staggering number. I think the way farmers have benefited, everybody knows about it. As regards that fuel versus food debate, I think that will always continue. I think in relative terms, maize is much less water intensive compared to some other crops. And I think, this has to play that role. We are at a typical situation in our history where we have to find out alternate sources of fuel. And I think if India can meet it through domestic sources, why not? And at some stage, I believe that maybe, some of the 2G technologies will also play their role.
Sure.
So I think we have to be at it. We have to be constantly expanding the scope of this alternate fuel.
So, Mr. Shab, that exactly is my final question then. You've talked about the kind of KLPDs that you would be increasing to, but what kind of an investment are you looking at, let's say, in the next 3 to 5 years?
So I think, we have invested about 300 crore in creating this 180 KLPD capacity. And if you want to expand it by 5 times, you can easily estimate what that number could be. But it all depends on how quickly the whole thing is rolled out and how quickly the demand builds up. We are expecting that these recent announcements will result in firm orders from the OMCs. And I think you will see, people expanding their capacities.
Okay, all right. Take that point, Mr. Shah. Thank you so much for joining in. Energy security, the big talking point now. Thank you, Manisha, for taking us through this interesting conversation. That's all about ethanol blending and a lot more on the energy side. But for now, we'll slip into a short break. When we come back, we'll get you everything crypto on the other side. Stay tuned.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome to Crypto Corner, and when you look at that as an asset class, we've seen kind of declines come in for this one on a weekly basis, on monthly basis, and year to date as well. So crypto clearly hasn't done so well in the last few sessions there. Also, the decline comes in as the money is shifting to the AI equities. Crypto has seen $1.23 billion of a liquidation happen in the matter of last 1 week itself. And when you look at the total overall market cap, well, that has declined quite sharply to 2.3 trillion. It did hit an all-time high of 4.4 trillion in the previous year itself. The next chart should show you on what we've done in sense of prices. So Bitcoin is down 17% in last 1 month, taking that down to 25% of a decline in this year till time. And that's exactly the scenario that we seem to be looking at for every crypto, leaving Binance out. 3% of gains on a monthly basis, but YTD, it also is putting or registering in a decline of 26%. So 38 to 40% of a decline coming in for the major market cap movers when it comes to many of those cryptocurrencies therein. The 3 or 4 major reasons for this kind of a decline is, one, MicroStrategy as a company has always bought crypto. But this is the first Bitcoin sale that they have done, first one in 41 months, by the way, and they offloaded just about 32 Bitcoin, but that is enough to do that sentiment damage that the markets were dealing with. And then you have the ETF outflows, consequently for 11 days. That seems to be weighing onto the markets as well, and this is the longest stretch that you've seen in sense of sales since the launch of Bitcoin ETFs therein. And then Mt. Gox movements is another thing that the street is keeping an eye on. It has moved 10,422 Bitcoins to its new wallet. Now, markets are looking at that as as various ways that you could be looking at in sense of crediting, distributing, or selling these Bitcoins. And that is another thing that is bothering the markets therein. There also has been a lot of regulatory and institutional shift that we've seen within the space. To begin with, it is the U.S. Treasury Department, which is heavily sanctioning Nobitex right now. Nobitex, by the way, is Iran's largest digital asset exchange. This is alongside 3 other Iranian crypto platforms that U.S. Treasury Department as of now has sanctioned. The second is the UK Lords of Committee publicly urging Bank of England to now register or reconsider its rigid proposed individual holding limits of £20,000. This is in case of stablecoins. And third important is the DTCC officially selecting Stellar for its tokenized securities platform. This is boosting Stellar's real-world assets going forward there. And finally, the major decentralized ecosystem as well is moving quite a bit. The Galaxy is returning into the markets to institutionalize prediction of market landscape. And we also have seen Polymarket, Solana strategies come back into the fore as well, making bigger investments and doing higher acquisitions.
Okay, all right, Manisha, thank you so much for joining us. So that's all the crypto update. We'll slip into a quick break, come back and get you more on the markets.
CNBC TV 18 presents Crypto Corner, powered by Binance.
There is some selling pressure from the highs again, especially on the bank Nifty. So keep tracking that. For now, there is a recovery which has been sold into a little bit. That's the mood of the market. And with that, we'll take your leave on halftime report. But Business Lunch will come up next to take all the action ahead.
Stocks are under pressure but off the lows of the day as resumption of strikes by the US and Iran ups the risk of disruption and inflation. The rupee also sulks as India's external vulnerabilities come to the fore. IT and realty are the big losers while banks lead a minor bounce from the lows.
India has underperformed on growth and policy reforms are needed for acceleration, says Morgan Stanley's Rhythm Desai. He sees this along with easing of taxation and registration processes as steps to draw foreign investors.
Oil prices rise after the US and Iran exchange fire after an uneasy calm and an elusive deal. IEA's Fatih Birol warns that the oil crisis could enter a red zone if the Strait of Hormuz is not reopened by the end of June.
Gold has emerged the reserve asset of choice for central banks across the world, overtaking U.S. Treasuries as the #1 asset, reveals an ECB report. Central banks have bought in excess of 1,000 tons of gold in each of the past 3 years. Even the RBI's holding stands at over 880 tons.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Hi, Hormaz. Good afternoon, guys. The markets, you know that tensions in West Asia are flaring up and that's clearly having an impact on the markets. We've come off the lows of the day, but still in the red.
You know, Sudarshan and I were sitting outside for the last half an hour trying to find an expression for what the market is doing. We could not find one. We failed to do so, especially for the last 30 minutes. And it was very similar to yesterday's trading session when at 12:30 the market began to stage a recovery and it made a one-way move back towards the positive territory. And again today at 12:30 is when the recovery started from the lows of the day. And similar to yesterday, it was the Nifty Bank that has led that charge. And the Nifty Bank saw a one-way move upwards from losses of almost 600, 700 points. The index slipped into positive territory. Yet again, that recovery is getting sold into. At one point when the index was down around 70 points, we took a blink and the index was down 150. So there are extremely choppy moves that are being seen in the market right now, especially over the last 30 minutes, because until the first half of the trading session, the index was moving one way and that was lower. It broke past yesterday's lows. It broke past the 23,200 mark on the downside as well. So that is going to be the most important level that the bulls bulls would be wanting to defend as of now for this trading session as we go into the Sensex expiry tomorrow. 23,200 on the downside. Banks are the ones that are contributing to this volatility, but it is the IT stocks that are the major antagonists in today's session.
Absolutely. That's the biggest thing to point out today in the trading session, right? The culprit is that IT pack. That index is down 5.5%. If you take a look, TCS is down about 8.5%. Infosys, HCL Tech, both of them down over 4%. And every single constituent is in the red. The Realty pack is the other big loser. DLF, Prestige, Lodha, all of those stocks between 2 and 4% in the red. Now, most of the sectoral indices are in the red. If you take a look at the healthcare pack, that's absolutely flat. Seeing some green there, we've got Apollo Hospitals, Max Healthcare, Mankind Pharma, all of them over to between 1.5% to 2% in the green. And some of those banking names seeing a recovery, private banks like Kotak Mahindra Bank, Axis Bank, and ICICI Bank. All of those are seeing some green in the trading session. So that's how the markets are shaping up today. But our top focus, the oil prices, which continue to rise on the back of renewed tensions in West Asia and uncertainty over the US-Iran deal. Manisha Gupta joins us now with all of those updates on crude. Manisha?
Well, after 19% of a decline for the month of May, the crude prices already are up by nearly 3.5% for the month of June in the initial 1 week itself. This is because there are reports of Iran firing missiles to Kuwait and Bahrain. The diplomatic talks between US and Iran seem to be falling apart, and that is where the premium seems to be coming in from. Also, when you look at the US inventories, they have declined for a 6th straight week and by a large 6.8 million barrels in the previous week itself. The support also comes in from the fact that the actual physical molecules of refined products like jet fuel and diesel are all behind the blockade and not easily available to the rest of the world, and that perhaps could lead to prices going higher, especially for refined products going forward therein. Also, when you look at the energy reserve, they have continued to decline for US and for the IEA members as well. China continues to hold very strong reserves at this point in time too. But then again, there are various statements, whether it's from IEA, from Vitol, from ANZ Bank, even ADNOC for that matter, all suggesting that going forward from here, if we do not see Strait of Hormuz open by the time it's June end and July, we are looking at higher prices. It also is concerning because the summer season driving demand also is begin very soon, and there's not enough inventories into the market. The global inventories have continued to decline, and when you look at the kind of supply shock that the world is reeling with, this is perhaps the largest in the history, is the sense coming in from all of these big names telling us that we are perhaps preparing ourselves for higher prices going forward, something that the physical markets are not factoring in right now. So most of them are coming out with a range anywhere between 95 to 125 on the higher side for the second half of 2026.
Manisha, thank you for those updates there. Brent hovering around the mark of 98 barrel as we speak. Let's get you some market opinion then. Morgan Stanley's Rhythm Desai says that India looks attractive on a valuation basis but weaker on the growth front. He added that retail participation is unlikely to fade and that policy reforms can help get back the FII flows. Listen.
On a relative basis, India is not looking good on growth. It's looking very good on valuations, but it's looking very inferior on growth. So if you compare with other large markets, and this is, AI is an excuse. The real deal is on growth. And this has not been the situation only for the last 2 or 3 months. It's been the situation since September of 2024, when India's growth peaked, valuations peaked, and since then the market has derated on a relative basis, and growth has been decelerating. Now, growth did pick up in the December quarter, but the growth elsewhere is very strong.
Foreign selling is showing up on the screen every day.
Foreign is also selling Korea. Okay.
Right.
So let's not...
No, it's almost, but there it's more technical. The selling is...
but this is also technical.
Yeah.
Large part of the outflows are passive. It's because the weight is falling, because India is underperforming, and every single day India underperforms, the weight falls, and passives have to adjust their index, their position to match the index weight. But I think we can also do adjustments on the policy front.
I was coming to that.
So, for example, I think make it easier for foreigners to participate. And that is, I think, something that should be done over the next few months, because it takes a lot of time for people to get registered. Taxation, I don't think is a burning issue in my view. The issue about taxation is the whole administrative process to file returns and to pay the tax. I think tax is not such a burning issue. The administrative process around that could be. Yeah, but I think easier access is probably the better thing. If you want to choose amongst policies, and I think that's the easier thing to fix. Also, capital gains tax, it can be a tricky thing. You can't do it retrospectively.
Correct.
Now.
Correct.
Because if you do it, suppose hypothetically you reduce long-term capital gains tax to zero, it's going to be a selling avalanche.
Citi is holding its annual India conference on its sidelines. We spoke with Alok Gupte, Citi's global co-head for international equities and capital markets. Listen into why he feels bullish on India and certain IP offerings in the Indian market.
It's the only large market that has delivered positive returns every year since 2020. So when we think about things in a short term, we should also think about them in a medium term, where India's had a fantastic secular run that has happened over the last 5 years. I'm actually extremely bullish over the next 5-year period as well. It is actually pretty well flagged that when you think about the hyperscalers, they have some pretty extensive spends. I mean, at the beginning of the year, the 5 biggest hyperscalers or 4 biggest hyperscalers were going to spend $400 billion. That number is now $700 billion at this point in time. So clearly, I think a lot of these things were well flagged and well advertised. So we are not surprised. And the strength of the market is immense. The constructiveness of the market is immense. Investors globally want to actually play this cycle and see how the AI sort of ecosystem develops over the next few years. And so from that standpoint, it's a uniquely strong time to raise capital, even if you're net cash. The number of IPOs that will happen in India, which are above $1 billion in size and comfortably more than $1 billion in size, is very, very high. You also have the global MNCs looking to IPO. There were a few that happened last year. There will be. We were part of most of them. We were very privileged to be part of that. There will certainly be more through the course of 26 and through next year as well. So I think when you look at the elements of the types of businesses coming, the scale of the India equity story, I don't think it's a market that frankly can be ignored for too long. We have some unique and amazing assets which will likely come to market, in the next 12 months. I obviously can't speak about live transactions, but these will be very globally relevant assets, not just, India relevant assets. And I can assure you every global PM is going to look at them, very, very closely.
Take a short break then. More news and updates follow on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. Gold has replaced US Treasuries as the world's top reserve asset class. Ritu decodes this as part of today's macro signal. Ritu, take it away.
For decades, US government bonds were the world's reserve asset of choice. Central banks parked their money in treasuries because they were considered the safest and the most liquid asset in the world, but that's changing. A new report from ECB shows gold accounted for 27% of the global reserve assets at the end of 2025, overtaking US Treasuries at 22% and the euro at 15%. Now, it's the first time in decades that gold has occupied such a dominant position in global reserves. Of course, part of the story is simply about prices. Gold prices surged roughly 30% in 2024, another 60% in 2025, and that boosted the value of gold that was already held by central banks. But the other part of the story is that central banks have also been buying gold at a record pace. For 3 straight years, they've bought more than 1,000 tons annually, which is more than double the average before Russia's invasion of Ukraine in 2022. So today, central banks account for more than a fifth of the global gold demand. The reason goes beyond markets. The freezing of Russian reserves after the Ukraine war forced many countries to rethink what really makes a good reserve asset. Government bonds and foreign deposits can be sanctioned or frozen, whereas gold cannot. It has no issuer, no counterparty, and if stored domestically, it remains fully under a country's control. Reserve managers are also increasingly treating gold not just as a financial asset, but as a geopolitical insurance. And it's not just countries buying gold. One of the largest buyers of gold last year wasn't a central bank at all. It was Tether, which is the issuer of the world's biggest stable coin. Its purchases exceeded those of several sovereign nations, showing how gold is increasingly being used as a reserve asset beyond the traditional banking system. Now, India is very much part of the broader trend. The Reserve Bank now holds more than 880 tons of gold, with gold accounting for nearly 17% of its total reserves, and nearly 77% of our gold stockpile is now stored within the boundaries of India, which is up sharply from just 6 months ago. So the takeaway from all this, the dollar remains the world's dominant currency, yes, but when it comes to reserve assets, gold is making a comeback simply because in an increasingly uncertain world, countries and institutions are once again placing a premium on assets that they can hold, control, and trust.
Ritu, thank you for that update there. Now, the Reserve Bank of India's crucial 3-day Monetary Policy Committee meeting began today with Governor Sanjay Malhotra set to announce the policy decision on Friday. The June policy review comes against the backdrop of the prolonged tensions in West Asia, rising crude oil and gas prices, supply chain disruptions and a sharp depreciation in the currency, all of which have increased concerns over inflation and growth. However, most market participants expect the RBI to keep the benchmark repo rate unchanged at 5.25% and also expect the MPC to retain its neutral stance as well.
Neelkant Mishra of Axis Bank tells CNBC that there is no justification for the RBI to hike rates this week. Take a look.
Given where the prevailing consensus is, given what we have seen in the media of looks like RBI signaling to the markets, it does look like a rate hike is extremely unlikely. And at the same time, I must say that our expectation or projection of CPI is that the reported CPI is likely to cross 5% by the end of this calendar year. But again, this is because of the really low base of vegetable prices last year, and there is absolutely no evidence of sticky inflation even in our forecasts.
Meanwhile, Chetan Iyer, the chief Asia economist at Morgan Stanley, told CNBC TV 18 that a 25 basis point rate hike is unlikely to meaningfully improve yields. Listen to what he had to say.
We don't think that the RBI should hike. India doesn't have an inflation problem. India doesn't have a current account deficit problem. So if you're going to hike interest rates, what purpose is it going to serve? If the purpose is to provide higher yields on your currency, then 25 basis points is not going to do it. How we did it in 2013 is by lifting the upper end of the policy rate band and effectively letting the liquidity tighten when capital outflows are happening. And you have to do something like 150, 200 basis points of overnight interest rate hike.
Let's also listen in to what CS Setty, chairman of SBI, had to say about the upcoming MPC decision.
Broadly, the market expects that there could be a rate pause. At this juncture, growth inflation dynamics are more important. I think a pause will definitely help us to stabilize in terms of ensuring that the smooth growth rates are achieved.
Welcome back. Now, the USTR has made findings and proposes action in Section 301 investigations relating to failures to take action on trade in forced labor goods. Ashmit is now joining in with more details on this. Ashmit, what are you picking up? Tell us more on this.
Well, the latest that we're picking up is that India potentially could be looking at additional levies of 12.5% following the USTR recommendations. Here are the facts of the case. Now, it's important to understand that in March is when the US had initiated Section 301 investigations against India. One of those investigations has finally come out with its results, its recommendations. The finding against India is that India has failed, as per the US, to deploy safeguards, to deploy prohibitions of importing from countries which employ forced labor. As a result of that, the recommendation that the USTR has given, there were 60 countries in total that were subject to investigations. 54 have been levied with additional penalties. This, of course, is a recommendation at this stage. A select grouping of countries are looking at additional levies of 10%. Countries like India, China are looking at additional levies of 12.5%. Now, there are a couple of aspects to bear in mind, even as we process this news coming out of the United States. The first is that this is a recommendation. This is not final. There will be public deliberations done. There will be public hearings done. The Indian Commerce Ministry has said that it will actively engage with the United States, also be a part of those public hearings. Those hearings are scheduled for July 7th, and that's when a better picture will emerge on whether or not these levies will be implemented and enforced as far as India is concerned. Another aspect to bear in mind is that this is only one of two investigations that had been initiated. The other investigation was on structural overcapacity in areas such as steel, aluminum, processed foods, and that is something on which clarity is still awaited on what the recommendation of the USTR could be. So that's going to be another key news trigger to watch for. The third, of course, is all of this comes when Brendan Lynch, leading the United States delegation, is currently in India negotiating a bilateral trade agreement. Section 301 investigations and their fallout is something that actively the Indian negotiators are expected to be raising before the American negotiators to protect the Indian exporters from some form of these overcharges, these levies that are being considered by the United States. So that will actively be a part of these negotiations. The negotiations, we understand, are still underway right here in the national capital.
So negotiations still underway, and we'll have to see what happens after that. All right, Ashmit, many thanks for taking us through those details. But a small programming note as we slip into a short break. Uncertainty in the market is rising given geopolitical and trade headwinds. We at CNBC TV 18 are featuring some of the biggest faces in the market from 3 mega conferences to help you make informed investment decisions. Tune in to CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amish Shah and Vikram Sahu. You can also catch macro and market opinion from Morgan Stanley's Chetan Iyer, Rhythm Desai and Jonathan Garner. Citi's Managing Director Sue Lee and CEO Jane Fraser will also be part of the blockbuster panels lined up only on CNBC TV 18.
Welcome back. On to updates from West Asia. Then the United States Military Central Command says that its forces conducted self-defense strikes on Iran's Qasem Island and defeated multiple Iranian missiles and drones as civilian vessels and regional allies Kuwait and Bahrain came under attack. CNBC's Dan Murphy is now joining in with the latest updates. Dan.
On the strikes, U.S. Central Command says it took down multiple Iranian ballistic missiles and drones in what it's calling the most intense fighting since the truce took hold in April. Iran fired ballistic missiles at U.S. bases in both Kuwait and Bahrain. CENTCOM saying 2 missiles aimed at Kuwait fell short or broke apart in flight, and then 3 launched at Bahrain were intercepted by U.S. and Bahraini air defenses. None hit their targets and no American personnel were harmed. The U.S. also disabled an empty tanker, it's called the Lexi, by firing a Hellfire missile into its engine room as it moved towards Iran's Karg Island. Washington saying that vessel was trying to breach its blockade. That ship had been sanctioned by the U.S. Treasury all the way back in March for trying to move Iranian crude. And then on the other side, Tehran's Revolutionary Guard says that strike, along with a hit on a communications tower on Qasem Island, triggered its response. The U.S. also shooting down 3 attack drones aimed at civilian vessels in the Gulf and also conducting self-defense strikes on an Iranian ground control station. So we have seen tensions ratcheting up. Despite this exchange, though, CENTCOM also insisting that the ceasefire remains in place this morning and, in its own words, is still ongoing. Critically, it also denied the Iranian claims that we saw in state media that the 5th Fleet headquarters in Bahrain were hit, saying that all Iranian attacks on American forces had failed. And then, of course, on the diplomatic front, there really has been no material progress in the last 24 hours, both sides failing to convert the truce into a lasting deal. And Iranian media says Tehran is still reviewing that U.S. proposal to pause the war, but hasn't submitted a counter yet. And President Trump maintains negotiations are still very much alive. It's back over to you.
So Dan there with the latest on the West Asia war. Now, a massive fire at the Lemon Green restaurant in Delhi's Malviya Nagar has resulted in the death of over 20 people and injuries to several others. As per PTI, a number of foreigners have also lost their lives in the mishap. A senior fire official said 10 fire tenders were deployed to control the blaze, while the cause of the fire has also not yet been established. The Prime Minister's office has announced an ex gratia of 2 lakh rupees from the PM National Relief Fund for the next of kin of the deceased, along with 50,000 for those injured in the blaze.
And on that somber note, we take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. Today joining us on the show is Hormuz Patakia. Hormuz, good afternoon. Well, recovery is what we are tracking for the markets above that 23,300 mark comfortably for now. Bank Nifty is the one which is leading the gains. It is in the green for now, but then, you know, at those higher levels, we did see some sort of pressure come back. But again, sustenance is the big question, whether that continues or not.
Leading the gains, causing the chaos, you can call it whichever way you would want to see it, but that's been the state of the market over the last couple of days now. And well, of course, as Sonal mentioned, sustaining those recoveries is the key. But before we get to that, here are the headlines that we are tracking at 1:30 this afternoon. Equities feel the heat of the rising uncertainties. Crude benchmarks extend gains to over 2%. The Nifty is now above the mark of 23,300. The mid-caps, though, are underperforming.
ID stocks are down and out, reversing 3 days of gains. Mid-cap ID stocks, Persistent, Coforge, Tata Elxsi, they are the top drags on the mid-cap index.
The NHBC OFS, subscribed nearly 3.5 times by non-retail investors, is starting to see response from retail investors as well. Today, the center is now going to exercise the green shoe option for the power company. The stock is higher by over 4%.
India extends countervailing duty on textured tempered glass imports from Malaysia. Finance Ministry imposes duty for a fresh 5-year period, superseding the 2021 notification. Shares of Borosil Renewables extend gains.
And Cartrade Tech is bucking the trend in a weak market as Kotak Institutional Equities has upgraded the stock to a buy recommendation and raised its target to 2,300 rupees a share, citing sharply higher valuations for its OLX business.
All right, those are the top headlines that we are tracking. We'll discuss some of these individual stocks in greater detail. For now, as we indicated, recovery is the big news that we are tracking. Whether that sustains or not continues to be the big question. The broader markets, they are in focus as well. We do have the advanced decline ratio in favor of declines as we speak, but a lot of buzzing stocks in the broader markets. So let's go across to Sudarshan. He is joining us with all the mid-cap movers that he has on his radar. Sudarshan.
So we are seeing recovery in the market and things are happening amidst extreme volatility and it's changing as we blink. But there are some of the major mid-cap movers on both the sides. So I'll start with some of the stocks that are moving higher. So IFCI for second straight the stock has been trading higher with healthy volumes currently up more than 11%. Borosil Renewables, because of countervailing duty on imports from Malaysia, this stock has surged more than 8%. HFCL has been moving just in one direction. Today also the stock is at upper circuit of 5%. Similar move for Sterlite Technologies, again at upper circuit 5%. Tejas Networks, since the time there was a not announcement, there were reports that Tata Sons board may consider certain announcements related to some of the companies, and Tejas Networks was part of that. And since then, the stock has moved almost 20%. Today also up almost 3%. But there are some mid-cap losers. Now on top of the list, Apollo Micro. This stock too has seen a huge move over the last few months, and today it's under pressure, seeing profit booking down more than 6%. Physicswala, since the time the company had released Q4 earnings, it's been moving in one direction. That's down move. Today also down more than 5%. A Finance, that's again trading lower with healthy volumes, down almost 6%. And E-Plus Services, because it's the IT name and all the IT stocks are under pressure, this too is down 5%. And JM Financial and amongst is one of the few capital market names that's trading with healthy major cuts, down almost 5%. Some of the stocks that are 52-week close, Wakefit Innovation, that's trading with a cut of 5% at 52-week low. Late Revenues, Imami, Mahindra Holidays, and Sri Renuka are some of those stocks that are trading at 52-week close.
Many such names at 52-week lows in today's session. Sudarshan, thank you for summarizing those movers for us. Just one more addition to Sudarshan's list, and that has seen a very, very sharp spike in the last few minutes. That is Vodafone Idea, 6% higher now on the stock. It's crossed levels of 15, and of course the plenty of news flow surrounding that stock as well. And there you can see 5.5% higher now on Vodafone Idea, nearing that 15 rupee mark. Let's also welcome in Ajit Mishra from Religare Broking for a quick chart check and some trading ideas as well. Ajit, good afternoon. Thank you for joining in. Similar to yesterday, at 12:30 onwards, there is a recovery that has started to play out on the index. Do you use this recovery to trim your positions now because of the ongoing volatility? Your call on the index and your stock recommendations as well for the afternoon.
Yeah, good afternoon, Hormuz. So yes, you are right that 12:45 last session also we saw a very sharp rebound. Again, we need to see whether we manage to sustain these gains or not. Importantly today, almost that the gap that we had on the daily charts around 23,150, finally we have filled that gap in the daily charts in the index. And from that exactly level from where we are seeing a rebound. But it's important to see whether we manage to hold this gain, because broadly, if you see that on the daily chart, the structure is still negative, means we are seeing lower highs, lower lows formation continuing. And like IT, which was the savior of late, is again back to the square. So considering this, we still feel that index is still in sell on rise trajectory, with 23,600, 800 now being the major hurdle area. So in this market scenario, I feel that one should continue with buy and a mixed approach, long and short approach in stocks as well. So Federal Bank from the banking basket, wherein we see potential of next leg of the up move. The stock was anyways maintaining its positive tone amid all this carnage that we are seeing in the banking pack, still holding around the record highs and looks set for the next leg of the up move. So 306 is what we are eyeing in Federal Bank at current levels. One can look to accumulate. And IT pack Coforge, wherein again we are seeing profit taking after this recent rebound, and we believe that the recovery was almost over. So 1330 is what we are eyeing in Coforge in the near future. So with stop at 1480, one can go short in Coforge.
All right, so those are some technical bets, but 23,600 according to you is the major hurdle. We could continue to see sell and rise on the Nifty. Thank you for joining us today. With that, we'll slip into a short break. When we come back, we'll get you more on the markets, talk about some stock-specific action as well. Stay tuned for that. Welcome back. You're still tuned in a mid-cap radar. It's time for a corporate conversation now. Dhanuka Agritech is the management joining us on the show now. The company announced a buyback of paid-up equity at 1,400 rupees per share for 70 crore rupees. It was announced earlier, and now the particular document is out. To talk about this and a lot more, of course, about the weather conditions and the IMD forecast, we are now joined by M.K. Dhanuka, the chairman of Dhanuka Agritech, to discuss the fundamentals going ahead. Mr. Dhanuka, good afternoon. Thank you so much for joining in. IMD has forecasted that rainfall will be 92% below the long-term average. What are the initial signs that you're seeing on ground with respect to sowing, with respect to demand? Is there some sort of stress that you're seeing on ground?
You see, definitely monsoon plays an important role in Indian agriculture, and if monsoon is to the extent of 92%, some sentiments are low amongst the farmer community. But overall, since we have around 60% of the area which is irrigated, so only 40% is dependent on monsoon, and I don't foresee that around 8% shortfall can have any major impact. It will depend that it should have a regular interval, and it should be widely spread. So these parameters will decide the fate of the agriculture sector.
Mr. Dhanuka, what is the current pricing situation that you are witnessing currently? Because considering the input costs that have gone up, have you passed them on to your customers? If so, by how much? And what kind of impact do you see? How much of that FY27 growth is going to be value-led versus volume-led?
You see, we have increased the prices 3 times from 1st of April, then 16th of April, and from 1st of May. But since the dealers and distributors, the final product prices are not acceptable in the market, the new increase. So that's why they are in the situation of wait and watch. So they are thinking that if we have to buy at higher price, let us wait, and as the season starts, only then we should buy. So there is a little pressure at this time, but we do hope that once the monsoon starts in Kerala and it forward further in the other parts of the country, definitely the season will pick up and demand will start. So some prices, because of the less demand in the market, some correction is happening in the month of May last and June first week. But we have passed on this correction also to the customers with effect from 1st of June.
Okay, so two-part question here, Mr. Dhanuka. How much was the price hike, the last 3 price hikes that you took? What is the percentage there? From 1st June, you have taken a price cut. So how much is that? And when you say that dealers are not accepting the higher prices, are they sitting on that high price inventory in that case?
You see, we have taken the price hike because we are manufacturing more than 90 products. So the products which we are importing from Japan, there is no price hike. We have not taken the price hike, although because of the rupee depreciation, the cost has increased in those products also. But that we are keeping from the margins. But the generics which are imported from China or which are manufactured by local technical manufacturers, the prices have increased, and we have taken overall 5 to 7% price hike in the last 3 price increases. And the reduction is only nominal in few of the molecules. Out of 90 molecules, the increase was in around 30 to 35 molecules, and rest of the molecules, there was no price hike.
Okay. Also on the dealers, then now it's a nominal price cut that you've taken. You said dealers are not really accepting the higher prices. So have they taken the inventory from you, or is that inventory lying with you? What is the situation currently, since the acceptance for higher prices is not there?
Definitely the inventory levels are higher with the company because dealers is not accepting. So there is no excess inventory in the channel. The inventory is only with the company. as I told, that once the monsoon starts, definitely the demand will immediately pick up because the channel inventory is low. So the dealer will definitely require the material once the rainfall comes. So we hope that the season will pick up and demand will start suddenly. And then since those companies who will be having the inventory, they will be benefited from that.
And Mr. Dhanuka, what's happening with the hedge? You've trimmed your revenue guidance for there from 100 crore to 75. Why is that so? And when do you EBITDA break even over there?
We were expecting that we will be able to get the registration for export in various countries, but that has been delayed. We were thinking that it's a not lengthy process, but it is taking more time in getting the registration. So we have to sell only in the domestic market. So earlier we have considered the export also, but since export is not going to happen once till the registration is being done in the various countries, so that's why only domestic market we have down the guidance for the hedge plan.
Okay. Mr. Dhanuka, last question before we let you go. You have accelerated your global footprint with the acquisition from Bayer AG. What is it currently doing? What are the expectations in terms of revenues? Are these high margin products? What does it do to your overall margin profile?
These products are also having around similar gross margin, around 40%, whatever the company is having overall gross margins. And we have taken the global rights for 20 countries. And with Bayer Crop Science, we have made the arrangement that till 31st December 2026, they will continue to sell the product on behalf of Dhanuka. So Dhanuka will continue to get the net economic benefit from Bayer. You can say it's a sort of royalty from Bayer Crop Science. But from 1st January 2027, the sales will start coming in the books of Dhanuka only.
Okay, take that point. So look forward to more updates on this particular partnership and your Dahej plant as well. Thank you so much, Mr. Dhanuka, for joining us with your thoughts on the business and the outlook going forward. That's the word coming in from Dhanuka Agritech. The stock has recovered from the lows of the day and is right now at the highs as we speak. Before we slip into a short break, take a look at Go Fashion. That stock is surging. It's up around 15% as we speak. It is at around that 379 mark, but do remember the stock is sharply off its listing price of 1310 and it has fallen from those highs, and the issue price was around 700 rupees. So half of that and much lower than its listing price. So with that, we'll slip into a break. As we do that, a small programming note. Uncertainty in the market is rising given geopolitical and trade headwinds. We at CNBC TV 18 are featuring some of the biggest faces in the market from 3 mega conferences to help you take informed investment decisions. Tune into CNBC TV 18 to catch the top minds from Bank of America's global investment team, including Amish Shah and Vikram Sahu. You can also catch macro and market opinion from Morgan Stanley's Chetan Iyer, Rhythm Desai and Jonathan Garner. Citi's Managing Director Sue Lee and CEO Jane Fraser will also be part of the blockbuster panels lined up only on CNBC TV 18.
Well, the markets continue to be extremely choppy, and the Nifty at one point had crossed the mark of 23,400 intraday, still down 120 points. And look at the banks that are leading that recovery. ICICI Bank is now up 1.5%. HDFC Bank has moved into the green, as has Axis Bank, Kotak Mahindra Bank, all of them now at or near the highest point of the day. So the banks continuing to lead the recovery on the market. Well, the International Energy Agency head Fatih Birol has warned that the oil market could enter a red zone if the Strait of Hormuz does not open unconditionally by June. Now, in an exclusive conversation with Shireen Bhan, Birol said that the oil markets will continue to be rocky and volatile even after the war ends. When asked if the IEA was considering a release of another tranche of emergency reserves, the IEA head said not there yet. Listen into what he had to say.
I think it is rather naive to expect that the Qatar LNG terminals will go back very quickly where they were just before the war. So if it is, to sum up, if the Hormuz Strait is open, if there is a peace, it is an agreement, it will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process, volatile markets for some time to come. This 400 million barrels is big, but it is only 20% of the reserves we have. 80% is still in the pocket. And we will we will assess the market conditions, and if we think it is necessary, we will be ready to act immediately. Now, I don't think that we are at this stage yet, but we are monitoring the markets momentarily and very closely. If we believe it is the time, we will definitely go for it. But at the moment, we are not there.
That's the big word coming in from the IEA chief. Now I have to expect pre-war oil levels now. But with that, we'll take your leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. Welcome to Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, good afternoon. And we have seen a bit of a good afternoon coming in for the markets as well. A good recovery from the day's lowest point. Nifty holding on to 23,350, above that mark. And Bank Nifty is leading that recovery for the markets.
Absolutely. And you know, initially when we started the trading session, the tensions in West Asia kept the markets lower. But that recovery coming in at the same point, we saw it yesterday, right? The market's still in the red, but Nifty Bank, that recovery has helped the Nifty go higher. But the biggest culprit in today's trading session is those IT stocks, right? If you take a look at it, that pack is nearly 5% in the red. We've got TCS, HCL Tech, Infosys, all of them trading lower today, seeing big cuts. And Realty as well, not doing so well in trade today. However, private banks, PSU banks, the healthcare pack, all of those now in the green and helping the Nifty gain in trade today. But let's go across to our guests who are joining us today to answer all of your stock queries. And joining us today is Astha Jain, Research Analyst, Haim Securities, and Vaishali Parekh, Vice President, Technical Research, Prabhudas Leeladhar, to answer all of your stock queries. Ladies, thank you so much for taking time out and being here with us on your stocks. Let's go across to the first query that we're getting. Bhagyesh Solanki writes to us from Gujarat. He holds 1,000 shares of ITC at 382 rupees. He wants to know the long-term view on the stock. So, Astha, let's start with coming to you first. Give us the fundamental view on the stock.
Hi, good afternoon to everyone. Talking about fundamentals, what we have seen in the fundamentals is that now the cigarette earnings is showing some sort of, or it is posing some sort of concerns right now for the company. So I think although they have taken in a price hike, immediate price hike, but still I think it will take some time to cope up with those price hikes. My idea here is that going forward, this company will take some more time to move in the northward direction on the basis of the fundamental, because fundamentals are still not seen to be on the higher side. We are seeing certain concerns on the some segment part of the company, and hence my idea here is invest in this counter in the long term or hold this counter only from a long-term perspective, because in the short term, we might see some sort of negative momentum in the stock prices. In the short term, stock prices may move further downside from here, but in the long term, hold is recommended with a price target of 320.
Okay, thanks so much for that. We'll keep an eye out on the targets there. But let's also bring on board Vaishali to take us through the levels that she's keeping an eye out on. Long-term story for the stock. They bought it at 382. What are your long-term targets and what should the viewer do? Is averaging an option?
Hi, very good afternoon, ladies. So I think ITC definitely is quite a disappointment and in a downward trend. But when I'm looking at the weekly charts and all, I think maybe there is an exhaustion in the selling. It should halt over here. So I'm not suggesting to add more, but probably just continue holding for a bounce back. Because as Astha says, even technical bounce back comes to around 300, 310.
Sure. Okay, Vaishali, we'll come back to you, but we have Sergio Gore, US Ambassador to India, addressing the Citi 2026 India Conference. Let's cut across.
Room of investors assembled here today. Look, let me get straight to the point. Citi's the largest American bank in India for a reason, because American and Indian business leaders in this room know how to drive results. My vision is to make the US-India relationship the defining strategic partnership of the 21st century and deliver tangible results for the people of both of our nations. We can ensure the impact of our partnership is felt, not just in boardrooms, but in the daily lives of our citizens. I'm talking about American companies expanding into Indian markets and creating jobs, joint breakthroughs in medicine that improve health outcomes, US energy exports, and technologies supporting India's energy security and resilience. Deeper collaboration in critical technologies like AI, semiconductors, and biotechnology. As business leaders in key sectors, each of you has an important role to play in this work. With global supply chains being reconfigured, economies are seeking trusted and resilient partnerships. We have seen over the last decade that overdependence on a single segment of the supply chain creates vulnerability. Simply put, President Trump trusts India. Just last week, we celebrated our Freedom 250 celebration in New Delhi, and President Trump actually called into our event. He wanted to make sure that the message was clear. He deeply values the relationship with India. He deeply values his friendship with the Prime Minister, and he wants to move things on a further path. The US-India partnership has the potential to be globally transformative, and now is the time for us to fulfill our ambitious shared goals. Working together, America and India can combat dependence, allowing a broader range of suppliers to reach markets. Together, we can integrate value chains, accelerate technological advancement, and strengthen energy security. The United States and India are uniquely positioned to drive the next phase of global economic growth. And when we work together on such shared objectives, we create more than the sum of our parts. We stand at a truly remarkable moment. In just over 2 decades, our bilateral trade has shattered records, skyrocketing from $20 billion to $220 billion in goods and services. That 11-fold increase isn't just about volume. It reflects deep, unbreakable trust. Today, the unparalleled growth in our two-way trade is being driven by innovation and high-value sectors. We see linkages not just between massive global corporations, but between agile startups and entrepreneurs in digital trade, advanced manufacturing, and emerging tech. As I've traveled across India, I've met some incredible startups, including in some of the IIT campuses. Every one of those startups has had a connection to the United States. It's an incredible thing to witness these startups literally on the ground level. Some of these will be life-changing over the next few years. And to see this partnership between our two countries is something that it is truly remarkable. We've seen unprecedented progress, and we have incredible potential ahead. We can seize opportunities to scale the US-India partnership into a more seamless, resilient, and transformative economic relationship. India's growing economy and significant infrastructure needs align well with American expertise in energy, aviation, R&D, advanced manufacturing, and digital infrastructure. Such investments will benefit both of our nations. We need to identify those win-win situations. Our investment and trade expansion offer transformative potential. President Trump's goal is to facilitate bilateral trade in a way that creates lucrative opportunities for American businesses and workers. Our current interim trade agreement is on the table for us to finalize, and it will unlock prosperity for both of our nations. When I first arrived in India 5 months ago, one of my first priorities was to get this trade agreement as close to finality as possible. And within a month, we announced an interim trade deal. Just this morning, before I flew out here to Mumbai, I met with the trade team that is visiting us right now in New Delhi. Last week, they were in Washington, D.C. This week, we sent our team to New Delhi. That same team will continue meeting this week. Tomorrow, they're going to be meeting with Minister Goyal. We're on the last 1%. 99% of this deal is in place. That last percent, we will figure out sooner than later. To put it in perspective, because a lot of individuals will ask me, why is this taking so long? It's been a year. It's been a year and a half. The European Union deal with India took 19 years. And so keep that in mind. These are massive, complex deals that involve not hundreds, but tens of thousands of points sometimes. Everything from mangoes to IT to technology to fuel. And so we are getting there. There's so much good that will be identified and will come out of this deal that will benefit both of our nations. As we continue deepening our economic engagement, we need predictable taxation and regulatory frameworks that enable businesses to thrive. We need candid and constructive engagement on export controls and technology flows grounded in trust. And we need strong intellectual property protection to encourage innovation and investment. Quite often I have American companies that ask me, is it safe to invest in India? These are individuals that are coming from other nations where their IP, where their R&D has been stolen time and again. And our message to them is, yes, here you are able to trust. Here you have a government that does care about those issues. And so that's important to maintain. Most importantly, we must work together as partners to drive growth and stability across the region. Investment flows are reaching new heights. Indian companies continue to expand in the United States, particularly in pharmaceuticals, manufacturing, and technology, while U.S. firms are expanding their footprint in India's fast-growing market. Every embassy around the world competes to bring investments into the United States. And just about 2 weeks ago, a big event was held in Washington at the Commerce Department. And literally every embassy gets up and says, we are announcing $200 million. we're announcing $400 million in investments in the United States. Proudly, our embassy in India came in first. Not at $200 million, not at $500 million, not at $1 billion, but at $20.5 billion. And that is a testament to the trade that is going to the United States. Similarly, we've seen how much trade is coming into India. And on that note, it's been one company after another that has invested here. I'll get to that in a second. We've seen how much President Trump cares about India, from his call last week to his regular phone calls with the prime ministers. About 3 weeks ago, he had a phone call with the prime minister, and I think the prime minister's office might not want me to put this out there, but I happily will. The president ended the phone call with, "I hope the people of India realize how lucky they are to have you and the stability and experience that you bring to India." And so that's a true trust, that's a true friendship that transcends this administration. This goes back a decade. I've been with President Trump for about 10 years now. I remember the 4 years the president was out of office. Not everybody around the world, forget about being friends, not everyone around the world was on the same pathway as your prime minister. Your prime minister not only never criticized the president, he stayed in touch during those 4 years the president was out. And that's something the president remembers. It's easy to see today some leaders from Europe that show up to the Oval Office, every one of them wants to be the president's best friend. But it matters when you're down on who your true friend is. And that's one of the things that the president does appreciate about Prime Minister Modi. President Trump's a visionary who invests in our bilateral relationship. In February of 2025, just weeks into his second term, he and Prime Minister Modi launched a Transforming the Relationship Utilizing Strategic Technologies, known as TRUST, the TRUST Initiative. Under the framework, the United States is laser-focused on boosting bilateral cooperation on AI development and expanding trusted supply chains for active pharmaceutical ingredients and critical minerals. Today, the United States imports close to 40% of our generic pharmaceuticals from India. That's because we trust this place. That's because we want to work with this place. That's a massive life-saving ingredient to our country. And it's not by accident that we're working with India on that. Just last week, alongside Secretary of State Marco Rubio and Minister Jaishankar, we officially signed the U.S.-India Critical Minerals Framework. This is a massive milestone. It will help to ensure the foundational elements required for advanced technology and energy are available within trusted networks. Together, we will undertake efforts to protect sensitive supply chains from coercive market practices and reduce our collective vulnerability to single-source monopolies. Additionally, Undersecretary Helberg and I officially welcomed India into Pax Silica in February. Through that initiative, we are building a trusted ecosystem and resilient supply chains for the technologies that will define the future, from artificial intelligence to semiconductors to quantum computing. India was invited because it's a trusted partner. It's not an accident that India was among the first 10 countries in the world that was brought into the fold. The next day after the announcement on India, the White House received over 60 requests from around the world, from other countries, to join the same initiative. Mobilizing unprecedented resources to secure our supply chains will require billions of dollars in new private sector capital. That is where the financial services sector, American businesses, and leaders in this room come in. In addition to government engagement, the U.S. private sector has made significant commitments in India, and that is the win-win situations that we identify. Amazon expects to invest $35 billion into India by 2030 to advance AI-driven digitization, export growth, and job creation. Microsoft announced a $17.5 billion investment in India, including the expansion of hyperscale cloud infrastructure. And earlier this month, Google announced a $15 billion AI hub to support AI research, development, and enterprise adoption. When these companies invest in India, it creates a job back home in the United States. So these are things that go hand in hand, and those are the win-win situations that we like to identify at our embassies.
That's Sergio Gore, the U.S. ambassador to India, speaking at the City conference today, outlining the India-U.S. trade ties. He also said that 99% of the deal was done and they just had to figure out 1% of the complex deal, and that they are going to figure it out sooner rather than later, and pointed out the deal would benefit both of those countries. So that's Sergio Gore there at the City conference. But on that note, it's time for us to head into a short break. We'll answer more of your stock queries on the other side. Stay tuned. Welcome back to Your Stocks on CNBC TV 18. We still have with us Asta Jain of Hem Securities and Vaishali Parekh of Prabhudas Leeladhar to answer all of your stock queries. The next query is coming in from Aditya Patil, who writes to us from Mumbai. He holds 152 shares of Swiggy at 390 rupees and is making a loss on Swiggy. That stock is at 251. And he's also got 128 shares of Afcons Infra at 463 rupees. He wants to know whether he should stay invested or exit at current levels. So Asta, let me come to you first. Swiggy and Afcons Infra. He wants to know if he should stay invested, making a loss on both stocks, or whether he should exit at current levels. What's your view?
For Swiggy, the view is clear. If the horizon is more than 1 year, then remain invested. Because what happens in the Swiggy is that they are facing a lot of competition. In fact, they require a lot of cash burn in order to face those competition, to build more warehouses, etc. So there is a thing which I think competition is majorly, playing around for the Swiggy, and that is why it is not able to post that strong numbers. Apart from that, valuation risk also persists for Swiggy because at these levels it is highly priced. So my idea here is going ahead. If company focuses more on the Instamart expansion, then definitely it will going to help the company and getting more revenue. So it is a good long-term story to bet upon, but in the short term, I'm not very much convinced about its price momentum towards upside. So if horizon is long-term, remain invested with the price target of 270. 8 to 290, but in the long term, it can move beyond 300 level. Now, talking about Afcons Infra is also looking good to us. For Afcon Infra, my idea here is stay invested in this counter because this has shown a very strong performance. It is a good bet to play for the long term. So Afcon Infra is a good infrastructure story because they work around all the projects, whether it is metro rail, tunnels, bridges, etc. And they have got a very strong order book, which I think remain one of the focus areas for the company. And execution strength is also high in this counter. So Afcons Infra is looking good to us. Remain invested in this counter for the price target of around 360 to 370. But for Swiggy, it's a long-term story to play upon. So if our horizon is long-term, then remain invested.
Okay. Vaishali, your thoughts on Swiggy and as well as Afcons Infra? What should they be doing? They're making a loss here.
I would say Swiggy definitely is in a downward trend, and if there is a bounce, it would be just up to 5 to 7% right now. So I would say you can switch from Swiggy. But as far as Afcons is concerned, it is showing signs of reversal. And I think this can go towards 370 to 400 levels. So Afcons is a better choice, but Swiggy can be a switch.
Okay, let's move on. Afcons is a better choice. Swiggy can be a switch. That's the word on the technicals. Next query then, Meher is writing to us from Visakhapatnam. Investment query. They want to accumulate 10,000 shares of Vedanta. And obviously, we'll see those arms also getting listed sometime this month as well. So that is what we'll keep an eye out on. But he wants to know whether it's the right time to look at entering Vedanta and target price for this as well. First up to you. Asta, what's your view?
Vedanta, I think the kind of news flow which is going around related to ED, we should just wait for the outcome of those news flow, because if these news flow always create a temporary impact on the stock price momentum, and that is what we are seeing. Because if we see the fundamentals, they seems to be very, very strong. They have posted very strong set of numbers, and as you have rightly mentioned, value unlocking will be there, and the investor will get a lot of varied companies stock in their portfolio. So overall, Vedanta is looking very strong from the fundamental point of view. The only dampener right now is the kind of news flow which is hovering around regarding ED searches, etc. So that might impact the stock price momentum. So just wait for more fall to come in and then make entry into this counter. Don't enter into this counter at this moment of the time. He may get a chance to enter at a lower level of around 310 rupees or 300 rupees.
All right. And Vaishali, Meher is writing to us with a query on Vedanta Aluminium. So what's your view? Is it a good time to invest and the target price for it?
Definitely. So I think Vedanta is likely to correct further. 300 is an ideal level. So I would say accumulate. I mean, buy at every different tranche of a dip and keep 300 as a support level, because once the stock is getting into new round of momentum, I think this can go towards 380 to 400. So value buying comes between 300 and 320.
Okay, that's the word coming in there from Vedanta. It was a bit of a truncated show today, but that was the last query for today. So, Vaishali as well as Astha, thank you so much for joining us as always and helping answer all those view-related queries. And viewers, we'll take more of your queries on Friday as well. So, keep sending them in and we'll get them answered with our experts. The phone number's there, email ID is there. So, send them to us. On that note, it's goodbye from myself as well as Arundhati. Up next, we have Closing Bell to take you through the last hour of trade, so stay tuned in.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan index is holding on to very strong gains of 1.8%. Hang Seng, on the other hand, is down almost 1%.
There's reportedly military activity once again, not large scale, but military activity nevertheless.
So the earnings growth in Korea, Taiwan, Japan, the US, even parts of Europe are way above India's growth.
If you see passenger vehicle players, most of them kind of guided 10% plus growth. Two-wheelers was single-digit growth guidance. CVs was a little cautious.
The opening tick on the Nifty is 23,420, a cut of about 50 points on the Nifty.
Tax collection anywhere from capital gains is not a lot. So it's a good trade-off, in my opinion, government can make out.
Why not give omnibus facility to private wealth bank insurance pool so that they can collect money from their customers and invest via Gift City.
All forms of energy security, including biofuels, including coal gasification, more electrification.
And there's so many factors at play here. You've got the Middle East crisis, you've got the AI revolution, you've got balance of payments, currency, you've got many factors in play. You've got valuations in play. And all of that is impacting our portfolio.
This is on forced labor. The other one is on structural overcapacity in areas of steel, aluminum, processed food, solar modules. That, the result of that second investigation, again, we're awaiting clarity on that. So that could be, again, another aspect that US and Indian trade negotiators will have to watch out for.
There is no intraday recovery whatsoever. There is this ever so brief bit that you saw past 10 o'clock, but then ever since, we've just continued to grind lower.
Recovery is what we are tracking for the markets above that 23,300 mark comfortably for now.
Okay, we're off the lows by a lot, that is. That is the day so far. Nifty is down just about 75, 76 points. I mean, at the press conference which we were on, that is the US ambassador to India, Sergio Gore, one element of this puzzle, right? Which, of course, has been afflicting our markets. So for now, it's not looking all that bad. It was looking quite poor early on, 23,400 plus on the Nifty. This is Closing Bell. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, Nigel. Nigel, hi.
Well, it's going to be an interesting trading session, Prashant. You know, the last 60 minutes promises a lot. And the Nifty Bank, the kind of recovery, you have an 800-point recovery that's ongoing out there. The street is sniffing something. Maybe, in fact, we move into the green, or maybe we give up this sort of a pullback that we're seeing. The street is sensing something. Let's see whether or not it's up to their expectations. Maybe we'll know in the next 30, 40 minutes out.
So there is a cabinet briefing at 3 o'clock, is what we understand. And we'll see if there is, something which comes out of it. You just put out the Nifty Bank chart, and that perhaps has seen actually everything has bounced off. Around 12 o'clock was the low, and most things have come off very, very sharply. The Nifty Bank, though, is the one which has come back into the green. It's up actually about 240 odd points. So something on bond taxation is the buzz out there. We'll see if something comes through. And of course, I mean, the perennial hope always is that will they give equities a relook as well? Do announce something and intend something. We'll see what really comes out of it. But that's at 3, so don't have to wait very long.
Yeah, I think the point that you made with regard to the bonds, and normally you see the one that reacts to that sort of news flows, PNB Gilts, because they obviously have a debt portfolio, a bond portfolio, and if there's any kind of tweaking out there, they could possibly gain on their bond book. So explains why that stock has been buzzing. We don't know as yet what it's going to be, but the street is sensing something, going by the move you're seeing in PNB Gilts, as well as the move that you're seeing in the Nifty Bank.
Kuch to aayega.
Kuch to aayega. Will it be up to the mark?
30 minutes to go. Somal Mehta is with us, Head of Retail Research, Mirae Asset Sharekhan. Good to have you with us here, Somal. Your trades?
Hi. Good afternoon to everyone.
My trades would be on the sell side. The first one would be Godrej Properties. Godrej Properties has been a little, sideways, has broken below the averages, 20 and 40 daily moving average, making low top, slow bottom. My stop loss would be around 1735, and my targets would be on around 1550. My second stock on the sell side would be HCL Tech. HCL Tech has formed a small, a flag pattern on the hourly charts. However, on the daily charts, it has taken resistance at the 40 daily exponential moving average. Again, next wave on the downside. So my targets would be around 1120 for HCL Tech, and stop loss would be 1210.
Okay, two sells, right, Samal? Sign of... two sells, right, Samal? Did I miss a buy there? No.
No, two sells.
Just confirming. Samal, thanks very much for that. Well, let's go across to the Morgan Stanley Investor Forum 2026. And we have with us Jonathan Garner, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley. Jonathan, great to have you with us here on the program. Thank you very much for joining us. It's always a pleasure. I want to just get straight to what is really, it's on everyone's, it's what everyone is talking about, which is what can the government of India do to change sentiment around? And one of the things which perhaps is being discussed as something very imminent, perhaps even today, is something on, the withholding tax as far as bond investments are concerned for foreigners. So that it was 5%, went to 20%. Will it go to 5%? Will they take it away?
I think
So just your thoughts, Jonathan, to start the conversation.
Yeah, so I was listening to your show just before coming on air, and I don't think it would be appropriate to speculate on something that might get announced within the next half an hour. But what I would say is we've seen certain measures to secure the balance of payments, which have proven to be, I think, quite proactive on the part of the Indian authorities. But things that can attract capital inflows will certainly be helpful in the current environment of very high oil prices.
Okay, so we won't talk about that specific measure, but I'm sure you get asked all the time. What would you like to see happen, Jonathan, to help do that, which is attract more capital in?
Well, it's interesting you're framing this as what governments can do, but as you well know, in a private corporate environment, it's really about what earnings growth can be. And I think, as my colleagues and myself have been writing about all year, this is an environment where earnings growth drivers are profoundly different in different geographies. And we have a situation where we both have AI capex ongoing, which highly benefits the North Asian markets. But we also have an oil and energy shock, which affects Asia as a whole negatively. But given the scale of national reserves that actually exist again in North Asia, they're more resilient. So there's not too much that governments can do around this when these private sector drivers or geopolitical factors that are outside the controls of, for example, the Indian authorities are really what's driving the relative earnings story and the relative performance. So I wouldn't frame it as things that the Indian authorities can necessarily easily deal with.
Hi, Jonathan. Good afternoon. Good to see you. And, Jonathan, you spoke about the commodity price spike up that we're seeing. And maybe a country like Brazil, they stand to gain from something like that. Small economies as well, like Chile, because of their exposure to a couple of commodities, have done pretty okay. What is your view now with regard to the global exposure? Because India is missing out on the AI theme. And also you have, various other economies that are more commodity linked that are gaining. So how do you view things? I recall in the past you were equal weight, I think, on Korea as well as Taiwan. I'm not sure what's the updated take out there.
Yeah, so we have three sort of key overweights across our coverage. One is Japan, which probably has the best story around underlying earnings revisions breadth and a very interesting policy agenda around improving the supply side of the economy under Takaichi. We do like Brazil, that you just mentioned, which has a very significant resource endowment and is somewhat on one side or outside of the geopolitical risk debate. And we like Singapore, which has the strongest sovereign balance sheet of all of the markets we cover in Asia. We disfavor, we are underweight, Indonesia and Philippines. And we have a number of equal weights. India is one of them, along with China, Taiwan and Korea. But I would emphasize on Taiwan and Korea that
because of the outperformance, an equal weight stance means that you're holding more as the year goes on. And so that's a sort of a challenge for markets like India and China that are falling in weight day by day in the overall EM index. The passive allocations that will essentially follow the benchmark are mechanically forced to be buying more Taiwan and Korea, where the earnings story is strongest, and to sell India and China, where the earnings story is less good.
Because we get these negative FI numbers every day, are these markets still being used as funding markets towards Korea, Taiwan, Japan, etc.?
Yes, in a word, yes. So if you look at China, for example, in early 2021, that peaked at 45% of the EM index. It's almost halved in weight now, and it's dropped into number 3 position. Taiwan is number 1, Korea is number 2, and India has dropped from number 2 to number 4, and is only around sort of a 12% index weight. So early on, when China underperformed, I remember being at this conference and probably talking to you, there was a phase where that reallocation from China benefited India. But now both China and India are under pressure as Taiwan and Korea gain. And those two markets, now the largest markets in emerging markets, are almost 50% of the index, which is a record high.
Korea, Taiwan, 50% of the MSCI EM index.
Yes. Yes, it's a record high, all-time high.
Jonathan, and what is Morgan's view on how long? You know, this memory, we've had many of these cycles before, but there was always cyclical commodities, you know, and it used to fizzle out. We are looking at humongous jumps, you know, on a year-on-year basis. I was looking at Samsung, for example, on 30 billion profits, it'll do some $250 billion plus, SK Hynix and all these others, right? I mean, these are very large jumps, but how sustainable is this beyond 26?
It's certainly sustainable through 2027, and then the debate is around the fade period thereafter. One of the interesting things about this whole area, as you rightly mentioned, it's been highly cyclical historically, is the sheer scale of the AI capex is so large, and the sector is oligopolized in memory, that the companies are now entering into long-term agreements with their customers. Their customers are so keen to secure access to their product, and so that is a significant improvement and arguably de-risks the earnings profile. So again, every time we come back and look at this, we find that the underlying capex in the area is higher, and the sustainable competitive advantage of these memory firms just gets stronger and stronger.
Right. And when you say this is sustainable at least through 2027, what we are, because markets will reward incremental upgrade to earnings estimates. So that upgrades, you think, will keep happening? You know, from what you're projecting now, I mean, you think that there's going to be room to upgrade those numbers, right? Because that is what investors will reward.
Well, we work very closely with our excellent semiconductor and technology team, and every time they've come back and looked at it, they've ended up upgrading further. And again, if you look at Korea, we're around about something on consensus close to 250% year-on-year earnings growth, which is obviously a quite astonishing number. But that number continues to be revised upwards. So again, coming back to earnings, my answer to your very first question, I mean, the earnings revisions breadth in aggregate is best in Japan if you just look at it stock by stock. In terms of the actual quantum year-on-year, it's by far highest in Korea, and it's also extremely strong in Taiwan. It's not to be in any sense sort of dismissive of the fact that the Indian economy has been resilient, and corporate earnings outlook is, I would say, reasonable here. It's sort of a mid-teens year-on-year outlook here, but it's very difficult to compete against the scale of the earnings growth that the North Asian markets are able to deliver in this environment.
Jonathan, what about crude oil prices? You know, we've got a little bit worried over the last few days because crude oil, it showed signs of breaking down, and now it's headed closer to around $97, $98 per barrel odd. You know, I think we chatted a few months ago when it was on the verge, I think, of breaking above the $120 per barrel mark. For an economy like India, you know, it's very important because we import most of our crude. What are you all penciling in?
Yes, it is. So if you look at the scenario analysis we did originally in March, we had 3 scenarios. One of relatively rapid move back down to 80 to 90 and then lower. An intermediate scenario sort of in the low 100s, and then an adverse scenario of 150 to 180 dollars on Brent. And actually, since the crisis started, we've alternated really between the favorable and the intermediate scenario, but not explored the adverse scenario. And it is certainly interesting that the oil price has started to move back up again in the last 48 to 72 hours. Unfortunately, that's somewhat more negative for the markets in South Asia than the markets in North Asia, for the reasons I gave earlier, that the North Asian economies have more reserves of oil and gas and products, and they tend to have more degrees of freedom in how they can maneuver. Do remember that Korea and Taiwan are printing exceptionally high GDP and export growth rates right now. So they have plenty of financial resources available to purchase product, obviously if that's needed at higher prices.
Just once again, we've, over the last, I think, 76 hours or so, Jonathan, we've heard from, I think, the Exxon CEO, the Shell CEO. Yesterday, I think one more global oil company CEO came on and said, world markets are not pricing how low inventories really are. And and I think it was the Shell CEO who said maybe prices Brent could go up to about 140. I mean, just your, what's the Morgan view here? Are we kind of surely we're not sleepwalking into a,
as I mentioned, we have the three scenarios, so as I mentioned, we have three scenarios. It'd be very foolish to over-anchor on one scenario when the situation is so dynamic around the negotiations. And as I just said, we've been moving between the intermediate and the positive scenario really over the last 2 months, but there is this more adverse scenario, which is substantially higher. And if that scenario transpires, it will force some difficult decisions on policymakers, particularly central banks. So you would start to see much more upward pressure on interest rates, because the underlying effect would be to diminish the growth outlook and simultaneously raise the inflation outlook. It's just a fundamentally negative thing, particularly in the southern parts of Asia, when oil would move beyond what we've seen so far.
Got that. So for investors, I mean, in investing into markets like sort of India, I mean, what's the one of the things is India doesn't have those a direct AI play, and there's been a complaint. So are we just waiting for this earnings bump and this massive earnings cycle elsewhere to taper off for foreigners to look at markets like India more favorably? Is that the game here?
Well, it's interesting. Obviously, we're going to have data center build out in India, and we have the capabilities to use these tools. The AI adopters that we've written about can potentially use these tools to change their business models and deliver more value to shareholders and grow earnings. So we're obviously going to be tracking that, and it's something that is highly debated in the marketplace. It's fairly clear who the upstream capex beneficiaries are as this technology develops, but the longer term impact as it diffuses throughout the world and enhances productivity, it could certainly benefit particularly financial services firms or other services firms that can change their business model to use the technology.
Jonathan, we'll leave it there. Thank you very much for joining us. Good speaking with you. Have a good conference, and appreciate your time here on CNBC TV 18. I think markets are sort of down, but down just 50 points. So this is more in the flat zone after being down a lot earlier on. We'll take a quick commercial break here. This is the first break on the program. We'll just come back and continue the market coverage. We'll also have Alok Agarwal of Alchemy Capital Management on the other side. Stay tuned. Welcome back. There's the markets which are down about 50. Alok Agarwal is CIO at Alchemy Capital Management. Alok, good to have you with us here. Thanks for joining in. Lots of chatter, lots of buzz on what could come with regards to or maybe something on the bond side, equities. We don't know. Maybe the bar is higher there. But we'll know soon enough because there is a briefing, a cabinet briefing at 3. Alok, what is, if I can ask you that, or if you've thought enough about this, what is most likely, and what not what you're hearing, but what would you like to see happen?
No, of course, hi, Prashant. A lot of expectations around what could happen, and we are seeing a huge amount of outflows as well. And especially after the West Asia war, India was disproportionately impacted, primarily because bulk of our oil requirement is imported. So a lot of chatter around what could come into in terms of whether there is a change in the cap against taxes or some other kind of leeways given so that more amount of investments can come in. Of course, we need to wait out and watch. But the more important point is that the authorities are taking note of the same, and they are quite resolved in their mindset that they need to come out with some steps proactively so that more incremental positive things may happen.
I'm just thinking out loud. For example, there's this for bond investments, if the withholding tax is cut, right, as has been discussed, we don't know if that is the announcement per se. That then could be like a sequence of events, right? Because that could, it may indicate, we don't know if we'll see because that's I guess RBI's domain, whether there is a precursor to maybe an announcement with regards to a bond issuance, right? Because to make it attractive, right? Because to attract capital in with a 20% rate is going to be tough, but with a 5% rate perhaps is a lot easier. So I'm not sure. There's a RBI meeting on Friday. So is this kind of being sequenced out? So we'll just have to see, and we'll get the opportunity perhaps to ask a question or two at 3 o'clock. Any thoughts, Alok?
No, I perfectly agree, Prashant. As it is, the differential of interest rates was not too attractive. So if you look at the dollar versus India, say US versus India 10-year differences, the 10-year yield gaps are only about 240 basis points, which is much lower than the hedging costs required. So at least to sweeten this differential returns, of course, the rates need to come down. So that would be a welcome move and ensure that not just we raise money, but also there's a lot amount of dollar flows coming back, which of course will be a positive for the forex flows. And more importantly, even the import cover gets better.
Hi, Alok. Good to see you in. Alok, where are you in terms of this metal cycle? I'm just looking at a rough look across your portfolios. You seem to be having a fair bit of metals, ferrous, non-ferrous as well, and they would be holding you in good stead. What part of that run are we in? The middle of it, the early part of it, the latter part of it? If you could give us your analysis.
Hi, Nigel. Yes, I'm quite overweight on the metal side. And while the portfolios have both ferrous and non-ferrous, but the non-ferrous is the one that is far more structural in nature. It's not very often do you see that all the three major non-ferrous metals, the silver, copper, and aluminum, all of them getting into almost a super cycle kind of a mode, wherein they are already in deficits. Their demand is getting more and more little bit on the inelastic side. And most importantly, the supply is unable to ramp up. So, earlier, what used to happen was when one commodity went into some kind of deficit, there would be substitution from the other one, or supply would come back. This time, that is getting difficult. So after a very, very long time, all three of them are into some kind of deficits, and that deficit doesn't seem like improving. So the exposure on the non-ferrous side is far more structural. The exposure on the ferrous side is more tactical in nature because the bulk of the supply and demand comes from China side, where the construction activity has picked up this year, due to which there's more of domestic consumption, less of exports, leading to ensuring that there's a tighter market out there. But the non-ferrous side is far more tactical. We have much longer runway ahead in the non-ferrous side.
Okay, all right. Got that. Non-ferrous, it seems to be a bit of a structural theme, and I would not have said it for many, many years, but it seems now that seems to be playing out. The way aluminium prices are moved, the way copper prices are moving, and there's a demand strength as well as some supply constraints. What about the precious metals? As a percentage of your portfolio, how much is it? Because I'm noticing you have some silver ETFs in your portfolio as well, and I think you have a decent weight between these two.
Yeah, in the precious metals, we do have close to 10% weightage across both gold and silver. And, while gold is more of monetary asset demand, silver plays that dual role, both on the monetary asset side as well as in the industrial side. And the outlook could not have been better. The monetary demand side is up. At the same time, the industrial demand is getting not just better and stronger, the incremental demand is coming from more inelastic zones, wherein, even at the higher incremental prices, though that extra demand, especially from the semiconductors, from grid upgradation, from the EVs, those are unlikely to come down meaningfully. So that's where the, silver is quite well positioned from both the sides.
Okay, all right. Very final question then. Besides metals, I'm observing you have some AMCs in your portfolio. You have both the listed exchanges as well, BSE as well as MCX. You believe this is a longer structural theme that will play out? Because these stocks are already multi-baggers, I think.
Yes, Nigel, let me explain this in a manner. Like if I go back in the last 22 years, let's break that between pre-COVID and post-COVID. And Indians have forever been savers, whether somebody's earning 100 rupees or a few crores, they're all savers. So from 2004, say, till COVID, bulk of those savings used to go into savings accounts and FDs. And we saw that that was the low-cost deposits for the lenders, and lenders really outperformed. They really ensured that their earnings multiplied in that period. Their weightage in Nifty shot up from under 5% in 2004 to close to 40% by the time COVID hit. But post-COVID, a lot of changes have been noticed. Out of possibly experiences of a generation, seeing their family, friends, and neighbors making more money in the equity side, or maybe the capital market side, we started noticing that the same savings getting channeled more into the capital markets rather than the savings accounts and FDs. The proof of the pudding is that while lenders are struggling for that deposit growth, the SIP numbers are actually navigating even the volatile times quite easily. So the whole structure is changing. The capital market side is the one that is attracting those savings. That's why our overweight on the capital market side as compared to the lenders.
We appreciate you joining in, Alok, and giving us your view and how you positioned as well. You like some of these capital market themes. You're overweight on the metal space as well. And within that, you're quite positive on the non-ferrous theme. Thanks a lot for joining in, and we catch up soon. By the way, we have a recovery that's underway in terms of the markets. You have Mahindra & Mahindra that's now moved to the high point of the day from the Nifty pack. But for the time being, let's hop across to Hormuz. He's joining to tell us about some of the big movers in trade today. Hormuz?
Banks have been the top contributors to this recovery, and SBI has played its part as well. Recovered over 3% from the lows of the day. On the FNO side as well, the premiums on the 1000 call option have gone up almost 50%. And typically, as has happened over the last 2 days, volumes have spiked after 12:45 p.m. in today's session as well. 2.5 crore shares have been traded today. 20-day average is around about 1.5 crore. Almost 60% of those shares are marked for delivery, but still the stock is well below its key moving averages. The 200-day moving average on the upside is 984, so that's the first level to track. And the stock is down over 20% from its 52-week high, which is at 1234. IFCI is one broader market name that has done well today. It's bucking the trend, 12.5% higher, the biggest single-day gain in 5 months. In fact, it's gained in 5 out of the last 6 sessions as well during this period, which it has gained over 30%. And the market cap today has crossed 20,000 crore rupees as well. Now, over 25 crore shares have been traded today. The 20-day average is just over 3 crore shares, and 20% of those are marked for delivery. And the stock already is in overbought territory on the charts. The RSI is at 80 currently. And today's session, among the most traded stocks on the Nifty 500 today, trading at a 52-week high. And lastly, 2 names from the electric mobility space doing well: Ola Electric and Ather Energy. Both of them seeing gains of any. Ola Electric is now up 10%. Ather Energy is up 8%. And in fact, Ola has seen over 20 crore shares traded, 2x its 20-day average. Ather too is at 2.5 times its 20-day average in terms of volumes. And both of them have seen at least a quarter of the total number of shares that have been traded so far getting marked for delivery in today's trading session. And lastly, Even after this recovery, Ola has recovered almost 100% from the lows, but is still down over 70% from its post-listing highs. Ather is up over 230% from its 52-week low and is trading close to its 52-week high today.
Got it. Okay, all right. Thanks a lot, Hormuz, for that. Well, we'll be getting you visuals coming in from the cabinet briefing. We get to that in just a bit from now. I think some visuals are coming in gradually. But in okay, it'll happen then. In the meanwhile, let's just take a quick check on what's going on in the FNO market. Well, the Nifty was under pressure early on because both the opening batsmen actually were under pressure. But then suddenly you had the Nifty bank that's come into form and that's firing away. And that's definitely helped the Nifty recover from around 230 points down. Now we're down only around 25 points down. In the morning, we were telling you, various factors. Then the Nifty ends into the green. I don't know whether that's possible. It looked remotely possible earlier. But now it seems we're in with a bit of a chance. The PCR, it had moved to around 0.75 earlier today. Now it's at around 1.03 because put writing has come back into play. Earlier, there was a lot of aggressive call writing that was taking place. But now the put writers as well have come in. So the 23,300 put, the premium at around, close to around 200 or thereabouts is what it's showing on the screen. The 23,500 call, well, the premium out there is around 220 rupees. I think we'll have to correct those strikes that should come up for you. Yes. We need the near-term contract. So the premium on this particular strike, which is the 23,500 call, it's around 225. So there is writing being seen at that particular level. Individual stocks that are in focus, Vodafone Idea, that's coming for a bit of a short covering bounce. I recall when we were getting into the May series, the rolls were looking like they were favorable. And at that point of time, the stock was less than 10 rupees. Now it's close to around 15 rupees. So there is a short squeeze that's taking place, as is the case with Tata Motors PV. Short squeeze taking place out there. And from the banking pack, surprise, surprise, Union Bank, big delivery is what we're seeing in the cash market, and it's backed up by a fair bit of fresh build-up in the futures and options space as well in the stock future. So that stock is well holding up well in the green.
Okay, all right, Nigel, as we wait for that press conference, the cabinet briefing, we'll stick with the story, right? Then the story is, what can we do to attract more foreign capital into the country? And at the CNBC TV 18 IBLA Collective, we asked exactly that question, but in the context of Gift City, which is essentially aimed for exactly that reason, to be the gateway to bring in more foreign capital easier, and perhaps with lower taxation as well. So this is a snippet of the conversation that we had at the event last evening. Listen in.
Omnibus investment. Undoubtedly, there is risk of round tripping. But omnibus, where a private bank or a wealth manager or an insurance repper makes investment on behalf of hundreds of their clients, is a globally accepted practice. If round tripping is not an issue in those jurisdictions, we will have to provide similar facility to global investors and global capital. Today, there are many foreign citizens who would like to invest in India. They have some connection with India, or they are interested in participating in India growth story. But they'll have to take a PAN account, PAN number, PAN card in India for investment. That's not going to work. So why not give omnibus facility to private wealth bank insurance pool so that they can collect money from their customers and invest via Gift City into India.
If you created a leasing company in Gift City and you want to remove the asset from an Indian airline to, let's say, a foreign airline in a third country, then the most efficient way to do that is if you have a double taxation treaty with the third country, which India has a few of them, perhaps not to the extent that Ireland has. And so, yes, over time, we will need to increase the amount of double taxation treaties we have to be able to create a stronger set of sort of taxation infrastructure for Akasa. I mean, the good news is we're an airline, not a leasing company.
Correct. No, I mean,
so as such,
on the other side, yes.
Yeah. So as such, we will continue to lease from third-party leasing companies that could be sitting anywhere in the world. And that doesn't change. I think the question that you asked has an effect on someone wanting to create a leasing entity in India.
Lessor sitting in Gift City.
A lessor sitting in Gift City. And that's something that, you know, for that to be fully effective, we'll need to have a broader set of double taxation treaties.
I think India must do a campaign called Inevitable India to attract long-term capital and to attract high-quality talent back. How do we make it easier for onboarding, easier for the convenience of like investing initially? Omnibus is one, maybe the digital KYC instead of having those physical, instead of wet signatures, we make it very easy. And just to expand on the point of what Nilesh Bhai mentioned, that when you look at Clearstream, all fund, those aggregators or the platforms, or you look at, let's say, Standard Chartered Bank as a custodian, globally they would be marketing different kinds of products in different jurisdictions, be it a UCITS fund, be it a fund in DFM, be it a fund in whatever in Singapore, or maybe a fund listed somewhere. A Gift City product doesn't get added there today because you have to do a completely separate onboarding exercise. If you make it easy, we market very strongly as a country, and all of us will put our might behind this to put like India as a great destination. This time, I think instead of doing some of those kind of like bonds and all, we should really try getting money from the NRIs in the equity market.
Cabinet briefing is on. Let's cut across.
चलो थैंक्स आज माननीय प्रधानमंत्री श्री नरेंद्र मोदी जी की अध्यक्षता में कैबिनेट में बहुत बड़े महत्वपूर्ण फैसले लिए गए हैं, उनके बारे में आपको जानकारी दूंगा। 6 बड़े फैसले लिए गए हैं, जिसमें सबसे पहला फैसला है आज की जो वेस्ट एशिया क्राइसिस के कारण जो एटीएफ एविएशन टर्बाइन फ्यूल उसका जो प्राइस बढ़ा है और उसका जो इम्पैक्ट आ रहा है एविएशन सेक्टर पे, उसको मिटिगेट करने के लिए 10,000 करोड़ रुपीस का एक एटीएफ प्राइस स्टेबलाइजेशन फंड क्रिएट किया गया। दूसरा, दिल्ली के पॉल्यूशन को रोकने के लिए लगातार कई स्टेप्स लिए जा रहे हैं। उन स्टेप्स में एक बहुत बड़ा निर्णय लिया गया कि जो 40% कंट्रीब्यूशन है पार्टिकुलेट मटेरियल का, वो ट्रांसपोर्टेशन सेक्टर के कारण आता है, और उस ट्रांसपोर्टेशन में जो सबसे बड़ा कंट्रीब्यूटर है हैवी ट्रक्स और बसेस, उनको रिप्लेस करने का, पुराने ट्रकों और बसों को रिप्लेस करने का इसमें फैसला लिया गया है। तीसरा फैसला है उड़ीसा में कोस्टल हाईवे, पूरे कोस्ट में जो इसका फेज 1 आज अप्रूव हुआ है, रामेश्वर से कोणार्क से लेके पारादीप तक, यानी उड़ीसा के सदर्न टिप से लेके करीब आपके सेंटर तक आ जाएगा, पारादीप तक। फिर बिहार का बहुत एक इम्पोर्टेंट हाईवे का प्रोजेक्ट अप्रूव हुआ है, खगड़िया से पूर्णिया के बीच में 4 लेनिंग NH 31 और 231 के सेक्शंस का है ये। 5वां फैसला लिया गया, तेलंगाना में 2 बड़े हाईवे हैं जो वारंगल के साइड में है, उनका 4 लेनिंग का फैसला लिया गया। और 6ठा फैसला लिया गया मध्य प्रदेश में खरगांव ये अपने 2 NH 347B के अपग्रेडेशन का। टोटल 39,290 करोड़ रुपीस के सारे बड़े फैसले हैं। सबसे पहला फैसला है एटीएफ प्राइस स्टेबलाइजेशन फंड। हम सब जानते हैं कि वेस्ट एशिया क्राइसिस के कारण एक बड़ी समस्या उभरी है, एविएशन टर्बाइन फ्यूल एटीएफ, इसका प्राइस बहुत बढ़ गया। जो अगर हम देखें तो मार्च में 60 रुपए पर लीटर एटीएफ का प्राइस था, वो बढ़ के 142 रुपए हो गया मई 2026 में। अब इसका प्रभाव हमारे डोमेस्टिक पैसेंजर्स पे ना पड़े, और आज एक मिडिल क्लास के लिए भी सवारी बहुत अच्छी है, फ्लाइट के माध्यम से बहुत मिडिल क्लास के लोग भी ट्रैवल करते हैं, उनके पॉकेट पे बहुत बड़ा बोझ ना पड़े, इसलिए सरकार ने एटीएफ प्राइसेस को कैप कर दिया था 75 रुपीज 60 पैसा पे डोमेस्टिक ऑपरेशंस के लिए। तो डोमेस्टिक ऑपरेशंस तो उससे स्टेबलाइज हुए, लेकिन साथ ही साथ जैसे जैसे क्राइसिस लंबा खिंचता गया तो जो ऑयल मार्केटिंग कंपनीज हैं उनके ऊपर इसका बड़ा नेगेटिव इम्पैक्ट पड़ रहा है। तो कैसे एक विन 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 सोल्यूशन निकले, जिसमें विन फॉर द एयरलाइंस, विन फॉर द ओएमसी कंपनीज एंड विन फॉर द सिटीजन्स, ये विन 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 फार्मूला कैसे निकले, उसके लिए बहुत बड़ा अटेम्प्ट किया गया एंड लॉट ऑफ थिंकिंग, लॉट ऑफ कंसल्टेशन विद द इंडस्ट्री, consultation with the banking sectors, consultation with the OMCs. Finally, the solution which has come out is a ATF price stabilization fund. ATF price stabilization fund में basically एक self sustaining revolving fund बनाया गया है. Self sustaining revolving fund के माध्यम से ATF price for the airline carriers who want to participate in this, उनको एक स्टेबल ATF प्राइस अभी करंट क्राइसिस के दौरान मिलेगा और जब क्राइसिस फिनिश हो जाए तब उसका एक रीइंबर्समेंट और रिटर्न का भी मैकेनिज्म इसमें क्रिएट किया गया है. इसके सारे डिटेल्स आपको मिनिस्ट्री ऑफ सिविल एविएशन की तरफ से प्रॉपर एक डिटेल्ड स्कीम की गाइडलाइंस शेयर की जाएगी. मैं आपको नेट इसका बताना चाहता हूं कि इससे हमारे एंटायर एविएशन सेक्टर में करीब 70 लाख से अधिक जो जॉब्स हैं जिनके ऊपर इम्पैक्ट पड़ना आरंभ होने लगा था बिकॉज ऑफ द स्ट्रेस इन द सेक्टर, वो इससे सिग्निफिकेंटली मिटिगेट होगा. और जो एयरपोर्ट इंफ्रास्ट्रक्चर में, एविएशन सेक्टर में पिछले दशक में जो बड़ा चेंज आया है, एयरपोर्ट्स डबल हुए, एविएशन सेक्टर अपने आप में बहुत बड़ा एक ग्रोथ का माध्यम बना. देश के इतने कोने कोने में एविएशन की एक पहचान बनी, लोग पहुंचने लगे, टूरिज्म को बेनिफिट मिला, कॉमर्स को, बिजनेस एक्टिविटीज को, हेल्थ केयर को, स्टूडेंट्स को, सबको इसका बेनिफिट मिला. वो सेक्टर इस स्कीम से सिग्निफिकेंटली स्ट्रेस से बाहर निकल के आएगा. और जो पाकिस्तान एयर स्पेस क्लोजर के कारण हमारी जितनी भी इंटरनेशनल मतलब इंडियन कैरियर्स को जो इंटरनेशनल फ्लाइट के लिए घूम के जाना पड़ता था, वो इससे मिटिगेट हो जाएगा. इससे काफी कुछ हद तक मिटिगेट हो जाएगा. इंटरनेशनल कैरियर्स तो पाकिस्तान के ऊपर से जा सकते थे, हमारे डोमेस्टिक कैरियर्स कुड नॉट गो ओवर द पाकिस्तान एयर स्पेस. वो कनेक्टिविटी का जो इश्यू है वो भी इससे सॉल्व होगा. ये पहला आज का फैसला था. दूसरा है ओल्ड ट्रक्स और बसेस दिल्ली में, एनसीआर में, इनको रिप्लेस करने का एक 5041 करोड़ रुपीस का फंड, एक स्कीम आज अप्रूव हुई है कैबिनेट में. जैसा आपने देखा होगा, हाल ही में बहुत सारे स्टेप्स लिए गए दिल्ली के पोल्यूशन को कंट्रोल में लाने के लिए. जो बड़ा फोकस किया गया है क्लीनिंग पे, प्लांटेशन पे, इलेक्ट्रिक व्हीकल्स के अडॉप्शन पे, चार्जिंग इंफ्रास्ट्रक्चर बनाने के लिए, और कई सारे ऐसे स्टेप्स लिए. उसमें जो एनालिसिस से निकला वो ये था कि 40% ऑफ द पार्टिकुलेट एमिशन इज बिकॉज ऑफ द ट्रांसपोर्टेशन सेक्टर, और उसमें भी प्राइमरीली बिकॉज ऑफ द डीजल एंड पेट्रोल व्हीकल्स विच आर प्लाइंग इन द सिटी, चाहे वो 2 व्हीलर्स हो, चाहे 4 व्हीलर्स हो, चाहे बसेस हो, चाहे ट्रक्स हो. इन सब में से भी जो मेजर कंट्रीब्यूटर्स हैं वो है ट्रक्स और बसेस. तो ट्रक्स एंड बसेस के रिप्लेसमेंट का, रिप्लेस दी ओल्डर व्हीकल्स विद मॉडर्न लेस एमिशंस वाले BS6 और CNG और इलेक्ट्रिक व्हीकल, ऐसे ट्रक्स और बसेस का रिप्लेसमेंट का स्कीम आज बना है. इट्स अ वेरी genuinely good scheme because इससे एक नेचुरल इंसेंटिव क्रिएट होगा और लोग जो भी पुरानी ट्रक्स और पुरानी बसेस हैं उनको रिप्लेस करना चाहेंगे. अगर हम डेटा देखें तो BS1 to BS4 जो व्हीकल्स हैं, पुराने वाले व्हीकल्स हैं, वो 67% मोर CO और 97% मोर पार्टिकुलेट मैटर एमिट करते हैं कंपेयर टू द BS6 व्हीकल्स. तो उनको अगर हम रिप्लेस करते हैं तो एक सब्सटैंशियल रिडक्शन आता है पार्टिकुलेट एमिशंस में. इसको इंसेंटिवाइज करने के लिए आज कैबिनेट में अप्रूव हुआ रिप्लेसमेंट ऑफ ओल्ड ट्रक्स एंड बसेस रजिस्टर्ड इन दिल्ली NCR टू BS6 और EV और CNG व्हीकल्स. इस स्कीम के लिए 5041 करोड़ रुपीस का आउटले है और इम्प्लीमेंटेशन 3 संस्थाएं भारत सरकार की MORTH, MOHUA यानी हाउसिंग अर्बन डेवलपमेंट और NCR प्लानिंग बोर्ड, साथ ही साथ सपोर्ट लेंगे गवर्नमेंट्स ऑफ दिल्ली, हरियाणा, उत्तर प्रदेश एंड राजस्थान। इनकी मदद से करीब 2 लाख के आसपास ट्रक्स हैं जिनको रिप्लेस करने का प्रोग्राम बनाया जाएगा और करीब 16,000 बसेस हैं जिनको रिप्लेस करने का प्रोग्राम बनेगा। इससे हमारा मीडियम टर्म में और लॉन्ग टर्म में दिल्ली में पोल्यूशन सिग्निफिकेंटली कम होगा। साथ ही साथ माननीय प्रधानमंत्री जी ने ये भी आज सभी को आग्रह किया कि एक होल ऑफ द गवर्नमेंट अप्रोच से दिल्ली के पोल्यूशन को टैकल करना चाहिए। इसमें हर एक डिपार्टमेंट अपनी अपनी तरफ से क्या कंट्रीब्यूट कर सकते हैं वो सबको देखना चाहिए, चाहे रेलवे डिपार्टमेंट हो, चाहे अर्बन डेवलपमेंट डिपार्टमेंट हो या फिर दिल्ली गवर्नमेंट के डिपार्टमेंट्स हो, चाहे डिफरेंट मिनिस्ट्रीज में जिनका भी इंटरेक्शन दिल्ली गवर्नमेंट या दिल्ली के सिटी से रिलेटेड मैटर्स पे आता है, उन सब का इसमें रोल हो और एक कंसर्टेड एफर्ट करें जिससे कि दिल्ली के पोल्यूशन से एक सिग्निफिकेंट रिडक्शन आ सके। स्कीम के डिटेल्स आपके साथ मिनिस्ट्री से बहुत डिटेल स्कीम के गाइडलाइंस इश्यू होंगे। शॉर्ट में इस तरह का है कि 5% इंटरेस्ट सबवेंशन होगा व्हीकल लोन पे और मंथली फ्यूल वाउचर्स 5 साल के लिए विया दी ऑयल मार्केटिंग कंपनीज और एक्स शोरूम डिस्काउंट दिया जाएगा ऑटो कंपनीज द्वारा। साथ ही साथ पुराने व्हीकल को रजिस्टर्ड स्क्रैपिंग सेंटर्स पे वहां पर उसे करना पड़ेगा स्क्रैप या फिर किसी नॉन एनकैप सिटी के अंदर बेचे और इसकी जगह नया व्हीकल परचेज करे। राजेश
Okay, well, you know, 2 or 3 names which basically were moving in reaction. The ATF Stabilization Fund, so Indigo, moved up a little bit on that announcement from Mr. Vaishnav, and of course the phase out 5,000 crore support to phase out older trucks and buses in favor of CNG electric buses, the JBM Auto was one, and of course Electra has moved up to the high point of the day, about 3.5% higher as well. We'll take a break. We'll come back to Mr. Vaishnav as he sort of continues announcing some of these measures in just a bit. Stay tuned.
Welcome back. Well, the stocks of the last 20 minutes or so are those, likely beneficiaries if the old buses are going to be getting replaced. So you have Ashok Leyland that's come off the lows. You have JBM Auto. The entire move has come post the announcement that came in from Mr. Vaishnav. And also you have Olectra, Green Tech. Just take a look at the way those stocks have spiked up. They were trading in the red and they've clearly reacted very, very favorably. Sudeep Bandyopadhyay joins us on the show. Sudeep, what do you think? Sometimes there's a gap between these announcements and actually when the orders do come. But for the time being, the street is bidding them up. I think you should track Olectra, if I'm not mistaken.
You're absolutely right. I think, this is something on the expected lines. I don't know. I didn't know that this is going to be announced. I think nobody knew. But something like this was expected. And these stocks were ripe for accumulation. Now that the announcement has come, I think the excitement is visible in all these counters. But even otherwise, Nigel, I think fundamentally I like both Olectra as well as JBM Auto from a long-term perspective. Public transport transition from traditional ICE to EV is bound to happen. And this is the way things will move. So it's better that we start buying into these companies. Ashok Leyland and Tata Motor Commercial Vehicle also will benefit because now the transition will happen in a phased manner. But eventually it is going to be EV, and eventual beneficiaries over a, let's say, 5-year period will be JBM Auto and Olectra.
Okay, got it. Prashant, at the start of the show, we were saying that in case there is something that's announced on the bond side of things in terms of relaxation, then PNB Gilts will be the stock to be in focus. We've not yet heard anything on that front. The stock is sold off big time. It was, I think, up more than 10%. And I think it went up close to around 12-13% as well. It's come off a little bit because that hope that was there with regard to bonds, it's some kind of relaxation on the bonds front, is cooling off a little bit. Not yet announced, at least, in terms of whatever speculation was going on.
I was wonder, who's going into PNB Gilts, one corner of the market but that's the market for you,
That's
right?
the market for you. That's the only play. I mean, I've seen it in the past. You would have seen it as well. More than 10, 15 years. Any news on bonds, that's the one to...
things to express your view, and you have PNB Gilts one, all kinds of specific kind of things, right? Now, Sudeep, yeah, you're right. I mean, on that EV point, look at what Ather is doing. I think even today, it's the last I checked was up about 6 odd percent as things stand. But something may still come, and it does. Maybe it won't get announced by Mr. Vaishnav at that cabinet briefing, perhaps an ordinance or something. Anything, Sudeep, you're hearing? There's a lot of chatter. Nimesh is not with us on the chat to tell us the chatter. So let me ask you, any chatter you're hearing?
Well, Prashant, I'm hearing a lot of chatter, but that's from us, the market, the guys in the market. I don't know whether government is seriously considering anything at this point in time. But honestly, I personally feel that they should. And they should do something about bond. They should do something about the capital gains tax. And they should do something about, not changing the rules of the game continuously. I think these are the basic things which they should be doing. From whatever I heard Mr. Ashwini Vaishnav talk, I don't think that was on the agenda today.
Yeah, absolutely. And looks like it. We'll see. What really, if there's something apart from the presser, etc., which really comes up in that sense. The market's down about 80 odd points or so, and there is 1,900 stocks down, about 1,350 stocks which are higher at this point. And of course, I mean, after that big 4% move yesterday on the upside, IT is down about 5.5. Surprise, Sudeep, with the sharp move on IT today on the way down?
Well, even yesterday, I think we had a brief conversation. I was not in favor of this. I didn't really support this rally in IT, which we did see over the last couple of days. And I think it was a little overdone. The AI-related challenges for the IT companies, particularly Indian IT companies, is real. We cannot run away from that. And, the way we view it, we think we are seeing the trailer of it. There are a lot more things to come. Yes, of course, even OpenAI and Anthropic have floated their own service companies. So there will be requirement for services, and Indian IT companies can come in and compete with these subsidiaries of Anthropic and OpenAI and try and get those services mandates. But I think it's a process. It'll take maybe a couple of years for this transition to happen. Indian IT companies to graduate from whatever they were doing into this, for some time, the revenues will suffer, margins will suffer, and profits will suffer.
Yeah. Got it. Sudeep, stay with us. There is 5 minutes to go for market closing. And there is things to do, there is things not to do. I caught up with Rhythm Desai of Morgan Stanley earlier as part of their conference. And that is exactly what he's saying. I mean, rate hike, he's saying don't do. And any form of capital control, which is, again, as part of that, Sudeep, you also said chatter, right? Anything on LRS, etc. Well, he says it'll send the opposite message. Listen and take that break. We'll see you on the other side.
Rate hike doesn't work.
Yeah.
Why? Because India is a growth market.
We're an equity market.
Yeah,
so
the minute you increase interest rates, growth will slow down. The relative growth picture will worsen. The selling will actually aggravate. We're not a yield market, so it's not going to help. And 25 basis points is not going to take you anywhere. So you'll have to be a far bigger rate hike, which is therefore far more punitive to growth. So that's one. The rate hike, if at all, is considered is only because inflation, prospective inflation is rising. So that's the only reason. Is that rising? Yes, it is. Because there is some impact of the currency depreciation, some impact of the increase in fuel cost, and there is also some potential impact of the El Nino and Indian Ocean dipole situation, which could result in a constrained food supply. So if I look out 1 year, it does look like CPI headline is going to nudge past 4%, which is the RBI's target. Now, the RBI needs to decide, do I respond to it today, or do I respond to it once I have a little bit more data on the war, on the weather, etc., to therefore put that price in. So I think this is not the week in which a rate hike is relevant. Which prevent the dollar outflow, it will suggest that there is a problem, and it will actually result in counterproductive outcomes. So you will get the opposite outcomes. So you have to be careful about what you do and say with respect to, and you cannot assuage the market that things are fine, but we're doing this as a precautionary measure. The market is going to react. With respect to dollar inflows, I think if you look at gross FDI, it's actually doing quite fine.
Well, we got a bit of a bounce from the day's low, but the market's going with a cut of close to around 80 points. What lost out today? The sector that supported us yesterday. You had tech stocks that sold off. TCS, Tech Mahindra, HCL Tech, Infosys, Wipro. The top 5 losers on the Nifty were from the tech pack. What did well? Apollo Hospital stock is rock solid now. It's not very, very cheap, but the street clearly, is looking ahead. And they believe there's big growth over here, and it's essential as well, right? Hospitals. So that stock was the top gainer, up 2.5%. Tata Motors PV did very, very well. Interglobe Aviation, some measures that were announced from Delhi just a short while back. Well, that played out in their favor. The stock goes on with a gain of around 2%. And SBI and ICICI Bank, massive intraday recovery is what you saw on both those two names. So that's why both those two stocks, in fact, did pretty well. SBI, not SBI Life, SBI the bank. We should keep an eye out on that as well. From the broader markets, well, there was some pain. So by the time we wound up, at least you had 1,300 stocks that were advancing. At one point of time, there were only 700 stocks that were advancing. So the breadth of the market improved. What did well? You had MK Global. That's not a stock we normally talk about. Stock was up 20%. Savita Oil, another stock we don't talk about too often, was up 20%. Go Fashion was up 13%. Lakshmi Organic was up close to 10%. Borosil Renewables, well, there were some measures that were announced to protect their business. So that stock as well did pretty well in trade. We should get a few of these names. MK, Savita, Go Fashion, Lakshmi Organic, Borosil, Car Trade as well, up 9%. What was losing out in trade today? Well, there were a few stocks that came in for a bit of a knock in today's trading session. So from the broader markets, actually, just to get a few names up for you. LT Mindtree, that stock was down. Persistent Systems. Coforge was under pressure. Tata Elxsi as well on the losing end. Add to the list something like a Prestige Estates and PB Fintech, both of them down 3.5% or thereabouts. Well, on that note, though, we'll wrap up on this edition of Closing Bell. You stay with us. The team of Markets Forward comes up next.
Markets end lower after a volatile trading session. However, benchmarks recovered from the day's low. The Nifty closed below 23,400, around that level of 23,400, weighed down by the IT stocks, while the Nifty Bank outperforms. The broader market also sees good recovery.
Union Cabinet approves a new fund with an outlay of 10,000 crore rupees to stabilize jet fuel prices. Also creates a 5,000 crore rupees scheme to phase out old trucks and buses in the National Capital Region.
Car trade tech rallies as Kotak Institutional Equity upgrades the stock to a buy rating and raises its target price to 2,300 rupees. Concord Biotech also rises on US FDA approval of a new drug.
You're with us here on Markets Forward. We are coming to you live from the CNBC TV 18 Motilal Oswal studios, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Hormuz Fatakia, with me, Vinny Motiwala. Well, Vinny, another session, another day divided into two halves. Yet again, just like yesterday, we were down and out for the first half of the trading session, and then comes a very sharp recovery again.
Absolutely, and we did see a very good recovery, but still just slightly near the 23,400 mark, but no complaining, right? Good recovery is what we saw coming in for the markets. The Bank Nifty, that's what led to the recovery as well. Look at the Bank Nifty. When you look at the chart, red, and then we saw that green, and comfortably closing near the day's highest point is what the Bank Nifty did. Broader end of the market too saw that recovery coming in the trading session as well. So yes, the mid and small cap also saw a good up move. Did touch a bit of a green, but then came off from that as well. Small cap also managing to see just a decline of around 0.1% in the trading session. But yes, that's how the market setup was looking like today. But we have a very exciting lineup for you all on the show today. And we'll start off with the top movers and shakers of the day with Darshan. And also, we'll have the top brokerages that, came in for car trade as well. So we'll talk about that. Then we'll also talk about NMDC, the iron ore price hikes that came in. We'll break down all these stocks individually for you all. And last but not the least, we're going to delve into the key market events to watch out for in tomorrow's trading session. So stay tuned in for that.
And to our first segment of the day, Sudarshan, as always, is here to tell us the top movers in today's trade. Sudarshan, over to you.
So if yesterday IT was the biggest contributor towards the upside, today it has basically dragged Nifty, and like top Nifty gainers, just top 5. If you take a look, all the names are from IT. TCS yesterday surged more than 6%, today slipped more than 8%, followed by Infosys down almost 4%. Tech Mahindra slipped more than 6%, and even in the mid-cap space, Persistent Systems down almost 7%. Even other stocks too saw fall. LTM was down almost 7%. So we'll have to see exactly how the AI is going to impact these names, because that's the concern that the segment or the sector has been facing. But one segment or one sector that has supported the market is the Nifty Bank. What a recovery from day's low, almost 1,000 points. The Nifty Bank has seen a recovery on an expectation of certain announcements from cabinet meeting. That announcement is yet to happen. Let's see if there is any. But ICICI Bank seen a sharp recovery, closed with a gain of 1%. HDFC Bank, Indian Bank, Federal Bank, Canara Bank, all the names have seen a huge recovery, somewhere in the range of 4 to 5%. Some of the other big movers, Vodafone Idea, closed with a gain of almost 5% from day's low. If you calculate, it's up almost 7 to 8%. NHPC, non-retail portion of OFS subscribed yesterday. Today, retail portion also fully subscribed, closed with a gain of 4%. PV Fintech ahead of, because we are expecting discussion paper related to distribution from IRDI. And because of that, the stock has been moving in one direction downward. Today, also 4% down. IFCI and Card Trade Technology closed with healthy gains in the range of 9 to 12%.
Plenty of movers in today's trading session. Sudarshan, thank you for summarizing that for us. Now, the Union Cabinet has cleared a new fund with an outlay of 10,000 crore rupees to stabilize jet fuel prices. It has also cleared a 5,000 crore rupees scheme to phase out old trucks and buses in the National Capital Region. Now, Indigo reacted to that move. Announcement ended with gains of over 2%. And of course, the trucks and bus related names, be it JBM Auto, be it Electra Green Tech, both of them saw gains of anywhere between 3 to 4% in today's trading session. So that were the two major outcomes of the cabinet briefing. And to take this discussion forward, we are now being joined by Sudeep Bandyopadhyay from IndiTrade Capital and Shrikant Chauhan from Kotak Securities. Gentlemen, good afternoon. Thank you for joining in. Shrikant, yet another session where we have seen a recovery from the lows of the day. But does the market template still remain a sell on rallies one, because this lower high, lower low trajectory continues?
afternoon, everyone. So looking at the setup of the market, like today, we can say the market has formed a bear trap sort of formation after breaching the level of 23,200 for a shorter time. It quickly reversed back, and it not only closed above the mark of 23,200, but it closed above the mark of 23,400, which is something positive. So based on that, again, we can expect market to move towards the levels of 23,700 or 800 sort of levels. The reason is because since last 2 months, whenever the market has approached the level of 23,200, we saw bouncing back towards the levels of 23,800. So that's the reason I'm of the view that now till the market is holding above this level 23,200 on a closing basis, we can always expect upward activity towards 23,800 sort of levels. And Bank Nifty, there also we saw good amount of gains, but Nifty IT unexpectedly fell and it closed at the lowest point of the day. But in case from tomorrow onwards, if we start seeing upward activity in IT companies, then it will definitely help the markets to move higher.
Okay, that's about there coming in on the technicals. But Sudeep, your thoughts coming in on absolutely the cabinet announcements that we saw coming in as well, and a couple of names when we talk about JBM Auto, Electra Green Tech, Indigo for the ETF side as well. Anything that you would be looking at or worth looking at from now also on the fundamental point of view?
Well, we've been liking both the EV commercial vehicle manufacturers, which is Electra as well as JBM Auto. And we believe that, the public transport, and this is one area where world over, the ICE is being replaced with EV. And this is bound to happen. It's a matter of time. So that's the way to go. So these two companies, even without this announcement, of course, the benefit because of this, without this would have progressed over a period of time. So from a fundamental point of view, both these stocks are worth having in the portfolio. Amongst the other passenger vehicle companies who also will benefit to an extent, Ashok Leyland and Tata Motors commercial vehicles, they all also will benefit because replacement, a part of that will definitely happen through the BS6 approved commercial vehicles which come out of Ashok Leyland as well as Tata Motors passenger vehicles as well. So that's where it is. Interglobe, of course, this is a good announcement from Interglobe's perspective, and that's why the stock was up, but I don't recommend it buying Interglobe at current levels.
Interesting. So Indigo there as well as JBM Auto and of course Electra Green Tech. Staying with the auto space, actually, the car trade tech stock was up over 8% today. One of the stocks that bucked the trend in the broader markets. In fact, ended with gains of close to 9.5%, and that's after Kotak upgraded the stock, raised its target as well. Sudarshan is back with us. What are the key reasons behind this upgrade, Sudarshan?
So today, Kotak Institutional Equities has upgraded the stock to buy, and target price has been increased to 2,300 per share. And remember, this stock has been one of the biggest underperformers of 2026, has fallen more than 30%. But today, the stock has seen a big up move, closed with a gain of more than 9%. And Kotak's upgrade has mainly come on the basis of the higher valuation for OLX. And it's saying that because of the concerns related to the disruptions from AI models, the stock had seen a sharp downgrade or down move. But its deep dealer database and value-added offerings may limit the impact to an extent. And the upgrade is done on account of higher valuations for OLX, which sees steady GMV growth, improving monetization and margin. It has gone ahead and even raised FY27-29 EPS estimates in the range of 1 to 5% on higher profitability assumptions for OLX. So OLX is the main reason why the stock has been upgraded and the big up move that you have seen today.
Okay, thank you so much for that, Sudarshan. But another stock that was holding on to gains of almost 1% was NMDC. This came in after the company announced a surprise price hike for iron ore. Let's go across to Nigel to actually understand and get more details on this one.
Well, that's right. NMDC has been moving quite well, and early this morning, we here at CNBC TV 18 give you a bit of a heads up that there's possibly 150 to 200 rupee price hike that's been affected in the Bailadila mines, which is in Chhattisgarh effectively. Now, that's come through, right? Because you have the lump prices that have been fixed at around 5,700 rupees and the fine prices that have been fixed at around 4,850 rupees per ton. In the last few months, we have seen close to 1,000 rupee price hike, and this price hike has come as a bit of a surprise. The reason I say that is because we are awaiting the monsoon, and in the monsoon season, normally you see activity slowing down. So that's why it's come as a bit of a surprise, point number one. And there's been no big fluctuation with regard to global prices as well. So that's why the street is quite impressed. After such a big price increase, getting into the monsoon season, still they go ahead and increase prices, explains why this stock is doing a relative outperformance in today's trading session. Back to you guys.
Nigel, thank you for that update there. Sudeep, NMDC, within this metals and mining space, a lot of these PSU stocks have been in the spotlight recently, be it NMDC, be it Coal India. Anything that catches your eye within this basket?
Well, we did like Coal India, and we continue to like Coal India. I think it's a very safe bet from a current market perspective. As far as NMDC is concerned, the numbers for the last quarter were not at all impressive. However, the projections and the way things are moving, I think is encouraging. Particularly the price hike they have taken shows the confidence the management has on the demand, and I'm sure it is robust. That's why even in the monsoon season, they are taking a price hike. So under the circumstances, it is also worth watching. If I have to buy one, I'll buy Coal India. If I can buy more, probably NMDC also can be looked at.
Mm-hmm. And Shrikant, your thoughts on car trade as well as NMDC on the technicals?
See, like both these stocks, they are showing a good amount of strength on daily charts as well as on long-term charts, especially car trade, which has formed multi-base close to its important level of 1850, 1800. And after hitting multiple times those levels, we saw buying accumulation. And now, based on its technical formation, the next level to watch out for would be 2100 or maybe 2200. So broadly, I am of the view that in case if we see any correction, even from current levels, it's an opportunity to buy. Even at this level also, it's a buy because upside looks very clearly somewhere close to 2200 sort of levels. For NMDC, there also we are seeing higher top, higher bottom series, and it is into all-time highs. But the best part is that even at these levels, the volumes are more than average. So clearly indicates that there is fresh buying interest in the stock, and the stock can move towards the levels of maybe 110 based on technicals.
Okay, that's a word coming in there on the technicals for both the names. But let's talk about Concord Biotech as well as Borosil Renewables. Now, Concord Biotech, why was that in focus today? What we saw coming in was that the US FDA had approved a drug that is used for treating organ rejection during a transplant. They've given that approval. Now, the market size is around $30 million. That approval came in for Concord Biotech, and that is why the stock was buzzing in trade. It was holding on to gains of 3% even at the end of the day. Apart from that, we had Borosil Renewable. Now, that was in focus. Why did that run up in trade? What happened was that the Indian government has extended the countervailing duty on imports of texture-tempered glass from Malaysia. Now, for Borosil Renewables, obviously, they manufacture these products as well. So, when you have an import duty on another country, it means that the import to India becomes expensive. So it is better for our domestic players. The main reason for CVDs and ADDs are normally that. Now the CVD is extended for a period of 5 years, especially for two Malaysian players, it's at a rate of 9.7%. And other than that, for other Malaysian companies, it's at 10.1%. So this protects local players and import becomes expensive. That's why Borosil Renewable was buzzing in trade today.
8.5% higher, did very well in an otherwise choppy market in today's session. But Sudeep, to you, Borosil Renewables, if you track this counter, any views that you have?
We are positive on this entire renewable space, and I think this is one company which has been kind of meeting the expectations of the market and definitely can be looked at from a long-term perspective. Also, this entire West Asia crisis has clearly indicated that we need to look for alternate energy resources and energy sources. Obviously, under the circumstances, renewables become extremely important, and we believe the support from authorities and the governments for renewables will be strong going forward as well.
Shrikant, I was very intrigued about one stock that keeps popping up every single day, and that is Aditya Infotech. You may not have enough information on the charts because it's a very recent listing, but if you can share something that comes up on the charts with whatever data you have.
So there also, Harmaz, we are seeing consistent upward activity. And whenever we see such type of activity, it is always like very difficult to say that because see, in between also the stock has never corrected sharply, and that's the reason I'm of the view that the stock is completely into overbought, over retraced zone. It is better if there is any correction based on extensions. I am of the view that somewhere close to 3050, 3100, the stock is having support. So in case if there is any correction, then certainly we should look for adding some position. But at these levels, it is better to stay away.
Okay, at this level, you said it's better to stay away. On the fundamentals, Sudeep, have you managed to see this Aditya Infotech as well? It's a CP Plus brand. And in the recent time, it's seen such a run-up that it's coming on everyone's chart. Everywhere it's topping there. Okay, I think you're nodding your head, so you've not managed to see it. Okay, then what about your thought? What's your thought coming in on the IT pack as well? If we see a correction right now, is it time to maybe look at any of these big names?
No, definitely not, Vinny. I think, the AI-related disruption is real. We can't wish it away. And, it will take some time before Indian IT companies are able to adjust and get their act together. The deceleration in revenue, negative impact on margins and profitability is real. So we have to be prepared for that. Yes, it's a matter of fact that OpenAI and Anthropic both have started their own services companies. So there is a need for the services company to take forward the modules which these AI companies are releasing. And Indian IT companies can definitely play a role there, but it will take some time before they reach. So I think at this stage, it is definitely avoidable. Also because of the fact that we are seeing the AI-related disruption, probably the beginning of it. It's a long way to go. So I think next couple of years, we have to keep a watch on this sector, not jump into it.
It's a long way to go indeed. Sudeep, Srikanth, thank you so much for sparing time and joining us today with your views on the markets and the top movers of the day as well. Take a short break. On the other side, we bring you the top market voices and some key events to watch going into tomorrow's trading session. Stay tuned.
Welcome back to Markets Forward on CNBC TV 18. Well, we had a slew of big market voices throughout the day. Riddhan Desai, the chief equity strategist India at Morgan Stanley, says that the India outlook is attractive and looks very attractive on valuations, but is weaker on growth. Meanwhile, Citigroup's Alok Gupte expects big IPOs to attract foreign capital. Let's listen in.
On a relative basis, India is not looking good on growth. It's looking very good on valuations, but it's looking very inferior on growth. So if you compare with other large markets, and this is, AI is an excuse. The real deal is on growth. And this has not been the situation only for the last 2 or 3 months. It's been the situation since September of 2024, when India's growth peaked, valuations peaked, and since then the market has derated on a relative basis, and growth has been decelerating. Now, growth did pick up in the December quarter, but the growth elsewhere is very strong.
The number of IPOs that will happen in India which are above $1 billion in size and comfortably more than $1 billion in size is very, very high. You also have the global MNCs looking to IPO. There were a few that happened last year. There will be. We were part of most of them. We were very privileged to be part of that. There will certainly be more through the course of 26 and through next year as well. So I think when you look at the elements of the types of businesses coming, the scale of the India equity story, I don't think it's a market that frankly can be ignored for too long. We have some unique and amazing assets which will likely come to market, in the next 12 months. I obviously can't speak about live transactions, but these will be very globally relevant assets, not just, India relevant assets. And I can assure you every global PM is going to look at them, very, very closely.
There's not too much that governments can do around this when these private sector drivers or geopolitical factors that are outside the controls of, for example, the Indian authorities are really what's driving the relative earnings story and the relative performance. Look at China, for example, in early 2021, that peaked at 45% of the EM index. It's almost halved in weight now, and it's dropped into number 3 position. Taiwan is number 1, Korea is number 2, and India has dropped from number 2 to number 4 and is only around sort of a 12% index weight.
And before we call time on the show, let's bring you some key events to watch out for going into Thursday's trade. Ananya is standing by with that highlight. Ananya, over to you.
So let me give you a quick overview of the key events that could drive the markets tomorrow. So starting with the global events, investors will closely track remarks from ECB President Christine Lagarde and San Francisco Fed President for fresh clues on the interest rate outlook in Europe and United States. On the economic data front, markets will watch UK construction PMI and Eurozone retail sales data for cues on economic activity across the region. Back home, all eyes will remain on day 2 of the RBI MPC meeting, with investors looking for signals ahead of the policy outcome. Among stocks in focus, Satin Credit Care's fundraising proposal and Trent 1:2 bonus issue will remain key monitorables. Now, other important events include the City India Conference 2026, Maruti Suzuki's launch of India's first flex fuel car. Markets will also track the conclusion of the India-US trade talks in New Delhi and the progress of the southwest monsoon, which is expected to advance further over Kerala. So these will be the key events to watch going forward.
Okay. Thank you so much for that, Ananya. But with that, it's a wrap on this edition of Markets Forward. Thank you so much for tuning in. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Crude oil prices flare up after US and Iran exchange heavy fire. Kuwait suspends flights after several people were wounded in a missile strike at the airport. Iran says the attack was in retaliation to US strikes on Qasem Island. Amidst all of this, President Trump says negotiations continue and Iran's supreme leader is involved. Sensex and the Nifty end in the red after a volatile session. The bank stocks bucked the trend. Morgan Stanley's Rhythm Desai calls for easing taxation and registration process to attract foreign investors. President Donald Trump rebuilds his tariff arsenal, proposes fresh duties on 60 nations under trade laws targeting alleged unfair trade practices. While most countries face a 10% tariff, India, UK, Brazil, China and Japan are among those facing a higher 12.5% levy. India's Commerce Ministry says New Delhi remains engaged with Washington as trade talks continue. The Union Cabinet has approved a new fund with an outlay of 10,000 crore rupees to stabilize jet fuel prices. Also cleared a 5,000 crore rupee scheme to phase out old trucks and buses in the National Capital Region. Gold replaces U.S. Treasuries as the world's top reserve asset as prices double in the last 2 years. Analysis by the European Central Bank. Stablecoin company Tether becomes the single biggest buyer of gold in 2025, surpassing all the global central banks. The mother of all IPOs is here. Elon Musk SpaceX eyes a record $75 billion next week at a valuation of $1.75 trillion. If successful, Musk would become the world's first trillionaire. Indian companies get access to Anthropic's new AI model, Mythos. Government sources say Indian entities in single digits have been given access to the AI model, which is capable of finding serious cybersecurity vulnerabilities. Anthropic is given access to 200 entities spread across 15 countries. At least 21 people dead, several injured after a massive fire ripped through a building that housed a bread and breakfast facility in South Delhi's Malviya Nagar. Police say several of those killed were foreigners. Sources say the place was popular among foreigners who came to India on a medical visa. Well, straight to the top global story this evening. Oil prices surging as the conflict has widened across West Asia once again, with Iran and the US exchanging heavy fire. Let's break down the latest developments for you. Now, Kuwait has suspended flights after several people were wounded in a missile strike at the airport. The foreign ministry said that one person was killed in the attack that caused significant damage. The ministry said it condemned Iran's attack on civilian and vital facilities and added it reserves its right to take appropriate measures in response. Iranian media reported the latest exchange began when U.S. forces struck an Iranian oil tanker near the Strait of Hormuz. The attack reportedly damaged the vessel's engine room. The IRGC claims it responded by targeting a U.S.-Israeli vessel with naval missiles. Soon after, the U.S. military said it carried out self-defense strikes on Iran's Qasem Island. While Iranian media reported explosions in the area, the IRG claimed that it launched missiles and drones and at what it described as U.S. military targets. The U.S. said it has intercepted all of those drones. Amidst all of this, President Trump said that negotiations continue despite claims to the contrary by Iranian state media. Now, speaking to an Australian podcast, President Trump claims Iran's Ayatollah is involved in the negotiations and the naval blockade could be lifted by Labor Day, which is the 7th of September. So we're not talking anytime soon at all. Top U.S. diplomat Marco Rubio claimed the war is over. This when he was grilled by U.S. lawmakers. Rubio appeared before the U.S. Senate committee in what was his first appearance since the war in Iran. There were several testy exchanges between lawmakers and Rubio during that hearing.
Iran has lost a substantial percentage of their missile launchers, and their economy is far worse today, and I mean far worse today, than it was 6 to 9 months ago. And they are looking at hundreds of billions of dollars of reconstruction costs just to get to where they were 6 months ago.
Mr. Rubio, you keep telling us how we're winning this war. The president keeps saying,
well, the war's over
completely annihilated. The war is not over.
Well, that's the Secretary of State, Marco Rubio, telling Congress that the war is over. Clearly, that is not the case. Now, Ukraine's army has killed at least 7 people after a drone hit a bus in the Russian-controlled Donetsk region. The governor of St. Petersburg said Ukrainian drones hit infrastructure in several districts, causing damage and wounding several people. The strike comes a day after a barrage of Russian missiles and drones killed 23 people across Ukraine as the fighting continues with no clear end in sight. Let's talk about the markets. It turned out to be a volatile session with Dalal Street ending in the red, but it was off its intraday lows. The Nifty closing below the 23,450 mark, weighed down by a sharp sell-off in IT stocks. The Nifty IT index down by almost 6% today. Remember, we saw a little bit of relief coming in, and today we saw a 3-day winning streak snapping. The Nifty mid-cap index down about 0.5% or so. Every constituent has ended in the red. Banks were the outperformers, helping the Nifty cap its losses. The Nifty Bank closed nearly 1% higher today. Morgan Stanley's Rhythm This High has called for easing taxation and registration process to attract foreign investors to India. Take a look.
Foreign selling is showing up on the screen every day.
Foreigners are also selling Korea. Okay.
Right.
So
Correct.
let's not.
No, it's almost, but there it's more technical. The selling is.
But this is also technical.
Yeah.
Large part of the outflows are passive. It's because the weight is falling, because India is underperforming, and every single day India underperforms, the weight falls, and passives have to adjust their index in their position to match the index weight. But I think we can also do adjustments on the policy front.
I was coming to that.
So, for example, I think make it easier for foreigners to participate, and that is, I think, something that should be done over the next few months, because it takes a lot of time for people to get registered.
Well, that's Rhythm Desai asking for some more relief for from the government for the markets. Now, the rupee weakened by 44 paise, ending the day at 95.71 against the dollar. This on account of escalating tensions in West Asia, rising oil prices, all of that weighing on the currency market. Other Asian currencies were also under pressure today. 95.70 is where it closed for the day. Now, President Trump has threatened a fresh round of tariffs, proposing additional duties on 60 countries under laws that target alleged unfair trade practices. Now, while most countries face a 10% additional tariff levy, India, UK, Brazil, China and Japan are among the countries that could be subjected to a higher 12.5% levy. Ashmit joins us now to take us through the proposal and its implications. Ashmit, the US trade representative has put this proposal forward. It is still a proposal. It is not a decision yet. What is the basis for this 12.5% levy on countries like India?
Well, let's remember that in March, there were 2 investigations under Section 301 that had been initiated by the US. Now, importantly, as a part of one of those 2 investigations, that investigation went into prohibitions that may have been introduced by countries for stopping the imports of goods from countries which employ forced labor. That was the criteria. That was the subject matter of investigation. 60 countries in total, and all 60 will now see a recommendation of higher tariffs, of additional tariffs. The set of countries have been divided into 2 baskets. One set of countries which have introduced some prohibitions will see a 10% levy. Countries such as China, India will see a 12.5% levy. But this, of course, is a recommendation at this stage. This is a long process which will invite written submissions. There will be public hearings as well. The public hearings are scheduled for July 7th. India has, of course, also released a statement saying that they are actively engaging with the US negotiators and will also be watching out for those public hearings as well. But again, as you correctly pointed out, important to clarify for the benefit of our viewers, only recommendations at this stage. These levies don't take effect. Let's also not forget that these recommendations come at a time when Brendan Lynch and his team of delegates are here in the national capital while they're negotiating a bilateral trade agreement. Sergio Gall, the US ambassador, says it's only the 1 final percent that's left in the negotiations for an interim framework. How much of a spanner will this throw in the works? Bear in mind, the Indian negotiators have been pushing hard for some form of protection from any future levies under sections such as Section 301. That is a big, big concern on the mind of Indian negotiators. And finally, another aspect, let's not forget, this is one of 2 investigations. There is also another second investigation which is currently underway on the issue of structural overcapacity, and that is with respect to areas, sectors such as steel, aluminum, solar modules, processed food. The result of that, of course, is still awaited, so we'll have to see whether or not it has any impact on these ongoing negotiations. But for now, the negotiations between Indian as well as the American delegates continue right here in the national capital.
All right, Ashmit, many thanks for joining us. And staying with trade, India and the UK have discussed contentious issues that were delaying the implementation of the trade agreement between both sides. These issues were brought up during the UK Trade Secretary Pete Kyle's meeting with Commerce Minister Piyush Goyal. In a post on social media, Goyal said that both ministers discussed economic ties between the two nations, advancing shared business priorities and further strengthening robust and forward-looking partnership. Commerce Secretary Rajesh Agarwal also met his British counterpart Amanda Brooks. The bureaucrats reaffirmed commitment to a regular engagement for effective implementation of the India-UK trade deal. Now, the Union Cabinet has cleared a new fund with an outlay of 10,000 crore rupees to stabilise jet fuel prices. Minister Ashwini Vaishnav said the fund is aimed at cushioning the impact of rising ATF prices on airlines and passengers. The Cabinet has also cleared a 5,000 crore rupees scheme to phase out old trucks and buses in the National Capital Region. The government has clarified that previous under-recoveries of oil marketing companies will not be covered under the new ATF fund. Sapna joins us now to take us through how this fund is going to work. Sapna, one of the decisions that the Cabinet cleared today, an ATF price stabilization fund of 10,000 crores. When is it going to be operationalized? How will it work?
Well, first of all, in terms of funding the fund, which is, I think, the basic question that everybody has in mind, 10,000 odd crore rupees. So an important thing that the INB minister shared was it's going to be funded via the Economic Stabilization Fund. Now, if you remember, at the time of the passage of the budget in the parliament, the finance minister had said that she's setting up a rupee 1 lakh crore corpus, setting aside for, a crisis situation, a kind of an emergency buffer type, if you may say so. And just after that, we had the West Asia crisis hit us. So that 1 lakh crore rupees, a partial amount, of course, is going to be used to fund this ATF stabilization fund. In fact, this was one of the queries from our side also in terms of what are going to be the usages of this 1 lakh crore fund. And, this ATF stabilization fund financing is going to be one of the important aspects. That's number one. Second, of course, this new stabilization fund is not going to cover the under-recoveries of OMCs which have already been incurred. So it is kind of futuristic looking. As of now, there is no clear deadline or a dateline as to when it's going to roll out, but there is going to be a high-level panel that's going to be set up, which will obviously have representation from the airlines, from the aviation sector, from the aviation ministry, from MOPNG, and other stakeholders. Of course, OMC is also going to be very important. So all of them will be part of the panel. And I suppose the decisions will be taken in that as to, how much has to go, by when it has to go, what else can be done. As of now, the government is very clear, and this has been again announced by the INB minister today, and also looks like a cabinet decision that actually ATF prices for the domestic airlines have been capped. So that's an important takeaway. So that will also indicate the reason why there was no change in the domestic ATF prices, on the 1st of June. Or rather, there was an expectation that they could actually go up, which didn't happen. In fact, for international airlines, the rates actually came down. So anyway, but international airlines are not going to be covered by this. This is purely to take care of the OMC losses, the kind of gaps they are facing, and what else needs to be done on that front, and how the pricing for the domestic consumer can be handled so that they don't really face the full brunt of the West Asia crisis.
All right, Sapna, many thanks for joining us. Now, gold has overtaken U.S. Treasuries as the world's largest reserve asset by market value. According to the European Central Bank's report, gold accounted for 27% of global official reserve assets at the end of 2025, surpassing both U.S. Treasuries and the euro. Ritu joins us now with more. Ritu, take us through what the report says.
For decades, U.S. government bonds were the world's reserve asset of choice. Central banks parked their money in treasuries because they were considered the safest and the most liquid asset in the world, but that's changing. A new report from ECB shows gold accounted for 27% of the global reserve assets at the end of 2025, overtaking U.S. Treasuries at 22% and the euro at 15%. Now, it's the first time in decades that gold has occupied such a dominant position in global reserves. Of course, part of the story is simply about prices. Gold prices surged roughly 30% in 2024, another 60% in 2025, and that boosted the value of gold that was already held by central banks. But the other part of the story is that central banks have also been buying gold at a record pace. For 3 straight years, they've bought more than 1,000 tons annually, which is more than double the average before Russia's invasion of Ukraine in 2022. So today, central banks account for more than a fifth of the global gold demand. The reason goes beyond markets. The freezing of Russian reserves after the Ukraine war forced many countries to rethink what really makes a good reserve asset. Government bonds and foreign deposits can be sanctioned or frozen, whereas gold cannot. It has no issuer, no counterparty, and if stored domestically, it remains fully under a country's control. Reserve managers are also increasingly treating gold not just as a financial asset, but as a geopolitical insurance. And it's not just countries buying gold. One of the largest buyers of gold last year wasn't a central bank at all. It was Tether, which is the issuer of the world's biggest stable coin. Its purchases exceeded those of several sovereign nations, showing how gold is increasingly being used as a reserve asset beyond the traditional banking system. Now, India is very much part of the broader trend. The Reserve Bank now holds more than 880 tons of gold, with gold accounting for nearly 17% of its total reserves, and nearly 77% of our gold stockpile is now stored within the boundaries of India, which is up sharply from just 6 months ago. So the takeaway from all this, the dollar remains the world's dominant currency, yes, but when it comes to reserve assets, gold is making a comeback simply because in an increasingly uncertain world, countries and institutions are once again placing a premium on assets that they can hold, control, and trust.
All right, Ritu, many thanks for joining us. And speaking of gold, the RBI and the government have denied a Bloomberg report that claimed the central bank sold gold reserves worth $12 billion. RBI rebutted the report, saying that gold holdings remain unchanged at more than 880 tons. Meanwhile, the crucial three-day Monetary Policy Committee meeting begins today, with Governor Sanjay Malhotra set to announce the policy decision on Friday. The June policy review comes against the backdrop of prolonged tensions in West Asia, rising crude oil and gas prices, and a sharp depreciation in the rupee, all of which have increased concerns over inflation and growth. However, most market participants expect the RBI to keep the benchmark repo rate unchanged at 5.25%. Take a look.
Given where the prevailing consensus is, given what we have seen in the media of looks like RBI signaling to the markets, it does look like a rate hike is extremely unlikely. And at the same time, I must say that our expectation or projection of CPI is that the reported CPI is likely to cross 5% by the end of this calendar year. But again, this is because of the really low base of vegetable prices last year, and there is absolutely no evidence of sticky inflation even in our forecasts.
We don't think that the RBI should hike. India doesn't have an inflation problem. India doesn't have a current account deficit problem. So if you're going to hike interest rates, what purpose is it going to serve? If the purpose is to provide higher yields on your currency, then 25 basis points is not going to do it. How we did it in 2013 is by lifting the upper end of the policy rate band and effectively letting the liquidity tighten when capital outflows are happening. And you have to do something like 150, 200 basis points of overnight interest rate hike.
Broadly, the market expects that there could be a rate pause. At this juncture, growth inflation dynamics are more important. I think a pause will definitely help us to stabilize in terms of ensuring that the smooth growth rates are achieved.
Now, AI giant Anthropic has provided access to its Mythos model to 150 organizations across more than 15 countries under its project Glasswing. Sources say certain Indian financial and cybersecurity entities have also been given access. These entities will be able to test for cyber vulnerabilities using this model. Now, SpaceX is preparing for one of the largest IPOs in history. According to Reuters, the Elon Musk-led company is planning to raise $75 billion. This will value the business at roughly $1.75 trillion. Rachna joins us now with more. Take us through the SpaceX IPO plan.
Well, we've been on this story even before the S1 hit, but the S1 filing told us that SpaceX was serious about the IPO. The roadshow structure tells us that Musk is trying to rewrite the IPO playbook, and now Reuters is reporting that the price is set. $135 a share, $75 billion the raise, $1.75 trillion is the valuation, and all of this is just the opening move in what is going to be one of the most watched IPO roadshows in the history of global capital markets. The terms are out, the bankers are assembled, all 21 of them, and the pitch to investors begins June 8th. And the pitch is going to have to work hard, because what SpaceX is asking investors to accept is not straightforward. In fact, Morningstar's independent estimate puts fair value of the company at around $780 billion. SpaceX is pricing at $1.75 trillion. So it's not just a modest premium, because it's nearly $1 trillion gap that every institutional investor on that roadshow is going to push back on. The financials give them very much the reason to do so. $18.67 billion in revenue in FY25, which is strong, no question about it, but $4.94 billion in the same year in net losses, and losses that widened further in Q1 FY26. The Starlink business, which is the core business, is profitable and growing, but much of the valuation rests on businesses that don't yet fully exist. Starship, orbital infrastructure, Mars, all of this investors are being asked to price in ambition alongside revenue, also not to forget XAI. Then there's the structure of the deal itself, which continues to be unlike anything Wall Street is used to. No price range, no negotiation. Musk has set the number and the market has to meet it, which is 30% of the offering goes to retail, the largest retail allocation in IPO history. 1,500 retail investors will be hosted at a dedicated event on June 11th, the same day as final pricing. So it is all deliberate in a bid to build a shareholder base that reflects Musk's own image. Loyal, retail-heavy, long horizon. That should work until maybe it wouldn't. All of it we will find out when the roadshow begins on June 8th. June 11th is pricing. So between now and then, every conversation between SpaceX, bankers and institutional money managers is going to be a negotiation pretty much. And the negotiation wouldn't be on the price, because that has been fixed. It's on the conviction of how much of this business can actually appeal to the retail investors and institutionals alike. So that is the real story that we will be watching out for now. June 12th is the listing date that has been set. So clearly we'll be looking out for it.
Yes, we will most certainly be doing that. Many thanks, Rachna, for joining us. Up next, at least 21 people dead, several injured after a massive fire ripped through a building that housed a bread and breakfast facility in South Delhi's Malviya Nagar. That and more when we return. At least 21 people have died after a massive fire broke out in a hotel in Delhi's Malviya Nagar. The blaze in the building that housed the bed and breakfast facility have now been extinguished. The Delhi police has filed an FIR under charges of culpable homicide. More than 40 people have been rescued and shifted to nearby hospitals. Police say several of those killed were foreigners. Sources indicate that the BNB was popular among foreign nationals who were visiting India on medical visas. The cause of the fire is yet to be ascertained. Abhimanyu Sharma reports from the site of the tragic, horrific incident.
We are at the Malviya Nagar Inferno site, and as per several first responders, several eyewitnesses, an inferno was reported at around 8:48 a.m. in the morning. Several people tried to enter the building to evacuate the stuck occupants. However, they saw their pathways blocked by the fire. Many people also broke window panes of the building which had caught fire, and behind me is that building, the area around which has already been cordoned off. We can also see mattresses strewn on the ground which were kept to ensure that people who are stuck inside the building could jump. We spoke to several first responders, several eyewitnesses, many of which claimed that several norms were being violated in the area, and several buildings were violative of different building bylaws.
कंधे पे ले लेके भाग रहे हैं हम लोग, ऊपर जीने या नीचे से लेके ऊपर चढ़ा हमने, जीने पे चढ़ा मैंने, सीढ़ी बाहर से लगा के, कोई जीने पे लगा के, जीने से जाने वाला रास्ता नहीं था, सब ब्लॉक हो गया था। एक ही गेट है उस होटल में, एक ही गेट है।
उसे लोगों को बोला कि आप बाहर कूद जाइए, जंप करिए, तो जंप कराया, जंप करके वो गद्दे बिछा करके ना वो बच गए, सभी लोग बच गए। वो एक बच्ची भी थी उसके अंदर और लेडीज भी थी, सोमालिया के लोग थे, काफी विदेशी नागरिक थे।
Further probe would be undertaken by the authorities, not just by the Delhi police, but also by the Delhi Fire Service and possibly by the Delhi government too. For now, people are being rushed to the hospital. The injured are being tended treatment. And also, it's likely that many political leaders may also visit the site.
Absolutely horrific what has happened there. Now, the National Family Health Survey for 2023-2024 shows several encouraging trends. Health insurance coverage has actually gone up across India. For children under the age of 5, stunting has decreased from over 35% to less than 30%, and the share of women who've ever used the internet has nearly doubled. However, the number of data points in the survey have been reduced from 131 to 101. Kiran joins us now to explain to us what's missing from the survey. Kiran.
Well, yes, this survey has 30 fewer indicators than the previous one. Now, it's important to clarify that the final report on the survey is usually published a few months later, but it is unclear whether the omitted indicators will be included in that report. So let's understand what's missing. All indicators on anemia have been dropped. This is significant because programs like Poshan Abhiyan and Anemia Mukt Bharat are directly benchmarked against the NFHS data. Key demographic indicators like the population level sex ratio at birth, infant and child mortality rates, and birth and death registrations data have also been removed. The sample registration system and the civil registration system track this data. However, the NFHS was crucial for cross-validation. Now, data on screening for oral, breast and cervical cancer is also absent. The previous survey was the first to capture screening rates on a nationwide scale. Those rates were already alarmingly low, under 2%. The portion on sanitation facilities in households and clean cooking fuel is also missing. These two indicators are directly linked to flagship government schemes, the Swachh Bharat Abhiyan and the Ujjwala Yojana, which provides free LPG connections. Data on the quality of family planning services, whether health workers have spoken to women about family planning, and whether women using contraceptives were informed of side effects, has been dropped. To find out the rationale for the removal, CNBC TV 18 reached out to the Health Ministry. However, the ministry is yet to comment. An Indian Express report cited Health Ministry sources as saying that the parameters reported by other government surveys have been removed to ensure data harmonization. However, health experts are concerned because the NFHS provided district-level insights that were not available elsewhere. It also has data that links health outcomes to income, geography, and other social factors in ways no other survey does.
All right, Kiran, many thanks for joining us. DK Shiv Kumar has been sworn in as Karnataka's new Chief Minister. This comes days after former Chief Minister Siddaramaiah tendered his resignation. The ceremony was held at Lok Bhavan in Bengaluru in the presence of senior Congress leaders, party workers and other dignitaries. Senior leader J. Parameshwara is the new Deputy Chief Minister. Well, DK Shiv Kumar finally the Chief Minister in Karnataka. That's a wrap on this edition of Business 360. Do stay tuned to CNBC TV 18. The news will continue. We're back in a moment after this very short break.
Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Well, today on the show, we're going to spend some time trying to understand the nature and the character of this market. It's a market that's been trapped in a trading range, at least at the headline index level, for the better part of the last almost 2 years now. We've had a war, which has complicated matters further. And we've got these fuel price hikes, which are now feeding into inflation. And there are a lot of other macro issues, right from interest rates and what happens there to the direction of the currency. A lot of newer questions coming up on the horizon, complicating perhaps the investing decisions for investors. So we will talk about how the second half could perhaps play out, what is the nature of this market, and then we'll put the spotlight on large and mid-cap funds. How can these funds help investors in terms of offering a balanced entry into the market, also looking at the earnings revival story? So is this a category that perhaps could be your best bet in playing an economy that's going through the motions right now, but perhaps will come out emerging stronger at the other side? To talk about all of this and more, we have with us R. Sivakumar, Chief Investment Officer at Axis Mutual Fund. Sivakumar, thank you so much for joining in. Great to have you back with us, and this time in person on the show.
Thank you, Surabhi. Great to be here.
So at the outset, as you heard me say, there are, 100 problems if I start listing them out. And for investors, I think it's been a testing time, right? Patience is being really tested. So far, I think investors have kept their faith. They're continuing their SIPs, continuing to put in the money. What have you made of the year so far? We're exactly at the halfway mark, right? And what lies ahead?
Right. So great questions all. I think you laid it out right. 2 years, almost 2 years now since the peak of at least the kind of large cap indices, and while mid caps have come back to new highs, but obviously, from an overall market perspective, it's been a sideways market, let's say, for a couple of years. But underlying this reality is that the economy has been running slow. Last year, for financial year 25-26, we saw GDP growth at about 8.5% nominal. And this is very important because nominal GDP growth correlates strongly with corporate profit growth, especially for large cap companies. So you have 8% growth in large cap earnings growth, which correlates with an 8% growth in GDP. And nobody wants to pay 20 PE to be in a market which gives you 8% growth, right? So it just comes down to that we have a low growth number. To put this in context, 8.5% nominal GDP growth, you really need to go back 22 years. So it's basically like a 2+ decade low in terms of growth that we are seeing this time around.
And we're not used to seeing this, right? No. As investors, as market participants, India always was the growth market, and therefore it got the premium. Yes. So I think the question on a lot of people's mind is this just one of those rough patches that you have to go through? Or is this a bit of a structural issue that's building, that we're no longer a 20% growth kind of a market across the universe of stocks?
I think 20%, you don't even need to be 20%. I think the point is that if you can grow at 10, 11, 12% nominal GDP and therefore 10, 11%, 12% growth in, let's say, large cap earnings, which means your mid cap and small caps can potentially grow even faster. That's really what people are looking for. But it's not structural. Most of the reason for the slowdown can be pinpointed to sort of a couple of points. One is the substantial reduction in fiscal deficit post-COVID. I mean, we've seen consolidated fiscal deficit of states and center coming from more than 13% of GDP to about 7.5%. That's a material consolidation in a very short period of time.
Which is a good thing, right? It's good
which inherently is good.
Yeah.
But it does put a little bit of a downward pressure on GDP
earnings,
growth, right?
Yeah.
For the near term. So it's more of a cyclical, it's just an adjustment, and we need to go through that. But it puts the government in a better footing going forward. The RBI in 22-23 also raised rates effectively by about 400 basis points. Your short-term interest rates went up from 3 to 7. So you had effectively 2 feet on the brakes. And that is the reason why the economy has slowed. 22-23 rate hikes doesn't mean that economy slows in 22-23. It takes 24-25 for that slowdown to happen. But the good news is both of these are off now. I mean, we don't see further fiscal consolidation. The government's target fiscal, both in the center and the states, is roughly flat. So at least there's no further downward pressure.
And the RBI cut rates.
Absolutely. Cut rates, easy liquidity, absolutely, 125 basis points. Rate cuts, easy liquidity. And one point which we sort of always fret about, which is a currency depreciation, effectively acts as a stimulus to the economy. Exports become more competitive and so on, right? Over time, obviously that it again doesn't kick in the same quarter that there's a depreciation, it takes time. So I think this is a cyclical low, and we should see that pick up quite strongly in the coming year. So if For example, we now believe that, let's say, the RBI's last forecast was for inflation to go to about the 4.5-5% mark. They might revise that this week, but let's say it stays in that 4.5-5% mark, and you get 7% real GDP growth, then we're looking at nominal GDP growth, which is closer to 11-12% a year from now. Great news. I think we need some amount of inflation in this economy. We have too low inflation. Just think about it. Last year we were running CPI inflation at 0 to 2%. That's just too low for us. If we get a little bit of inflation, that means profit growth picks up. If the same FIs who've been selling aggressively, seeing a lack of growth, will come back and buy if you show 12% growth at index level.
Okay, so from what you're saying, it's maybe not that bad, and some of the screaming headlines, currency weakening, inflation rising, the headlines sound very negative, but maybe in the medium term, they're not as negative when it comes to corporate profitability. So, and then therefore it feeds into earnings. What have you made of investor behavior through the last, 18 odd months now?
Well, it's a sea change in behavior. And I've been in this market for, let's say, as of 2 days ago, 28 years. And, and it is amazing. Every time when we've seen market corrections in the past, we've seen investor behavior in one way: stop SIPs, redeem, and so on and so forth. Post-COVID, we've seen a big change in investor behavior. We are actually seeing people top up. During this war, for example, we saw net inflows into equities spike higher, significantly higher. And so that behavior change is amazing, that people are actually looking at, continuing their SIPs, in fact, topping up. New lump sum sales shot up in the industry, for example, right? So I think that is a big change in investor behavior, which we should commend the entire retail investors. So I think the message here is stay the course. I think if you have an asset allocation philosophy, stick on to it. If you have, whatever schemes, strategies, whatever you're doing, stick on to it. Because this blip that you've seen over the last, let's say, year or so will not last.
So in the midst of all this, I think what's been confusing investors, while they've kept their equity SIPs going, and I think buying when the market falls precipitously is the easier thing now. People have understood. Right. When there's a big fall, you should go in and buy. But what is difficult to do is your ongoing investments, how you manage your portfolio. And that's where sometimes you'll see a rush towards, gold ETFs and silver ETFs. And sometimes people will say we want to do overseas equity. Because everyone's, it's a game of patience, right? Indian equities have not been the best. Yeah. In this environment, what is the house view right now? I mean, the equity call that you folks at Axis are taking, how would the next couple of months and quarters perhaps play out?
See, the very near term is complicated by this West Asia war, right? So there is obviously this concern because you have oil prices go up, but actually it's more than that. It's, we've seen that impact in gas and in various other commodities, sulfur, helium, aluminum, we can go on. Yeah. So the reality is that the next 1 or 2 quarters, the June quarter and perhaps even the September quarter, earnings could be affected. But I think the markets will look through that. The real question is, will demand hold up, right? Okay. So what I mean by this is, if you have demand in the economy and I'm not able to produce because I don't have the raw materials today, I can produce it next quarter or the quarter after. Sure. As long as it's what we classically call the pent-up demand, right? So you can carry forward the demand if you have the demand holding up. The thing is, if the war persists for long enough, then the questions will be asked, will this demand remain in the economy? For now, every corporate that we speak to tells us that demand is holding up. And that's what gives us the confidence that, let's say, if not from the second quarter, but the third quarter onwards, we should start seeing a pickup in the overall earnings numbers and so on. So if you were to look at 4-quarter sum, Q3, Q4, Q1, Q2 next year, it should be a lot better than what we have seen in the recent past.
So how does one invest for that? And I will come to the classic debate now, large cap versus mid cap. The last couple of months, from what I recall, because I look at a lot of the daily market shows as well, most people in the market were suggesting be with the safety of large caps. The economy is going through multiple shocks. Large caps offer the comfort and all that. But in the midst of all of this, again, it was the mid caps that hit the all-time high. So it's always a confusing question for investors.
No, it is confusing if you were to look at it from the context of where the safety is, as you rightly said, because large cap valuations have corrected meaningfully, thanks to the fact that you have significant foreign selling. I mean, if you look at the FI selling, it is concentrated in large cap. Why? Because that's what they own. You sell what you own. Right? Whereas the buying is more distributed. In fact, foreigners have bought mid caps and small caps. So in that sense, you have a change in behavior, both the domestic investors as well as foreign investors. There is a change in flow in favor of mid and small. But why? It's because that's where the growth is. If you look at your mid caps and small caps, from December quarter, they are showing 15% earnings growth. So even though your large cap companies may not be showing that kind of earnings growth, the earnings growth is there in mid and small. India is a growth market. If you see 15% growth, money will flow there and that sector will perform. So that's the reason why your mid caps have really held up, even though the large caps may be continuing to remain under pressure. So it's a tale of two halves. One, where there is growth, the mid caps, and therefore you will continue to see that getting a valuation premium. And two, the large caps actually give you a sort of valuation safety. So, for example, if there's more volatility to come, and we could discuss, for example, the risks which are still emerging out there in the world because of the AI trade and et cetera, et cetera. So that gives you safety in large caps. So I think it's no one versus the other. We are quite happy to recommend people to run a more balanced across capitalization.
But just one more point on large caps. I mean, since you mentioned, and very rightly so, that while they offer the sense of safety, they're larger companies, more stable companies, and valuations are on their side, they're also absolutely at risk of this constant FPI selling, right?
Yes, absolutely.
So what would you say to people who've actually taken, a meaningful exposure to large cap funds and now are wondering and watching their friends who've been in mid caps, race away once again?
See, I think it just says that you can't have a single strategy. In this country, when you look at if you look at the investable universe, we have more than 1,000 odd, more than 1,000, significantly over 1,000 stocks. Why should the money only be going to the top 100 stocks, which is your large caps, right? I think it makes sense to have a diversified portfolio. So to start with, we have to change our point of view. It's not 50 stocks, it's not 100 stocks, it's a much larger universe. The growth is in the smaller companies. Even within the large cap universe, if you look at your Nifty 50 versus Next 50 and all that, the performance is there in the relatively smaller companies within that space. So I think we have to take that approach first, that it's not a large cap story in India, it's actually much more diverse. But the valuation safety is a very important aspect here. If there is a shock in the global economy for whatever reason, again because of a war or because of any other shock to the economy, I think there will be people will ask the question, right? Where is the safety? And that money again could go back to large cap in such a scenario.
So you need to be, well diversified across both.
Yeah, it's not a this versus that. I don't think you can take a view that this versus that.
Okay, fair enough. That point is well taken. We'll do one thing. We'll take a break, and on the other side, then we talk about the instrument that the mutual fund world offers, which is the large and mid cap fund. One fund which gives you the best of both. Now, should you be looking at it, or should you be looking at individual funds within the large and the mid-cap category? If you're looking at a large and mid-cap fund, how do you blend it in your overall portfolio? Some of those questions after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing the relevance of large and mid-cap funds in your portfolio. And you just heard R. Sivakumar of Axis Mutual Fund explain why we need both strategies. It can't just be a portfolio fully geared towards large caps or fully geared towards mid and small caps. So Siva, now the question is that you can play this individually as well, right? You can choose to have a large cap fund and a mid cap fund. Then why look at the blended strategy, which is large and mid cap?
You could do both. I mean, to be honest, there is no one answer here saying that this is the best way or that's the best way. But for most investors who are just looking for two answers, right? One is, can I just build a sort of portfolio which comprises of a wider range of stocks? I mean, like I said earlier, large caps is basically your top 100 stocks. When you look at your mid caps, it's the next 150. So we have now picking from a 250 stock universe, which is definitely giving you a much wider range of stocks to pick from as a fund manager, right? So that's the first thing, that it gives more flexibility to the fund manager to pick and choose the stocks where there is growth opportunities, where there is reasonable valuation, etc. Right? So that the first reason is to have a wider universe in the fund. The second is, how do you choose how much to allocate to large and mid cap on an ongoing basis, right? So that again is a fund manager's choice. Of course, as an investor, you can do it yourself, and many investors choose to do that, and I think I applaud them for it. It's fantastic. But there's also a lot of people who say, this is not my job. Can I have
it to the discretion of the fund manager
to do?
Okay.
So I think that's the reason this category exists. There are, of course, the entire universe of small caps which is excluded from this, but that's fine for people who are really looking at the relatively larger companies. These are the top 250 companies. I think it makes a lot of sense for just taking that appropriate amount of risk, where you're going into outside the large cap space, outside the safety of large caps, if I may, but not taking too much.
Not sort of going too further down the risk curve. Okay, got that. And in terms of how these funds are structured and what the mandate is there a clear cutoff in terms of how much large cap should there be in a large cap, how much mid cap should there be?
Yes, there is, but it's also, there's a fair amount of discretion available. So it's not bound so hard that fund managers are passively buying large and mids. It's not the way. I think there is
the reason I ask is, like in a multi-cap fund, you need to have 25% of each category, right? So how does it work here?
You do have a regulatory minimum, but that's not but that is not constraint in the sense of you having to allocate. I think it's there is a fair amount of freedom. It's not like a multi-cap where there is a strict 25 kind of allocation. I think that gives me a little bit more freedom for the fund managers to allocate. That makes I think in this category, it's not the continuum is not, it's not long tail. It is still at the end of the day relatively known large companies.
Okay. So, if someone is to add a large and mid-cap fund now, I mean, a lot of investors also ask questions about fresh allocation, and everybody has their running portfolios, which typically you don't want to churn, and especially if these are medium to long-term portfolios. If someone is adding a large and mid-cap fund to their portfolio now, what should they be cognizant of? And, would it create a lot of overlaps if you already have a large cap fund? I mean, what's the best way of introducing it in a portfolio?
Yeah, it's a very good question. I think if your portfolio is already biased towards large cap to start with, and you want to sort of make first steps towards diversifying your portfolio into mid and small, this may be a great way to start doing that. Maybe shift a large cap, part of a large cap allocation to a large and mid cap, or incrementally add something like this just to get a flavor of mid cap. Similarly, if you're coming from the other side, for example, there are so many investors who, if you look at the flows into this industry, mid cap and small cap funds have got significantly greater amount of flows than large cap funds over the last, let's say, couple of years, right? I mean, for good reason. That's where, like I said, the growth has been, and that's where money has been made. But if you therefore want to take a little bit of a defensive position, right, you may not want to go all the way into large cap. Right? If you have the ability to take that risk, but in the current market environment, you want to bias a bit towards large cap, this may be a way to get that exposure. So I think you have to look at it, either if you're starting out, yes, you could look at this as a first fund of choice, maybe along with a multi-cap or something like that as a first fund of choice. But if you already have a portfolio, then look at this as a way to balance.
So what should a reasonable expectation be? I mean, over long term, in terms of returns from a fund which has that mid-cap edge as well?
See, market follows earnings growth over a cycle, right? So if we are able to get double-digit growth back at a GDP level, therefore double-digit backs on Nifty earnings level, then your large caps will start trending towards that double-digit rates of return over a period of time. Already, when your Nifty earnings growth is sitting in single digits, your mid caps are already growing at earnings of 15%, right? So if Nifty earnings starts moving towards 10 plus, so they can easily hold up and perhaps even grow faster. So I think if when you look at it over a cycle, definitely your large and mid cap, you should expect to make more than a large cap, and large cap itself should give you, let's say, over a cycle double-digit rates of return. So I think it's as a category, the way to look at it is a large cap plus rather than anything else.
Okay. And Sivakumar, finally coming to the last thoughts, and I mean, through the years in your earlier avatar, you've been a rates specialist, you've tracked the fixed income market for so long, right? And now we're probably entering that phase where the interest rate cycle here in India and maybe even around the world is going to turn. Just give us your thoughts on that. We're going to be approaching the policy as well. And if indeed we're going to get into a cycle of rate hikes again now, what will it mean for the equity market?
I think equity markets will welcome it. I think the reason, when rates go up, it's often because the economy is doing well. So the first thing is that economy needs to do well for rates to go up. I mean, you want to understand where the economy is going, and look at the bond markets. And bond yields have been going up since June last year.
Yeah, benchmark yield above 7%.
Absolutely, and that consistent rise in yields, and this is not, by the way, which has happened after the war in West Asia. This is consistently happening over the best part of a year now, almost exactly a year now. And this is despite the fact that you have got rate cuts, easy liquidity, and the RBI doing significant amount of open market operations to absorb the G6 supply. The only reason that happens is because bond markets are expecting better macro, meaning higher growth, higher inflation. And that's not bad news for equities. So when you look at it from that perspective, that higher rates essentially follow better macro. That macro dominates over rates, meaning to say that I would anytime take a higher rates with higher growth, which I think is way more positive for equities than a low growth, low rate economy.
So maybe not that bad. Maybe no need to start getting worried just yet.
No, I think we have seen time and again rate hike cycles correlate with very strong equity performance. If you go back over the last so many decades, I'm quite confident that if we are in a longer rate hike cycle, we should be
and good times are coming.
Good times are coming.
Okay, well, that's a very optimistic note to wrap up this conversation on. And thanks very much for putting a different lens to this, because typically, like I said, the headlines make you feel so worried that the world's coming to an end and what's happening with your investments. But sometimes a rate hike or even currency depreciation in the medium term may not be such a bad thing for our investments, as Sivakumar has explained. Thank you so much for being with us on the show this week, and we hope to see more of you.
Thank you.
On the program. Thank you very much. Well, that's it on this edition, but as we wrap up this week's Let's Talk Money, let's take a look at this explainer on large and mid-cap funds.
Let's talk money.
Hello and welcome. I am Ashmit Kumar. Now, the US has threatened a fresh round of tariffs, proposing additional duties on 60 economies under trade laws, targeting alleged unfair trade practices. Now, while most economies would face an additional 10% tariff, India, Brazil, China and Japan are among those that could be subjected to a higher 12.5% levy. The proposal follows a USTR Section 301 investigation launched in March of this year. The findings allege that several countries, including India, failed to adequately prohibit or enforce restrictions on imports linked to forced labor. However, these measures are still at a proposal stage. Requests to participate in public hearings are due by June of 22nd, with hearings scheduled to begin on July 7th. Meanwhile, India has taken up the issue during the advanced trade talks with the visiting US delegation. New Delhi said that it remains engaged with Washington on the Section 301 proceedings and is expected to seek protection from any additional duties once a bilateral trade framework is finalized. So, India also believes that USTR will take into account comments and testimony received during the consultation process before making a final decision. And well, joining us now to understand this further is with us former Foreign Secretary, Mr. Shashank. Also joining us a little later will be former Ambassador to Iran, Mr. D.P. Srivastav, as well as former diplomat and founder of the Banyan Tree Global, that's Sanjeev P. Yadav. But first, Mr. Shashank, coming to you, this was the very concern that the U.S. negotiators had expressed before the American delegation that, look, this 301 overhang is what is muddying waters. It is creating confusion. We don't want to be in a situation where we finalize on a tariff only to be met with an additional levy a few months down the road.
Well, thank you for inviting me. I think what I find is that it is more a response to the domestic developments in America, where the tariffs which were imposed unilaterally by President Trump were turned down by the Supreme Court. And therefore, the government at that stage were trying to find out some alternatives. And so the alternative, they went to the 1974 legislation, which allows the USTR representative to examine and then suggest tariffs. Now, these tariffs have been suggested. They have not yet been approved. So I'm quite sure that if India negotiates with the US and comes up with the bilateral tariffs to the extent they are there, and also they are able to convince the United States that the practices which are followed by India are fair, and whatever adequate precautions India can take are taken against the labor practices from the countries exporting to India. So I think there is a difficult situation. There is no doubt about it, but I'm quite sure that this is a continuing process. USA is in a war situation in the Gulf. USA is also in a domestic evolving situation where they are going to be midterm elections, and therefore they cannot go against the wishes of their own people and their own courts, which President Trump would have very much liked to do. But there is this situation that they have put, why 12.5% and not 10% as imposed on other countries, that we have to see who are our competing nations and how they will get an extra benefit as against India's exports to the United States.
Right. Mr. Srivastav, thank you for joining us. Let me take the same question with you. Let's take Indonesia, for example. Just before the US Supreme Court ruling, they signed a deal. They agreed upon a 19%. Now they're looking at an additional levy, courtesy the Section 301 proceedings. This is the very path that India doesn't want to go down on. We don't want to agree on a trade framework, agree on a deal, agree on a tariff, and then later be met with additional levies.
Well, this is something so typical of the US. I had gone through this experience in early 90s as a young first secretary in commercial section in Washington, where India was targeted under Super 301 and Special 301 trade laws. Eventually, they did not implement them, but today's US is very different. Protectionism is rising. I'm afraid that we really do not have an option, because the US, the duties under 301 provisions are over and above the normal tariff. So this is something which you have to take into account. We should, of course, try to have an understanding with them that once we have agreed on a tariff, there will not be additional duty. But under the US law, this is something which they can always try and impose on us.
Sure. Mr. Yadav, thank you for joining us. Help us with the Washington perspective here. What is the thinking? Many experts that I speak to off the record, what they tell me is that they're likening this to gunboat diplomacy. The gunboat is parked off the coast of the country. You're negotiating at a time when, of course, that threat, there's an overwhelming threat on further action by the United States. So just help us understand this. Is this a negotiating tactic? How far will it go, or will it muddy the waters as far as ongoing negotiations are concerned?
Sure, and I think we have to view this in the lens of these are obviously proposed actions that have a timeline attached to them, taking us into July. And what they do is they provide almost a pressure point for ongoing trade negotiations between India and the U.S., but a host of other countries as well. And these are a fallout of the Supreme Court action, and I think the impetus of the change is, this 12.5% proposed tariff on these, I think, 60 countries. What this does is really just put a little bit of an added layer of leverage and pressure on the Indian side to, move these negotiations forward and get to an interim deal quickly. I expect, given the comments that we've heard from both sides, that they're 99% there, that India is going to be looking for some sort of special carve out in respect to this Section 301 additional rate as part of an interim agreement. So I think, while the overall optics may seem like this is going to be an area of potential conflict or pressure point, I think this is going to be built into what comes out of this interim trade agreement with some sort of special carve out where the additional tariff won't be completely removed off the table, but in this interim agreement, there will be some special clause, hopefully.
If I can just labor on that same point, Mr. Yadav, one of the concerns here in the minds of Indian policymakers, of course, is that India likes to exercise strategic autonomy. That's vis-a-vis US, China, Russia, Iran. The concern is that tomorrow, if there is some strategic autonomy action that doesn't please Washington, it could then perhaps put the cart before the horse, initiate fresh investigations, and then levy fresh tariffs as a punitive measure. Is there a way of guarding against that as a part of a bilateral trade agreement, at least at an interim framework level?
I don't think, at least based on what we've seen and what we've heard, that an interim agreement will fully remove all of these Section 301 potential proposed tariffs completely. I think that will only be seen in a full BTA or full bilateral trade agreement. But yes, I believe they will hang there, but I believe at the end of the day, the Indian side is going to try to strongly negotiate a special carve-out that will give it the maximum protection it can have going forward until a full bilateral trade agreement can be negotiated.
Sure. Mr. Shashank, let me come to you. The fact that it comes, the timing of it, that it comes right in the middle of a Brendan Lynch-led delegation negotiating the final 1% of this trade deal, what does it do, at least as far as the optics of this delegation, this visit is concerned? Does it muddy the waters? Does it create more confusion in the minds of negotiators?
I think India should try to convey to the US trade delegation that we would be obliged to reciprocate these tariffs also and take them into account in our trade policy vis-a-vis United States. In a way, it is good that the US trade delegation is in town when the tariffs are being proposed, so that we can in fact ask them as to how do we take care of it in our first tranche of the trade deal, and later on to how to build it into the final trade arrangement between our two countries. And we have to keep the trade aspects little different from the other strategic issues, because those things we cannot foresee, and what effects will be there. We should keep our freedom of action, as the United States would also like to keep its freedom of action there.
Mr. Shashank, another point is that what we've seen today come out of the USTR is recommendations on one of two investigations that were initiated in March. There's a second investigation, of course. The result of that is awaited. That one concerns issues of structural overcapacity. Tell us, is this a case of United States of Washington keeping the powder dry to apply pressure at the right moments as a part of ongoing negotiations?
Well, as my colleagues have mentioned, the United States is in a very peculiar situation. It wants to have a rule-bound trade regime. It wants to have rule-bound maritime regime. But the rules are to be set up by the United States, because the US does not agree to any international agreements on this basis. So therefore, as a WTO member, the US should really have thought of first making WTO more effective, but they have not approved many of the nominations, and they have not gone before the WTO for a very long time. And similarly, in the other international organizations also, they want an exceptionalism for themselves, but they want others to be subject to whatever commitments these countries have made. So India stands by the commitment, but what we want is that the US also should, to the extent possible, when they are negotiating in good faith these bilateral deals, they take into account the interests of the other country also.
Sure. Mr. Srivastav, let me come to you that over the last few days, we've seen a lot of positive commentary coming in, both from the US as well as from India. We heard from Ambassador Gore talking about investments of $20 billion that India has proposed, commitments to buy $500 billion worth of goods and services from the US over the next 5 years. There's increased collaboration in the sphere of technology, nuclear energy. Do you see that as enough for Washington to offset any concerns that the US may have with respect to agriculture? That's been a sticky point in the negotiations.
If you're looking at the numbers, certainly these areas can offset whatever agricultural exports US wants to, and we are not prepared to open our markets yet. Let me give you an example. I think the energy sector is an area where we can cooperate most fruitfully for both sides. We are an energy deficit country. US is an energy surplus country. And in all three respects, oil, LNG, and nuclear, US has proven capacity and we have an increasing demand. WTI index of the US, it's always cheaper than Brent. And it's at least around $10 cheaper than Indian crude basket, which is sufficient to take care of additional freight charges for shipment from US instead of from the Gulf area to India. That also applies to LNG. And in case of LNG, there's an additional point, and that is US LNG will be outside Hormuz. Qatar is within the Hormuz, and unlike UAE or Saudi Arabia, which have pipelines going outside Hormuz, there's no such alternate route available for LNG supplies. So this is an additional point for increasing LNG imports from US. I was Director Gale when the first shipment came. I had the honor of receiving it along with the then minister. We can step up those supplies. And the third area is the nuclear. And this is where I think there's the greatest scope for cooperation, because Government of India has announced a target of 100 gigawatt by 2047. This leaves enough scope for both Indian industry and imports. We are already importing from Russia. We can import from US. And I think Westinghouse will be a very good candidate because they have proven technology. And given the size of India's demand, I think they fit in the bill. So these three verticals together, just the energy, that is oil, LNG, and nuclear, can substantially change the trade balance. And this is, I suppose, it also helps answer India's quest for energy security while bringing down the emissions.
Right, Mr. Srivastav. So again, a lot of commitments that India is seeking to make, areas where India is looking to work with the United States. Will that allow India the wiggle room to carve out some protection in the form of perhaps safeguards, guardrails against future 301 levies and 301 investigations? I'd like to thank all of our panelists for sharing their thoughts and insights on the ongoing US-India trade negotiations. But that is not all. We will continue a conversation on Iran, the West Asia tensions. We'll continue that with the help of our panelists on the other side after this short break. Welcome back to News Center. Now, tensions in West Asia have flared up once again. This comes after a major exchange between the US and Iran, despite both sides having earlier agreed to a ceasefire. Now, Iran claimed that it fired missiles towards Kuwait and Bahrain in retaliation to US strikes. Iran's Islamic Revolutionary Guard Corps has said that the retaliatory strikes should serve as a lesson for the United States as it targeted an Iranian oil tanker near the Strait of Hormuz. Further, Tehran claimed that US forces struck a communication tower south of Qeshm Island. Meanwhile, Kuwait's Interior Ministry has said that the attack caused significant damage to Kuwait International Airport and left 63 people injured, and one Indian has been killed. Calling it a criminal act of aggression by Iran, Kuwait has suspended air traffic. The United States, however, said that its actions were in self-defense, claiming that it intercepted missiles and drones targeting ships and Gulf nations. Now, Iran has also said that Kuwait and Bahrain bear direct responsibility for the attacks. At the same time, US President Donald Trump rejected reports that talks between Washington and Tehran have stalled. Iranian media outlets have also reported that diplomatic engagements between the two sides are continuing. However, Iran's top negotiator has warned of further escalation if Israel's attacks on Lebanon continue. This escalation comes at a time when US Secretary of State Marco Rubio told the Congress that the war is over. However, Washington continues to maintain sanctions on Iran, citing concerns over its highly enriched uranium stockpile. He said that sanctions relief could be on the table if Tehran agrees to the terms of a new nuclear deal.
Iran has lost a substantial percentage of their missile launchers, and their economy is far worse today, and I mean far worse today, than it was 6 to 9 months ago. And they are looking at hundreds of billions of dollars of reconstruction costs just to get to where they were 6 months ago.
Mr. Rubio, you keep telling us how we're winning this war. The president keeps saying,
well, the war's over
completely annihilated. The war is not over.
Well, to help us carry this discussion forward is with us former diplomat and founder of the Banyan Tree Global, Mr. Sanjeev P. Yadav, as well as former ambassador to Iran, Mr. D.P. Srivastav. Mr. Srivastav, let me come to you. The situation that we find ourselves in, the worst form of escalation that we are seeing since the ceasefire was announced, are we at the brink of falling back into that status of fire exchanges, of engaging in conflict between the two sides? Do we see that happening? Is that a real apprehension, a real possibility?
It's a tense situation, but as Secretary of State Mark Rubio said that the war is over, I don't think there's appetite for renewal of hostilities on the part of the US, and certainly not on the part of Iran. So that phase of active hostility is over, but that does not help the situation. This no war, no peace situation where Hormuz remains closed essentially means that the oil prices, the LNG prices remain elevated. It's not only Iran which suffers, but also the Gulf oil producing countries, because we have to remember Hormuz accounted for roughly 20 million barrel per day of oil and petro product exports. The two pipelines, one which Saudi Arabia has running east-west to Yanbu, and the other which UAE has to Fujairah, can hardly carry about 5 to 7 million barrel. And please remember that of the 5 million barrel which Saudi pipeline carries, the Yanbu port can only handle 3 million barrels. So actually, you're looking at a disruption of 10 million barrel of, or 50% of the supplies, which has a major impact on the global economy, on the economy of these countries. So I don't think it's a situation which either the region or the international community can afford for too long.
Sure. In fact, Fatih Birol, the chief of the International Energy Agency, joined us very recently, where he said that if there is no resumption of oil supplies by the end of this month, we could be looking at a bleak scenario for the world economy. Mr. Yadav, let me come to you. One of the key stumbling blocks as far as these negotiations, ceasefire is concerned, are, of course, Israeli actions vis-a-vis Beirut, vis-a-vis Lebanon. Tell us, there was an attempt made by Donald Trump to ensure that he's able to rein in Benjamin Netanyahu. We're not quite sure if that has worked out, because Benjamin Netanyahu came out and then posted on social media that Israeli IDF operations will continue in southern Lebanon. There's, of course, a show of aggression as well by the IDF. Tell us, are there limits to how much authority the Washington can exercise over Prime Minister Benjamin Netanyahu?
Well, I think, one thing, we can be clear about is there's the distinction between the domestic political rhetoric that all sides need to engage in, whether it's the Iranian side domestically and Israel for that matter. The President Trump announced this interim cessation of firing between Hezbollah and the IDF or Israel, which seems to hold, even though there have been obviously, back and forth still ongoing and skirmishes. Yesterday, obviously, as Secretary Rubio referenced in his conversations and testimony in the Senate, the Israeli and Lebanese counterparts were having active ongoing conversations, including yesterday at senior levels in Washington, D.C. at the State Department. Those are ongoing. So while this backdrop of the ongoing conflict between Hezbollah and Israel is going, we're actually seeing a lot of positive movement for the first time in a very long time period between Israel and Lebanon, where both states, both from a political level in Lebanon, are working strongly with the Americans and the Israelis to try to carve out some sort of agreement. And we see an impetus behind the Lebanese leadership to come to some way or manner to work with both the Americans and the Israelis to fully stamp out or try to remove the cancer that is Hezbollah in southern Lebanon. So, I think there's a lot of positives still coming out of this Lebanese issue. And I think going forward, we're seeing both from the American side in terms of defensive or offensive responses to the Iranians versus the Israeli responses to the Lebanese action, significant restraint, actually. So I think these conversations are going to take a lot of time. There's a lot of sensitive issues that have been simmering for decades that need to be worked out. So, all in all, it's still positive that we're not seeing significant conflict, and the skirmishes are minimized.
Mr. Yadav, many are asking this question that while even as Donald Trump engages in negotiations with Iran, he's having a more challenging time negotiating some kind of framework with Israel. Is that the bigger challenge that should be there on Donald Trump's mind? How to manage Prime Minister Benjamin Netanyahu rather than Tehran?
So I would put that in the bucket that's part of the ongoing information warfare that's going on, where there's a lot of misinformation coming out. Yes, there at the end of the day are going to be small and even significant at times disagreements between the U.S. and Israel, but the United States and Israel have a long history of working together. The president and Prime Minister Netanyahu are very close. They have a long-standing relationship. So I do not see that as an impediment to any significant either hold on the ceasefire or ongoing negotiations with Iran. As Secretary Rubio said yesterday, these are complicated talks that are going to take a long time. And he outlined what we've all come to see in the media, which is this disconnect between the IRGC, which is it's seemingly in full control, overtaking the political leadership. We've seen the resignation of the president of Iran. So there's a lot of rhetoric coming out, but at the end of the day, I'm sure talks are still going on. Talks are going to take time, and it's not so simple when you're dealing with an actor with no clear leadership structure in Iran, and it takes days and days to get back to a single point on where's the consensus on the Iranian side. So these are very nuanced, complicated discussions that are ongoing, but I believe that the U.S. and Israeli partnership and trust is there and will continue to be there, especially with the Trump administration's close relationship with Prime Minister Netanyahu and his team. I do not see that as an impediment going forward.
Well, many questions still remain, but we're completely out of time. I'd like to thank both of our panelists, Mr. Yadav, Mr. Srivastava, for joining us with their insight. But that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here.
Well, coming to you from the Morgan Stanley Investor Forum 2026, and as always, we're sitting down with the man who's got the pulse and who sort of puts this conference together for so many years now. Rhythm Desai is with me. Rhythm, great to have you with us here. Thank you very much for joining us.
Me.
And it's a day when we've got some showers, some rains in Mumbai, so hopefully, it rains good news as well. But just start with the starting point, Rhythm. It's not very demanding. It's not as if this is a raging bull market. I'm just starting with sentiment is quite negative. There's a fair bit of self-loathing, I feel now, which is kind of, we don't have AI, we don't have this, we don't have that, and all kinds of things, right? So it's almost very tough to justify a kind of bullish view. So that is where sentiment is at. So just talk us through the conference and what you aim to get to your investors from the conference, the message straight up?
So see, the interest level in India is very low. That's the bottom line. And the reason is that on a relative basis, India is not looking good on growth. It's looking very good on valuations, but it's looking very inferior on growth. So if you compare with other large markets, and this is, you know, AI is an excuse. The real deal is on growth. And this has not been the situation only for the last 2 or 3 months. It's been the situation since September of 2024, when India's growth peaked, valuations peaked, and since then the market has derated on a relative basis, and growth has been decelerating. Now, growth did pick up in the December quarter. It's actually picked up a fair bit in the March quarter. Companies are quite positive and are guiding despite the global uncertainty, despite the conflict in the Middle East. But the growth elsewhere is very strong. So the earnings growth in Korea, Taiwan, Japan, the US, even parts of Europe are way above India's growth. And this is not like a 2-3% point thing. So if India is doing 12, 13, 14% earnings growth, these markets are experiencing 30, 40, 50, and Korea is, you know, in the hundreds. Yeah. So that's where the thing stands. This thing with respect to foreign investors only flips when the growth flips or the growth expectations flip. It's not when the growth flips, because that will be too late, but when the expectations flip. So something has to give, say in the memory cycle, for Korea's growth to go down. Something has to give in the compute cycle for Taiwan's growth to decelerate, and so on. So that's not something that's visible. In fact, the capex in the world has been very resilient, and it has not reacted to the uncertainty coming from the conflict, which is why markets elsewhere outside India are all putting up new highs, and just not a soft new high, really strong highs. I mean, Korea is up 60% from its March end low.
Yeah. No, it's up 60% this year. It was up 75%. Yeah. No, it's up 100% YTD, and it was up 75% last year. And of course, Taiwan has done what it has. Rhythm, the question is, so are you saying that for FII, especially FII flows to flip, how you put it, right? This memory trade in North Asia, or I mean, this entire AI capex frenzy has got to end, because those are beneficiaries. That's where that money is going. So that needs to slow down a little bit for investors, foreign investors, to pay attention to India.
It's about expectations. The expectations have to pivot. The expectations that this is going to generate more and more growth has to change. And India's growth expectations have to accelerate. So both have to happen. Both are one. I mean, the relative growth picture has to change with respect to forward expectations.
Is there any signs of the former happening?
No,
because
not at all. I mean, if you look at Morgan Stanley estimates, we are only upping our capex forecast for AI. And a lot of this has to do with the AI supply chain. So there is no visible sign that this is about to slow down. That's not in the horizon.
If anything, I've seen numbers which say that it's going to accelerate all the way into 2028, maybe even beyond. I mean, and you're kind of sort of agreeing with that, right? That's your expectation, estimates as well.
28 is far away, but it's there for 27 at least. So if you're looking at from a near-term perspective, next 12 to 18 months, this capex cycle is pretty intact, and it is not seemingly going away.
It's not going away. So where does that leave us?
No, so India's growth is accelerating, and at some point in time, the valuations relative to growth opportunities do become attractive. And of course, see, there is a technical aspect to this. Retail investors in India are just not stopping the bid. So in March, you would have ordinarily expected retail investors to be a little bit hesitant because the markets were volatile, there was bad news, there was a drawdown, but they put record inflows. And they followed up with another strong April, and I think the May month also has been probably very strong, going back by the amount of buying that domestic funds have done. So if that bid is on, then there has to be a seller. Now there can potentially be two sellers. There can be corporate issuances and there can be foreigners. So the other way that foreigners can become buyers is that corporate issuances resume. It's counterintuitive, but that will be good for
more supply, basically.
Exactly. That will be good for the overall bid on the market. It will be good for the BOP. It will be good. So it's counterintuitive, but issuances can make a difference here.
That foreigners can come back and participate in those issuances.
Yeah, because then they get space to come into the market. Otherwise, retail has just kind of taken them out.
I mean, that bid has been absolutely strong.
And I don't expect the retail bid to go away, because that's a secular shift that's underway in India.
And you pointed it out.
We've been talking about for 11 years now, and now finally that skepticism is fading. But people are waiting that one day retail will panic. But retail has matured in this, and they are upping their equity allocation, rightfully so in my view. In the long run, this is going to pay off quite well to them.
You started by saying that sentiment, there is very low foreign interest in India at this point in time. I mean, you've done this conference, what, 20 plus years?
28 years.
28 years. And if we were to sort of plot a interest level, foreign investor level through those 20 conferences, where are we now? Are we pretty much at the lows?
No, we have been through these.
Okay.
Like 2011-12, I remember, was very bad.
Yeah.
But, frankly, I should have been ready with this data. I am not. We should see the data. But, when we were doing this conference in the early 2000s, like in 2003, we used to write a conference book. Now we don't do it.
Right.
So I used to write the preface.
Right.
India's market cap in 2003 was $100 billion.
Wow.
Because I remember writing this, that 50% of India's market cap is going to be represented at our summit. $50 billion
was here.
Yeah, so we have come really long way, $100 billion. So it's difficult to make comparisons on the basis of numbers.
Yeah.
Because the market is now up 45x.
Yeah.
It's a much different, it's sized up.
Yeah.
It's a player in the global.
Sure, absolutely. I started in 2003 as well, so it's a year which I remember. But Rhythm, so just to complete the foreigner point, right? This constant selling that we're seeing. I was speaking to somebody, and I was kind of surprised to hear it, that typically, and this was in response to what I asked, is that, well, typically we get asked whether foreigners are calling up and asking what should we buy. But the gentleman, again, a foreign firm, said, well, I'm getting questions of what can we sell to increase allocation to these other markets that you were talking about as well. Is that something you pick up as well? Because that foreign selling is showing up on the screen every day.
Foreigners are also selling Korea. Okay.
Right.
So let's not.
No, it's almost, but there it's more technical. The selling is,
but this is also technical.
Yeah.
Large part of the outflows are passive. It's because the weight is falling, because India is underperforming, and every single day India underperforms, the weight falls, and passives have to adjust their index in their position to match the index weight.
So the flow bit, it's not active discretionary kind of reallocation, that kind of thing, or that has already happened.
There is that also. But there's a fair bit of passive in this. So it has got a circularity to it. The opposite of this was happening in 2024, which is why India's valuations got stretched. And now it's going the other way, and that's why it's getting depressed. And these the passive thing has gained share globally in total assets under management, and is a dominant dominant price mover, and is not actually going to react to valuations, is not going to react to relative growth opportunity.
Yeah.
It's in the active bit, but the active bit has lost share. So that is, I think, part of the problem. Just going back to the FPI question, of course, relative growth needs to get fixed. Or we can have corporate issuances. But I think we can also do adjustments on the policy front.
I was coming to that.
So, for example, I think make it easier for foreigners to participate. And that is, I think, something that should be done over the next few months, because it takes a lot of time for people to get registered. If I want to trade a US stock, I just have to go to one of the brokers' website, register myself, and I'm up for trading in 5 minutes. That ease of trading that market.
I thought that got. I remember at the CNBC TV 18 forum, the SEBI chairman was there, and I think you and others made that point to him, that the time to registration, the time when you come in, put the application in, and when you're able to participate, that was very, very long, and we got that feedback as well. But that is still an issue? That is still a niggle?
So, for example, in the budget, we increased the limit for non-residents, which includes non-Indians, to buy up to 24%. But they still have to go through a process which makes it rather hard for them to actually participate easily.
Sure.
It's not like a decision I make today, I want to buy Indian stocks and I'm up and ready for trading this morning. I can't take a decision at 8 o'clock in the morning to trade at 9:15. If I'm sitting outside India without an approval. And that I think can change and it can become a lot easier. I know there are concerns around round tripping, etc. But I think there is room for us to make it easier. On the debt side, there's room for us to reconsider withholding tax because debt investors don't do it.
Discussed, so
and,
perhaps.
and debt investors surprisingly have stood. They've not exited. They've actually been buying, and this is despite the losses they are suffering on the currency.
What about taxation, equities taxation?
So taxation, I don't think is a burning issue in my view. The issue about taxation is the whole administrative process to file returns and to pay the tax. It's not about the tax itself. And you know, it reminds me of what my father told me in the 80s when I was first filing my tax returns for the first time. I was still a teenager filing my tax returns, and I was complaining to him, you know, Dad, tax okay, I have to now pay tax. So he said, Beta, you made money, na? So that is why you're paying tax. So never be unhappy about paying tax. The fact is that, you know, a lot of foreigners who probably are not making money now and selling, and so they're not paying the tax, right? So I think tax is not such a burning issue. The administrative process around that could be. But I think easier access is probably the better thing. If you want to choose amongst policies, then I think that's the easier thing to fix. Also, capital gains tax, it can be a tricky thing. You can't do it retrospectively.
Correct.
Because if you do it, suppose hypothetically you reduce long-term capital gains tax to 0, it's going to be a selling avalanche. Because now I can take all my gains without paying tax. Who knows
on
where
the stock of investments that you have?
Exactly. Who knows where the tax will be in 3-4 years? So it can't be done retrospectively. It can only be done prospectively, if at all. So that is, I think, not going to change
the sentiment here and now.
Well, it may, but the reason why it changes things is because then investors say, okay, I don't have to deal with the administrative process around tax. So now this it fits in the ease of doing business. So there are two parts to it. One is the process which I have to deal with on tax, and the other is the process that I have to deal on registration. And we could, you know, make these two simpler and therefore do make it a little bit more attractive.
Rhythm,
but ultimately, it only turns when the relative growth. So we could end up doing this and still not see FPI flows.
Rhythm, stay with us. Allow me to take a quick commercial break here. So take that break. See you on the other side at the Morgan Stanley Investor Forum 2026 with Rhythm Desai. Welcome back. We are coming to you from the Morgan Stanley Investor Forum 2026, sitting down with Rhythm Desai. The dynamic that you put us up for was that other markets are doing very well. Here, relative growth perhaps is a little slow. AI, not AI, and that kind of thing, right? But the other variable is oil and what's happening with this geopolitical situation. And there are the Shell CEOs on record and other top energy firms, etc., saying, well, the world's not recognizing that oil inventories are at very, very low levels, and they need to prices need to reprice to reflect the realities underlying. Do you think we need a bit of a firefighting here and now to defend? I mean, there's the rupee, there's a fair bit of talk around that as well. Do we need to do a debt issuance, a dollar bond, or all kinds of things, right? I mean, the last measure rate hike, the RBI meeting, by the way, is later this week. So is there some firefighting required, or you think this will just fall in place over a period of time?
That's far too many questions into one.
No, do we need firefighting?
No, because you asked some very important things, so I need to address each one of them. So first of all, rate hike doesn't work.
Yeah.
Why? Because India is a growth market.
We're an equity market.
Yeah,
so
the minute you increase interest rates, growth will slow down, the relative growth picture will worsen, the selling will actually aggravate. We're not a yield market, so it's not going to help. And 25 basis points is not going to take you anywhere. So you'll have to be a far bigger rate hike, which is therefore far more punitive to growth. So that's one. The rate hike, if at all, is considered is only because inflation, prospective inflation is rising. So that's the only reason. Is that rising? Yes, it is. Because there is some impact of the currency depreciation, some impact of the increase in fuel cost, and there is also some potential impact of the El Nino and Indian Ocean dipole situation, which could result in a constrained food supply. So if I look out 1 year, it does look like CPI headline is going to nudge past 4%, which is the RBI's target. Now, the RBI needs to decide, do I respond to it today, or do I respond to it once I have a little bit more data on the war, on the weather, etc., to therefore put that price in. So I think this is not the week in which a rate hike is relevant. The second thing is that rupee depreciation is not such a bad thing. The rupee is quite undervalued. If you go past the last 30 years, this is the most undervalued it has been, save for the global financial crisis in 2008 and 2013 when the Fed taper tantrum happened. So the rupee has got to that level. It's actually helping India's exports and it's helping India's growth. The collateral consequences, its impact on inflation, which is what we have to deal with. So per se, the rupee's depreciation was not something that the RBI would have resisted, because inflation was far too low 12 months ago, and therefore reflating the economy, the rupee depreciation is the best tool you have. So that's the bit on the, and then the third bit is on the sentiment impact. So that I think is quite contained. It doesn't look like that the currency is in a free fall, and it's quite contained. So I don't worry so much about it.
The reason I asked you that is because there is a messaging is important, right? Either you are at a time like this curbing money leaving, right? That is one way to do it. I mean, all kinds of talks that LRS limit perhaps reduce, all kinds of things, right? Which is basically keep dollars within the country, stop it from going out, right? And the other is, do a big push to get more dollars in. I mean, open up, right? So it's a pretty, they're two very distinct kind of ways to think about this.
If you take actions which prevent the dollar outflow, it will suggest that there is a problem, and it will actually result in counterproductive outcomes. So you will get the opposite outcomes. So you have to be careful about what you do and say with respect to, and you cannot assuage the market that things are fine, but we're doing this as a precautionary measure. The market is going to react. With respect to dollar inflows, I think if you look at gross FDI, it's actually doing quite fine. India is gaining share in global FDI. It's not losing share. The problem that we primarily face is that with respect to outflows. There are two parts to this outflow. One is the investments that Indian companies are making abroad. That number has doubled in the last 18 months. It's a good thing. Indian companies are finally looking out abroad, buying a manufacturing facility, buying a company here, setting up a factory there, and spreading their tentacles. It's something we've been wishing for many years.
Yep.
The second part of it is the profits that that Ps or venture capital funds are taking. That's a good thing, because if they can't take the profits, they're not going to bring new money. And the fact that they have been able to take profits out is actually going to get more money back into the country. So it's a rather tactical situation, not a strategic problem for India. I mean, I dare say here that net FDI is going to be much better in the next 12 months than it has been in the last 12 months. And the reason is because exits are going to be probably less. Gross FDI is likely to pass the 3-digit mark. So I don't think we need to react tactically. Strategically, completely different ball game. I mean, do you want to open yourself up for more dollar flows? Which is what I talked about. How do you open up yourself for more dollar flows? You make it easier for investors to come in. So that can be done on all fronts. It can be done with respect to debt. So you water down the withholding tax. It can be done with respect to equities. You make the registration process easier. It can be done with respect to FDI, which is already happening. So I think that strategic approach is fine. Now the last point, bonds. Do you want to actually raise a bond? So if it's a tactical thing, I'm not very convinced that it's going to result in the outcome that we desire, which is you want the rupee to stabilize. For example, if that's the outcome you desire. Strategically, it's fine. I mean, Indian companies can always raise capital abroad and bring it to either fuel in fund their investments abroad or at home.
Again. Rhythm, I have two more questions, and I think I have about 2 or 3 minutes left on this conversation. One is, later this year, we have these mega IPOs in the US. Is it going to be a seminal market-turning kind of an event? I think I've asked you that before, but now we're closer to it. I mean, there are already filings, etc., which are happening.
Not according to my equity strategist. So Mike Wilson remains very constructive on US equities because he's seeing a lot of tailwind of earnings growth.
So it's not going to tip over global markets in any way. The supply can be handled in that sense, right? That's the view. Okay, now to the Indian, just to sort of come back to what you like and how to position yourself, right? And we're going to be talking to your analysts through the course of the day. So I wanted to keep this more top-down, macro-ish in terms of just the view. But I was reading your report, and you prefer domestic cyclicals a lot more compared to export-faced sectors, etc. And you say IT can be a dark horse. So why don't you talk to us a little bit about that?
So I'll talk about the first part. So I think we are entering into a very strong capex cycle. Our view is that the investment rate by the turn of this decade will rise from the circa 31.5% today to 37.5%. That's a major boost for corporate profits. So corporate profit share in GDP is likely to go up. That's the 4-year view. And that's what investors should be focused on. It will unfold a lot of opportunities. It will create better loan growth. So the lending companies will do very well. Lending businesses will do well. Of course, industrials will do well. In some parts, the industrial valuations are a little bit crazy. So you have to be careful about the spots you pick. The consumer will do well. So this is, the domestic story. It is quite strong for India on a 3 to 4 year basis. IT services can be very tricky in the near term. The dust is still not settled down on the AI narrative, but my 2-line story is that AI is a great opportunity for new business, like cloud was 15 years ago. And a lot of people were skeptical about cloud. They've forgotten that. Indian IT companies went 2 notches higher. I think AI has the potential to take them 5 notches higher. Because what it does is that it brings down the price points of the engineering solutions that they offer to their potential customers, which means it increases TAM. And it doesn't take TAM up 1x, 2x, it takes TAM up 10x. Because at a lower price point, suddenly even the middle-sized company in America says, I want this solution in my business. So I think it's a great opportunity, but right now we're dealing with cyclical headwinds. We're dealing with uncertainty with respect to tech budgets, so that near term
we're
has
in that
to
flux right now.
Yeah. So it is all a function of how long your portfolio duration is, and the longer it is, the better you are in buying stuff which people are so super negative on, because in the long run that pays off well.
Play the long game. That's the message. And look through this noise, volatility, and you said this is not the worst we've been at. You've seen
Prashant,
Worse
I tell
periods,
you,
worse times.
Indian retail investors are doing precisely that.
Yeah.
They're just looking through all this and saying, we're staying there.
Yeah.
And I think they'll get rewarded quite nicely over the next few quarters.
Well, we certainly hope so, and we'll be there to cover it. Thank you very much, Rhythm, for joining us. All the best.
Thank you.
And 28th conference, wishing you all the best. Thank you.
Thank you.
Hello and welcome to Business 360. I'm Arundhati Ramanan, and here are the headlines that we're tracking for you this evening. An Indian national killed in Kuwait as US and Iran exchange heavy fire. Iran says the attack was in retaliation to US strikes on Qasem Island. Crude oil prices flare up. Kuwait suspends all flights after damage to airport. Amidst all this, President Trump says negotiations continue and Iran's supreme leader is involved. Sensex and Nifty end in the red after a volatile session. Bank stocks buck the trend. Morgan Stanley's Rhythm Desai calls for easing taxation and registration process to attract foreign investors. US President Donald Trump rebuilt his tariff arsenal, proposing fresh duties on 60 economies under trade laws targeting alleged unfair labor practices. Most countries face a 10% tariff. India, Brazil, China and Japan among those facing a higher 12.5% levy. Union Cabinet approves a new fund with an outlay of 10,000 crore rupees to stabilize jet fuel prices. Also clears a 5,000 crore rupees scheme to phase out old trucks and buses in the National Capital Region. Gold replaces US Treasuries as the world's top reserve asset as prices double in the last 2 years. Analysis by European Central Bank, stablecoin company Tether become the single biggest buyer of gold in 2025, surpassing all the global central banks. The mother of all IPOs is here. Elon Musk's SpaceX eyes a record $75 billion IPO next week at a valuation of $1.75 trillion. If successful, Musk could become the world's first trillionaire. Indian companies get access to Anthropic's new AI model, Mythos. Government sources say Indian entities in single digits have been given access to the AI model, which is capable of finding serious cybersecurity vulnerabilities. Anthropic has given access to 200 entities spread across 15 countries. At least 21 people dead and several injured after a massive fire ripped through a building that housed a bread and breakfast facility in South Delhi's Malviya Nagar. Police say several of those killed were foreigners. Sources say the place was popular among foreigners who came to India on a medical visa. DK Shivakumar takes oath as the new Chief Minister of Karnataka along with 13 cabinet ministers. G. Parameshwar takes oath as Deputy Chief Minister. Outgoing Chief Minister Siddaramaya's son inducted into the cabinet. A mutiny against Mamata Banerjee in West Bengal. Expelled Trinamool MLA Ritabrata Banerjee is the new leader of the opposition. Claimed support of 59 Trinamool MLAs in defiance of the party leadership. The top global story this evening, oil prices surge as conflict has widened across West Asia once again, with Iran and the USA exchanging heavy fire. Here are the latest developments. Kuwait suspended flights after several people were wounded in a missile strike at the airport. The foreign ministry said that an Indian was killed in the attacks that caused significant damage. The ministry said it condemned Iran's attacks on civilian and vital facilities and added that it reserves its right to take appropriate measures in response. Iranian media reported the latest exchange began when U.S. forces struck an Iranian oil tanker near the Strait of Hormuz. The attack reportedly damaged the vessel's engine room. The IRGC claimed it responded by targeting a U.S.-Israeli vessel with naval missiles. Soon after, the United States military said it carried out self-defense strikes on Iran's Qasem Island, while Iranian media reported explosions in the area. The IRGC claimed it then launched missiles and drones at what it described as U.S. military targets. The United States said it had intercepted all of these drones. Amidst all this, President Trump said that negotiations continue despite claims to the contrary by Iranian state media. Speaking to an Australian podcast, President Trump claimed Iran's Ayatollah is involved in the negotiations and was ambivalent about lifting the naval blockade. Top U.S. diplomat Marco Rubio claimed that the war is over when grilled by U.S. lawmakers. Rubio appeared before the U.S. Senate committee in what was his first appearance since the war in Iran began. There were several testy exchanges between lawmakers and Rubio during the hearing.
Iran has lost a substantial percentage of their missile launchers, and their economy is far worse today, and I mean far worse today, than it was 6 to 9 months ago. And they are looking at hundreds of billions of dollars of reconstruction costs just to get to where they were 6 months ago.
Mr. Rubio, you keep telling us how we're winning this war. The president keeps saying,
well, the war's over.
Completely annihilated. The war is not over.
Ukraine's army killed at least 7 people after a drone hit a bus in the Russian-controlled Donetsk region. The governor of St. Petersburg said Ukrainian drones hit infrastructure in several districts, causing damage and wounding several people. The strikes come a day after a barrage of Russian missiles and drones killed 23 people across Ukraine as the fighting continues with no clear end in sight. And back home, a volatile session saw Dalal Street end in the red, but off lows. The Nifty closed below the 23,450 mark, weighed down by a sharp sell-off in IT stocks. The Nifty IT index snapped its 3-day winning streak, plunging 5.5%, with every constituent ending in the red. Banks were the outperformers, helping the Nifty cap its losses. Nifty Bank closed nearly 1% higher. The Indian rupee weakened by 44 paise to end at 95.71 against the US dollar. Escalating tensions in West Asia and rising oil prices weighed on the rupee. Other Asian currencies were also under pressure. US President Donald Trump has threatened a fresh round of tariffs, proposing additional duties on 60 countries under laws targeting alleged unfair trade practices. While most countries face a 10% additional tariff levy, India, Brazil, China and Japan are among the nations that could be subjected to a higher 12.5% levy. Ashmit Kumar joins us now with the details. Ashmit, take us through the proposal and its implications.
Well, even before the U.S. negotiators landed in the national capital for negotiating what both sides are calling the final 1% of an interim trade framework, there were concerns being raised in Indian policy circles on what will become of the Section 301 investigations launched by the U.S. Will it lead to additional levies? Well, let's break it down for the benefit of our viewers. First up, Section 301 investigations, that's Section 301 of the U.S. Trade Act. What it does is that it empowers the U.S. government to, number one, investigate practices across other geographies, other countries like India, which adversely impacts U.S. commerce, and subsequently also empowers the U.S. government to levy an additional tariff. Now, importantly, there were 2 such investigations that the U.S. had initiated against other countries, including India. So India was facing 2 301 investigations. So what was the result? Well, at least one of them came out with the result overnight. The result is, the finding against India is that India has not deployed sufficient safeguards to prevent imports from countries which allow forced labor. And as a result of that, it is adversely affecting US commerce, and therefore India is a fit case for additional tariff levy. So what happens now? Well, importantly, such findings were not reserved exclusively for India. A total of 60 countries were also subjected to similar findings. What we now find is that basis the extent of safeguards deployed by different countries, they were put in two baskets. The first basket is the 10% basket, which sees countries such as the likes of EU, United Kingdom, Indonesia, Pakistan, Mexico, Argentina. This is the first basket. India, however, is in the second basket. The second basket is the 12.5% basket. It includes countries such as India, China, Vietnam, Brazil, and Japan. Now, importantly, this is a recommendation at this stage, which is important to bear in mind. This is one of three key aspects that we'll be focusing on. Number one, this is only a recommendation at this stage. It has not been finalized. This will not be an additional levy that exporters will have to immediately be concerned about. This is a lengthy, detailed process as a part of these investigations. First, the request for public hearings needs to go in. Then there are written public comments that need to be filed. Then the public hearing takes place, which is scheduled for July 7th. So again, a detailed, lengthy process is what is expected. Second, there are two such investigations. We've seen results for only one of them that concerned forced labor practices. We have no clue as to what the investigation outcome will be regarding the second 301 investigation featuring structural overcapacity, especially in areas such as solar, steel, aluminum, as well as food processing. We spoke to some experts. They say it's a case of Washington keeping the powder dry to apply pressure at the right moments as a part of ongoing negotiations. And well, speaking of ongoing negotiations, as we mentioned at the very outset, the U.S. delegation is here in the national capital. They're thrashing out the details of the final 1%, the U.S. delegation being led by Brendan Lynch. And now what's important is that India is seeking protection. India's concerns essentially is that India does not want to be in a situation where it finalizes a trade framework, it finalizes on a rate, on a tariff that is to be applied, and then subsequently a few months, years down the road is met with a fresh 301 investigation and is met with additional levies over and above what was agreed upon as a part of this bilateral trade agreement. So concerns being raised, whether or not it will yield any results, well, we'll continue to have our ears close to the ground.
Absolutely. Thank you so much for those details, Ashmit. Now, India and the United Kingdom discussed contentious issues that were delaying the implementation of the trade agreement. These issues were brought up during UK Trade Secretary Pete Kyle's meeting with Commerce Minister Piyush Goyal. In a post on social media, Goyal said that both the ministers discussed economic ties between the two nations, advancing shared business priorities, and further strengthening robust and forward-looking partnership. Commerce Secretary Rajesh Agarwal also met his British counterpart Amanda Brooks. The bureaucrats reaffirmed commitment for regular engagement for effective implementation of the trade deal. The Union Cabinet has cleared a new fund with an outlay of 10,000 crore rupees to stabilize jet fuel prices. Minister Ashwini Vaishnaw said that previous under-recoveries of OMCs won't be covered under the new fund. The Cabinet has also cleared a 5,000 crore rupee scheme to phase out old trucks and buses in the National Capital Region. Gold has overtaken U.S. Treasuries as the world's largest reserve asset by market value. According to the European Central Bank's report, gold accounted for 27% of global official reserve assets at the end of 2025, surpassing both U.S. Treasuries and the euro. Ritu Singh joins us now with all of those details. Ritu, take us through the report.
For decades, U.S. government bonds were the world's reserve asset of choice. Central banks parked their money in treasuries because they were considered the safest and the most liquid asset in the world, but that's changing. A new report from ECB shows gold accounted for 27% of the global reserve assets at the end of 2025, overtaking U.S. Treasuries at 22% and the euro at 15%. Now, it's the first time in decades that gold has occupied such a dominant position in global reserves. Of course, part of the story is simply about prices. Gold prices surged roughly 30% in 2024, another 60% in 2025, and that boosted the value of gold that was already held by central banks. But the other part of the story is that central banks have also been buying gold at a record pace. For 3 straight years, they've bought more than 1,000 tons annually, which is more than double the average before Russia's invasion of Ukraine in 2022. So today, central banks account for more than a fifth of the global gold demand. The reason goes beyond markets. The freezing of Russian reserves after the Ukraine war forced many countries to rethink what really makes a good reserve asset. Government bonds and foreign deposits can be sanctioned or frozen, whereas gold cannot. It has no issuer, no counterparty, and if stored domestically, it remains fully under a country's control. Reserve managers are also increasingly treating gold not just as a financial asset, but as a geopolitical insurance. And it's not just countries buying gold. One of the largest buyers of gold last year wasn't a central bank at all. It was Tether, which is the issuer of the world's biggest stable coin. Its purchases exceeded those of several sovereign nations, showing how gold is increasingly being used as a reserve asset beyond the traditional banking system. Now, India is very much part of the broader trend. The Reserve Bank now holds more than 880 tons of gold, with gold accounting for nearly 17% of its total reserves, and nearly 77% of our gold stockpile is now stored within the boundaries of India, which is up sharply from just 6 months ago. So the takeaway from all this, the dollar remains the world's dominant currency, yes, but when it comes to reserve assets, gold is making a comeback simply because in an increasingly uncertain world, countries and institutions are once again placing a premium on assets that they can hold, control, and trust.
All right, Ritu, many thanks for those details. Now, speaking of gold, the RBI and the government have denied a Bloomberg report that claimed that the central bank sold gold reserves worth $12 billion. RBI rebutted the report, saying its gold holdings remain unchanged at more than 880 tons. And to the big political story of the day, DK Shivakumar has been sworn in as Karnataka's new chief minister. This comes days after former chief minister Siddaramaiah tendered in his resignation. G. Parameshwara took oath as Deputy Chief Minister, and outgoing Chief Minister Siddaramaiah's son has been inducted into the cabinet. The ceremony was held at Lok Bhavan in Bengaluru in the presence of senior Congress leaders, party workers and other dignitaries. And from Karnataka to West Bengal, where Mamata Banerjee is facing a mutiny, expelled Trinamool MLA Ritabrata Banerjee is the new leader of the opposition. He arrived at the assembly and claimed support of 59 Trinamool MLAs in defiance of the party leadership. Earlier in the day, the Trinamool Congress dissolved all internal committees within the party, possibly in anticipation of this development. Yesterday, Mamata Banerjee held a protest in Kolkata, but most of the party MLAs were absent. Speaking to the media, Ritabrata Banerjee made an appeal to Mamata Banerjee, asking her to remain as the main advisor to Trinamool Legislature Party. On that note, it is time for us to head into a short break. But coming up, an exclusive interaction with economist Geeta Gopinath on India's current account deficit pangs, the rupee, West Asia conflict, and a whole lot more. Stay tuned for that.
Welcome to Indianomics. I have among the best of guests from the City Conference. I have with me Geeta Gopinath, former chief economist with IMF, now with Harvard, and quite clearly one of the most followed economists in India. Geeta, thank you very much for this unscheduled stop at the CNBC booth.
Always a pleasure to speak to you, Lata.
Thank you. Thank you very much. Well, I heard you earlier today, and you were saying that the IMF has said this year's global growth can be 3.1% according to them, but there is a downside risk to it. How bad do you think it can get?
So right now we have two stories playing out in the world.
which is one is what's happening in West Asia and the Hormuz and the fact that it's still closed, though there is optimism that there will be a deal soon. That's the negative side. But there is a positive story which is coming from AI and the whole AI build out that's happening that is raising a lot of boats, including not just in the US, but also in like Korea and Taiwan. And depending upon where you are, you're getting affected differentially by these two major trends that we're seeing right now. So for the world economy, I expect that the IMF could, in all likelihood, reduce global growth projections, but somewhat modestly, not by a large amount, because of these two opposing forces. I mean, in the case of India, I think the challenge is that because of what's happening in West Asia and the impact on oil and on gas and so on, that is a negative impact on the Indian economy. It's also inflationary, as we would expect it to be. But then you also have that on AI, the story is not positive. And therefore, that is reducing the amount of interest in terms of foreign capital in India.
No, I take your point that there are downside risks. But the numbers that come out in terms of capex cycle, in the US, the investment, as you said in your speech, 800 billion only in AI from 4 or 5 top companies. And if you took the entire capex, along with data centers and everything, it's some 4 trillion in terms of capex that's going in. Taiwan and China and Korea are putting in their own capex cycle. And the stock market at all-time highs in Japan, Korea, Taiwan, China, not China maybe, US, also creates a wealth effect.
Right.
Can't this multiplier lift all boats? I mean, more export markets for India. You don't think that there is a positive spin-off to the capex?
No, for sure. When you have global growth increasing, which will be the case if you have a lot of investment happening in these different parts of the world, there is absolutely positive spillovers to the rest of the world, and that helps. That is a positive. But obviously, you're going to be better off if you are the country where all this enthusiasm and optimism is there, as opposed to if you're having more the second round effect of that spillover.
Fair point. I mean, at the moment, we are suffering the negative, so I'm trying to look for straws in the wind to see if there's anything positive. Then we come to the India part. Clearly, we are impacted by our current account deficit being higher than last year and capital flows simply not enough to bridge the gap. You have earlier said that, let the rupee take the hit, or so to speak, let it be the balancing factor. It can also become self-fulfilling and start hurting other macros if it goes down more than already 3 standard deviations less than the long-term average in terms of real effective exchange rate. So do you think interest rates should be deployed to protect exchange rate, or are you the, faithful to the flexible inflation targeting?
So I'm actually somebody who believes that in flexible exchange rates, but I'm also very well aware of the risks associated with having the currency move around in, too volatile a fashion and an unexpected fashion. And so therefore, some of the work that I did at the IMF, including creating the integrated policy framework, was precisely for countries to know when to intervene and when not to intervene in currency markets. There are times when intervention is helpful when you see disorderly market conditions. And, yes, when there is a depreciation of the currency, there can be some piece that looks disorderly, and there is some intervention. I mean, the RBI is doing some small amounts of intervention. My basic point is that there is no argument for a whole scale, let's keep the rupee unchanged and unmoving at this moment, because this is a fundamental shock, and having the rupee depreciate will be supportive. If you don't, and you artificially prop the currency up, then actually it can be self-defeating, because foreign investors are also going to think, well, the currency is going to depreciate eventually, and they're just going to stay on the sidelines. So there's always that trade-off. You don't want anything terribly disorderly, but you do want the currency to react to fundamentals. At the current point, I would say that the fundamentals are an important part of the story, which is why letting the exchange rate play its role as a shock absorber is helpful.
Okay. But to the other point, there are the flexible inflation targeting theorists and purists who believe that you use interest rates to curb inflation and other steps for exchange rate. And there are countries like Indonesia which also use interest rate to protect the exchange rate. Do you think India should also think on those lines?
No, at this moment, I don't think there's a reason to raise interest rates to protect the exchange rate. For also the reason that given the negative impact that the war is having on production in India and in terms of demand in India, that opens up, makes the economy slow in terms of economic activity. I don't think there's an argument for the RBI to have to raise interest rates right now, because that would slow the economy even further. So just again, given what we're seeing in terms of the rupee and given the forces we're seeing playing out, the RBI can very much wait and see over time. If there is something showing up that makes you worried about core inflation going up in a dramatic fashion or inflation expectations de-anchoring, then certainly in that case you could use an interest rate instrument too.
Fair point. So use it for inflation. Let me come back to the way in which, as you said, some countries have the negative impact of the Hormuz trade closure rather than the positives of AI, and we are in that club. Our current account deficit at 2% is having a problem getting it filled. India went into marketized or market-driven exchange rates as recently as 1991, 1992. Since then, the world was also kind of, there were no industrial policies. You had China entering the WTO, and therefore the world markets were liberal. But therefore, we could always get money to fill our current account deficit. Now, do you think having a current account deficit itself is becoming a problem? Because all countries are nearshoring, they're building up tariffs. So is it a time now to just go square on current account deficit? Those with current account surpluses have no problems. Yeah. Those with deficits have.
Despite everything we've seen on tariffs, the world still remains very integrated. 75% of world trade is still being conducted according to WTO rules. The US is run one of the biggest trade deficits it's had, and so nothing's changed over there. China is running very big trade surpluses. So I don't think that's the issue. In the case of India, again, a 2% current account deficit is not a big number. What has indeed changed is the ability to finance that deficit. And the fact that there's weakness in capital flows coming into India, either the short-term portfolio flows or FDI, is truly where policy action can be helpful, including in terms of, reinvigorating domestic private corporate investment in India. Again, continuing on the reform path, there should be a good story from AI in India, given India's has grown as a service sector, given the success it's had with its technology, with its highly skilled workforce, with the startup culture that it has, all of that. There has to be new products and new processes that are AI driven that then also provide a good story for why it's a good place to invest.
You've already answered what I was going to ask you. What is the recipe to solve the current account deficit in that case? What more would you say? I mean, we clearly have fallen back on the AI game. We are not up there along with the North Asian countries and China and the United States. What's your sense now? Is the AI story likely to be very negative for India? Or are people being unnecessarily pessimistic and that AI application will give us more jobs down the line?
Yeah. I think there is lots of reasons why India should be on the positive cycle on AI. Yes, right now there is the concern that, especially with IT services exports, that this could be a negative. But things don't always play out as in a way you expect. For example, Philippines, which has a very big call centers, large number of people employed, you've actually seen that call center activity grow in the Philippines because they're using AI to reduce the cost of the service, and that has increased the demand for that service, and that's actually growing the industry, right? So similar positive dynamics can also play out in India. We're also now in a world where immigration is frowned upon in all of these countries, which means I think there's actually going to be more a demand for services outsourcing. including higher end services outsourcing. And India can be a location for that too.
Okay. So what's your sense about India? Is it that the worst is priced in terms of crude and the negative sentiment around AI? Is the growth story still largely intact? Or is this going to be the year of reckoning?
I mean, this depends not just, unfortunately, on what India does, but it also depends on what's happening in the rest of the world. Yes. And I don't think we are completely out of the woods when it comes to the West Asia crisis. It's not been resolved. Hormuz is still closed. And so we could see things going much worse. So, the risk of volatility, the risk that there are further downsides very much is there, even setting aside what India does, just coming from the rest of the world. But I want to leave on a positive note, which is the fact that it's quite impressive how India has been able to manage its inflation, manage its fiscal deficit at the central government level over these last 5 to 6 years, despite all the shocks that have hit the country. And that's positive, and that is one of the reasons why India is an attractive country to invest in. You need to get the other aspects more, to go right, which is including on the AI front, a positive AI story. You have to make it easier to do business in India, deregulation, setting up factories, manufacturing. We're back to now another wave of industrialization in the world, thanks to all the geopolitics and geoeconomic fragmentation. I think this is an opportunity for India to be able to put the reforms, deregulate more, make it easier for people to do business, and I think that would be positive. I mean, that would help bring in capital.
That's a great wrap-up line, but like any market reporter, I want one more. Let me be Oliver Twist. What do you expect from the US Fed? Because this 4.5% risk-free return is also a danger to flows coming to emerging markets. I mean, for India, it's an added reason. Does it get worse? I mean, will rates rise in the US?
The 4.5% interest rates, and more generally the fact that interest rates are higher in the US, are a combination of things, including AI. Because all of these companies that are doing large amounts of AI investments are borrowing more on the capital markets. So there's an increase in demand for that capital that's coming from the private sector. US fiscal deficits are large. That's another source of demand for the capital. So both of those are keeping interest rates higher, including uncertainty around inflation.
And what El Erian pointed out, that this is the 63rd month, April, 3.8% inflation, 63rd month that it is above the 2% target.
Yes, there's also been several years of really one shock after another.
So good chance of, we cannot write off rising.
As of now, I don't think that, I think in the near immediate future, the Fed will probably stay on hold. But again, if this continues and the AI story is generating a lot of economic activity and the big concern is inflation, then we could see interest rates going up further.
Well, so long as the payoffs of growth are good enough, I guess India will be able to, withstand the interest rates as well. Thank you very much, Geeta Gopinath. I know it's an unscheduled stop, but it's really kind of you to spend time with us.
Thank you, Lata.
That's it on this very special Genomics. Thanks for watching.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and with me is Shruti Mishra. These are the headlines from the startup world. The mother of all IPOs is here. Elon Musk's SpaceX eyes a record $75 billion IPO next week at a valuation of $1.75 trillion. If successful, Musk could become the world's first trillionaire.
Vertically integrated sportswear and athleisure company Agilita Sports has raised 225 crore rupees from Nexus Venture Partners and Rain Matter. It is now expanding Sportsyard, its large format multi-brand retail chain that houses brands including Nike, Adidas, Asics and more.
PropSoc, a home buyer advisory platform, has raised $2 million in a seed funding round. The fresh capital will be used to strengthen the company's research and advisory capabilities, expand its team across functions, and support market expansion.
Vijay Shekhar Sharma has joined AWE Funds, an early growth venture capital platform, as an investor. The fund is focused on sectors such as AI, space tech, defense tech, robotics, and advanced manufacturing.
Apple has agreed to submit its India financials to CCI, a key step that could help the regulator determine any penalty in its ongoing App Store abuse of dominance case. Apple has until June 25th to furnish the data while continuing to challenge the findings against it.
Well, those were the headlines we've been tracking for you this evening. The top story today, SpaceX is preparing for one of the largest initial public offerings in history. According to Reuters, the Elon Musk-led company is planning to raise $75 billion, and this will value the business at roughly $1.75 trillion. Rachna Dhanrajani joins us now with more. Rachna, take us through SpaceX's plan.
Well, we've been on this story even before the S1 hit, but the S1 filing told us that SpaceX was serious about the IPO. The roadshow structure tells us that Musk is trying to rewrite the IPO playbook, and now Reuters is reporting that the price is set. $135 a share, $75 billion they raise, $1.75 trillion is the valuation, and all of this is just the opening move in what is going to be one of the most watched IPO roadshows in the history of global capital markets. The terms are out, the bankers are assembled, all 21 of them, and the pitch to investors begins June 8th. And the pitch is going to have to work hard, because what SpaceX is asking investors to accept is not straightforward. In fact, Morningstar's independent estimate puts fair value of the company at around $780 billion. SpaceX is pricing at $1.75 trillion. So it's not just a modest premium, because it's nearly $1 trillion gap that every institutional investor on that roadshow is going to push back on. The financials give them very much the reason to do so. $18.67 billion in revenue in FY25, which is strong, no question about it. But $4.94 billion in the same year in net losses, and losses that widened further in Q1 FY26. The Starlink business, which is the core business, is profitable and growing, but much of the valuation rests on businesses that don't yet fully exist. Starship, orbital infrastructure, Mars, all of this investors are being asked to price in ambition alongside revenue, also not to forget XAI. Then there's the structure of the deal itself, which continues to be unlike anything Wall Street is used to. No price range, no negotiation. Musk has set the number and the market has to meet it, which is 30% of the offering goes to retail, the largest retail allocation in IPO history. 1,500 retail investors will be hosted at a dedicated event on June 11th, the same day as final pricing. So it is all deliberate in a bid to build a shareholder base that reflects Musk's own image. Loyal, retail-heavy, long horizon. That should work until maybe it wouldn't. All of it we will find out when the roadshow begins on June 8th. June 11th is pricing. So between now and then, every conversation between SpaceX, bankers and institutional money managers is going to be a negotiation pretty much. And the negotiation wouldn't be on the price, because that has been fixed. It's on the conviction of how much of this business can actually appeal to the retail investors and institutionals alike. So that is the real story that we will be watching out for now. June 12th is the listing date that has been set. So clearly we'll be looking out for it.
So June 12th will be the date to watch. Thank you so much for all those details, Rachna. Cross-border gifting is emerging as a fast-growing consumer category as more people live, work and celebrate relationships across geographies. Capitalizing on this trend, Zoovis has raised 30 crore rupees in funding, including a fresh investment from Ivy Cap Ventures to expand its AI-powered gifting platform and accelerate its global growth plans. The company, which already serves customers across more than 50 countries, is betting on personalization, trust and rapid fulfillment to redefine the cross-border gifting experience. So what's driving this opportunity and how is AI changing the way people gift, and what does the next phase of growth look like? Joining us now is Vijay Kumar Gadge, the co-founder and CEO of Zoovis. Vijay, thank you so much for taking time out and being here with us on Startup Street. You know, the global gifting market is quite crowded, right? With players ranging from whether it's florists or marketplaces to giants like Amazon. So what is the problem that Zoovis is solving differently, and why do you believe trust is the biggest gap in the gifting market?
First, gifting has to happen on the day of the occasion. Okay, so Amazons of the world are not able to do that. They probably will deliver 30% of the time on the day of the occasion, or maybe a day before, or maybe a day after. So Amazons, etc., will not be able to manage the occasions. You won't even be able to personalize the gifts much. And when the gift arrives, it generally arrives in a brown box or a white poly bag, which is not the kind of experience that you would like to give when you are sending a gift for an anniversary or a birthday, or maybe some other important occasion. So I don't think Amazons of the world solved gifting as such very nicely. And then existing players, while there are flower companies, other companies, there is a huge gap between what is shown and what actually gets delivered. So precision is an issue. Then delivering on time is an issue. So we are solving for these three things. One, making sure the gift looks like a gift. It arrives on the day or time within the day. For example, you want it to be arrived on at midnight on the day of your birthday. We will do that for you. And Absolutely. It will always look like a gift and awesome presentation.
Sure. So you've outlined what exactly it is you do that's different from other companies. You've raised this 30 crore rupees and you're targeting a total Series A raise of 60 to 80 crore rupees, right? What will be the key areas of capital deployment, and what milestones do you hope to achieve before closing the full round?
So there's no special milestones to achieve before closing the round. We are open for fundraise, and we are getting active interest. What we will use this fundraise is for us to build our completely build our tech stack so that we can take whatever we're building as a playbook in UAE to other cities of the world. So a lot of that money will go into developing the tech. We will be investing in expanding our store footprint, and we'll be investing on customer acquisition. So these are the three areas.
All right, and you've already crossed a $3 million annualized revenue run rate, right? What has sort of driven this early traction, and what kind of revenue growth are you targeting over the next 12 to 24 months?
I think growth-wise, I will not be surprised if we hit 3x minimum next Feb, or maybe more. That's what I'm expecting. And what was your next question?
I was just asking you, what is the target that you have for the next 24 months?
3x to 4x growth. Yeah, that's what.
3x to 4x growth is what you're looking at. And where are you seeing most of the demand coming in from? What are the occasions that people are most, ordering for, most likely ordering gifts for?
The most common occasion is birthdays. And I've seen an interesting trend. Get well soon and graduation. These two categories are also doing very well, especially in UAE. So we started our operations first from UAE because UAE has a very good cosmopolitan population and very good testing ground for a global brand, a brand which has global ambitions. So we are able to test our designs, our execution capabilities, etc. here. And so, as I said, most surprising was Get Well Soon, which is doing pretty well. Biggest is birthdays. Second biggest is anniversary.
All right, and you launched, first in the UAE, and now you serve customers across 50 countries. Which new markets are next on the expansion roadmap? And do you see India becoming a major growth market or remaining primarily a source market for global gifting?
It will remain in the shorter term, next 2 to 3 years, it will remain a source market. We have our tech team sitting out of India. Execution happens locally in every market. We are looking at expanding within MENA. So the way we will expand is we will build the playbook here. We will replicate the playbook in one of the cities or countries within MENA, then take it to global. We have our list of markets finalized basis some 52 different criterias, basis which we will go to cities one by one.
Sure, and we're seeing AI sort of reshape everything from shopping to customer service, right? How far can AI go in understanding human emotions and gifting intent? And how is AI playing into your company right now?
So AI currently is a force multiplier for us. It helps us drive precision. It helps us drive planning. It helps us drive customer interactions, drive our cost lower. We are not an AI company, but we do use AI to make sure that whatever we do is better, more efficient, and faster.
Absolutely. So using AI to make everything more efficient. All right, Vijay, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on your journey.
Thank you for having me here. Thank you so much.
All right, moving on, also on what's brewing, Cars24 is making one of its biggest bets yet, not on cars, but on artificial intelligence. The company has launched Cars24 Labs and committed $20 million towards building AI products, backing AI startups, and partnering with frontier AI companies such as OpenAI, AWS, and 11 Labs. Joining me now is Vikram Chopra, the founder and CEO of Cars24. Vikram, welcome back to Startup Street. Cars24 has spent over a decade building a used car marketplace, financing, and automotive ecosystem. What made you commit $20 million and launch Cars24 Labs? What's the big play here?
I think an entrepreneur is always looking for the next big wave. And it feels like I spent 11 years of building Cars24 towards waiting for the absolutely once in a lifetime opportunity. And we think AI is that opportunity that allows us to do, a decade-long work in 1 year, right? So what we did in last 10 years and what we intend to do in the next 10 years, we believe leveraging AI can get done in in a year itself. So we look forward to building an organization that is AI native, built on AI, not using AI as a tool. And that's what led us to start this.
So picking up from what you just said, Cars24 Labs isn't just about internal AI adoption. You're talking about building products, investing in startups, and partnering with frontier AI companies, like I mentioned, OpenAI, 11 Labs, and AWS. Vikram, elaborate on these plans and the timelines you're looking at.
Yeah, I think, while we all are aware that there are hundreds of millions of AI users, but, the primary use case is still chat, which is not even leveraging 1% of the capabilities that AI has. Today, the number of people who are using AI to its full potential are 0.01% of the entire world. So I think the AI Labs is our effort to bring together those people, whether inside Cars24, but more importantly, outside. That includes our partners, the Frontier Labs, as well as other. It could be academia, it could be entrepreneurs who are just really at forefront of being AI native. And we want to just build and bring this ecosystem together so that everybody can benefit. It's still very early days, and we can 100x anything that we do from here.
All right, you're also looking to invest in startups, incubate founders, and support open source AI development. Vikram, why did you choose this three-pronged approach of build, partner, and invest instead of simply deploying AI within Cars24?
I think right now AI is still being fully adopted by a handful of people across the world. So I think the whole ecosystem will benefit. We will benefit dramatically more if we bring the ecosystem of people who are at the forefront of it. That's why we want to do it broadly with the community. not just
Okay.
try to do it alone.
Okay, so Vikram, as you plan to incubate and invest in AI startups, what types of founders or startups are you looking to back? And if you had to identify one or two categories where India could produce globally significant AI companies, what would they be?
I think the new kind of startups are coming with a mindset where their employees are their agents. Their org structure is an agentic org structure, and humans are just an orchestration layer managing those agents. So I think it's a very different mindset altogether. It's exactly these kind of people we are looking at. I think AI is going to just supercharge Indian entrepreneurship. Last decade or so, we have seen software being exported outside India globally. I think now will be the wave of consumer companies building for the world because agents will solve for a lot of our problems while we apply our intellect.
Okay. Also, one of the most striking observations from your AI hackathon was that young builders, sometimes without degrees or formal credentials, were outperforming experienced professionals. Does AI then fundamentally change how companies evaluate talent? Are traditional resumes becoming less relevant?
Absolutely does. I think the way I have worked in my 15, 20 years of work experience, I think has completely been reset. Intellect, the base level of intellect, information availability, everything has been normalized with AI. So what really matters now is just applying yourself, being curious, being, having a taste, having creativity. And I think it like the CVs and the pedigree doesn't matter at all.
Okay. There is, of course, growing concern, Vikram, that AI could eliminate jobs even as IT creates new opportunities. As someone investing heavily in this space, how do you think founders and employees should prepare for this transition? What skills will matter most in an AI-first economy?
I think we are in a new world called flatland, where your experience or your pedigrees don't matter, like we just discussed. What matters is your intent. Nobody needs to do manual work, as more work gets automated, everybody can move to do higher value added stuff. So when entry-level software jobs have gotten automated through AI, what has happened is those people who were earlier doing those jobs don't want to do that manual coding anyway. So they have upgraded themselves to higher value added work, right? So essentially everyone is moving up the value chain.
Absolutely. Vikram, one final question, and if you would quickly answer that. While you are making this AI push, Cars24's core business has also been showing signs of stronger financial discipline. The company reported 27% revenue growth in FY26, significantly narrowed losses and achieved EBITDA profitability in the Jan to March quarter, while also indicating IPO ambitions. So what are the future growth targets, and have you set a timeline for an IPO?
I think the future growth targets are honestly what could be done in 5 years can now be done in a year. So we are looking forward to fully embracing and becoming an AI native organization. We genuinely believe that, the 5-year plan goes out of the window and it can be done in like 5 months now. And that becoming AI native is our #1 priority. And I think IPO as a consequence of that will be an easier thing to do because, AI just fundamentally accelerates our revenue and profitability is what my strongest belief right now.
All right. On that note, it's time for me to wrap up our conversation. Vikram, many thanks for joining us on Startup Street and wish you the very best.
Thank you very much.
On that note, it is time for us to head into a short break. Mumbai Tech Week is in its 3rd edition. Saw over 10,000 founders, techies and enthusiasts at the event last weekend. We bring you a special conversation from the event on the other side. Stay tuned. Welcome back. You're still with us on Startup Street. Mumbai Tech Week is in its third edition, and it saw over 10,000 founders, techies, and enthusiasts at the event last weekend. The conversations were dominated by AI. CNBC TV 18's Rachna Dhanrajani sat down with two of Mumbai's most prominent founders, Akrit Vaish of AI venture fund Activate and Nazara Technologies CEO Nitish Mittersain for a candid conversation on where Indian tech goes from here.
The relationship between founders has significantly enhanced over 3 years. Because we met so often, which we've not done for the last 10 years, 20 years, right? So I think it's been fantastic just to meet each other, exchange ideas. A lot of actual working relationships are emerging from there. So I think that's been great. And I think initiatives like Mumbai Tech Week, which is now in its third year, have been also a very big success.
Akrit, especially you, because you've been a founder, but now you're writing checks for founders. How's the journey been, and where has sort of MTW come in?
Yeah, so I think if you look at some of the work I've been doing over the last 4 or 5 years, I feel very excited about building ecosystems. I think that's really where my energy comes from every morning, which is how do you bring together a bunch of people and, pun intended, activate an ecosystem. So when we put together this organization team, that was the idea. How do you put Mumbai tech on the map? When I spent some time at the government, that was the same idea, which is how do you bring together the AI ecosystem when it comes to national policy? And with the new venture firm Activate, we call it Activate because the idea is to establish and activate the AI ecosystem in the country. And for me, the AI ecosystem includes founders, investors, and then stakeholders and large founders who can help out and really put India's AI story on the map.
Right, like I said, you two come from very different sides. You're running a listed company, so you sit running a company where you're dealing with the regulator, you're dealing with other things. But you went on to advise the government, now writing checks. Do you two see the same kind of India? Do you two see similarities in your point of view when you view opportunities in this country for founders?
Well, I'm obviously still looking at it largely from the lens of an entrepreneur, right? In the trenches with other entrepreneurs. And therefore, you're always navigating ever-changing environment, I must say, especially in our side of the business. But I think it doesn't take away the fact that underlying India as a tech startup opportunity, right, continues to be massive. I really believe India is well on its way to become a startup nation of the world over the next decade or so. And I think everything and everyone that can come together to kind of power this, support new founders, help companies across the entire journey, right, all the way to going public and beyond. I think all of us are trying to contribute to that. And it's a very exciting time to be here in Mumbai, pushing tech.
But majorly, now that we're seeing Anthropic, Google, all these names come to India, today Anthropic has almost reached $1 trillion valuation. That almost comes to, if you put 3 of the biggest companies together in India, then you reach $1 trillion valuation. So where do you see that we're lacking? What are the opportunities that we're sitting on and that could take us to that level?
So if you look at on its own the India AI opportunity, it is meaningfully large. And it is meaningfully large as a relative percentage of GDP for India. So what that means is, let's say folks like Nitish, to some degree what I did with Haptake and others, we built the first wave of internet companies and we meaningfully contributed to India's GDP growth. Absolutely, right? Same thing is going to happen to AI, where at the GDP level that we sit, AI companies in India for India will meaningfully contribute. The difference and the challenge this time, which is causing global perception challenges, like you mentioned, is the goalpost on the US and China has moved so far ahead. This wave of AI R&D and AI capex, that has created this massive capital sort of flywheel for these large US and Chinese companies, which India has not participated in. And that we can go into. Obviously, there are 20 different reasons why India has not participated in that wave. But if you look at the application wave and the kind of companies that will get built now, there we will absolutely hold our ground. And if you will, in few years, if you will just take out application AI companies in US, China, and India, we will definitely be on the same level playing field.
Well, with that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned. Hello and welcome to the Global Dialogues. I'm Shireen Bhan. The on-again, off-again nature of the Iran-US peace talks and continued uncertainty over the Strait of Hormuz have kept the crude oil markets on the edge. Crude prices have seen some wild swings as the US and Iran continue to clash despite the ceasefire, and there appears to be no consensus on an agreement to end all hostilities. The Strait of Hormuz remains one of the world's most critical energy choke points, with nearly a quarter of global seaborne oil trade passing through it. The head of the International Energy Agency, Fatih Birol, had warned a few weeks ago that oil markets could soon enter a red zone as global inventories decline and demand strengthens during the peak summer travel season. He's also warned of the worst energy crisis the world has ever seen. Joining me now to discuss all of this and more is the man himself, Fatih Birol. Mr. Birol, many thanks for joining us here on CNBC TV 18 on the Global Dialogue. And let me start by asking you about the signals that you're picking up from the oil markets at this point in time. The Strait of Hormuz continues to remain blocked. There is no consensus as of today. Oil markets have, of course, been reacting today under $95 a barrel. What gives you hope, if anything at all, and what do you fear the most today, Mr. Birol?
Thank you. Greetings to India from International Energy Agency headquarters in Paris. We are facing a major problem in the energy markets. And as I said, almost 2 months ago, this is the largest energy crisis in the history. We had 3 major energy crises in the last half a century. 1973, a major oil crisis. 1979, another major oil crisis. And 2022, after Russia-Ukraine war, a natural gas and oil crisis, especially in Europe. So the amount of oil and gas the world has lost, combined in this 3 major crises, is less than oil and gas we lost in this very crisis of Iran war. So we lost huge amount of oil, huge amount of natural gas, and this would have major implications for the global economy, especially in Asia, and within Asia, developing economies. So my biggest worry is the following. When we entered this crisis, we had buffers. The IEA has said that before the 28th of February, there was a lot of surplus, there was a lot of oil in the markets, pushing the oil prices down. And after the crisis started, we have been using this surplus plus the inventories, the stocks that the governments and companies have, and all this gas, oil we have already is now diminishing. The inventories, the stocks, the money in the pocket is diminishing and not new money is coming in. We are coming at the bottom of those. And as I said, if we are not able to see fully an unconditional open of Strait of Hormuz by end of June, July and August, the travel season around the world in many countries are starting, the flights and the cars and the buses. We may be entering the red zone for the global economy, especially those in Asia.
You know, you talk about entering the red zone in July and August, which is when you expect travel demand to rise. And you talked about an unconditional opening of the Strait of Hormuz. As things stand today, Mr. Birol, how likely is that scenario? We've seen Iran and Oman talk about a mechanism being put in place. They refuse to call it a tolling structure. But do we now need to grapple with the reality of that new mechanism coming into place? And what will that mean for the oil markets?
So what the oil markets want to see, what the energy actors, players want to see, that a state is open fully and unconditionally, which means that the tankers can travel without having any questions about security and without paying any fees, because the international law, the maritime law, tells us that the international travel in the waterways is free. So, of course, it's up to governments to decide what they are going to agree, under which conditions this agreement will be made between the different parties. But it is important to give the markets the confidence that the tankers can travel without any security questions. And this is, of course, not an easy task. Many people think, I talk with all the actors, both governments and the industry, many people think if it is closed once, it may be closed again. So this is something that I think the countries around the world need to give it good thought. What are their energy strategies, priorities in the future, and what kind of lessons they need to draw from this very situation.
I'll come to the lessons in just a second, but if I can talk to you about immediate next steps, Mr. Birol. You know, the 400 million barrel emergency release was the IEA's largest ever. You've said that it reduces the pain, but it is not the cure. We've also seen strategic reserves, for instance, for America being drawn down quite significantly. Now, are we looking at the possibility of another tranche from the IEA, and what will that mean in terms of the oil markets if, in fact, you go through with that?
So when I announced on 11th of March that we are releasing 400 million barrels of oil to the markets, it is historic. It is we have made several releases, but this is the largest by a big margin. We have seen that as soon as the markets saw that this oil is coming to to the markets to calm the markets, the prices went down by about $20 US. It provided relief. It was very good. And it was a unanimous decision of our member countries, and many countries who are the accession countries to are yet to be a full member, such as India, gave a strong support. And here I want to thank Minister Puri for his strong support. Now, this 400 million barrels is big, but it is only 20% of the reserves we have. 80% is still in the pocket. And we will see, we will assess the market conditions, and if we think it is necessary, we will be ready to act immediately. So it is up to markets, up to market conditions. If we think there is a need for that, and we are ready to act immediately and swiftly.
If I may double down on that, Mr. Birol, you said that you will act immediately if the conditions so arise. What could trigger the move on the second tranche of the reserves being activated? What could those conditions be that will force your hand in some ways?
Now, we are discussing this in the last few weeks, few months, almost on a daily basis with our member governments. We need to come to a conclusion that the disruption came to such a level that it is now time to go ahead. But as of now, as we speak now, I don't think that we are at this stage yet. But we are monitoring the markets momentarily and very closely. If we believe it is the time, we will definitely go for it. But at the moment, we are not there.
Let's also understand what the process of rebuilding will look like and what timelines we're talking about, Mr. Birol. Assuming that an agreement were to be reached between the US and Iran, that the strait were to reopen, in the next few weeks, what will that mean in terms of rebuilding, in terms of what is already stuck, the oil that's stuck at the Hormuz? What will it mean in terms of rebuilding infrastructure in key markets like Qatar, etc.?
It will be, in some cases, in some countries, it will be easier. Those countries who are able to store the oil in the major storage facilities, and the countries who have strong financial muscles and technical capabilities. For example, Saudi Arabia, I think, will move very fast. Emirates can move also fast, and some others. But some countries such as Iraq, I am worried about Iraq because Iraq's oil storage facilities are not as big as the other countries in the Gulf region, and there are many shut-ins of the fields. It may take some time, and also as I said, the financial capabilities of the countries are important. And it will be also depending on the damage that the facilities have witnessed, such as the ones in Qatar. I think it is rather naive to expect that the Qatar LNG terminals will go back very quickly where they were just before the war. So if it is, to sum up, if the Hormuz Strait is open, if there is a peace, it is an agreement, it will be rather naive to think that the next day everything will go back where they were before the war. It will be a rocky process, volatile markets for some time to come.
If you're saying that it will be a rocky process, it will continue to be volatile even if the strait opens and there is an agreement, what does that mean in terms of oil prices? We've seen wild swings from 144 now down to about 95. What do you see as the possible ceiling? What do you see as the possible floor?
So I will not mention any specific price levels, but first of all, I would like to remind all of us that some observers say the oil prices are low, but they are not low. They are, let's remember that they are at least $30 higher than where they were just before the war has started. And it is already being a major pain on the economies of many oil importing countries, especially developing countries, and we will see they are going to push the inflation numbers up in several countries, especially when the currencies are not so strong. Looking at the next few weeks and months, I believe it will be rather a transitional period, and it will be not easy to get all the Middle East oil, which exported more than 20% of the global oil to the rest of the world, to see that everything will be easy and the prices will come down the next day. I think we need to expect that the prices will be at these levels for some time to come. And I am only worried, once again, that the Strait of Hormuz is not open before the end of June, before the inventories are going completely to the bottom, and before the travel season in many parts of the world starts. Otherwise, we may well see even higher prices than today.
Let me end, Mr. Birol. I know you're out of time, but let me end by asking you about the future as far as the OPEC is concerned, especially with UAE exiting the bloc. What do you see as the future as far as the oil bloc itself is concerned?
I mean, it is, of course, it is up to OPEC countries to decide what they are going to do. And I have recently, when I was in Vienna, meeting the Prime Minister of Austria for several issues, I had the opportunity to visit the OPEC Secretary General, and I think it is important that all the parties in these difficult days have a good, sincere dialogue, because this is a situation that we don't have the luxury to have tensions between the producing countries, consuming countries, and I think that it requires a good communication, good dialogue among the parties around the world. Emirates, they made their own announcement. The colleagues from the Emirates, both the minister and the other authorities, that they chose this way, and they are going to increase their production in the next years to come. And I also have good contacts, good coordination, and good dialogue with the authorities and the government of United Arab Emirates.
Well, Mr. Birol, always a pleasure. Appreciate you joining us. We hope it doesn't get to that scenario of the red zone that you spoke of. And we hope that there is a breakthrough in the talks that are currently ongoing. But appreciate you joining us this afternoon to talk to us about all things energy. Always a pleasure. Thanks very much for joining us on the Global Dialogue.
Thank you.
Well, that is Fatih Birol of the International Energy Agency. Telling us very clearly about what the possible pain points are likely to be. In his words, it would be naive to imagine that even if there were to be an agreement between Iran and the US, that oil prices are going to drop significantly, as is being claimed by President Trump. But of course, also highlighting that there needs to be safe, secure and unconditional movement through the Strait of Hormuz. The red zone that he talks of is the July to August period, when travel typically is expected to pick up, and that could put pressure on demand. Supply already constrained. Importantly, the IEA is not looking at releasing the second tranche of the strategic reserves. Remember, they've already done a tranche, the first tranche of a historic 400 million barrels, but they don't feel the need to act on the second tranche just yet. We will take a break here, but there's a lot more coming up for you on CNBC TV 18. Stay tuned. We're back with more right after this.